the investigation was unrelated to the business, but did find action inconsistent with its business ethics policy. Board member Ronald Sargent will serve as chairman and CEO as the company searches for McMullen's replacement. Kroger shares were down about 3% today. That's what's happening here in the U.S. Back to you in Mumbai.
Well, some flashes on your screen. Canada has announced retaliatory tariffs on the U.S. after the tariff announcements by U.S. President Donald Trump that take effect today. Now, there are more details awaited on this, but based on what reports are suggesting, it will be done in two phases. The first one will be a 25% tariff on orange juice and of the other products, but we'll await more clarity on that. But for now, Canada has announced retaliatory tariffs on the U.S. and Justin Trudeau, the outgoing Canadian Prime Minister, has issued a statement on the same. We'll get you more details as they emerge. But staying with Wall Street, let's also listen to market experts and economists to give their views on how the tariffs that are soon to come into effect could impact the economy.
Tariffs are an adverse supply shock. It's bad for growth and it's bad for inflation. So if we just take the tariffs that are under discussion now, 25% on Mexico and Canada, another 10% for China, that we think takes about 0.7% off of GDP growth, just the arithmetic of that, and adds about 1% to inflation. So you're looking at an effective tariff rate that could go to 8 to 9%. But remember, we're also talking about still an aluminum tariffs. And on those tariffs, no exemptions have been announced. They're universal. And I think that's what the market is looking for. The tariffs have been threatened for foreign policy purposes initially, but now you're moving into specific products.
I think in the short term here, it creates a lot of uncertainty about earnings, and we are seeing analysts lowering their earnings for the first quarter. So they're obviously reading the newspapers, reading the headlines, watching you guys, and recognizing that right now, the way tariffs are going, it's not good for the economy. It's not good for earnings. We tend to pay a lot of attention to what's going on in Washington, and Washington matters, but we often forget to recognize how well the economy does despite Washington. And that's kind of the thesis I have, is that the economy is going to prove to be resilient, notwithstanding Washington.
Well, all of this hit the U.S. markets overnight, but how will all of that impact our own markets? We'll tell you on the other side of this short break. Stay tuned, we'll be right back.
You don't get with traditional mutual funds. And SIFs themselves can be either open-ended, meaning you can enter and exit anytime, or close-ended, meaning there's a fixed tenure. But even for closed-ended SIFs, SEBI says that they must be listed on stock exchanges so investors have a chance to exit early if needed. Now, SEBI hasn't just opened the gates and said launch what you want. There has been a clear rule set for AMCs who want to offer these funds. Only AMCs with at least 5 years of track record are eligible to launch SIFs, plus they need to manage at least 5,000 crore rupees in existing mutual fund assets to even qualify. This ensures that only experienced players with rock-solid management systems get to handle these advanced funds, because these aren't plain vanilla products meant for casual investors. So who should even look at SIFs? If you're already comfortable with the markets, maybe you've been investing for a few years now, you understand terms like hedging, short selling, and global macro strategies, and you want to go beyond mutual funds but without committing 50 lakh rupees to a PMS, this could be worth exploring. But remember, flexibility comes with higher risk. These are not simple set and forget products like mutual funds. They're designed for investors who actively want to participate in more complex strategies and who understand the risk involved. This is a new space, so keep an eye out for which fund houses launch the first SIF and what kind of themes and strategies they bring in. And
user development fee is charged by an airport operator to passengers to bridge the revenue shortfall.
This fees varies across airports and the amount is approved by the Airports Economic Regulatory Authority or AERA. Now, GMR Airports operates Delhi Airport, Hyderabad Airport, Goa Airport, Nagpur and Bidar airports. It is also developing the Visakhapatnam International Airport. Now, when it comes to UDF, Delhi Airport stands among the lowest at a flat fee of 129 rupees for domestic and international passengers as compared to Bengaluru, Hyderabad, Chennai, Kolkata and Ahmedabad. Now, GMR took over Delhi Airport in 2006 and the tariff proposal that it has submitted now is the fourth control period from April 2024 to March 2029. Here, DIAL has proposed UDF for departing as well as arriving passengers on peak hour and non-peak hour basis. So, for domestic passengers, the proposed fee is at 405 rupees during off-peak hours and 610 rupees during peak hours. For international passengers, departing economy class will pay 810 rupees and business class will pay 1620 rupees. Now, please note that these rates are in proposal stage and the final tariff will only be determined.
Welcome back, and our research team is ready with how the trade setup looks like, the stocks that are likely to be in the news, and of course the setup on the FNO side as well. First up, Vinny is joining in to get all the market cues we need to watch out for. Vinny, good morning. A potential gap down start, but what are the other cues you're watching out for today?
Absolutely, a gap down start is what we were watching out for. But yesterday wasn't anything exciting as well. It started in the green and then went up to the red side, though recovered from the day's lowest point is what we saw coming in for the Nifty. Almost 100 points recovery at the end of the ended in the green as well. So that was some bit of a green that we saw coming in from the Nifty mid cap side. But small cap saw recovery, but that ended on the red side, and small cap saw a decline of around 0.3% approximately in yesterday's trading session. Now FIIs, they continue to sell. 4,788 crores is what FIIs have sold, while DIIs have bought around 8,791 crore. The intensity of selling versus the previous sessions for FIIs, slight bit of that subduedness we saw, but continued selling is what we've seen coming in for the FII. So that is something that we're watching out for, because if that continues to sell, we're seeing that pressure coming in on the markets. Now, factors to watch out for: the US Feb manufacturing data that came in, the data overnight that we saw coming in, that was not anything exciting, subdued data that came in, and that is something that is impacting the markets. A bit of a subduedness in the US market is also what we're seeing in terms of the data points. Now, tariffs that were announced by Donald Trump on Canada, Mexico, China, that take effect today. So that uncertainty, weak sentiment continues. And overnight also what we got in terms of an update that US has halted the military aid that is given on Ukraine, and that is what is something that could see an impact, and that is why overall that weak sentiment continues in the market. We're expecting a gap down start is what the Nifty implied is indicating for the Indian markets.
160 points lower is what the implied open is suggesting. Vinny, thanks a lot for that. Over to Vamakshi now, who list out the stocks you need to watch out for today. Vamakshi, good morning. What's on your list?
Good morning, Hormaz. Let me first start off with IEX. The stock will be in focus on the back of a monthly update. In the month of Feb, electricity traded volume saw an uptick of almost 9% on a year-on-year basis. The day-ahead market, that is the DAM, volume was up nearly 14% year-on-year. Real-time electricity market was also quite strong, with the volume seeing an uptick of almost 23% year-on-year. But it is the market clearing price in the day-ahead market that saw a downtick of almost 11% year-on-year. RBL Bank is another counter that we will be watching out for, and that is because GST authorities have initiated search at 3 offices of the bank in Maharashtra. The bank says that the proceedings are ongoing and they are cooperating in providing data as per the request placed. Ask Automotive will also be in focus. They've signed a technical assistant and license agreement with Kyushu Yanagawa Seki Corporation. This is for cast wheel production. InGrid Investment is another counter we'll be watching out for. Its arm has received a letter of intent for a project worth 195 crores from REC Power. And lastly, keep an eye out on Godrej Properties, because they've gone ahead and cancelled the 2000 agreement that they had signed with TCM Limited for a land parcel in Kochi. However, the company maintains that they see no material impact on the company's financials, operations, as well as other business activities.
Actually, thanks a lot for that. And finally, Manglam joins in with cues from the FNO space. Manglam, good morning. A potential start below 22,000, but what's the FNO data indicating?
That's exactly right. If you look at the markets yesterday, there was a pullback from the lows in the second half of trade yesterday, specifically for the Nifty. And it was led by the Nifty IT index. Remember, the IT index was an underperformer in the previous trading session, did well in yesterday's trading session. It was the Nifty Bank which was slightly under pressure. The low yesterday, 22,004.7. That is something that we'll keep an eye out on, as the GIFT Nifty is indicating that the start could be below that low as well. And were we to break that, it would be breaking 22,000 for the first time since June 2024 itself. The broader markets, they recovered a little better in yesterday's trading session. The Nifty Next 50 and the mid-cap index actually ended mildly in the green. And that was largely because of strong domestic flows that came in a little over $1 billion, 8,700 crores. And this compares with FII selling of close to 4,800 crores. And if you look at the net institutional flows at 4,000 crores, that's the highest that we've seen in at least a month, X of all block deals, etc. The FIs also bought in index futures, close to around 150 crores. They had a little more longs than shorts, and their long exposure now stands at 16%, with shorts at 84% itself. They bought more calls than puts, and at the same time they also sold more puts than they bought puts. So that's telling you that they were hoping for some sort of support that came by. So today's low will be extremely crucial. We open with a gap down. Do we see a bit of a recovery from there or not? Because there are a lot of writers at the 22,000 put and the 22,100 put. On the way up, however, we will see some resistance around yesterday's high of 22,250 thereabouts, but that seems a far way given the given the sort of gift nifty start that we're seeing. A couple of stocks I'll be watching out for. We have Angel One and BSE, both of them under severe pressure. Do we see some turnaround out there, or maybe with the weakness in the market, weakness continues in these capital market names too?
Indeed, we'll keep an eye out on all of this. Mangalam, thanks a lot for that. And even as the market continues to remain under pressure, the question that is being asked the most, and pertinently today as well, are we at the bottom or close to the sell-off ending? Well, that's exactly the question we posed to our market editor Ramdev Agrawal of Motilal Oswal Financial Services, and this is what he had to say.
Earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. So I think we have set the mood. One, correction is done. The P multiple, which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So I think it is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. I think the divergence between mid and small is too high. Let's see how the market does. Maybe mid will keep correcting and large will make a move. Or large will make a move, but mid will stay there. And then it will catch up. So market does its own stuff. I think most important thing is now, don't wait for because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Now, this is a time stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay. So if you like certain stock, and that stock is available at your dreamy price, and it has gone below that, don't hesitate, start moving into the market. In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you got seeing that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected. Capital market is as the sentiments gets hurt in last 5-6 months, there is a decline. There are restrictive, say like from daily F&O, now you have come to weekly expiry. So obviously there is a almost 30-40% decline in the overall F&O volume. So we got expanded too much. Between 21 and 24, we got expanded too much, and then the regulator got scared and they said, we want to contain it. And that's what they did. And effect of that is visible. I mean, Nitin of course knows the books. So that's what is happening in broking. That's what is happening in slowdown in now. AMC flow was very good till last month. This month, I think there is somewhat, it is slower.
Ramdev Agrawal there speaking to CNBC-TV18. Some flashes on your screen again. The Canadian Prime Minister in his statement saying that the tariffs will remain until the US levies are withdrawn. And so these are retaliatory tariffs imposed by Canada on the imports coming in from US. We'll get you more details as they emerge. But speaking at the Mobile World Congress, Bharti Airtel chairman Sunil Mittal has called for a reset of the way the global telecom industry functions. Now, he said that the industry is bearing the burden of building the world's digital infrastructure with very low returns on capital. Now, Mittal also said that he preferred collaboration compared to competition in the industry and pushed for consolidation among operators to enhance service quality, especially in rural areas, and to reduce operational costs. We'll take a short break. Up next, we get you cues from the commodities market. Manisha Gupta joins us on the other side. Stay tuned.
Now, DIAL has justified the demand, citing insufficient cash flows and consecutive losses totaling 1795 crores from FY21 to FY24. They are projecting a 1794 crore loss in FY25 as well. With a debt of 14,786 crores and a declining credit rating, the airport told ERA that raising funds for future projects has become difficult. It claims to have invested 12,500 crore rupees from 2019 to 2024 in new development projects like Terminal 1 development, 4th runway and Eastern Cross taxiway. The airport said that there is a significant need for capital expenditure for further developing the airport's infrastructure, and which is why the need for higher user development fee.
What next for Donald Trump and Ukraine's President Zelensky after the massive showdown that the entire world witnessed at the Oval Office? Before this, America and Ukraine were planning to sign a minerals deal. But then we all saw what happened. Now, in the latest statement, Zelensky says Ukraine is ready to sign that deal.
If we agreed that a minerals deal with the US will be signed, from our side, we are ready to sign. I honestly think the United States will be ready as well.
So what is this deal all about? And before that, why does Trump want Ukraine's minerals? Trump claims that US military and economic aid to Ukraine is almost about $500 billion, and he wants the US to have access to Ukrainian minerals equivalent to that amount. However, Ukraine disputes this figure. Even the German think tank, the Kiel Institute, estimates that the US has sent $119 billion in aid to Ukraine. Trump has argued that such a deal would help US taxpayers get their money back for the aid provided throughout the war. Additionally, America is keen on securing Ukraine's mineral resources to reduce its dependency on China, which controls 75% of the world's rare earth deposits. This is according to the Geological Investment Group. Now let's return to the deal itself. Both Ukraine and the United States had agreed to give the US access to Ukraine's rich mineral reserves, with revenues diverted to a joint US-Ukrainian fund. Ukraine holds approximately 5% of the world's mineral resources, which Trump seeks to secure. However, not all of these resources are currently exploited or easily exploitable, and some lie in territory which is occupied by Russia. Ukraine is known to be the producer of several critical minerals. It ranks as the world's 8th largest producer of manganese, which is according to the World Mining Data, the 11th largest producer of titanium, and the 14th largest producer of graphite, which is essential for electricity.
Welcome back. Now, US President Donald Trump has also paused military aid to Ukraine following the spat with Ukrainian President Volodymyr Zelensky. According to Trump administration officials, Trump will pause all aid until he determines that Zelensky is committed to good faith negotiations for peace. The move comes after Trump criticized Zelensky for not being sufficiently grateful about the US backing the Ukraine in the war against Russia. And Manisha Gupta now joins us with all the updates from the commodity space. Manisha, good morning. It seems that the OPEC is finally biting the bullet. How has that impacted crude prices?
Oh, well, absolutely. We've seen 2% of a decline in the overnight markets, and that has brought the crude oil prices to a 12-week lows as we stand. OPEC has said that they will increase output in the month of April. And then the U.S. tariffs could also hurt the global economic growth. Oil demand is something that the markets are dealing with. U.S. also could give sanctions relief to Russia. Russia, remember, is the third largest oil producer in the world. And if the Russian oil also starts coming into the market, well, that really is what is impacting the prices at this point in time and is the reason that we've seen the U.S. crude prices now decline below $70 a barrel. But the declines also have come in for some of these metal prices also. The trades are choppy on tariff uncertainty, while there has been support from strong China factory activity for the month of Feb. But the kind of statements coming in that Mexico will propose matching tariffs to China, more tariffs of 10% on China would perhaps take effect from today. So there's a lot of tariff tension, which seems to be weighing on many of these base metal prices. So you have copper, aluminum trading in the negative, and iron ore prices now at a 6-week lows.
Iron ore prices at a 6-week low, oil prices at a 3-month low. And will that oil prices have an impact on our oil marketing companies and other oil sensitives? We'll wait and watch. But with that, it's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call sets you up for what promises to be an action-packed day.
Ukraine also possesses 20% of the world's estimated graphite resources, according to France's Bureau of Geological and Mining Research. Additionally, it claims to have one of the largest lithium deposits in Europe. However, there's another interested player in this game, Russian President Vladimir Putin. He has suggested that he's open to cooperating with the US on rare earth minerals and has expressed support for US investment in Russian-occupied regions. While Zelensky has expressed confidence that relations with Trump can be salvaged and that the Trump administration won't cut off assistance to Kiev, the world is closely watching Trump's next move.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live from the CNBC-TV18 Multi-Rose File Studios, and the roller coaster continues. We'll get into the details in just a bit from now, but I think it's sufficient to point to Surabhi's dress color. Yesterday it was green, today it is red. So, morning, guys.
I had nothing to do with it. It was selected by our very able wardrobe team. But this is all I've been hearing since morning, that it's this wrong color that I've picked for the day. Well, it's like you embrace what's going on. Beyond the point, you just embrace it. So it's fine. Red, green, it's all part of life.
So yesterday you wore green, right?
Yes.
And markets were red. So
mostly ended red. Flat, no? Recovered from the opening gap.
Yeah,
I don't know. Anyway.
But today is going to be an interesting trading session because India has underperformed and now you have the global markets that are in a tizzy. So how much of the bad news is already in the price for India? Well, today is going to be that crucial session, I think.
Absolutely. And I think, in the US, the debate still continues because, and that debate was interrupted last Friday when the market bounced very strongly. The debate all of last week and maybe the last fortnight has been that whether the US has entered into a bit of a correction. And it looked like that. Then Friday, the market bounced about 2.5–3%, right? And a lot of people went over the weekend were saying, well, the market's being bought into, the dips are being bought into, etc. So, but last night, look at what's happened. The market fell again, the US equity market, that is, down about 1.7 on the S&P, NASDAQ down about 2.6–2.7%. VIX was back above 22, which is a 16% jump, the CBOE VIX index. 10-year yield lost 5 basis points. I mean, it's remarkable how quickly bond markets have repriced, right? Bond prices have gone up, yields have fallen, and we're at about 4.16%. I think we've lost maybe 50–60 basis points in the last 1 month or so. So it's just incredible. And that's essentially pointing to nothing but fears around tariffs and what that will do to growth in the US. Dollar index about 106.56. Data which came through from the US continues to be sobering. And over the last 10 days, high frequency data starting with US services PMI. We mentioned that number with regards to the Atlanta Fed GDP now. That's a GDP projector for the first quarter, which had turned negative. I think it's turned even more south. So, stagflationary concerns on the back of ISM manufacturing data, which came out last night. That's the latest one. And why? Because prices paid sub-index surged. So prices went up. And new orders and employment sub-indices within the ISM manufacturing, that actually fell. And, prices are higher, growth is lower. And hence fears about whether we are entering a bit of a stagflationary zone, not using that word lightly, but it's just sort of, something which kind of was the overlay, at least last night. Now, in terms of tariffs, and they come in thick and fast as well. Today, of course, is the day when tariffs go into effect, Canada, Mexico, China, and looks like they are going into effect. So China's extra 10% tariffs on top of the 10% which is already present is going into effect. And, the executive order was signed. So the order said 10%, it's been replaced. The 10 has been struck off and instead 20 has been put in. So, the 10% extra on China has come through. By the way, the response from China has been, the fact that they've obviously strongly opposed it, but there is no action yet. They're saying, well, we are let's get into a dialogue. I mean, it's more conciliatory in that sense. Before a dialogue, will China want to do something it's obviously going to be a negotiation. So we'll see. Trump, of course, also confirmed that 25% tariffs on Canada, Mexico are coming on Tuesday as well. There was a specific time which was mentioned, I think our time 10:30, but it was given earlier that these tariffs will go into effect. So we'll see if last minute something comes around. But I think Canada has already retaliated and imposed tariffs on the US. So again, a very, very fluid kind of situation out there. It's all, of course, taking into effect today, all these tariffs, etc. And remember, China, of course, is the big one. It was widely anticipated. But Canada and Mexico are some of the closest kind of sort of trading partners for the US. And they're next door neighbors as well. So the impact actually perhaps could be significantly large if these tariffs are put on for a long period of time. Oil prices about 2.5% lower. We're about 71. And this is not because of Russia, Ukraine. There was an OPEC Plus delegate who announced that the group will increase oil output in and beyond April. There's more oil in the market perhaps. In India, just to sort of tie in the levels, etc., it's a lower start, and I'll refer to the GIFT Nifty in just a bit. We are still waiting for a positive daily close. Look at the close yesterday, almost there. And of course, from the lows of about 22,004, it was a decent bounce back. This morning is going to be, of course, lower. So a low of 20, which is yesterday's low, which is 22,004, is an important level. We'll sort of work with that first up. Below that, as I said yesterday, between 21,800, 21,900, there were multiple lows which were made and respected in the middle of 2024. So between 21,800 to about 22,000 is the broad support zone. And of course, the upside, the 40-hourly exponential average, which is 22,400, is the resistance. Nifty Bank yesterday tested the previous low of 47,844 and then bounced a little bit. Resistance for the Nifty Bank stands at about 48,675. So we'll see if the levels on both these indices are respected, despite the very, very red screen that we've got globally speaking. So 160 points lower on the GIFT Nifty. Surabhi.
Oh, absolutely. It's this tariff trauma that's getting a little real now, isn't it?
Yeah.
Because, I mean, when Trump took office, there was all supposed to be, a brinksmanship, but now those numbers are becoming a reality. And that's what sparked what is not just a global equity rout, it's a global risk-off across asset classes, whether it's bonds, whether it's the moves in the dollar, or whether you're looking at what's happening, for instance, in cryptocurrencies as well. And I'll come to that in just a bit. First, let's look at the Asian market rout. Now, markets are down anywhere between about 0.3% in Singapore. Singapore is actually relatively the best market in the region right now. To Japan, the hit on Japan is quite big, almost 2% there. The Hang Seng's opened weaker as well, 1.5% on the lower side. Actually, on tariffs, I just want to point out, what the U.S. president also said, and maybe why the Japanese market's taking such note of it. He went on to, slam both China and Japan, and he spoke about how they're using currency as a tool to perhaps enhance their export value. The quote is on your screen. He says, I've called President Xi and leaders of Japan to say you can't continue to reduce and break down your own currency. You can't do it because it's unfair to us. So that's what he's really talking about. He's saying it's difficult for us to make our Caterpillars and our tractors here in the US if you're using currency to your advantage. And, a lot of these headlines coupled with the reality of tariffs, it's really hitting the Asian region today. Okay, let's talk about why this is not just an equity sell-off. Like I said, even, cryptocurrencies, despite that announcement that came in on the strategic crypto reserve that Trump is going to make in the US, despite that, this whole uncertainty is hitting cryptos as well. Markets are down anywhere between 4-5% to almost 9%. The overnight tumble on Bitcoin was 9%. They're again down about 3%, 4% this morning, all the crypto assets. To add to the mix, you've got, of course, the Ukraine issue. And now it's official. This morning, we've got news that White House has decided to stop all possible military aid to Ukraine. So it's very, very clear that this is not sort of ending anytime soon. So that geopolitical risk premium is continuing as well. Talk about some data out of Asia this morning. We've got the unemployment data from Japan. It's all right, slightly weaker than what the market would have liked to see, perhaps. Unemployment rate at 2.5%. The estimate was 2.4%. There's some data out of South Korea as well on retail sales, and that's also slightly weak. The key to watch is going to be the big Chinese meeting that kicks off this week. In fact, today we're talking about the parliamentary gathering, which is in 2 phases. And tomorrow is going to be the really important one because the National People's Congress, will start. And ahead of that, the expectation is that A, they'll lower their inflation estimate for this year to 2% because it's deflation very clearly entrenched in China. And B, the growth number is supposed to be around 5%. That's what the market's working with. But the bigger issue is, will China announce something more significant in the face of the tariff threats that are so real? Now it's 20% tariffs from the U.S., additional tariffs since President Trump came over. So let's watch for this. Now, for the Nifty, we're all bracing for that gap down, no taking away from that. I was looking at the election day lows, just for what it's worth. So we're 226 points away from the close of that day, June 4 close, 226 points away. That could happen, who knows if it happens today in the gap down. And then the actual intraday low, which was 21,281. That's about 3.5% or 3.75% away from where we are. So let's see. These are sentimental levels. You don't know if the market's indeed done with this bear hug or not. Doesn't look like it. Fund flows finally to round it off. Nothing very happy to report here. The selling continues. 4,800 crores of selling. Domestic buying is very, very heartening. Look at that number. 8,800 crores of domestic buying coming in. trying to provide support to the market. Let's see, I guess Nigel will need more of that domestic money to kind of recover from probably what will be an opening blow.
Well, on a day like today, you thank your stars that in fact the Indian markets have actually already underperformed. And the second factor is a high amount of crude into the markets will be good from an India economy point of view as well. So those are the two positives that I'm looking at. Now, India, yes, in the recent 6 months to around a year or so, we have underperformed even the emerging markets. But how do valuations stack up post the recent underperformance? Remember, on a 10-year basis, the Indian markets have done much better in comparison to the emerging market index. But post this correction, how are things stacked up? The India's premium to the MSCI emerging market, well, that's come down to close to around 59%. That compares with around 78%. On a PE basis as well, on a forward earnings basis, we are much lower in comparison to the long-term averages, which is at around 20.5. Currently, we're at around 18.6. And more than 50% of the Nifty constituents, well, they're trading below their long-term averages. So valuation-wise as well, a lot of stocks have come to those levels. Only the market cap to GDP number, well, that was at around 135% or thereabouts. That's cooled down to around 120%. So that's how valuations are stacking up as of now. A lot of factors are suggesting that the Nifty has gotten to that zone where it could see some kind of buying and some kind of bottoming out. And various stocks have come to those attractive levels as well. What did the FIs do in yesterday's trading session? Quite interesting, right? They sold in the cash market. But on index futures, they added more longs than shorts. Even on stock futures, they added more longs than shorts. Now, some part of this could be an arbitrage that's at play, but that's been the trend. They have been net long on stock futures, as you can see, while on the index futures, they're aggressively net short as well. So select stocks could continue to do well. Some part of that will be an arbitrage, but otherwise, in fact, there appears there is some long addition on individual stocks as well. That's another data point, right? SBI Securities, they put out a note and they said that now only around 18% of the Nifty constituents are trading above the 20 simple moving average. And whenever history suggests that whenever that number comes down below 20%, you normally see a bit of buying and a bit of a bounce just in the near term. Price action will have to be monitored, but that's an interesting data point as well. Less than 20% of the Nifty constituents are trading above the 20 simple moving averages. So keep an eye out on that parameter as well. Moving to the options data, well, the 22,400 call, 21,900 put, extremely active in yesterday's trading session. And just looking at the options data and the recent moves that we're seeing, the important range comes up for you in the screen. The 21,800 mark, that's the important mark on the downside. The PCR as well is moving to in that band of around 0.7 to around 0.8 or thereabouts. Crucial levels. 21,800, very, very important that it holds out at these levels. And I expect the bulls to come in and fight at these levels if we get around there. However, the trend is still very, very weak. The structure is punctured. So we'll see resistance coming at around 22,500. You'll only get more confident once you get past that mark. On the Nifty Bank, yesterday we went to around 47,800. Well, that 7,500 is very, very important for the Nifty Bank. Did a relative underperformance. It needs to get back to its fighting ways as we've been seeing in the last few trading sessions. So it'll have to outperform yet again. And finally, before we wind down, I just want to pull up a few stocks. There are some factors at play which is beyond fundamentals, and that could be trading action. Tax harvesting, there'll be advanced tax payments and also margin triggers. And that's why in yesterday's trading session, you saw a few stocks that fell on very, very low volumes and then bounced back. So just highlighting few of these stocks in yesterday's trading session that saw a big bounce of more than 10% from the lows of the day. And there could be more of the same just in the near term. That's because of the year-end phenomena as well as some margin triggers that are gradually getting out of the system.
Absolutely, Nigel, agree with that. The only point with tax loss harvesting is that you've got the whole month.
Yeah.
But people might say that there are more losses. We'll book more losses, then harvest them maybe by the 20th. You never know.
We could expect more of the same, I think, the next few trading sessions.
Yeah. Let's see. But eventually people do want to book those losses as well to offset against other gains. Perhaps maybe that could provide some comfort. Let's move on. Equity call of the morning coming in from Gautam Duggar of Motilal Oswal. He says the market correction has coincided with a slowdown in earnings growth, as the Nifty 50 has managed only 4% profit after tax growth in the 9 months so far this fiscal year. That's FY25. He says the expectations for FY26 corporate earnings are still somewhat elevated in their opinion, given the underlying macro and micro backdrop, and are thus ripe for further downgrades. He says the recent correction in the broader market factors in some of the potential disappointments in earnings ahead. That said, he adds that valuations for mid and small caps are still expensive vis-a-vis their history, as well as vis-a-vis the Nifty 50.
All right, Ben Powell is with us, Chief Middle East and Asia Pacific Investment Strategist at BlackRock Investment Institute. Ben, good morning. Good to have you with us here. Thanks for your time. So the tariffs are finally taking effect. Now that they take effect, I think the next question is going to be how long will they be around for? Because these tariffs are essentially with regards to, they're not tariffs, at least that's not what's been stated. They're not tariffs to raise revenue for the US. They are to stop the sort of supply, the flow of drugs, illegal drugs into the US, right? Fentanyl, etc. So it's for a specific purpose. So you think they'll be around a long time, or resolution will be found?
Good morning. Yes, a historic day, actually. I think unusually we can have a clear moment where we move from one paradigm to a different global economic paradigm, and that's today. So the tariffs, as you say, go from theoretical to real, so they are here. To your critical question as to whether they're going to persist, but the honest and real answer is we don't know. And even the specific tariffs you're referencing towards Mexico and Canada, seemingly to do with the fentanyl crisis in the US, there's no clarity on exactly what Canada and Mexico need to do to kind of get tariff relief. Rumors are that President Trump is watching deaths specifically in the US, but that's not confirmed. So it's an extremely uncertain situation. So are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that is that uncertainty is a kind of permanent change, which we're all going to have to kind of get used to as investors in the months and even years ahead.
Absolutely, Ben. Never a dull moment, I think, since President Trump took office, right? But while you're absolutely right, I agree with you, there's no way to know whether these tariffs last, whether they get changed tomorrow, who knows. But if you work with what we have right now, which is, say, 25% Canada and Mexico, and now 10 plus 10, which means 20% effective additional tariffs on China, if we work with that, then are we looking at a very real possibility of a growth slowdown, higher inflation in the U.S.? Because that's something which will be very tangible, and that's, I think, something that's beginning to worry the market.
Yes. So I think, look, this is now a stagflation shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. So the growth impacts of a tariff conflict, I mean, Canada have already said they're going to retaliate. President Trump and his team have said they will retaliate to the retaliation. So we are potentially, right at the beginning of this kind of tit-for-tat escalation. So that is going to give everyone the heebie-jeebies. You would expect to see less spending, people kind of reining in, whether you're a company or an individual. People are nervously going to put incremental money away for a rainy day because it very much feels like it's raining. So the negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So if we are imposing just a pure cost onto the construction import of everything, then prices should go up. And I slightly worry that the market is less focused on that, less aware of that, but that should come. So yes, it's kind of a double negative, unfortunately, of a stagflationary shock. For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute, because they, like everyone, are waiting for the inflationary impacts of tariffs, which should be significant. And sadly, another kind of consequence of this tariff new paradigm, which we have entered as of midnight this morning.
Ben, give and take everything. Tariffs, probability of Fed not going ahead and cutting. How do you approach global equities? I recall that you were quite positive on US equities, particularly the AI-focused companies, and the Japanese market as well as something you liked. How are you approaching global equities year on, give and take everything, all the various factors at play?
Yeah, so we're still constructive. I would say a couple of things. Firstly, clearly, as the facts are evolving in real time, so are our thoughts. So we're still, like everyone, seeing how this plays out and the consequences for global markets. That's the first thing. The second thing, I do think this different paradigm requires more selectivity from investors. So during the good old days, the great moderation, when the kind of economic, geopolitical, even market volatility was quite low, you could be so-called risk on, right? You just were long risk. I think it's a much more complicated situation now, and we as investors need to be much more targeted, much more specific in exactly what geographies we like, exactly what sectors we like, and exactly what themes we like. So I would say this is a time, sadly, we're all going to have to do a lot more work and be a lot more picky in exactly what areas we want in our portfolio and those we don't. You highlighted a couple. Artificial intelligence, we still think is a huge deal. Japan is totally different kind of domestic corporate governance story, but they are examples of the kind of cherry-picking approach that we at BlackRock think is just necessary as part of a much more fractured, complicated investment landscape.
No, absolutely. Ben, in the first term, President Trump, by the way, the S&P is still just about under 5% away from all-time highs. So if this is the beginning of a correction, in the first term, he would wake up many times, tweet about how the Dow is looking strong. I mean, so equity markets being high was a big kind of a point of pride, right? I'm assuming that is still the case. Although this time there is another feature. Does he want equities higher, or does he want cost of borrowing lower, what is the measure to gauge success? Is it lower yields in the US, which of course is happening, or higher equities?
So firstly, I think the market is working with this assumption. So just to make explicit a very important point that you made almost in passing there, which is the idea that he is constrained to some degree by his sense of greatness. He wants to make America great again. It's not exactly clear what that means, but it probably doesn't mean a recession or the equity market kind of collapsing, right? That doesn't seem consistent with his desire for greatness. So there is a hope and a reasonable argument as to why he is constrained by the equity market, which I guess allows us to somewhat sleep at night. Our concern, though, I guess, is if he really pushes through, if the US administration really pushes through with a tariff-first kind of policy approach, he might get neither. You were saying, is he looking for equities higher or yields lower? Stagflation, if we look, there's a lot of steps here, but if we go all the way through to stagflation, that's bad for growth, that's bad for earnings and bad for equities. It's also bad for inflation, meaning higher, meaning rates higher. So we're not there yet, but I must admit, I'm a bit concerned that if we are looking at a world of more and more tariffs, tit for tat, uncertainty will be higher, growth will be lower, inflation will be higher. And again, that's just bad news prospectively for equities and for fixed income. We feel President Trump and his team around him are, of course, brilliant people. One may or may not agree with their politics, but these are very sophisticated people. So there's a hope and an expectation that they fully understand this. And again, this is more of a hope. We don't know, but there's a hope that there is some kind of constraints imposed by the market and by economic data, with the overarching desire from the US administration for greatness not being consistent, one would have thought, with an equity market kind of maelstrom. So let's see, but that's the hope, I guess, that we're all working with in markets for now.
So Ben, finally, to wrap all this up, where does one hide? It's a very complex world, right? I mean, equities are issues. You discuss some pockets like maybe AI. Obviously, people are piling into US treasuries and bonds because that's a traditional safe haven. But I don't know if that will really sort of work given the stagflation scenario that you described. Basically, for the next couple of months, what's the best hiding ground?
So diversification continues. Sorry to give the normal strategist answer, but we should all be conscious that time in the market is important rather than timing the market. So as best we can, let's try to stay invested, try to stay well diversified, and try to stay more active in our investment kind of approach. So artificial intelligence, we continue to believe in, let's say, the story, and then a few cherries we'd be picking would include Japan, China as well, by the way, and a few others I won't go into here. Just this overarching point let's all try to stay focused on what we really believe. It's so difficult at the moment. We're all going to get, or the risk is we all get whipsawed around like tweet by tweet, which is dangerous, I guess. There's a risk there. We're all chasing our tails. So try to stay anchored in what we are really going to say high conviction on. That would include artificial intelligence, as you mentioned, but more broadly, a more specific, a more active approach to investing we think is necessary in a more complicated, more fractured geopolitical and economic landscape.
All right, Ben, we'll leave it there. Thank you very much for your time. Great speaking with you, and look forward to our next one. We'll tell you what the corporate interactions are on the show here over the next 2.5 hours. 8:35 coming up. You have the management of City Union Bank to talk about the 2025 outlook. They've announced new business initiatives. 9 o'clock, we'll have Citi's Robert Sockin, a global economist. So tariffs are the talk of the town, and we'll talk more on those aspects. 9:20, Nilesh of Kotak Mahindra Asset Management Companies, a market master of the day. 9:30, you'll hear from the management of Bajaj Auto as they talk about their February auto sales numbers. 9:40, we'll have Jupiter Group joining us to talk about the business and the order book picture. At 9:50, we'll have Sandeep Agarwal of Suvilo Investment Managers talk about trends in the IT space and stocks you need to look at in the IT services pack. And towards the end of this show, it's the economy. Lata in conversation with Jairam Sridharan of Piramal Enterprises on the state of NBFCs. Right, time for a quick commercial break here. Up next, list of stocks to watch out for with our research team coming right up.
Was just a generic tweet about the fitness of a sports person. It is not body shaming, it's about the fitness of a sports person. I always believe a sports person has to be fit. So I felt he's a bit overweight and I just tweeted on that. And I've been attacked for no reason, And when I compared him to the other captains, previous captains like Dhoni, or for that matter, Ganguly, Dravid, Tendulkar, Kapil Dev. So I put in and Virat. I put in a statement because I found him, I have the right, it's a democracy, what is wrong in saying it? So that is what you have to understand. So I just spoke in a generic manner and I fail to understand a democracy, we don't have the right to speak in such a manner.
Okay, so we're preparing for what's going to be a rocky start. The hope is that it gets better after that gap down. Let's talk about a couple of stocks that you should also keep your eye on. We have Vamakshi joining in to round up the action for us. Vamakshi, good morning.
Good morning, Surbhi. Let me first start off with IEX. The electricity traded volume saw an uptick of almost 9% on a year-on-year basis. The day-ahead market, which is the DAM, the volume shot up by almost 14%. The real-time electricity market saw a much higher growth in terms of volume, up nearly 23%. But it is the market clearing price in the day-ahead market, which was down nearly 11%. Keep an eye out on ASK Automotive as well, because the company has signed a technical assistance and licensing agreement with Kyushu Yanagawa Seki Corporation. This will enable the company to manufacture high-pressure die-casted alloy wheels for two-wheelers. The company, in turn for that sort of tech exchange, will be paying one-time initial royalty and running royalty as per the agreement, the details of which has not been disclosed yet. RBL Bank is another counter that we will be watching out for, and that is because GST authorities have initiated search at nearly 3 offices of the bank in Maharashtra. The bank said that the proceedings are ongoing and they are cooperating in providing full data as per request placed. In addition to that, they've also announced a couple of appointments. They've appointed T.S. Pari as the Chief Operations Officer. They've also gone ahead and appointed Narendra Agarwal as the President and Head of Branch Banking and Retail Liabilities Business. Apart from that, keep an eye out on Inox Wind as well as Inox Green. CRISIL has revised its outlook on the long-term bank facility to positive from stable and reaffirmed the CRISIL A rating for both of these companies. Now, keep in mind that Inox Green is, handling the operations and maintenance projects of the parent Inox Wind. And overall, CRISIL said that the improvement in the outlook on both of these companies is because of the improvement in the business risk profile of the parent, that is Inox Wind. Lastly, keep an eye out on Time Technoplast. They've introduced a new product that is polyethylene pipes for gas distribution. This is in line with the company's goal to achieve nearly 30% growth in the PE pipe category, and the benefits of this new introduction is likely to flow through from Q2 of FY26.
Okay, Vamakshi, thanks a lot for giving us all the top stocks that we need to track. For the time being, let's turn our attention to the commodities and currency space. Manisha Gupta joins us to update us on what's going on there. Morning, Manisha.
Morning, Nigel. Well, it is slip and slide and fall and decline everywhere that you can see. So it's really a lot of unease in the broader markets there. I'll start with the crude oil prices because we've seen 2% of decline in the overnight markets. And with that, we are trading at a 12-week lows. Also, what's bothering the crude prices is the statement from OPEC that they will increase output from the month of April. Well, this is going on to the lines of what U.S. has been asking OPEC to do to increase production to ensure that the prices stay lower. We also have seen the base metal prices trade choppy because of the tariffs now taking effect there. So when you look at the copper prices, we've continued to decline, multi-week lows onto that one. Iron ore prices are trading at a 6-week lows as well, and a sharp decline is what we are working with in sense of steel prices also. Markets also are reacting to the fact that we could be looking at higher tariffs leading to inventory buildup in U.S., but shortage in the rest of the world. I mean, that is a phenomena that the street perhaps would want to read more on.
Okay, all right, Manisha, absolutely. I loved how you described it, right? Slip and slide and declines all around pretty much. That's exactly what's going on. Commodities, equities, crypto, everything in a tizzy. Thank you so much for that update. Well, with that, we'll take a very quick break, come back on the other side, and we'll discuss some of the fundamentals and how you can approach a market like this today. Amnisha Agarwal of Prabhudas Lilladhar will join in.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's get some fundamental analysis going. We have Amnish Agarwal, the Director Institutional Research at Prabhudas Lilladher, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, how are you all feeling about the markets? You all have been doing a lot of calls with your clients. What's the mood like? And, what are the top buy ideas you'll have? Because when the markets pull back, you get a lot of stocks at far more palatable valuations. So if you could give us a couple of names.
Okay, so the markets have been actually going down. It is more like a regular thing that you can say, look at the market, every day it goes down 50 points, 100 points. And the fall, particularly on a Friday, was very steep. Now, if you look at fundamentally, I think the things are improving. The economy is actually coming back to life. 3Q GDP numbers were good. And there are hopes of revival definitely over there. Now, the only trouble which seems to be there is that when people buy and next day or in the few days you see the stock down 5%, 7%, then it puts people off to some extent. But having said that, I think it is more now like a market which is driven by the news flows and technicals. Because fundamentally, I think things are more or less, I think a lot of it is already been discounted. Now, in terms of, say, a few stocks, I think if you look broadly, if we look at, say, our recommendations of stocks, I think today you will find that many of these stocks, they will show you very good, you can say, upside because the stock prices have corrected. Now, specifically coming to themes, I think there are two key things which are very visible now. First of all, the government capex has picked up. So the entire capex, defense, I think all that story, after a gap, I think that will start playing around. One of the key stocks there is Bharat Electronics, which is a play on all the armed forces. The order book is good. The stock today, I think it is available at sub 30 times valuations on FY27. I think this is one stock which looks reasonably good to us. Now, if you look at, say, the other pie, for example, in the, say, your capex, you can have more stocks. For example, even ABB Siemens, they have corrected. Praj has corrected. So there are a number of names which you can find which look good at the current prices in particular. So now, if you look at the
So BEL, ABB, Siemens, Praj, that those could be part of your top list.
Yeah, but having said that, one should be ready that the growth rate, say for the next couple of quarters at least, it will be lower than what the growth rates people have now used to over the last couple of years. Because the ordering momentum in between was lower and now the base is not that low for all the companies. So the growth rates now will be more secular. Maybe one can expect anywhere between, say, 15%, 17% on a CAGR basis. But having said that, a lot of froth in the valuation has also come off. Now, if you look at the other pie, which is very important for the Indian markets, that is the domestic consumption. And domestic consumption, I think we are close to the bottom and we will slowly start, you can say, witnessing the recovery. And if you can recall, particularly last year, 1Q and 2Q were not great because the elections were there, too much of heat was there. So my sense is that the numbers would have bottomed out and we will see, you can say, slow recovery. But having said that, the way the Indian economy is, we might see the recovery coming more on the discretionary side than on the staples. So if you have to pick, say, stocks over there, then on the auto side, Mahindra and Maruti, these are the two stocks which look good, particularly M&M after the sharp cut which it has seen in the last 10-15 days at around 25,000-26,000. I think M&M looks very, I think it looks really, really good at the current prices. Similarly, if you look at what is happening, for example, the airlines are doing very well. We have seen very strong, you can say, your air travel around Kumbh and all. So I think the entire travel space will do well. And it is more like a multi-year story. And the biggest stock to play there, one can play through two ways. One is your Interglobe Aviation, which is Indigo, and one can look at hotels. The third could be, you can see the other segments in discretionary in which some, you can say the stocks which cater to air conditioners will come because we are likely to have very intense summer this year. Last year, they had very strong growth, but if the summer, as per the initial indications, it is good, then AC stocks can have, you can say, good run for another year or so. So in addition to it, I think on the staple side, you can look at, say, maybe a Britannia, because at 4,500, the risk reward is highly favorable. ITC sub 400, it looks really interesting. Broadly on the discretionary side, even QSRs, even you can say some of the jewelry, they should do well. But the valuations there are not as attractive as it might seem to be for a stock like, say, a Britannia or an ITC. But yes, some of these segments, they are all, I would say, they are all near the bottom as of now. So it would be, I think, a phase of very selective stock picking in my view.
Okay, some interesting ideas there. So perhaps some from consumer discretionary, some from staples, and a couple of names from the capex space as well. Amnish, I want to draw your attention towards cement stocks because the numbers have been looking good. I mean, even in the core sector data, cement production was actually the best of the lot. And it seems the price hikes have been holding so far in the fourth quarter. There's a note from Nomura this morning. They're saying, I think the average Q4 price hike is about 6 rupees. 3 rupees have happened, pan-India price hikes in March itself. So does cement look interesting to you? And if yes, then which stock would you go for?
You see, cement stocks have actually, they have also, along with the market, they have got battered in the past few months. And the 3Q numbers were also not great for all these companies. Now, if you look at, let's say, at Ultratech around 10,000 or Ambuja sub 500, I think the stocks per se, they look good. But cement sector, I think that there's a lot of, you can say, hopes built around that once they all start using more renewable energy, their costs will go down and the margins will go up. But if you look at cement sector over the years, we have not seen any meaningful increase happening in their EBITDA per ton. Because a lot of these efficiency gains which the industry actually gets, they get passed on to either the consumer or, for example, the government buying or the, you can say, buying on the institutional side that has been quite big over the years. So if one has to pick your cement stocks, I think Ultratech still looks to be the best, followed by Ambuja Cement.
Okay. All right. Amnish, just stay on. We'll quickly get into a corporate conversation and then come back to you for some more stocks. The next management and company on our radar, actually, City Union Bank. The stock has seen a fair bit of correction, along with, of course, the rest of the financial space in the mid-cap market. It's down about 15% so far in this year. Let's pull up maybe a one-year chart or a year-to-date chart that will reflect that decline that we're talking about. So 12 months, obviously, it's still up 8%, but year-to-date, that decline became extremely steep. Now, one of the new initiatives that City Union Bank has announced is a partnership for co-branded credit cards with Chennai Super Kings. To discuss that and, of course, other business trends, we have Mr. N. Kamakodi, Managing Director of City Union Bank. So thanks so much for joining in. This is interesting. So, a lot of the CSK fans, of course, will be looking out for this one. But just explain the strategy, the rationale. I mean, what are you expecting from your credit card business? Because in the past, I think your stated, move has been that you will grow the retail book more on the secured side. So what are you planning now on unsecured with this tie-up on credit cards?
Yeah, actually the same strategy of going with the secured retail continues to a greater extent. At the same time, we could, when we analyzed the data, our own customers have taken, part of a lot of credit cards and other retail consumption from other institutions where we are losing them from our side, and also it is very much required for our strengthening our retail liability base. So one product that was missing was basically the credit card, with extra focus with our existing customers, being City Union Bank, being having almost more than 2/3 of the business from South India, particularly Tamil Nadu. We felt that it is very important for us to fill up the missing product offerings in our boutique. One of the products which we identified was the credit card, and we found that we have a significant number of our existing liability customers, particularly, are taking a lot of credit cards from the other banks, and ultimately the propensity for losing them appear to be higher. So to bridge that gap, we have entered into a tie-up with, the Chennai Super Kings, which is ultimately the product which is having significant appeal to the cricket lovers of the state. And also we have very strong tie-ups with a lot of educational institutions in the state of Tamil Nadu, where the next generation students are also having a lot of interest in and association with the brand CSK. When that opportunity came, we felt that it's something which we have to enter into and have a strong tie-up, and that's why we have signed up with CSK.
So, Mr. Kamakodi, if I could just come in, get your point, but if we can get some numbers and projections, that will also help. In the third quarter, of course, your growth picked up. I mean, you've been growing the book at about 15%. Now, as we look at FY26, what would your outlook be for overall growth of the book? On the credit side, within that, how much would be sort of powered through retail? And if you could give the breakup of the retail book right now, how much is secured and how much is unsecured?
Basically, if you look into overall, we had a very, sustained and, decent credit growth in the past, and the calendar year 23 was sort of not a good year for us. When our, in December 2022, we had about 14 to 15% growth, which is slowly slipped to about 1 to 2% for December 2023. Once again, the growth picked up in the calendar year in 24, and we slowly and steadily increased it to about 15% for that. The current year also, we expect the growth to be between around the same number, plus or minus 1% or so. For the financial year 25-26 also, we hope we should be having 15-16%, 15 plus or minus 1% growth rate. In that, as we had multiple times given, the retail growth, in that 15% growth rate, the contribution from the retail may be between, 1 to 2%. Even in that, we expect the entire credit card portfolio will not be more than 1% of our portfolio in the overall portfolio in the for when year ending 31st March 2026. In that also, not less than 80% will be for our existing customer base, and our existing strategy of focusing more on the secured retail, and particularly in the unsecured, it is only to support our existing customers, not to lose the existing customers, particularly on the liability base. So we want our liability customers, whenever they need the, the credit card product, we don't want them to get into the other brand, other institutions and lose them. So the incremental portion will be minuscule. That's how we have become the credit card partner with the CSK to take care of that one.
Okay, so that makes it clear that you're looking to grow 15 to 16% next year, and the growth on the retail side will continue to be largely through the secured book. Unsecured primarily to ensure that your customers don't go elsewhere if they need a credit card. So that's what the sense is. Just a sense on, we've recently got more announcements from the RBI, right? Whether it is the liquidity measures, then they've of course rolled back some of the prudential norms for NBFCs, etc. So for all the RBI measures that have happened, including the rate cut and the liquidity boost, the FX swaps, all of that, how has that improved liquidity conditions for you, and what do you see in the market?
See, what we feel, as we have seen multiple cycles of interest rate hikes, interest rate lows, and also the tight liquidity condition and lower liquidity conditions. You had a period when it is repeatedly said that the retail depositors are moving more into the, equity, and that's how the incremental deposit growth has started coming down, which is also part of the liquidity tightening. And also you had the government expenditures, that budget was not coming to the retail, commercial banking, but that was with the treasury and all. So all these things are, slowly getting on the unwinding. And we feel when we enter into the decreasing interest rate scenario, the going forward in the next couple of quarters, the things will definitely improve. At the same time, whenever you see that there will be some adjustments in the yield what you charge because of the interest rate passing and all, overall things are getting better and better for the, we expect things will get better and better for the banking industry, both on the liquidity front and also on the growth front.
Okay, all right. So thank you very much for joining us. Good speaking with you and getting that perspective across. Guys, while we talk about what are the good levels to buy and whether the market is bottomed, etc., and the debate will continue, for some time to come, I think. Ramdev Agarwal yesterday made a good point. One of the indicators you can see is when promoters start to buy their own
stock,
shares because they clearly know more than every other constituency in the market. And that should be a signal, not obviously a definitive kind of a vote that, well, this is the price to buy. And sometimes what happens is they also buy, you see these trades at 5,000 shares, 10,000 shares. It doesn't amount to very much. So, but if sizable buying at lower levels, when it starts to come in, I mean, that could be a bit of a signal. Actually, let's play out that soundbite. Ramdev Agarwal of Motilal Oswal Financial Services on whether that will start to happen and how should you use that as a bit of a signal, as an aid. Listen in.
In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know their value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected.
Okay, all right. That was Mr. Ramdev Agarwal.
Just
Nigel?
two stocks. We had done a small piece on, on CNBC-TV18 with regard to few stocks, JSPL, Maharashtra Seamless, part of the Wellspun Group. Small buying. I think JSPL, the Q3 numbers were very, very disappointing. The stock had fallen, I think, 15%. The promoter came in then the next few sessions and bought close to around 1%. And from there, we've seen some kind of stability. Maharashtra Seamless as well, close to around 0.5% is what they bought. So just a couple of instances from my sector that I recall, where promoters have bought either 0.5% to around 1%.
That is sizable. But I think that's sizable because I know so many cases where advisors say thoda sa le lo. To show confidence or whatever. But that doesn't mean very much. It's just sort of, or you ask some personnel to buy, that shows up and suddenly people say, well, the promoters are buying. But it's not very much. But 0.5%, 1%, that is so, you got to use that data point intelligently as well and not sort of look at everything as a bit of a signal. Some of it, of course, will be a noise as well. Let's take a quick commercial break here. Sudarshan Sukhani and Mitesh Thakur will be with us with some technical trades on the other side. Stay tuned. Okay, welcome back. You're with us here on Bazaar. 7 minutes to go for the pre-open session. Sudarshan and Mitesh are with us. Gentlemen, good morning. Good to have both of you here. 160 lower on the GIFT Nifty. Will we find some sort of support, or will the market respect 22,000 in some way? Or, I mean, broadly, the range of 21,800 to about 22,000. Is that where the market will find some stability? Mitesh, you go first.
Morning, Prashant. So I think, the only thing which is happening is that we keep getting oversold. The put call ratio is now around 0.8, 0.75 zones, which is 0.65 is the standard oversold levels. But as I said, I think that spark of reversal is missing. And that's why, we haven't been trading the index. So in fact, we have some put option spreads on the Bank Nifty. And the Bank Nifty hasn't broken that January low of 48,041 on closing basis. That could happen today. So I think the Bank Nifty could also see some declines, let's say to about levels of 47,600 as the minimum target, but a more logical target is around 47,200 to about 47,000. And that in turn would suggest that the Nifty would also be under pressure in case the Bank Nifty breakdown comes into play. So my sense is that the market pain is not yet over until we see a strong reversal, either with a gap up, which sustains and holds, or a strong bar which kind of engulfs the previous bars. I think we need to wait it out to take some kind of long position on the index. So as of now, my idea remains the same. Either it's a sell on rallies kind of a market, or you trade with put option spreads.
Okay, all right. Mitesh got that point. Let's ask Sudarshan as well. Sudarshan, morning. So we're all bracing for impact, looking at this gap down. What would you do today? Anything at all on the index, or is this let's sit out kind of a day?
Yeah, good morning. It's been a let's sit out kind of a week or maybe 2 weeks. And that's been a sensible idea, at least for me. But it does appear that this market is now getting tired of selling. We could see a gap down today. We could see significant selling. Whenever this gets exhausted, that will be the first sign that for the short term, this selling is over. And I think we are very close to that point. I can't say whether that will happen today or tomorrow, but we are very close. So traders and investors are well advised to watch for signs of a bounce, intraday bounce, interday bounce. That should happen soon enough. So this is not a buying suggestion. It's a suggestion that we are probably coming to the end of this leg of the downtrend.
Okay, that sounds good. That we could be, ending at least this leg of the downtrend, and that would be some relief that maybe the final shakeout happens today and then at least some stability. So let's see if that's the case, then stocks. Sudarshan, what would you do today?
Well, if that's the case, then I have a long buy list. Remember, they are mid caps and you have to be a positional trader, not an intraday trader for them, because the markets haven't bottomed out. Voltas is a buy with a stop at 1341. HDFC Bank is a buy with a stop at 1668. And SRF is a buy with a stop on at 2770. Don't rush to buy them. Wait patiently. If you get a sense that this market has stopped falling, these are good ideas. And finally, Ashok Leyland is an intraday short with a stop above 212. I would suggest that maybe this week we'll probably see some kind of a short-term low.
Mitesh, what about you? What are your trades?
I have all sell list, Adani Ports is a sell for me with a stop at 1,065 for targets of 1,020. HCL Tech is a sell with a stop at 1,591 for targets of 1,535. IGL is a sell with a stop at 186 for targets of 173. And Indian Bank is sell with a stop at 510 for targets of 480. Now with the gap down, you need to be tactically aware as to when to initiate the sell call, because then if there's a big gap on these stocks, then you might not get a good risk reward entry point. So I think I'll be slightly flexible there. But yeah, the idea is that the market does look, we might remain in some kind of a negative mood.
All right. Thank you very much, Mitesh. Thank you very much, Sudarshan. We'll talk again soon. We'll take a quick commercial break here. We'll come back with a pre-open session. We'll have Citi's global economist, Robert Sockin, join in to tell us what these tariffs will mean and what damage it will do to the US economy. Data has been slowing down. Markets have been starting to turn a little lower as well last fortnight or so. Stay tuned.
Through my discussions over recent days, we've agreed that the UK, France and others will work with Ukraine on a plan to stop the fighting. Then we'll discuss that plan with the United States and take it forward together. The purpose of today's meeting was to unite our partners around this effort, to strengthen Ukraine and to support a just and enduring peace for the good of all of us. Yesterday evening, the UK signed a £2.2 billion loan to provide more military aid to Ukraine, backed not by the British taxpayer, but by the profits from frozen Russian assets.
Welcome back. So in the next couple of minutes, we'll start getting the idea of how much of this gap down we will be looking at. Asia, as we've been pointing out, is down anywhere between 0.5% to as much as 2% in some of the markets like Japan. So as those pre-open rates start to come through, look at that. First rate on the Nifty is actually 100 points up. If only it works that way. Yeah, Sensex 400 points higher. We all know this is the first rate. Let's wait for it to settle. If only. But anyway, let's get more perspective on this whole tariff business that's become a complete reality now. Robert Suckin, global economist at Citi, is joining in with some thoughts. Robert, great to have you this morning. Never a dull moment, right? And now it's real, 25% Canada, 25% Mexico, and 20% effective additional tariffs on China as well. The market is nervous. Do you have some models or estimates so that one can work with that if these tariff levels persist, if they're not rolled back, then what does it mean for inflation or growth in the U.S.?
Yeah, absolutely. It's a very uncertain time, especially with these tariffs looking like they're going to go into effect. But then there's a broader question: if they do, will they stay in effect, and for how long? The models that we've run have shown that of these tariffs, the economic damage is probably largest for Canada and Mexico, given the significant ties to the U.S. economy. But the U.S. is not immune from the negative effects of these tariffs. And you're looking at a world where if our trading partners retaliate, which seems very likely, we just saw some news saying that Canada has prepared a list of retaliatory measures, that the stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation. So it is that stagflationary effects that most people in the markets are worried about. So we'll see if they go on and if they stay on, but I think it's a difficult and dangerous balancing act because the negative economic effects might be larger for some of our trading partners, but they're certainly negative for the U.S. As well.
Sorry, Robert, I missed the number. Could you just repeat the rough estimation right now for both inflation and GDP?
If our trading partners put on a sizable amount of retaliation, not one for one, but if they put on retaliatory measures, you're looking at U.S. real GDP that falls over a several quarter period by over 1 percentage point. And I would expect the spikes in U.S. inflation in the short term to be 0.5 percentage point or higher. So you're talking about sizable negative stagflationary effects.
Yeah, absolutely. Robert, hi, good morning. I have two questions. How long these tariffs will be in effect, according to you? Your best guess, base case, as they call it. And second, are U.S. stock markets not as important to Trump as they were during his first term? Because, I mean, how much damage will he tolerate?
Yeah, and these are the key questions. And I think I'd start with your second question, because the framework I've had in my mind and we've thought of on our team at Citi is that we know from Trump's first term that he cares a lot about the performance of the economy and the performance of the stock market. And it seems that under fairly large tariff scenarios, the economy is challenged and the stock market is challenged. You know, our teams at Citi have done a lot of work on this front. So I think on that point, I would assume that the tolerance is fairly low. which brings us back to, I think, even if these tariffs go into effect, my assumption would be that they would not stay on for a durable period because of those negative economic effects that I mentioned and the negative effects to equity markets you're likely to use as negotiating tactics to have countries work with Trump on other priorities. But there's a lot of uncertainty. Certainly, I did not expect the tariffs on Mexico or Canada to go into effect at all. If you had asked me a few weeks ago, now it looks likely they may go on for at least some time. So I think it's a very uncertain environment, but I'd be surprised if they'd stay on for a durable period. I think they are the prelude to a larger set of negotiations.
So some pullback of these tariffs actually will be good news, because it's not going to hurt just the US economy. The globe as well becomes a very, very uncertain place. Hi, Robert. Welcome to the show. Thanks a lot for joining in. Well, over the last few months, we have agreed that India is on a firm footing. Growth is pretty okay out here. Our stock markets have pulled back a little bit, and we have relatively underperformed. But growth in the past quarter was better than the previous quarter. And from here on, growth should be okay. In addition to that, we have an RBI that's cut, made one rate cut, and the optimism is there in the next couple of months we get another one. How do you see the Indian markets as well as the economy shape up from here on? And are you as bullish on the prospects here in India?
A great set of questions. And I think, we've highlighted many times on this program how India has been one of the best performing economies in emerging markets, but more broadly than that, in our forecast, we've been significantly surprised or impressed by the strength of the economy. And for this year, looking for a lot more of the same. So our forecast for Indian growth is roughly in line with last year's pace, which was very solid in the mid 6% range. We're looking for something similar. And as you also noted, some additional scope for further rate cuts from the RBI. So I think the economic backdrop is very favorable. But I would also highlight that these issues that we're talking about of tariffs and trade uncertainty could also come back to India. And, we've seen Trump discuss the potential for reciprocal tariffs with trading partners. And India at times has come into the president's sights in terms of countries to target. So I think broadly speaking, there's a very positive economic backdrop for India, but we also have to be paying attention to more broadly this risk and uncertainty around global trade and ultimately what the U.S. tariff policy is going to look like globally, but also vis-a-vis India.
Okay. By the way, just taking a moment to recap the pre-opening rates, which are now on our screens, 125 points lower on the Nifty, which means it's a 0.5% decline, which is not that bad. And I think it's the scenario that Nigel was talking about that's playing out because we've already fallen so much.
15%.
India has been leading the global equity world in the downward draft, the biggest underperforming market perhaps in the region this year. So therefore, we're not hit particularly hard this morning. And remember that our Commerce Minister is in the US this week to negotiate a trade deal with the US. And if, fingers crossed, if everything goes well, then perhaps, India could see some kind of gains as other partners also, hold their parlays with the US. So we're in very, very interesting times. So not too bad, must say, for a morning like today. Mid-cap index, though, is down a lot more. It's down about 1% or so. So, Robert, what's the sense? What's the advice? As this plays out from the Fed's perspective, what do you think the next steps could be? Because we had a guest earlier from BlackRock who was saying that all this complicates the situation for the Fed, and maybe the Fed has less maneuvering room if you're looking at a stagflation kind of a situation in the US.
Yeah, absolutely. And I think that is the real challenge of the environment we're in now, that if you go back even a few weeks ago, the fundamentals, broadly speaking, the US globally, all look solid going into this year. I think they're still on a solid footing. But what we're seeing now is that a lot of the noise coming out of the Trump administration, in particular with regard to tariffs, is creating a lot of economic uncertainty. And you're starting to see that move into a lot of the economic data. You're seeing, for example, in the US, confidence measures come down. You're seeing inflation expectation measures generally creep up. And you're seeing a lot of noise in some of the survey data, some of the spending data, and it's getting hard to assess where the ultimate trend is. And especially if we get these tariffs that come on in force and they stay on, those stagflationary forces that we talked about earlier would come even more into play. So I think we have to pay close attention to the policy developments, be nimble, and watch kind of the negotiations that will take place if those come on. Now, for the Fed, I think it is a challenging environment. I think if you go back again a few weeks ago, Fed was in no rush to remove accommodation, U.S. economy on solid footing, inflation gradually moving down, but with that risk of Trump tariffs looming large and the potential for the stagflationary effects of that. So if those come into play, they have a difficult balancing act to face. And I think it's going to depend on what they're seeing in the data and the size of the tariffs and what they think the effects are. But ultimately, I would think if we got broad-based tariffs and you had a big negative growth shock, I would expect the Fed to be cutting in that environment. But it's a lot to be seen.
Sure. There are too many moving parts. Very hard to sort of model any of this. So kudos to you. Just a final question from my side. China. Now their big, much-awaited March parliamentary meeting is kicking off today. What are your expectations and what is your assessment of the economy? Everything that they've done throughout 2024, is it adding to anything realistically on ground? And would you expect a bigger stimulus to also ward off tariffs plus their own local slowdown issues?
Yeah, absolutely. And China faces an array of challenges on top of the U.S.-China tensions and the tariff risks and the tariffs that have gone on, other sort of internal deep structural issues, unwinding property sector, aging demographics, high youth unemployment, and those structural factors and headwinds are likely weighing on consumer confidence and spending today. And so you've seen relatively tepid performance from the consumer. Our base case going into this year has been that growth in China would slow from 5% last year to 4.2%. That has an assumption of 10 to 15 point increase in tariffs from the U.S. administration, those staying on, so the durable increase. So far, we've seen 10, could go up to 20, and maybe more could come after that. So that could create headwinds, but the authorities in China could also come out with more stimulus to help offset that. So I think we have to watch both the U.S. space closely for the tariffs and how the Chinese authorities respond. Right now, we're sticking with that fairly decent growth forecast of somewhere in the low 4% range, but it'll depend on, I think, on those two factors. How the Chinese government responds, particularly for the consumer, to help offset some of those issues I mentioned and the tariff risk, and how large tariffs end up actually being on China and whether those stick.
All right, Robert, we'll leave it there. Very interesting conversation. Thank you for joining us. I'm assuming it's a late hour for you, so good night to you. And as we start our morning, thank you indeed for your time. Sudarshan is with us with 9-10 calls and what he'd like you to do. Sudarshan, tell us.
Well, yeah, consider buying Voltas with a stop under 1341. You have to adjust the stop because of the gap down. But it would be a buying opportunity.
Hitesh, what about you?
I'll go with the sell on HCL Tech for targets of 1535 to begin with.
Okay, HCL Tech. All right. Well, I think we have the market open coming up in about 3 minutes or so. If you can just look at the pre-open session and how that has ended. We are down 150 points, so in line with what the GIFT Nifty, largely in line with what I think we had a 160 point cut in the GIFT Nifty, and we've got about a 145 point cut right now, 21,974, so just under the 22,000 mark, and the sort of broad levels from here. Multiple lows between 21,800 to 21,900 last year, 2024, middle of 2024. So that kind of becomes the next logical zone to look for the market to stabilize a little bit if it were to. Najal, you want to make a point?
No, I just want to focus on a couple of brokerages that have come out as well.
Yeah.
SBI could be one such stock because Abhishek has just sent us a note that Citi has written. They have double upgraded SBI. Remember, it's been a bit of an underperformer, but they've double upgraded the stock from a sell to buy. The target price is at around 830 rupees or thereabouts, some 720 rupees. And they have made a few points out there. They're factoring in 13 to 14% growth, curtail credit cost. They also say that valuation-wise, it's inexpensive at around less than 1 time. So it's at around 0.85 times a book, which they believe is fairly attractive. So that could be one of the stocks. A lot of brokerages have written, but this is one of the notable ones because it's a double upgrade. So just thought we'll highlight that.
All right, no, absolutely. 2 minutes out to open. Let's just look at a few other stocks, right? I mean, this is from yesterday. REC and PFC, so these were two names which saw some buying yesterday, about 4%, 4.5% each by close. So they're starting about 1.5% lower, REC and PFC. Let's look at the hospital companies. Narayana was the biggest volume-led gainer, surged 10% yesterday, but there was also Medanta. So Narayana and Medanta, if we want to take a look at it, so giving back about half of yesterday's gains, and the other one is Medanta. We spoke about the AC companies, Blue Star and Voltas. I mean, if you're talking about cooling themes, maybe throw in the Varun Beverage name as well. I think there's a brokerage upgrade in Varun Beverage as well.
CLSA,
CLSA, so Voltas, Blue Star, these are all sort of big gainers yesterday. There was Supreme Industries, which surged about 6.5% in trade yesterday on volumes. And there was something like a Religare, which came up about 5-6% as well. So these are essentially broader outperformance that we saw. I just want to make one point. Maybe today will be different, but I said this yesterday as well. Yesterday, after a very long time, you essentially had the number of stocks which actually went down lacking volumes. You didn't have a very long list of names with a lot of volumes. Volumes were all on stocks which actually went up. So that's a, I think, important point. Maybe points to some amount of selling exhaustion, at least in the near term. 0.5% on the Nifty, so 22,000, around 22,000 right now, around yesterday's lows basically. You got the Nifty Bank, which is down about 0.25%, 47,990. The IT index is down about 1.3%. So the weaker US data does not help for a globally exposed sector like IT services, and we've seen that last week as well as data soured in the US. The IT index sold off about 7-8%, and this morning it's starting lower. And three names in the green and everything else up, everything else down is what you have at this point in time. So becoming a little deeper now, but about 0.5, 0.6% in that range as far as the Nifty index is concerned. Too early, but I mean, for what it's worth, 300 higher and about 1450, 1460 stocks lower. That's the market breadth.
Okay, let's see if the buyers come in at some point in time. Right now, we're dealing with this 140-point cut. So the weakest links, actually everything. ONGC is the one that's down about 3%. A couple of tech stocks are coming off quite a bit. Remember, the Nasdaq fell more than the other indices yesterday. A lot of the chip maker stocks were down big time. So here, HCL Tech, Infosys, Wipro, Tech Mahindra, IT is leading this decline, this wave down, which is about 2.5% on individual stocks. Coal India is down 1.5%. There is Bajaj Auto, which is lower. Remember, sales were not that great for Hero and Bajaj Auto. We'll be speaking with the management of Bajaj Auto as well in just a bit. Titan's lower by about 1.5%. Tata Steel is on the back foot. BEL, which had a good recovery yesterday, is cooling off this morning, down about 1% or so. Let's see if there's anything on the upside. So some of the banks are beginning to see a little bit of a pullback. ICICI Bank, HDFC Bank, SBI. So there is buying in banks this morning, which is interesting. And a bunch of consumer stocks could be breaking into positive. Look at HUL, ITC. These are some of the early names. Even Tata Consumer, they're still down 0.25% or so. But let's see if there's any traction on the upside. But again, as always, the much bigger problem continues to be the mid-cap part of the market, which is now down 1.5%, Nigel.
Well, let's pull up a few stocks and that are gaining actually. TD Power, we were talking about small chipping in from the promoter. That's something that I observed on TD Power. The stock has seen a sharp correction from the peak. Year to date, it's still down close to around 30%. But the stock is up close to around 8%. So that could be one of the factors at play. That's one of the big movers. Ask Automotive, remember they had announced that they signed a technical assistance and license agreement with Kushu Yanagawa Saiki. So because of that, that stock as well is up close to around 4.5%. So both those two big movers in initial trade. What's losing out? IGI, second day running, the stock is down close to around 10%. Yesterday, remember, the stock was at lower circuit. And, there were pending sell orders as well. So it appears some of those are getting executed in today's trading session. What's outperforming actually in the first few minutes of trade is the Nifty Bank. And that's giving signs that, if we need to fight back, that'll have to perform. Remember, yesterday it was an underperformer. Nifty Bank is almost into the green. It's down less than a 0.1%. So keep an eye out on that particular name. Otherwise, high beta is getting knocked back. Vedanta is pulling back 2.5%. NMDC is down close to around 2.5%. Coffee Day, you're not a stock we track very often, but yesterday as well, the stock was up. It's come off, I think, from the recent peak. Today as well, that one is moving up more than 10% or thereabouts. Not too bad, guys. 150 points down. I think that's par for the course. And 300 stocks advancing. That number needs to get better, though. Nifty Bank putting in a bit of a fight.
Down again, 21,975 is where we are. Corporation is up 5% against, it's got some volumes on it as well, about 6,200 rupees on that one. It's like a, it's like a fund basically for the like a mutual fund, basically a holding company with lots of stocks in it, blue chip names, well managed, and they invest Tata's money. Well, Blue Jet is up about 2.25%. MPS it's got some large individual investors there, 6% higher on MPS, and a few others coming up. GHCL is up about 3%, and far and few in between. Schaeffler is up about 4%. But again, I mean, volumes quickly drying up below a certain threshold, below the first 3-4 odd, below the first 6-7 names or so.
Nifty Bank in the green.
Okay, Nifty Bank will come up. Let's put that up.
Yeah,
and that is coming back up a little bit right now. So 10 points or so.
Just wanted to add one more stock. Arvind is seeing a major slash this morning, 9% down on Arvind. Volumes are already beginning to pick up. Now, perhaps this also has to do with the fact that some of these companies are also exporters on the textile side. I don't have the exact numbers in terms of Arvind's export business, but maybe that could be adding to the sentiment downtick. It's down about 9.5%. And IGI, AB Real Estate, by the way, which yesterday was rallying as we went into close. Again, is a slam dunk on this one, 9%. IGI is the interesting one. We had such a detailed conversation with the management yesterday. They kept maintaining that margins will not be impacted with the lab-grown diamonds, but I think the market's not quite convinced.
20% gone, and of course it's now, I think, maybe around the issue price, below the issue price, I have to check, but it's a recent listing essentially. So 330 or so is where we're at. Nilesh Shah is now with us, Managing Director at Kotak Mahindra Asset Management Company. He's our market master of the day. Nilesh bhai, good morning. Good to have you with us here as always. Prashant this side. Ab kya, Nilesh bhai, is the question. And the other question is, are we there yet in terms of having paid the price for the excesses, etc.? And let's just divide this question in two parts. For the Nifty, which just purely on a P multiple basis seems to have fallen to averages, and then mid and small caps. Go on, Nilesh bhai.
So Prashant bhai, as of today, it looks like FPIs are aggressively selling. On Friday, net of passive funds buying of about 8,000 crore. The gross sell number was about 20,000 crore. Never stand in front of a running train. If they are selling aggressively, undoubtedly buyers will continue to buy at lower and lower prices. And as long as their selling continues, we think market's unlikely to settle. Buyers will continue to buy at a lower and lower prices. In terms of valuation, now Nifty is trading little below its historical average valuation. This is a fair value market. The excesses of the past has been corrected. And now this is probably time for long-term investors to start accumulating. But keeping in mind, don't stand in front of a running train. In the small and mid caps, again, there is a divergence. Last quarter, mid caps earnings growth was in line with expectation at more than 20%. Small caps degrew by similar amount. And again, it was little below expectation. So within small and mid cap, go for quality, go for reasonable valuation. But do remember that right now the mood of FPI is on the selling side. It is your opportunity to accumulate, not to buy everything today.
Got that. So let's just spend 2 minutes on this FPI bit, right, Nilesh bhai? So as you said, aggressive sellers still, and buyers will come in, but at lower and lower levels, right? And there's only limited amount of cash for people who are doing it themselves, who've got systematic investment plans. That's, of course, getting deployed at lower levels, and over the long run, hopefully that will play out. But just your feedback, because you interact with a lot of people in the ecosystem. What is behind this FII selling? And recently, one has picked up another line of argument that, and just a clamor for the government perhaps to look at taxation and things like that, or capital gains tax, and how maybe the hike was a mistake, comparison with other countries. I'm sure you would have picked up on all those things. Just wanted your thoughts there.
So one, trying to figure out FPI is like five blind men trying to identify elephant. because there is no one homogeneous set of foreign portfolio investors. The university endowment funds and sovereign wealth funds have been buyer in our market. The long only, the passive, the US-based FPIs, some of the pension and insurance companies have been sellers. So within FPI, not everyone is seller, not everyone is buyer. Now, some of the reasons why FPIs have turned sellers, one, Indian market had expectations built in, and the September GDP growth number, December GDP growth number, as well as quarterly earnings of September 24 and December 24 quarter came below expectation. It couldn't justify those valuations. On top of it, America First, Make America Great Again, resulted into American vacuum cleaner starting, which is collecting money from all the emerging markets. Every emerging market is witnessing outflow, and China hasn't published numbers since October 24. So we don't know whether they're receiving inflows or outflows. But if someone is not publishing number, your guess is likely to be as good as mine. Number three, our rupee also was overvalued. That provided good exit to the FPIs. If I have to sum up, maybe there was a trade where rupee was likely to come down, Indian market was likely to come down, American market was likely to go up. There was a trade waiting to be taken, and FPIs took it. A large part of that is now behind us. But right now, the momentum for FPI is on the selling side. But do remember, they are doing quit emerging market and ghar wapsi to America. And not every FPI is seller. If we look at the data of December 24 quarter, sovereign wealth funds and university endowment funds have been buyers. Yesterday, I was on a panel with Samir Arora, where he said that being an FPI, they have received net inflows for December as well as January month.
That's good to hear.
Just on the other point, second point, do you think this clamor to cut capital gains tax, right? We're all in the market. We all want higher. Everybody wants higher prices. But I mean, the government has got to look at their own thing. Where do you come in this debate? That there is one point of view. As markets correct, everybody becomes more introspective. That maybe this was a self goal. Capital gains tax should not have been touched, etc., etc. Just wanted your thoughts there.
So one, there should be parity. गुजराती में कहावत है घरना छोकरा घंटी चाटे ने उपाध्याय ने आटो. Our own kids at home are starving and then we welcome visitors. We should not be doing it. Investor is investor, whether it's domestic or global. We should treat them equally. Second thing, just reducing taxes does not guarantee return. What if tomorrow FPIs demand guaranteed return? Will we succumb to it? I don't think so. We should be focused on creating earnings growth and governance. We have delivered better return than all the emerging markets put together. We have delivered better return than China, Brazil, Russia, South Africa. Yes, last 7 months have been bad, but people have made money over here. And on that money, they are paying taxes. So it's not an easy answer. People who are demanding lower taxes for FPIs are probably also demanding stability in taxation policies. Once they know that there is X amount of rate to be paid, they want that to remain constant for a long period of time. So there's no easy answer, but my recommendation will be treat all investors alike, whether it's foreigner or whether it's local.
Okay, that's a very interesting aspect, Nilesh, and brave of you to say that. Usually one would sort of jump to say that yes, cut capital gains tax, but that's not what you're saying. I mean, I get the drift that tax policy cannot move with the swings of the market. Then we'll have to change taxes maybe every 6 months or every year, but there has to be predictability. Take that point, Nilesh. So now come in on the extent of money that you folks have been getting and then putting in the market, and thank God for that, right? Even yesterday, there was almost net buying of 9,000 crores from domestic institutions. We had Ramdev Agarwal on the channel yesterday, and I think he picked up some input saying maybe February the flows would slow down a little bit as eventually people kind of get hit in terms of sentiment. But what's your sense? And with this kind of deployment, because the net deployment on a daily basis has been really huge, with this kind of deployment, what is the net cash level industry-wide when we're talking about Indian mutual funds? And what is the flow situation right now?
So once will flow start slowing down a little bit? Answer is yes. There are experienced investors and there are inexperienced investors. In March 20, when markets corrected very, very sharply, our SIP returns had become negative for 3 years. That did deter some investors and they stopped their SIPs. It also excited some investors and they topped up their SIP. Majority people were buyers during dark days of March 20 when markets were falling like a stone. And today they are rejoicing. Despite this correction, they are sitting on healthy double-digit return. So my feeling is that the experienced money will use this correction as an opportunity to buy, albeit in a calibrated manner, not in an aggressive manner. There will be undoubtedly some inexperienced money, mainly coming on direct platform, looking at last 6 months' performance. When they see negative return, they are likely to stop their flows or redeem money. My recommendation has always been that you have to follow your asset allocation model. And like for your physical health, you consult a doctor and don't go to the chemist directly. Same way for your financial health, you need to consult your advisor or mutual fund distributor. Don't invest looking at last 6 months' performance in direct plan on a platform. That's not going to give you financial freedom.
No, fair enough, but just the point on, so what you're saying that has been at a net level, there's been some slowdown in February. And what would the industry-wide cash position be like? I mean, there were some funds that were running as much as 18-20% cash. I'm guessing a lot of that has been deployed in this brutal February sell-off. Any estimates of overall how much firepower are you folks still sitting on?
So in the month of January, the average cash balance, and I'm just rounding off number, was about 5%. That's roughly about 1,75,000 crore. The asset allocation fund and balance advantage fund, which have ability to take higher equity as market becomes cheap or valuation-wise attractive, that's roughly about 1 lakh crore. So there is about 2,75,000 crore worth of potential firepower within domestic mutual fund industry. Obviously, it does not take into account SIP flows and lump sum flows, which can continue to come.
All right. Hi, Nilesh. Good morning and good to see you. Nilesh, first of all, you need to compliment you. I recall more than a year or so ago, you all stopped taking inflows, SIP inflows in small caps, and that worked well. My question to you is, do you think that, small caps now, they've seen a fair bit of correction? Will you all be revisiting that? So if you could give us a brief idea on that. And also, we've got a new SEBI chief, and I believe that there is feedback that, is being taken from various market participants. What would your top expectations be to the new SEBI chief?
So one, SEBI has always an open door policy, and I'm sure under new SEBI chief, the same will continue. Undoubtedly, they gather inputs from all the investors, not just domestic, but also global. Very recently at Kotak Institutional Equity Conference, we had brought certain global investors to India, and SEBI was very kind enough to meet them in their offices. When we tell these investors that we'll take you to our regulator, they are surprised because that doesn't often happen in their market. And the transparency with which our regulators interact with them, the transparency with which their questions and queries are answered, and some of the myths in their mind which are removed are truly spectacular. There's a lot of misconception about the registration process in FPI. But when they look at the data, interact with SEBI, and the willingness which SEBI officials are providing to process their application, it does leave very, very good impression with the investors. I'm sure under new SEBI chief, this trend will continue. We'll continue to give our inputs for the development of the market.
Okay. Nilesh, to round things off, and you've seen so many of these cycles, and you've seen bigger crises, including the global financial crisis, right? If I were to ask you, what are the signs? One sign would be FPI buying returns. That's one clear sign. But through the years, in the last 30, 40 years of your stock market career, what are the indicators or signs that you look for and that clearly tell you that, this is the bottom's almost here?
So, Surbhi, I'll answer this in a lighter vein first. When I go to party and no one recognizes me, no one comes nearer to me, everyone runs away from me, I know that is the bottom of the market. Now no one is interested in stock market. That's the time to go and buy. On a serious note, as you very correctly mentioned, FPI stopping.
So right now what happens when you go to parties? Are half the people coming to you, or is the whole crowd still coming to you? Where are we on the party circuit? If there are still parties happening.
You have still invited me on CNBC, so my guess is that party is, just beginning. It's not ending.
Okay, but yeah, you were saying on a serious note, yeah.
FPI stopping their aggressive selling or turning buying will be one opportunity. The second could be the valuation. Finally, at the end of the day, stocks are slave of earning power. Value is what you get and price is what you pay. So if the valuation becomes cheap, let's say 14 times forward, 15 times forward, then certainly I believe markets will bottom out. The third could be geopolitical side. As of today, we are in a situation where America is putting tariff, their markets are going down, and everyone else's market going down. It's a lose-lose trade rather than win-win trade. If there is reversal in those geopolitical scenario, where from lose-lose we go towards win-win kind of situation, again, market will bottom out. Again, my limited point is that there's no way we can predict where the markets will bottom out. All we know, when the markets are cheap, we should be a buyer. When markets are expensive, we should be a seller. That is the dharma of asset allocation.
निवेश भाई ये बड़ा टफ टेस्ट दिया है आपने. जब आप कहीं पार्टी में जाएंगे लोग पहचानेंगे नहीं, ये बहुत मुश्किल है. तो मतलब आई थिंक बहुत रुकना पड़ेगा फिर भी. Thank you very much for that. Really appreciate your time and good speaking with you. There as far as markets are concerned. 100 points lower, so there is a bit of a recovery. That 22,000 is back on the board, but it's still 100 points lower. But the important thing is, and I was saying earlier as well, there was no volume on the downside yesterday. Look at what has happened to market breadth. Market breadth has now converged almost 1:1. It was almost 3:1, 4:1 in about 5-10 minutes back. And now we got about 1150 stocks which are higher and about 1270 stocks which are lower. There you go. It's almost now equal in that sense. And lots of those stocks we were talking about, Narayana was down 5-6%, is down 1%. Many of those stocks have recovered in the intervening last 10-15 minutes or so. And a lot of stocks coming up. I mean, it was all very small on the upside, but you got 3, 4, 5%, at least 10 names with decent sized volumes now, which we'll address in just a bit, which have got volumes and which have got decent price gains as well. So broader market looking much better from what the start really showed us. Guys.
Okay, all right. Well, more mature reaction is what you've seen in our markets. I think a couple of factors that played out. One is that we had already corrected, crude oil prices lower as well, a bit of a tailwind. So it's actually a pretty good looking screen, going by what we saw in the global backdrop. But let's focus on a couple of other stocks then. Bajaj Auto, that's the management next on our radar. Remember, the stock is trading closer to around a 52-week low. We have Mr. Rakesh Sharma, the executive director at Bajaj Auto, who joins us on the show. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. Well, let's focus on the domestic part of the business first. Are we on track to achieve the industry growth of around 6 to around 8% in quarter 4? You had briefly talked about earlier. In the first 2 months of the quarter, I think the growth is a little more than 4%. So your take on that?
Good morning. Yes, I think despite the turbulence, the little speed breaker we have hit in February, the industry does seem to should close the financial year with a 6 to 8% kind of, there's only one more month left now, which is this month. But it should come in at 6 to 8%, which is what we had said actually even at the start of the financial year. But having said that, the year has been characterized, and I think this is a sign of our times, that there have been wild swings in growth rates from quarter to quarter. So, like the first quarter was double-digit growth, I think early teens, and then quarter 2 sank to 1 or 2% growth for the industry. Then quarter 3 again went to 11-12% growth for the industry, in which October played a very important role. And quarter 4 expectedly was seeming to be lower even at the outset. And therefore, it's just the nature of the way the business is flowing now that it is very difficult to extrapolate from any one month, and it's better to take a long shot. And that long short view suggests that the industry is at about 6% growth fundamentally.
Okay, all right. So you're sticking to that earlier guidance. Could you tell us about your market share in the 125cc segment? We believe that there is some competition out there as well. So if you could give us what is the updated market share according to the numbers that you have?
So there is competition in all the segments, and yes, but the 125cc plus segment, which is 125 upwards, not just 125, that is the area of our focus. And our market share has been hovering in the region of 21 to 23% now for the last, I would say, 4 or 5 months. And why I give this band always is because, you know, in the end, it's a bit of a derived market share. We tend to look at retail market share, but what is published is overall. So based on historical trends, we derive competitive numbers, and that suggests that we are operating in the zone of 21 to 23%, which is a number 2 spot, a few percentage points behind, still behind the leader in that segment.
Okay, got it. Mr. Sharma, morning, sir. Just to go back to that point of growth, and you're saying industry-wide, I think 6% is a number that we should work with. I mean, somewhere this is getting a little confusing because you have the big stimulus coming in from the government in the form of the income tax cut and other events like in the northern part of the country, like this Mahakumbh. But despite a lot of these positives, the numbers have been month on month, the numbers have been, you know, they've been dropping off. They've been anemic. An analyst that we were speaking to yesterday was telling us that the lack of adequate financing perhaps is now beginning to hurt. Is that the sense that you're also picking up? Why is it that the numbers are not firing as well as they were till the first half of this year?
Yeah, you know, your observation is very right, because if we look at it very simplistically, it is difficult to understand the sudden downturn which almost every segment has faced. Whether you look at ICE scooters, ICE motorcycles, electric vehicles, they're all negative single digit, you know. So February has been a little bit of a surprising point, but that's why I prefaced my comments about, you know, the nature of growth. What we are finding since the last 2-3 years, that it telescopes within a few weeks, and then the peaks and troughs are very, very sharp. Fundamentals wise, I agree with you that the road network is expanding. There has been an overall positive budget. You know, the things like GST cut immediately impact the pocket, but things like income tax cuts are not easily apparent, and the net is much smaller. They affect a much smaller number of people. On your comment on financing, I won't entirely agree. From at least the ground reports which we are getting, that financiers who have been prudent from the beginning are continuing with the same policy. So we have not seen a pulling back. But we have, yes, noticed with some financiers that they've pulled back. But that too, I feel in certain pockets. What has happened is, and there I think SEBI also made a very correct observation, there are a lot of these small loans and which have been deployed in the stock market is what the speculation is. And then there is this halo, this wealth effect which takes place when the markets are down. So
I was coming exactly.
Yeah, but I won't say that it is an all-pervasive thing. It is there in certain urban pockets. But fundamentally, I feel for the industry, it is the fundamental drivers are intact, and it is the consumer behavior which gets into a consumption cycle when it believes it is the best thing to get into.
So financing, sir, is not a concern, right? I'm just clarifying that to place it on the table for our understanding. That fundamentally, there's no, curb in financing that's leading to this. It's other factors, sentiment, etc., like you're describing, right?
Absolutely. We have a 100% captive finance company, and I can tell you that between October and now, nothing has really changed in terms of changing the risk algorithm and stuff like that. I mean, we have to exercise prudence at all times, and that's being done.
Right. Mr. Sharma, good morning. You took the words out of my mouth. I was coming to that. I've been asking real estate companies and others as well, four-wheeler companies, whether this is a powerful thing, right? You feel poorer as you see your portfolio every day mark to market, and it's worth lesser than it was yesterday and the day before yesterday and the day before that. And it's all behavior at the end of the day, consumer behavior. How much of that is responsible for, and do you think it's yet to play out and it'll have this lingering impact if markets stay like this for some time? And what part of the portfolio, the premium end?
No, your observation is right. I agree with you. At the end of the day, there is so much of sentiment involved, particularly when you come to products which have got a discretionary purchase, like holidays or motorcycles for that matter. When there are headwinds, people tend to postpone these purchases or downtrade to some extent. So I would agree with you. My only limited point is that this wealth effect aspect driven from the stock market is not an all-pervasive thing. We have seen rural incomes go. We made a comment about the Mahakumbh, etc. We feel that the Mahakumbh factor is going to play out. I mean, it's just concluded, right? These factors will play out. And I personally feel that in the oncoming mini season, which begins by end of March and continues this time right through April, May, June in the north, which is the marriage season, you will see a reversal of trend, because that is again the nature of the beast. People start to hold back. And let me tell you, a lot of this consumer behavior is being shaped by some of the mega companies in e-commerce, these Black Friday type of sales, etc. There is slowly a psyche is evolving, which controls the discretionary purchase and times it with the best periods in the year. We are seeing that phenomena play out. And that's why I'm saying that this minus in February is not alarming as yet. Yeah, if it repeats over 2 or 3 months, then one would sit up. But otherwise, I would expect this negative to reverse into a positive growth, perhaps in the next quarter, beginning end of March to entire Q1. That is what my expectation would be.
Okay, and so final question on this whole tariff business. While a lot of the export markets that you operated, I mean, there's no issues over there, whether it's Latin America or Africa. But as you're watching this from the sidelines, all this play out, do you see either challenges or maybe even opportunities because of the cross flow with, counter tariffs from one country to the other? Basically, this whole US tariff business, does it impact you in any way, positively or negatively, either for end products or even for the supply chains?
Well, not tariffs in particular, because large parts of our business are in the emerging markets, which are not in the radar screen and in the crossfire. But the consequent impact of all this discussion, the seeming reversal of globalization, is definitely causing, again, some instability in emerging market currencies. And that leads to, that devaluation leads to inflation in the local markets. Of course, in another way, the devaluation of the rupee is helpful for our bottom line. But on the other side of the coin, our retail markets experience inflation, and that sort of impacts demand. But on the positive side of all this, I think I see an opportunity for a China +1 kind of a story emerging for India, where there are a lot of companies now wanting to source, wanting to spread the base, certainly into countries, capable countries like India. I would say we missed the first bus, where people like Bangladesh, even Bangladesh and Vietnam harnessed the wind. But I think we've got handed a second opportunity for this China +1 kind of a move. And that could augur well for our manufacturing.
All right, Mr. Sharma, we'll wrap up on that very optimistic note, and I hope it does play out for the industry. Thank you very much for explaining all of that and sharing those insights with our viewers here on CNBC TV18. Till the next time then. Well, 70 points lower on the Nifty. There is a recovery afoot. And forget the Nifty. Look at the broader market. It's completely turned around from 4:1 declines to advances. It's now 2:1 advances to decline. The NSE market breadth, the advanced decline will come up, and that is essentially the signs of a recovering kind of market. 1600 up, 800 lower, 800 almost 900 lower. And we have to mention these stocks. I know we have another management waiting, but look at just a few of these. KRN is the top volume-led gainer right now. Stocks at about 928. KRN Energy. You've got Schaeffler, which is up 4%. It's got large volumes. TD Power Systems is up 8%, 329. There is Garden Reach, which is up 6%. Stocks at about 1287. Zentech is up 5.5%. These were all stocks not in the mix in the morning when we looked at least for the first 15-20 minutes or so. Zentech, that is 1097 on Zentech. Bluejet is up 3%. Let's have Bluejet up, please. Praj Industries is up about 6.5%. Jyoti CNC is up 10.5%, 11%. Stocks at about 855 at this stage. Okay, there you go. That's Bluejet, Praj, Jyoti CNC. Look at something like a SW Solar, which is surging. It was flat 5 minutes back. It's up 5.5%. SW Solar. Look at GHCL, which is up 7%. Gravita is up 5%. Taj GVK is up 4%. Newland Laboratories is up 5.5%. Suddenly, there's like a burst of activity in mid caps and small caps, all in the last 7-10 minutes or so. Less than 10 minutes actually, because this is all fairly new, and there's more, but you get the broad gist. So broader markets, very solid recovery coming through. We take a break. We'll have the management of Jupiter Wagons joining us, Jupiter Group joining us to talk about the business and order book picture. Stay tuned.
Welcome back. Well, let's talk about Jupiter Wagons. Their subsidiaries have been in the news lately. Jupiter Electric Mobility will launch its first commercial EV. Another subsidiary has received a 255 crore order for wheel sets, and the company also has a big capacity expansion plan. To talk about all of this development, we're joined by Mr. Vivek Loya, the managing director at the company. Hi, Vivek. Good morning, and thanks a lot for joining in. Well, let's focus on the first point. Jupiter Wagons will be launching the first commercial EV, which is Jupiter Electric Mobility TEZ in Indore. Tell us about this development, the rationale, revenue potential, and how do you see things pan out?
Yeah, so good morning and thank you for having me on the channel. So this has been in the works. The launch of the car has been in the works for the last 3 years. The whole idea was that we were already working with the major OEMs, mainly Tata Motors and Volvo. We were their biggest manufacturers for load bodies and chassis. So the entire idea was that how do we complement the entire infrastructure. So that was the genesis of the launch of our eLCV segment. So finally, yesterday we have launched the vehicle. It is a 1-ton vehicle with the maximum range right now in its class. On road, it is giving a range of about 190 kilometers, and it's got a fast charge where you can charge the vehicle in 1 hour. The payload capacity is also the highest in the segment. We have got a very strong positive feedback from the market. The vehicle will start rolling out to our dealers in this month itself. And towards the end of the year, we plan to also launch a 2-ton as well as the 3-ton payload variant. So this basically covers our entire last mile and mid mile ELCV segment, and that is our key focus.
All right, Vivek, just to reconfirm, in this particular vertical, you have around 75% of the company, right? Of this electric mobility. Got it. And going by all the launches that you said, what kind of revenue potential can you throw up? FY26, FY27, potential margins as well out there, and your peak operational capacity?
So right now for the vehicle business, our capacity is at about 8,000 vehicles. And FY26 definitely, again, to give specific numbers, since we've just entered the segment, to give different numbers, it's very difficult. Yeah, if you look at the segment, currently the ELCV segment in India, typically about anything between 400 to 500,000 vehicles are sold in this segment. And by all estimates, in the next 2-3 years, you're looking at least a 25% conversion from ICE engine to electric engine, because there is a distinct economic advantage of using an electric vehicle. And especially in the metro markets, you're seeing that the charging infra is developing rapidly. So that is giving a huge boost to the segment. So we expect that in the next 2-3 years, this will be close to 100,000 plus vehicle market. And idea is to be ready with the entire bouquet so that we can aggressively tap this segment. Besides this, again, another key in terms of the subsidiary, the key focus for us is our wheel business, where we are undergoing a massive capacity expansion. We'll be investing close to about 2,500 crores in the next 2 years. We are setting, besides the existing facility in Aurangabad, we are setting up a greenfield facility in Orissa, where we will take the capacity up to 100,000 wheel sets, and of which close to about 50% of the capacity will be exported to the European market, and mainly to our partners, Tata Wagonka, who are the biggest manufacturers of rolling stock currently in the European market. So they have a sizable demand for wheel sets. So this is basically going to complement their entire rolling stock business.
Let's talk about some overall targets as well. I mean, I think the original target was doubling revenues to about 600 crores. So as we're almost about to wind down the year, in terms of top line, where do you think you'll end the year, and what is the CAGR growth that you'll target for, say, the next 1 to 2 years?
So, if you look at the wheel business specifically, 600 crores which you are talking about is the target for FY26. This year we are going to grow by close to in FY24 we did a number of about 100 crores in this business, which in this year we will take it up to 300 crores. Right now the only limitation for us is the capacity. So in Aurangabad, from now 13,000 wheel sets, we are ramping it up to about 20,000 wheel sets. In the next 4 to 5 months, that capacity will be online. So that will, the 600 crore revenue target, basically that will help catapult us to that target. And once the Orissa capacity comes in, you're looking at numbers of close to anything between 2,500 crores to 3,000 crores of revenue just from the wheel business itself.
And which year would that be, when Odisha is fully operational, commercialized?
No, it'll 26 end is when the axle line is going to start, and 27 is when it'll be completely commercialized.
Okay. All right. Okay, we will leave it on that note. Thank you very much for joining in and giving us a sense on the business. That's the management at Jupiter Wagons. Back to the screen now, and what a brave, pullback by the bulls, you'd have to say, from a decline of 2% on the mid-cap index. Now it's a recovery of 0.5%. Beautiful exchange on the advanced decline ratio as well. It's a phenomenal screen to be looking at. So good to get Mitesh in. Mitesh, what's the sense? What are the trades now?
Good morning, Vivek. Good morning, everyone. Yes, I think the original target was doubling revenues to about 600 crores. As we're almost, about to wind down the year, we plan to also launch 2 tons as well as 3 ton payload variant. So this basically covers our entire last mile and mid mile ELCV segment. And
So I think should be the first signs of reversal at least from the banking names. Though I think it's still to be confirmed. I would want to see the bank Nifty get past 48, 350, 400 zones, and then we can look at 48, 600, possibly 48, 900 to about 49,000. I think if that plays out, then I think we'll have a good bounce back, and that will weigh in on the Nifty as well. I think what was the fear in the morning that the bank Nifty could break down. It hasn't done that because we didn't sustain below 48,000, and now I think we are trying to give a reversal on the hourly charts, and my figure is about 48 400. So about that, I would want to take some long position on the bank Nifty with a 120 140 point kind of a stop loss, and play out for 400 500 point kinds of rally from there. Having said that, on the stock side, Bandhan Bank is something which has caught my eye. It did well after the morning decline and is giving a reversal. So buy here with a stop at 140. The first target on the upside should be around 147, though I suspect we are looking at about 153, 154 on the upside. And the other stock is Indigo, which it actually didn't decline also much. This has been clearly showing outperformance, and today the intraday charts are also positive. So Indigo is a buy with a stop below 44.80 for targets of 46.20.
Okay, all right, Mitesh, thanks a lot for that. In fact, Interglobe is one of the stocks on the radar because crude oil prices have cooled off, which could have a bearing on the ATF prices as well. So that's one big stock that's recovered from the day's low, and the OMCs as well. Falling crude is a positive for them. It could help them in terms of their EBITDA numbers as well. So you pull up HPCL, BPCL and IOC. All of them from the low point of the day have seen a big recovery. Not ONGC, but the OMCs is what we're talking about because they gain when crude oil prices move down. And all of them have seen a big recovery from the low point of the day.
All right. No, I mean, I think it's a solid bounce coming through on the broader markets, and market breadth is improving even more as things stand right now. Let's talk about IT services as a space. Now, Sandeep Agarwal is with us, fund manager at Sowilo Investment Managers. Sandeep, good morning. Good to have you here. Prashant on this side. Now, IT, 2 weeks back, it was looking like it was not correcting. It was down about 8% from the highs. Last 2 weeks changed all of that. It lost another 10%. So we're down about 18, 19% from the highs for the IT index itself. The other question more recently, of course, is if the US market starts to come off and growth indicators, etc., are moderating, what will it mean for the market as such? Specifically, what will it mean for the IT services sector? So just start with that basic point. We've had very strong US economy and markets for a few years. And for the first time, we are starting to hear that maybe things are going to go in the other direction for a while, maybe temporary, we don't know. How does it affect IT services companies from here, where they are already? Sandeep. You'll have to unmute yourself, Sandeep.
Yeah, hi, good morning, and thanks for having me on the show. So Prashant, if you recollect our earlier conversation just 18-20 months back, when there was gloom and doom in the industry, we were extremely constructive and we were very positive. Last 5-6 months back, if you see all my interactions, I have been saying that, all the positives are baked in, but any kind of negative which can come, and if it at all comes, then we will be in a difficult spot. Now, Indian IT has a more than 95% market share globally in the outsourcing part, if you exclude the BPO piece. So we are very strongly positioned when it comes to execution at a reasonable price. But remember, when US economy was doing well, we were hurt very badly because of the disruption which was happening on the AI side. Because whenever disruption happens, the biggest task which Indian IT companies have, they have to, train their whole workforce into that new technology. And by the time when we are 2/3 in that journey of training, we are now seeing early signs of some weakness in the US economy. So, because Indian IT is priced to perfection and one of the cash flowing sector, no one leaves these stocks easily. And there are gaps in 2 or 3 years period of 2-3 months when you get them dirt cheap. And that gap, I think 18-20 months back was there. Now, I think, large part of correction has happened, but I still believe there is some more correction which will happen. The primary reason of saying this is that, no negative news from Trump at least has come yet on the sector. And Trump being Trump, you cannot take him for granted that, he won't do anything in such a big exporting sector. You remember 2014-15, all these localization things came and he enforced that we have more than 50% local employees and all, and that wiped out the margins of the Indian IT companies because local employees are hard to get and very expensive. So nothing can change that. Although, I can tell you that there is no one who can execute at this price in the US, and ultimately the US consumer will suffer very badly if any harsh step is taken on Indian IT. But having said so, politics being politics, you cannot take a call on either side.
You're talking about making it more expensive, sort of tougher to hire Indian workers. I mean, on that side, right? On HR side. You're not talking about a tax on services or anything in that sense.
I don't think it will be tax or services, but it will be more like, he may put in some more condition that you have to hire more local employees. And that becomes very difficult because it is in that market, employees are not available. So if you have to hire more, those few number of employees are chased by more number of employees. So the salaries and the outflows start going up, putting a dent on the margin. So the cost of doing business can go up. That is all I'm trying to say.
Okay. All right. Sandeep, good morning and thanks a lot for joining in. Well, FY26 growth forecasts are mid to high single-digit growth. The recovery, though, has been gradual. Do you think we get back to, say, double-digit growth from FY27 onwards?
I think so, because, in FY26, what will happen, all your training of AI workforce will be broadly over. So after that, we will get some benefits. So low double-digit growth or high single-digit growth is something which FY27 can obviously deliver. But with similar margins. So in that case, what multiple you assign is a very important question. I think the large names like TCS, Techem, and HCL, Infosys, Wipro, they are broadly corrected and the time correction is also done. So I think some money could be there. But some of the names still are very expensive in the mid-cap space where, we have little less comfort and we believe if cost of doing business goes up, then there is some risk.
But so you're saying there's some more correction ahead, perhaps in large cap IT names. And then the basic question, Sandeep, I mean, even if someone decides to buy IT, it'll probably be for other reasons, for instance, cash, safe haven, etc. In terms of growth, can we hope to buy anything more than 5-6% growth or 4-5% growth in these companies next 2 years, say? Will the growth numbers look the same or do you see some improvement?
No, I think FY27 will be better than FY26 by 2 to 3% at least.
Which means how much growth in FY27?
So around 8 to 12%, depending on the size of the company, is what I see in 27, but not in 26. In 26, I am more like 6 to 8.
Okay, but that's good. 6 to 8% growth in 26, maybe 12% in FY27. Don't remember the last time we were in double-digit growth. So then leave us with some top picks. If someone has that at least 1 year time horizon, if not longer, then what would be your top picks that you would perhaps be convinced on?
So we run a PMS. I will not give stock specific name, but I will give you a flavor. So, in the large cap, there are few stocks which are now reasonably priced at 16-17 times 1 year forward. Those are the stocks which you can start looking at. And in the mid cap, other than the ER&D space, if you are getting something at 18 to 20 times, so PEG ratio of 1.25, 1.5 is something we can start looking at. And in ER&D, you have to give obviously minimum 2 times PEG ratio because that is a space which will do more than IT services growth for next decade. So you will have to pay a higher premium there. So we clearly see ER&D as a very good play for a longer term if we get at a right price. And within the mid cap and large cap on the IT services, we will be willing to give around 1 to 1.25 PEG ratio. And whenever stocks are coming in that range, it is an attractive level in my view.
All right, Sandeep, we'll leave it there. A shorter chat today, but very, very useful in these volatile times and gives us a broad idea about how to think about the space. Thank you. We take a break. We're back with Manisha on the other side. Commodities in focus.
Today, I'm announcing a new deal which allows Ukraine to use £1.6 billion of UK export finance to buy more than 5,000 air defence missiles, which will be made in Belfast, creating jobs in our brilliant defence sector.
I think most important thing is now, don't wait for the, because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Okay. I have seen best of the chartists and all telling me, they're all eating their own stuff. So what I'm saying is, now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay. So if you like certain stock, and that stock is available at your dreamy price, and it has gone below that, don't hesitate, start moving into the market. This time, the market has moved from 500 rupees EPS to 1,000 rupees EPS for Nifty, and market extended from say 8,000 at the bottom to 24, 25,000. So it went 3x, earnings went double. So obviously market got re-rated big time. Now we are correcting that re-rating because earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%.
Welcome back. So the Indian equity screen is trying to recover. It's not looking as bad as the dire morning. Let's find out what's happening in commodities. Manisha's with us in the studios. It's all rock and roll, isn't it? Particularly in those Bitcoins and Solana and whatnot. But you tell us, Manisha, what's the latest?
Well, I'm looking at all of those markets right now because, you couldn't choose anything. Everything really seems to be looking at off-risk appetite in these markets. And the broader market sense really seems to be taking a hit because of that. And today is yet another day. But you rightly said it's not so sharp, not so deep and not so bad today. But the pain just about continues as markets are looking at tariffs and then this conversation about retaliatory tariffs as well, which seems to be weighing in. I just want to put some numbers in and explain. Well, US as of now has said that they're looking at 25% tariffs on Canada and Mexico, and that 10% tariff on China will go up to 20%. But if you look at those numbers, well, US imports worth nearly $900 billion from both of these countries. And when you look at both of these countries like Mexico and Canada as well, the export numbers that go to the US are really big. So it is really going to be impacting all of these countries there. So 83% of all Mexico exports happen to US and 78% of all exports from Canada happen to US. So those are big numbers that we're talking about. And this is going to be bothering broader markets as well. Well, US is looking at higher tariffs. And I also want to talk about reciprocal tariffs because that is a statement that also has come in from the US President Trump. He says that reciprocal tariffs will take effect from 2nd of April. So we're looking at tariffs right now. Retaliatory tariffs will come in from other countries and reciprocal tariffs from US will take effect on 2nd. So this is not really ending in any time soon. We already have seen statements coming from Canada announcing retaliatory tariffs, which will come in effect from today when the market opens. The second statement comes in from China, which has rejected US tariffs, saying that they will take countermeasures as well. And we have seen that impact come into the markets. Crude, for example, this is a third straight year that we are trading in negative for the crude oil prices, down by nearly 6% for this year until now. Overnight, we saw 2% of decline, and these prices really are a 12-week lows that we're looking at. The U.S. crude prices are now just about holding $68 a barrel there. The other factor that's bothering crude really is OPEC statement saying that they will increase output in the month of April. They really seem to have written that bullet that US has been given them. Apart from that, the US and Russia conversation also perhaps could give some relief on sanctions to Russia. Russia, remember, is the third largest oil producer after US and Saudi Arabia. And if we are looking at more Russian oil coming into the market, that also seems to be weighing in. Base metals should come in on your screen because we've seen a decline on that as well. On a week-on-week basis, almost every metal is trading in the negative side. The biggest declines coming in for iron ore, trading at a 6-week lows, and the steel prices trading at a 3-month lows as well. The U.S. consumer sentiment for the month of January declined because after U.S. signed that notification about including many of those cryptocurrencies in their strategic reserve, we saw the prices run up quite strongly, but not anymore. The last 24 hours really have been quite harsh. So 10% down on Bitcoin right now, 15% down on Ether, 20% down on Solana. And you have declines coming in for many of these cryptocurrencies to the tune of 30 to 45% as well in the last 24 hours there. But there's important data coming in as well. You have ADP employment numbers that come in on Wednesday, and then you have US non-farm payroll data that comes in on Friday. So this continues to be a very, very active week in that sense.
All right, Manisha, thank you very much for that. I'm wondering, Surbhi and Manisha, what are tariffs when you impose tariffs and there are the other country imposes tariffs? They're called reciprocal tariffs.
Or retaliatory. You can choose whichever word
and
sounds better.
If the first country imposes tariffs in response to the retaliatory tariff, what are those called?
Dual retaliatory. I don't know. I'll think it up in the break. It's called a tariff war, to keep it simple. Global trade war.
Okay, all right. Well, Manisha, thank you very much for that. We'll take a quick commercial break here. We're going to come back, but we're going to focus on the local economy. And we'll talk about NBFCs with Jairam Sridharan of Pyramid Enterprises. He's Lata's guest on the other side. Stay tuned. Interesting chat coming up.
There is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. And despite that, we are doing 6.5%. Don't forget that. It is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. Excesses in the market was very clearly visible. And regulator, government, worldwide investors, everybody was uncomfortable. So this is a very healthy correction. And now next year, earnings will pick up from 1,050 to maybe 1,150 or 1,200, whatever. And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. You know, government expenditure is picking up. So I think all the things are falling in place and correction has also happened.
Welcome back. We have spoken all morning about Trump's and tariffs in the US economy, but the market seems to have just recovered from the day's low. So let us now revert to one domestic issue which gave us much relief in early February. The Reserve Bank of India cut risk weights on bank loans to NBFCs and MFIs from 125% to 100%. This was probably because since November 2023, when the risk weights were raised, bank loans to NBFCs have fallen from 30% YOY to 7% YOY as of December. But the Reserve Bank has not cut the risk weight on unsecured loans. So have unsecured loans continued to be a pain point and are not yet out of danger? Also, how has life improved for NBFCs more generally? For all these, I'm joined by Jairam Sridharan, the Managing Director of Piramal Capital and Housing Finance. Good evening to you, Jairam, and thank you very much. Jairam is actually in the United States now and has stayed up for me. Thank you very much, Jairam.
Thank you. It's always a pleasure to be with you.
Well, for starters, you were the one who told us about unsecured loans actually a good 2 years ago. And actually, the Reserve Bank followed, I think, about 3 months later. So I wanted to ask you first about unsecured loans. Your own
Piramal balance sheet is quite good in the sense your NS3, GS3, that is gross NPAs and net NPAs are actually declined by a few basis points in your Q3 results. But what is your view of the sector? Are unsecured loans going to continue to give us bad news?
Yeah, the short answer to that is yes, unfortunately. The way the year has gone so far, the financial year, when it started, we were in absolutely the best of health, right? The sector had an absolutely rocking quarter, Q4 last year. But then suddenly, after March, when April happened, things seemed to have deteriorated quite suddenly. Like we didn't quite know what was going on. Operational metrics and unsecured credit were bad in April, and then worse in May, and then even worse in June. And the story just continued all the way through November, almost till December. So there has been many months of deterioration in unsecured credit, and it has been more severe in some product categories like microfinance and a little bit in small business unsecured credit, and a little bit less intense in salaried businesses, in larger ticket businesses, etc. So it has not been the same everywhere. It has been mixed. However, where we are today is that the pain seems to have, from an operating metrics perspective, things have stopped deteriorating. That's pretty much the most that can be said about it. Things are not getting worse anymore. It's been 3-4 months of relative calm, 3 months of relative calm, and things haven't gotten worse. However, by no means can it be said that things are getting better. So it is.
To speak on the I take a point. To speak on the side of things getting better, the government has really started spending well. Up until October, there was practically a drought of government spending, and then in December, it was a 95% increase over a year ago level, their capex spending. January, we again have the data, 50% more. So do you think now loan growth can improve simply because, there is more economic activity? After all, the Q3 GDP came out so much better than Q2. So is there a loan growth possibility?
I think so. I think the growth side of the story had also weakened, unfortunately, over the last 9 months, when the growth rate of overall lending at the sectoral level, which started the year at 20%, ended the year at, or ended December at less than 10% or around 10%. So growth rates have really, really slowed. But now you're absolutely right, Lata, in saying that the government spending makes a big difference. And as the government has started spending, projects have really started taking off. We can see that, that excitement come through. We can see small businesses start to spend a little bit more. And my guess is that you will start seeing loan growth pick up a little bit more from the low levels where it has been over the last couple of months.
Okay, you're in a vantage position to tell us about the real estate cycle. While it has been one of the better factors in the economy, has the cycle been impacted by the wealth effect? After all, we have seen trillions of rupees melt away in market cap. So what's the state of the real estate sector?
Very often when we speak about real estate, we get too carried away by, few real estate players who are listed, right? And their numbers and their public pronouncements, etc. But remember that real estate is a very, very, very fragmented industry. And to get a real sense of what's going on in the sector, you got to look at the entire country, small towns, big towns, everything together. The story there, Lata, is that since COVID, the recovery of the sector has been decidedly K-shaped. The higher end, the more luxury end, has done spectacularly well. Any project that comes out today, which is more than 2 crores, 3 crores ticket size, is just sells like hotcakes, right? In fact, in Mumbai, there are multiple projects with double-digit crores as the average ticket size, and you can't find a spot there. However, you look at the 25 lakhs and below space, and stuff is not selling at all. Things are very, very slow. So it's a very two-paced market right now. The top end is doing extremely well, and the bottom end is actually not doing well at all. And if you look, for example, at the lending business, at the less than 25 lakh loans, for housing, you will see that the growth there is negative at the industry level. So that shows you that there is no, the small low end is struggling. The guy in the semi-urban and rural markets is really struggling.
Okay. What about, then let me bring it down to Piramal itself. Piramal Finance, the disbursements in Q3 were 8.7% higher from YOY levels. So, and you of course serve used cars, business loans, salaried. How would your loan growth look like?
We're, we've been blessed. We've continued to have year-on-year growth rates upwards of, 30%, 40% actually over the last couple of years. And this quarter is continuing to look strong. So from an AUM perspective, we've continued to feel very good about the growth rates, and we will continue 30% plus growth rates that we've had. Whether it'll continue in the next year is a little bit harder to say, but right now this quarter is looking very strong.
Okay. Now, in your company, of course, you all are running down your old AUM, what you call 1.0, and building up your new loan book. The old DHL book is being run down. When does that process get completed? When will you be not impacted by higher credit costs, very high credit cost actually, because of that legacy part?
Yeah. So we have guided the market that we will end this financial year, that is March, with less than 10% of our AUM being from the legacy book. We are very much on track for that. We ended last quarter at 13%. We should be below 10% by the, over the next few weeks when March ends. Our hope is that by next year end, this number will be significantly south of 5% of our book, and hence will kind of become irrelevant.
Okay. Has life improved for you after the risk weight decline, and what might that do to margins?
Yeah, it's certainly better. Like it's more than the specific risk weight reduction action itself. It's the signaling that makes so much difference. It's a regulator telling the banks that, hey, lending to NBFCs is not a bad thing. I'm not discouraging you. And I do want NBFCs to participate in building the economy as well. That signal goes a very long way. See, specifically when banks are pricing on the basis of RAROC, or risk-adjusted return on capital, a 25 percentage point reduction or a 30 percentage point reduction in capital or risk weights results in about a 25-ish basis points reduction in price, right? So that's basically what mathematically one would expect. But much more so than that, what I'm really happy about is the signal that the regulator has sent, and hopefully that encourages a lot of lenders to step forward and go ahead with lending to NBFCs as they used to do in the early part of last year.
Okay, let me a quick last question. Also, because it's time I allowed you to retire. You've had a long day. Just wanted to know, what would you guide by way of margins now, and what would you guide by way of loan growth for the full year? I mean, this quarter is almost over. For the full year, do growth prospects look good, considering that the global environment is not very clement now?
Yeah, I think for us, idiosyncratically as a company, like, our growth prospects are pretty strong. So I feel very good about where we stand. Our core growth book should comfortably grow at about 20%, and on an overall basis, after accounting for the rundown of the other book, we should comfortably grow about 15%. So I feel reasonably okay on the growth front. On the margin front, the sector, NBFC sector overall, has seen margin compression throughout this year. But I think that margin compression story is largely done. Now that RBI has started the process of rate reduction, that will slowly start expanding margins. And that's the way historically it has happened, is that as RBI reduces repo rates, slowly it transmits to sectors like NBFC, and margins start to expand on the other side. That's what I expect to happen in this cycle as well. That should start, I would say, about 4 or 5 months from now, as banks start cutting their MCLRs.
Okay, that's good to hear. Jairam, when you're back in India, let's have a longer conversation on the state of the NBFC sector as well. The economy was clearly looking like in a good run, but today's global headlines are casting a bit of a scare. Let's wait and see how things pan out. Thank you very much for staying up for us and for this conversation. As we sign off on Bazaar, the markets have recovered a goodish bit from the morning lows, certainly much better than what the gift Nifty was indicating before markets opened. Positive note as we go into a break and invite Chartbusters team.
So the first thing is about the values inside the family. And for us, the work was never looked at the balancing part of life. It was always something which was the biggest part of our life. Growing up, we saw our parents, both my father and mother, not only try to balance family and work, but make them both the biggest priorities of our life. And that's something that I've continued to embody as we have now been working in Reliance for the last 10 years. So the question of balance really does not come of balancing family or work. Both are the biggest priorities of my life. And there's one simple funda that I think we all need to embody, which is, your priorities of your life. And, as you grow older, your priorities change, but you want to make sure that your priorities are something that are very meaningful to make your life what you imagine it to be. And from our point of view, my family and my work are the two biggest priorities of my life, not only for this phase, but going forward also.
Yeah, that's a great answer. Shlok, thumbs up. All right, you got the thumbs up from the wife. Talking about your dad, MDA, obviously, Mukesh Ambani for all of us is the inspiration for our whole country. Everyone looks up to him. You have a mom who actually runs larger companies than 99% of them.
D Street opens lower but quickly comes off the day's low, even as global markets continue to react to Trump's tariffs on China, Mexico and Canada. That come into effect today. The Sensex and the Nifty recover from the day's low to trade flat. Mid-caps outperform.
Bottom beverages climbs about 3% as CLSA upgrades the stock to a high conviction outperform, citing the company's risk-reward being compelling despite assuming competition impact of 4 to 5% on their earnings.
Ask Automotive rallies 5% after the company signs a tech assistance and license agreement with the Japanese company. The stock is up 5%.
Jupiter Wagons rises more than 5%. The subsidiary of the company, Jupiter Electric Mobility, announces the launch of its first commercial electric vehicle. That is, management tells CNBC-TV18 it will start rolling out to dealers within this month itself. Good morning, you're watching us here on Chartbusters on CNBC-TV18. I'm Manglam Malu. With me as always, Nigel D'Souza. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. It's an interesting trading session. We've seen drubbing over the last few weeks, and now it seems like maybe the process of bottom formation is on for the market. It hasn't been a slam dunk at lower levels. From yesterday afternoon itself, we've been seeing recovery, and that recovery actually has been led by individual stocks in the mid-cap end of things, which have seen a sharp drubbing itself. All things speak about silver linings in the market. Yes, at the top of our heads, we have the Nifty Sensex marginally in the red, the Nifty Bank outperforming. But Nigel, all is not lost. We are in the process of bottom formation.
Well, that's right. Mangalam, and the call this morning was that Nifty as it is underperformed. So in these sort of situations, it's not such a bad thing to be an underperformer. Otherwise, you're top of the pops and there's every reason to see some selling. But today, as it is, you've underperformed the globe, you've underperformed the emerging market basket. And that's why valuations have become more palatable. And in addition to that, I think a very, very important point from an India perspective is crude oil prices. That's cooled off to $71 per barrel, which is a big macro tailwind. So put all this together, the screen is looking better, not out of the woods, but yet I think the 21,800 mark, if that gets held out, you want some kinds of consolidation. And then, in fact, you can gradually see a recovery. So some consolidation, that will be the first call, and hopefully then a pullback.
Take that point entirely, Nigel. On Brent, as well as the other thing, which was the dollar index, which fell below that 107 mark as well, 106.5. So you have double tailwind, so to say, for the markets. Compelling valuations, favorable macros, hopefully. Let's see where it goes.
All right, let's get in Shilpa route then. Hi, Shilpa. Good morning. Good to see you, Ben. Shilpa, what's your take on the markets? Everyone's talking about this near-term band of around 21,800 on the downside, and on the upside, it's anything between 22,350 to around 22,500. What's your take? The Nifty is still down 50 points. Buy the dip?
Yeah, good morning, Nigel and Mangalam, and thank you for having me on the show. We have been talking about 21,800 based on technical levels, that it is a 50 WEMA, and in any falling market, usually the 50 WEMA holds a very crucial pivotal level where you see some sort of bottoming out happening on temporary basis. So 21,800 definitely looks like a very a strong support, and everybody's eyeing on there. If it holds, then we might see some sort of recovery happening towards 22,000 to 22,200 levels. And if that so happens, then eventually we might see some sort of stability in the market. Likewise, Bank Nifty 48,000 continues to be support, and it is holding on well. The put writers have the strong conviction out there. So as long as we are holding 48,000 mark, we should see some sort of respite, and the move towards 49,500 to 50,000 can happen then.
All right, we'll take that point on board. Just keep an eye on a bunch of stocks which are spiking right now. Alembic Pharma at the high point of trade. HPCL is at the high point of trade as well. We are seeing some traction in names like Geo Financial Services, Nykaa, Laurus Labs. All of them are doing well at the high point of this morning. The broader market's actually looking in much better fettle. Though the tug of war around tariffs continues, we have some news coming in from Bloomberg saying that China will impose up to 15% tariffs on goods from US. It is the season of retaliatory tariffs. China will levy tariffs on some US products, which include the likes of chicken as well as soybean. So we'll keep an eye out on this as it progresses, largely because we have tariffs, we have retaliatory tariffs. There's China, there's Mexico, there's Canada. All of that is happening.
Mangalam, one fear was they expected Trump to go hard out at China.
Yeah.
And suddenly we are not hearing about that. So, with this sort of tariffs and counter tariffs, between them, it's okay. Hopefully, we are saved a little bit. But, the hope is that Trump is quite strict with China. And, then it makes sentiment a little bit positive. And hopefully we have better bargaining power.
Take that point completely. But, let's talk about bargains in the market itself. Individual stocks. Shilpa, what do you have on your list?
I have two buys. The first one would be a buy in Scient. Scient is looking very strong. If you look at the option chain, you would understand that 1200 we have very strong support out there, very strong high conviction by put writers. So that becomes the stop loss. So 1200 should be the stop loss, and a little positional trade from here. Levels of 1400 can come as well. So one is Scient. The second one would be Hindalco. Hindalco is holding very well at around 640 zones. So the stop loss would be here 620. As long as we are holding above 620, we are good to see levels of 680 to 700 zones.
Okay, all right. Thanks a lot for that, Shilpa. Well, I think on that note, I think we can move on and get you some ideas of profit. That's our special segment, as always, from Money Control Pro. Khushbu joins in to tell us about a stock that she's tracking closely. Khushbu, take it away.
In today's idea for profit, we have Cholamandalam Investment and Finance. Chola has a diversified business model with a strong focus on rural-centric retail customers. If we look at the recent company's performance, The asset growth was ahead of guidance, but the asset quality saw some pressure due to seasonality and challenging macros. The company will be investing in incubating newer businesses, technology, and branch addition that will drive growth in the coming period. The capacity utilization, which was subdued during H1, has seen signs of improvement, and the asset growth is expected to continue to surpass guidance in FY25. Net interest margin will likely improve in a declining interest rate environment, which will help to improve the core business margin. Moreover, the business is shifting towards the high-yield product mix, which will help the company to sustain healthy profitability, while the low credit cost of the mortgage portfolio and improved collection in the vehicle finance will support the overall asset quality. Though the valuation is a bit higher than the industry average, it is justified given the better quality of the earnings.
Right, with that, we'll take a short break. On the other side, Ravi Jakhar, who is the Chief Strategy Officer of the All Cargo Group, joins in to discuss the group's business outlook at large. Stay with us.
India. So you have this like super achieving family. How do you step into these shoes? These shoes are like very large shoes to fill. And how do you manage, and what is your biggest inspiration?
You know, Harsh, biggest inspiration goes without doubt is the family that we've grown up with. We've all lived under one roof for now 32 years of our lives. And the inspiration is not too far to find in both my parents. I deeply value the human beings that they are and the work that they do. But the inspiration really does not come from, large items. Of course, the vision, the boldness, the ability to be very, very inspiring. It comes from the small things, like for example, till date, my father clears each and every email that is sent to him, and he does it till 2 a.m. at night, and he's working for the 4th decade of his working life. And that's where the inspiration really comes from. My mom, very, very similarly, like we'll be staring at the same thing. We share a joint passion for cricket, and we're watching the same TV, but the small little details that she notices is something that you can draw inspiration out of. And I think out of and above everything is their dedication is the biggest inspiration for everyone around us who are who have grown up around them. And that's really why we can say that the biggest inspirations, because we can tell all of the small nuanced things that make the difference. In our estimation at Jio, I think AI is the biggest technology change that we have seen in our lifetime till date. And it is, in my view, it is the engine that will empower India to grow at 10% or double-digit growth numbers for the foreseeable future. So we continue to, what we have to really do to do it, I think there are 3 fundamental blocks that we have to do to enable us in that AI leadership moment. I think to continue to invest in AI infrastructure, AI data centers that are completely ready, that can scale.
Welcome back. Even as the market continues to move around, we have Voltas, which has moved higher. Now look at Blue Star. Blue Star is a stock which actually had seen not much of a correction of its 52-week high. It was down just about 8-9%, and from today's low itself, it's recovered about 11-odd%. It's currently sitting with a gain of 8%. So a bunch of stocks in the broader markets doing a lot better, seeing purchases. And if you look at the advanced decline chart, that tells you the story of the day. 1,800 stocks now advancing for just about 773 stocks which are declining. So even as the frontline indices are marginally in the red, portfolios would be feeling slightly better after the drubbing that we've seen very, very recently. In that, let's talk about one of the business groups. That's the All Cargo Group. Ravi Jakhar, who's the Chief Strategy Officer, now joins in to discuss the company's outlook for the very near future, the medium and long term itself. Thanks a lot, Ravi, for joining in. Always a pleasure speaking with you. We have the update that has come in from your businesses, All Cargo Logistics, Gati, as well as All Cargo Terminals too, for the month of January. The question is, what is your volume growth prognosis for the full year when it comes to all these three businesses, and what are you targeting for FY26?
Thanks. It's always a pleasure being on your show. So let me start with the domestic business on India side, which is contract logistics and express business under All Cargo Gati. On the contract logistics, we are now tracking at more than 40 to 50% growth year on year, and we see the momentum continuing. We have done extremely well in some of the new segments that we have gotten, such as quick commerce, warehouse management initiatives. On the express business, for the month of January, like you mentioned, we started with a growth over the last year. And we believe that the domestic consumption, the rural economy has started to do well, and now that should have an impact on the urban economy. And the overall distribution of goods across the country should increase, which means that express industry should outperform the last 2-3 year average, which has been hovering at about 9%. And we are confident that we would beat the market growth rate. So I remain confident of a double-digit growth rate as far as the domestic express business is concerned. On the terminal side, we continue to do well on the CFS business. We have a new ICD coming up in NCR as well, but that won't be operational soon. It will take more than a year for that large project to come in. For now, the CFSs continue to run close to capacity, and we expect it to be again close to a double-digit growth for the year 2026. On the international business, we started the year with 9% growth in FCL and about 4 to 5% growth in LCL, which for a global business is quite good. We believe that given the whole international geopolitical and economic outlook, the next 3 to 6 months may remain subdued. However, we do expect pickup from mid-year, say after 3 to 4 months, and the volumes should expand beyond that. Personally, I believe that more than the US tariffs, it's the war in Europe that would have a far more bearing on the trade outlook, because that could revive some of the European economies on the back of Ukraine reconstruction. And so there are a lot of factors at play, but I believe that on the international trade, as well as on the domestic side, across businesses, we would continue to outperform the market growth rates, and therefore I remain confident about a good growth in the year.
All right. Hi, Ravi. Good morning and good to see you in. What's the targeted margins for the all cargo logistics business? I see at the 9-month mark, you're doing close to around 4.3% odd. Scope to improve further, or will it be in this vicinity?
Yeah, so I would say, one should look at the international and the domestic businesses separately. As you know, we are going through a scheme of rearrangement. About 2 weeks ago, we finally got shareholders' approval with an overwhelming majority, I think 97 or 99%, something like that, which was in the NCLT convened shareholders meeting. And now it's the final procedural steps which remain. So in the next about 2 to 3 months, we should see the international business listed separately and the domestic businesses all combining, eliminating all the subsidiary structures. So from a profit margin perspective, I would say, a like-to-like comparison could be difficult, but structurally on the international business, I would say, next couple of quarters could be more flat, but then we should see an upward movement on account of either the trade improvement, and even if that was to not come through, our own internal initiatives should help us improve on the margin side. On the domestic side, it's an operating leverage play as we continue to grow and expand. Margins should continually improve. That has been the trend for the last almost 3 quarters now, and the same trend should continue as the operating leverage should continue to play out.
So if you could give us some qualitative comment on the domestic margins itself, because I'm looking at All Cargo Gati, EBITDA for the first 9 months have increased by about 53%, with the third quarter EBITDA actually having tripled. What's the targeted margin for Gati as operating leverage increases? And if you could also give us a sense on what you're targeting when it comes to your revenue mix for the domestic business in terms of air volume, contract logistics, and express logistics.
So air volumes would remain about 5 to 7%, while the surface express would remain at about 95% as far as the domestic business is concerned. Contract logistics is not a volume business. It is about 6 to 7 million square feet of warehousing space that we manage. And we believe that it could be a low double-digit growth on the express business, while it could be a 20% plus growth rate on the contract logistics business on the top line. In terms of margins, like I said, the SG&A would be more inflationary increases, and therefore and operating leverage should play out, and we should see a continued improvement on both the absolute numbers as well as the percentages as far as the express logistics business is concerned.
Are you looking at double-digit margins anytime soon in the express logistics business?
That would possibly take a bit longer, considering the operating leverage and the near double-digit growth rate. I think that would take some time to play out.
Right. Do you have any, M&A plan in the very near future? Because you've always been acquisitive in nature, and even in the third quarter end, we saw you further increase your investments in a couple of the companies that you had earlier acquired. So is there any specific area where you're in talks and something that we can hear very soon?
So we are not looking at any acquisitions at this point in time. If you observe our long-term strategy, we were in a phase of acquisition to build out the positions in markets or segments where we were not present. That has all been completed. What you hear of now could be marginal, increases in existing joint ventures, which is very small. In terms of the business segments and geographic presence, we are well covered. We have all that we wanted. From a restructuring perspective, the two companies were already demerged and listed independently last year. And like I said, in the next 3 months, that will also get completed. And therefore, we come to the final terminal phase of restructuring. The focus right now is primarily on organic growth, and as we call it, internal consolidation, trying to see how we could, particularly in the international business, how we could continue to leverage cost synergies, how we could look at using the one global financial system to move certain functions into low-cost economies. How can we automate the operations? So the entire focus is around use of technology and bringing in greater cost efficiencies across the business. On the domestic side, it is, of course, on the back of buoyancy on the Indian economy. We believe that we would be beneficiaries from that. Any manufacturing-led economic growth has always been led by logistics, and we believe that next 5 to 10 years would continue to provide a great opportunity, and therefore the intent is more commercial revenue focused while maintaining the cost. On the international side, as long as the trade outlook remains subdued, our focus is on internal consolidation, trying to see how we could optimize costs and improve margins.
Take that point, Ravi. Always a pleasure speaking with you. And I think the street likes what you're saying with regards to double-digit growth and maybe the worst being behind for express logistics as well, even as there are some pressures in the international business for the next couple of quarters. Look at the intraday chart of, say, something like an all-cargo logistics or all-cargo Gati as well. You will see some bit of a recovery in the stocks from the lows. So all-cargo Gati is now at the high point of trade. And we also have all-cargo logistics, which has seen a bit of recovery from the lows itself. With that, what we'll do is take a short break. But as we do that, here's some good news coming in for all you viewers. It's India's business news leader, which is now a click away. That's the CNBC-TV18 app, the all-new CNBC-TV18 app, which gives you access to breaking news, in-depth article, and all financial world updates at your fingertips. You can download the app from your Apple Store or Google Play Store, or just scan that QR code, which is up for you on the screen, which will redirect you to the link that takes you to the all-new CNBC-TV18 app.
Scale for India at millions and millions of users. At Jio, we are already doing that. We recently announced in Jamnagar that we're building our AI data center, which will be a gigawatt capacity data center.
Wow, that's amazing.
But continuing to invest at the infrastructure level. The second and third thing actually go quite jointly is the research and development part of AI. Today at Jio, we've already invested in our overall full stack AI team, which is led by data scientists, researchers, and engineers to be 1,000 plus. The critical element in this, I feel, is also to foster new ideas and push the boundaries of development, right? It's not too far away where we will have a groundbreaking idea that will have 500 million people on one platform coming out of India. And I think that's really what I think will take us to have that AI leadership. I think we've already showcased to the world in connectivity that we can be the leaders of technology, not just be fast followers. I mean, you mentioned it in your opening note that not too long ago, I mean, back to 2015, which is just 10 years ago, internet speeds were less than 1 MB in this country, whether it be on the mobile or at the home. But today, everyone continues to enjoy very high data speeds. And so I think from an AI point of view is these 3 critical items that we need to focus on.
First, let me ask you, a lot of people talk about AI and they say that it's going to take jobs away. Do you think AI will get rid of a lot of jobs? Do you think we need to be worried about the amount of jobs that will have to be removed because AI will replace them?
I think at the invent of any new technology, this has always been a big kind of shift, that jobs are going to be taken away. I'm a firm believer that AI will transform jobs. Today, we've seen AI take over our mundane tasks, our repetitive tasks. I have Isha and Shloka here that have founded a new preschool in Bombay called Little Nest. I was on the joke.
Best preschool.
I was telling them that whilst you're listening to me, please do not start talking about Little Nest. Just listen to me. But the one thing that they have also been able to do is, really create the value for the student because of the repetitive, mundane jobs like, scheduling has been taken over with AI, and we see that as a definite, shift.
Welcome back. Well, the markets have seen a good recovery. The Nifty is now down only around 40 points. Remember, we started with a cut of around 150 points, so that's a good recovery is what we've seen. The Nifty Bank is trading well in the green, and the breadth of the market is heartening. Now you have 1,800 stocks that are advancing, which indicates that the breadth of the market is firmly in favor of the number of stocks advancing more than 2:1. At the start of trade, you had way more number of stocks that were declining. Well, time to wrap up on this edition of Chartbusters. As we do that, here's a quick note for our viewers. What does it take to move the needle on gender parity? The biggest names in the business, policy and leadership come together at the mega summit where HSBC presents CNBC-TV18 Future Female Forward, co-presented by Cognizant. To answer that, tune in live on CNBC-TV18 10th of March at 5:30 p.m. We bring you insights from those shaping the future.
Example, today we monitor our network that now covers about 95% of the living population of India. Before that, we had to do it across systems. Today, we can proactively monitor, and before even a customer has a bad experience, we can predict it. And this is just not, something that is, this is, again, instead of delving deep into the data, figuring out what the consumer does, the patterns are being picked up by ML engineers, AI engineers to kind of spend the time to actually solve the problem, then finding out what the problem is. So that's one way that we prepared for it at
So this is already happening.
Yeah.
First, of course, after someone being a private individual, we are again seeing a government person taking over SEBI. What will be the change in the style of working of a government person as compared to a private person, or would it largely be the same? Second question, sir. We've seen a significant correction in the Indian markets. Will your focus also be to make the Indian markets more attractive for foreign investors, or do you think it will be a natural course of market and they will find attractiveness in Indian markets yet again?
SEBI is a very robust market institution. It has been built over the years with successive leadership and will continue with it. We hold the trust of the people of India, we hold the trust of the Parliament of India, we hold the trust of the government, the industry. Trust is very important and we'll all look forward. So I'll say that, we have got 4 objectives. We work for trust, we work for transparency, we work for teamwork, and we work for technology. I think these 4 elements make it as a distinctive, and we have created one and will continue to create one of the best market institutions in the world, for which we will all be proud.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema. With me is Vinny. And for the markets, there has been a remarkable recovery. Once again, the Nifty has taken support just shy of that 22,000 mark. The intraday low today was 21,965. From there has been an over 100-point recovery on the Nifty. The mid-cap index, which is now back in the green, has recovered 1,100 points from the session lows, and the small-cap index is surging. And that's the reason why the advanced decline ratio has now turned firmly in favor of the gainers. When we opened up trade, we had nearly 4 stocks declining for 1 stock advancing. Those lines crisscrossed early on in the first half an hour, 45 minutes of trade. And since then, the gap between the gainers and decliners has only been widening. We've got about 1,800 stocks advancing for 750 stocks currently in the red. Well, it's, defense, PSU banks, which are leading from the front. Those are the sectoral indices which are topping the chart. State Bank of India is your top gainer. BEL is up nearly 2.7%. Oil marketing companies are on a tear with the decline seen in crude prices. On the way down, you've got Bajaj Auto that's shrunk, that's sinking close to about 3%. And then a combination of FMCG, IT stocks are under pressure. But all in all, it's heartening to see the 22,000 mark is holding on as a support, and buying has emerged in the mid and small cap stocks.
It does give you that fear, right? Is it going to go below that mark? Because yesterday also when we were talking to these market guests as well, everyone is fearing where is it going to be headed from here. 22,000 seems like that psychological mark, at least for the markets that everyone's keeping an eye out on. But surely important to watch out for. Some of the names that I want to highlight is also coming in for the broader markets. Mascot Dock, Cochin Shipyard, they're managing to hold on to good gains as well. So that is something to watch out for in terms of a move that we're seeing for the shipbuilder stocks as well. And interesting to watch out for in terms of trends, Reema. But I think, Reema, we have SBI that's in focus today as well. And this is on the back of a Citi note. Abhishek is joining in with us to give us the details of what this note is highlighting for SBI as well. Good morning, Abhishek.
Good morning, Vinny. So, Citi met the management of SBI and they have double upgraded SBI's rating to buy from sell, increased the target price to 830 per share from 720 that they had earlier. The key points that they have mentioned is that there is sharper focus with respect to net interest margin, a sustained growth as well as asset quality, and valuations remain inexpensive. So the key takeaways from the meeting with the management is management has outlined a multiple liability cost optimization yield levers as well as relatively lower EBLR loans, just 28%. MCLR hike should help in protecting the net interest margin downside. Now management has continued to guide net interest margin guidance of more than 3%. However, Citi expects net interest margin to be within 2.9% to 3% over FY25 to 27. The growth visibility is backed by express credit traction, robust corporate pipeline that they have, and accelerated housing loans as well. Unsecured retail slippages have been curtailed at less than 0.5%. The SMA2 pool, which is overdue between 60 to 90 days, that's also been reined in. So they expect the credit cost to be curtailed at less than 50 basis points. So they expect that the restoration of risk weights on NBFCs can boost CET1 CET1 ratio anywhere between 25 to 30 basis points. Weak market sentiments ally that the near-term, equity raise overhang over there. So they are factoring a 13 to 14% of growth. Curtail credit costs, they revise their earning estimate anywhere between 1% to 2% over the next few fiscals. They say that the stock has corrected and has underperformed Nifty over the last 3 months, 6 months, as well as 12 months. So valuations are inexpensive at price to book value of 0.85x. 1 year forward, given the fact that ROA of 1% and ROE of 15% augurs well with respect to the valuations comfort that they have on SBI. Back to you.
Okay, Abhishek, thank you so much for that. But let's move on and talk about some of these EMS companies that are in focus today. And today we have a note that's coming from Investec on this front as well. Upasna, what is the note highlighting? What is it that one is watching out for from these EMS players?
Well, certainly, Investec has written a positive note on EMS companies. Now, it has upgraded Kaynes Technology and Syrma SGS to a hold rating from sell earlier following the sharp correction seen in the EMS space that we saw recently, with valuation now looking reasonable is what the brokerage is highlighting. Now, brokerage says that it is convinced about the growth opportunity in the EMS space going forward, but has highlighted few concerns such as low barrier to entry, high working capital intensification, weak cash flow generation. These are some of the factors is what they've highlighted for PCBA companies. Now, it prefers Dixon Technology and Amber Enterprises. It says Dixon's capital efficacy and cost competitiveness and management's opportunistic approach is what stands out as compared to other peer companies. Hence, it prefers Dixon. And when it comes to Amber Enterprises, it says that the consumer durable business of the company is facing some competitive pressures, but electronic and railway business is yielding impressive ROICs and may face compelling growth drivers going forward. Hence, it is bullish on these two stocks.
Thank you very much for that. And let's turn our attention to quick commerce, always in the news, Swiggy and Zomato. There is an ICICI Securities note, so let's find out what it says. Manglam joins in with more. Manglam.
Well, there is a note that has come in from ICICI Securities where they've done a bunch of channel checks, and what they've figured out so far is that while discounting still persists in the quick commerce space, maybe at product level, the discounts are past the peak that we saw in November and December itself. Instead, what is happening is that, say for instance, I'm looking to buy a soap on quick commerce. Instead of giving me a 30, 40, 50% sort of discount on that soap itself, they're giving cart level discounts, which is basically if you order for say 500 or 600 rupees, you will get a 50 or 100 rupees off. What this does is reduces the discounts on a per product basis, but increases the incentives for people to go ahead and buy higher average order value products, and that in turn is a benefit for quick commerce companies. So yes, discounting persists, but the peak of product level discounts maybe behind them is what channel checks as per ICICI Securities is suggesting. And for those who are looking at investing in these companies, ICICI Securities says valuations now look compelling from a 1 year or more holding period itself, and as a result of which they've reiterated both their buy calls on Swiggy as well as Zomato. On Swiggy, the target price is 740 rupees. For Zomato, the target price is 310 rupees. On the back of this note and the news that companies are deploying newer strategies, reducing performance marketing spends as well, and taking steps that while may increase user engagement, but also at the same time reduce risks to their contribution margins, is positive, and these stocks are bouncing back off the lows.
Okay, Mangalam, thank you so much for that, keeping an eye out on the quick commerce names. But let's move on. And, we spoke to Ramdev Agarwal of Motilal Oswal Financial Services yesterday about his views on quick commerce space. Let's listen into what he had to say about this as well.
That is one sector which is holding out very well. If you see, because see, what is happening is, while price is where it is, I mean, it might have fallen 20-30% from the top, they are increasing value at very rapid pace. Price is here. Okay, it has come down from here, but value is increasing very rapidly. So it is quite possible if it stays here for 3-4 months. See, if you are talking about investing, it's not about picking the absolute bottom prices. It's about buying at fair prices. Okay, are you buying a company which is growing at 50-60% at a fair valuation? My sense is that is one sector where there is momentum, and momentum will pick up further. and it will become very interesting. There are not some 10, 20 players. There are only 2, 3 players, and others will find it difficult to enter. Of course, others will try as the pie becomes big. I think it's fair value. It is stabilized in the sense that, see, nobody can say that 5% can move down from here. It can, but we are closer to the bottom, I'm saying.
Okay, on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll come back and we'll be discussing what's buzzing in the world of commodities with Manisha Gupta, so don't go anywhere.
Very different from, earlier how SEBI has worked, or would that largely be the same? Also, any measures that you're looking at to make Indian markets again attractive for the foreign investor?
I would not go into this counter questions. You asked me questions, there were no questions. We are not going to comment on anything, on anyone, or any style. I said that we are a team here, and this team will work with what other teams. There's a team here in front of me, that's the media. There is a team there which is behind me, that is my employees, people who are working. There is a team out there which is the investors. There's a team out here which is industry. There is a team out, so this is the team, and if we work together, it's a stakeholder institution, we work together and we build it. We have built such a good institution, and we will continue to put our own contributions to its growth, to its merit.
It's 10 plus 10. In
10
case,
plus 10.
was there confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10. The drugs continue to pour into our country, killing hundreds of thousands of people. We're losing substantially more than 100,000 people. I mean, dead. They're dead. The families are destroyed after that happens.
Welcome back. Thanks for staying tuned into Trading Hour on CNBC-TV18. Let's move on and shift focus to the commodity space. Manisha is joining in with us, and this time she's highlighting importance in terms of metals, but this time it's not yellow metal, Manisha, it's the red metal.
Well, it is. And, the headline continues to be tariffs and the way the world really seems to be dealing with that uncertainty. So while that is keeping the markets choppy, but within that space as well, you have to take a look at the copper prices because they seem to be standing tall If you look at the LME markets, we are looking at copper prices trading around $9,900, and the US copper prices clearly trading at a premium with all those tariff conversations. So the US copper is trading at around 2-week highs above 5.5 or thereabouts. Well, we have seen, if you look at the US markets, they're in 50% of what US requires in sense of copper it imports, and much of that comes in from Peru, Canada and Mexico. And with the way the tariffs really seem to be going on, there's a lot of import of copper that we've seen into US. So, and there's an arbitrage opportunity as well, and you have the US copper prices trading at $100 per ton of a premium than what the other markets really seem to be doing. And because US imports much of its copper, it will really have to start its domestic production now. As of now, we understand that even as China may have a dozen smelting copper smelters there, US perhaps have 2. So you will be looking at perhaps an investment therein as well. More interestingly, it is the JP Morgan report that has come in overnight, which says that they are looking at a global copper deficit in 2026 to the tune of 10,000 tons there. Also, they do expect the copper prices to continue to trade higher, not just this year, but the next as well. And they also anticipate higher deficits going forward in the next couple of years or so. Inventory build-up in US and shortage in the rest of the world is another phenomena that the markets really seem to be working with. This is yet again JP Morgan's view coming in sense of global growth. So while we did see 3.2% for 2024, but we are looking at more global growth of around 2.9% in 2025 as well. So that tells you in some sense that the copper prices will continue to be firm. At this point in time, in this year until now, copper has been the best performer within the base metal prices. We are up by nearly 15% in this year already, and more gains is clearly what the street seems to be working with.
Manisha, thank you very much for that important update. Moving on, Prime Minister Narendra Modi inaugurated and visited the Wildlife Rescue Rehabilitation and Conservation Centre, Vantara in Gujarat. Vantara is home to more than 2,000 species and over 1.5 lakh rescued, endangered and threatened animals. The Prime Minister explored various facilities at the centre and also closely interacted with various species of animals which have been rehabilitated there. The Prime Minister visited the Wildlife Hospital at Vantara and saw the veterinary facilities which are equipped with MRI, CT scans, ICUs amongst others. Prime Minister Modi also interacted with doctors, supporting staff and workers who are managing various facilities at the centre.
Okay, and a small program, on that note, actually, we're going to slip into a very short break. Viewers, don't go anywhere because we'll be back with more news and updates after this short break, so don't go anywhere.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC.
Welcome back. Benchmark indices down about 0.25%, but this is after seeing a recovery in the first 1 hour of trade. The Nifty is holding on to the 22,000 mark. Experts have pointed out that 21,800 to 22,000 is an important support for a market. And that's the question, right? Are we close to the bottom? Because we've had a relentless fall over the last couple of weeks. And is the sell-off coming to an end? We posed this question to our market editor yesterday, Ramdev Agrawal of Motilal Oswal Financial Services. And this is what he had to say about the market trajectory going forward.
Earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. So I think we have set the mood. One, correction is done. The P multiple, which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So I think it is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. I think the divergence between mid and small is too high. Let's see how the market does. Maybe mid will keep correcting and large will make a move. Or large will make a move, but mid will stay there. And then it will catch up. So market does its own stuff. I think most important thing is now, don't wait for because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay, so if you like certain stock and that stock is available at your dreamy price and it has gone below that, don't hesitate, start moving into the market. In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know their value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, you know, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected. Capital market is as the sentiments gets hurt in last 5-6 months, there is a decline. There are restrictive, say like from daily F&O, now you have come to weekly expiry. So obviously there is a almost 30-40% decline in the overall F&O volume. So we got expanded too much. Between 21 and 24, we got expanded too much, and then the regulator got scared and they said, we want to contain it. And that's what they did. And effect of that is visible. I mean, Nitin of course knows the books. So that's what is happening in broking. That's what is happening in slowdown in now. AMC flow was very good till last month. This month, I think there is somewhat, it is slower.
Important opinion as always when there is so much pain in the market and investors are confused what you should be doing. Mitesh is now with us for a quick technical check in the market. Mitesh, in the morning you were telling how that recovery spark is missing. Now that we've had a little bit of an intraday pullback and the markets are holding on to this 22,060 odd level, What is the approach on the index and your individual ideas?
Yeah, I think that still is missing. I was hoping that the Bank Nifty will take out 48,400, and we got a high of 48,355. So I think that confirmation on the upside is still something which I'm craving for, which we haven't got as yet. So the idea is that we might want to wait it out for that move to play out. In case we see the Bank Nifty capture 48,400, I think that will be the first suggestion that the declining force should be arrested. And then we can look at Nifty getting to about 22,150, 200 zone. I think that if that is clear, then I think we can look at least, if not a trend reversal, at least a stronger bounce back than what we've had for the last few days. So on the index, still waiting and watching, but I do hope that the way the Bank Nifty has reacted in the face of a negative opening and gap down, I think there is a chance that we might see a late afternoon revival. But till then, I think just sit tight on the indexes.
Okay, so tight on the indices. And Mitesh, anything that you're looking at specifically in terms of stocks, mid cap, small cap, or large cap? What are you looking out for right
now? On the stock side, I have a buy on CESC. I think that's something which is reversed well. So buy here with the stop at about 132 for targets of 141 or so. And Dabur is something on the negative side. So sell with the stop at about 491 for targets of 470.
Okay, Mitesh, thanks so much for that. On that note, we're going to slip into a very short break, viewers, but a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This is a prestigious platform celebrating SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code on now and submit your entry for SME Champion Awards Season 2.
Weeknights at 7 p.m.
Let's talk about SIFs, the new investment option in town. If you have been investing for a while, you have probably heard about mutual funds, the go-to option for most retail investors, and maybe even about PMS, the portfolio management services, where high net worth individuals invest 50 lakh rupees or more for a custom-built portfolio. But now there's something new and interesting in between these two categories, and that's specialized investment funds or SIFs. This is a brand new category that SEBI has just approved, and it's designed for investors who want more flexibility and sharper investment strategies, but without needing to lock up 50 lakh rupees like PMS. To invest in this specialized investment fund, you'd need a minimum of 10 lakh rupees, so it's definitely not for first timers, but it's far more accessible than PMS. Now let's talk about how this fits into your investment toolkit. Mutual funds are obviously your starter pack. You can start with as little as 500 rupees. The strategies are basic, mostly long-term buy and hold, and they're designed to be simple and transparent. PMS, on the other side, is your high-end tailor-made option. You need at least 50 lakh rupees. The portfolio is customized for you, and the fund manager has a lot of flexibility to choose what to buy, sell, and when. Now, SIF sits right in the middle of these two, 10 lakh rupees minimum, advanced strategies like long-short trades and derivatives, but still regulated closely by SEBI, so there's proper oversight. Now, what makes SIFs different from regular mutual fund? For one, the strategies. Regular mutual funds mostly follow long-only strategies. They buy assets they expect to go up over time, but SIFs, on the other hand, can go both long and short, meaning they can bet on stocks and bonds and even on sectors that they think will rise or even fall. They can also use derivatives up to 25% of the portfolio, which lets them hedge risks or make more tactical bets. Flexibility you don't get with traditional mutual funds. And SIFs themselves can be either open-ended, meaning you can enter and exit anytime, or close-ended, meaning there's a fixed tenure. But even for close-ended SIFs, SEBI says that they must be listed on stock exchanges, so investors have a chance to exit early if needed. Now, SEBI hasn't just opened the gates and said launch what you want. there has been a clear rule set for AMCs who want to offer these funds. Only AMCs with at least 5 years of track record are eligible to launch SIFs, plus they need to manage at least 5,000 crore rupees in existing mutual fund assets to even qualify. This ensures that only experienced players with rock-solid management systems get to handle these advanced funds, because these aren't plain vanilla products meant for casual investors. So who should even look at SIFs? If you're already comfortable with the markets, maybe you've been investing for a few years now, you understand terms like hedging, short selling and global macro strategies, and you want to go beyond mutual funds but without committing 50 lakh rupees to a PMS, this could be worth exploring. But remember, flexibility comes with higher risk. These are not simple set and forget products like mutual funds. They're designed for investors who actively want to participate in more complex strategies and who understand the risk involved. This is a new space, so keep an eye out for which fund houses launch the first SIF and what kind of theme.
Welcome back. Thanks for staying tuned to Trading Hour on CNBC-TV18. Let's move on. And in our special segment, FinStreet, Abhishek Tool is here to today tell us about how Q3 FY25 panned out for the housing finance companies and NBFCs. Over to you, Abhishek.
Well, it has been a good quarter for the non-bank lenders with respect to the loan growth and net profit growth. Now, net interest income surprised positively, which actually helped sustain the net interest margin. OPEX cost was very high for both HFCs and NBFCs. Now, earnings have relatively been driven by the lower provisions that you saw this time around. Improvement in asset quality continued for them. Outlook remains healthy. Some pockets are witnessing asset quality issues. So for housing finance companies, the loan growth in Q3 FY25 was about 14.5% YOY and about 3.2% sequentially. X of LIC Housing Finance and Samman Capital, the AUM growth was much healthier at about 27.3% YOY and about 5.5% sequentially. The NII growth was healthy as well. NII growth was around 20.5% on a YOY basis and close to 3% on a sequential basis. So calculation shows that the net interest margin expanded YOY to 4.45%, up about 22 basis point YOY and down by 1 basis point sequentially. Operating expenses were high. They were up more than 32% YOY and about 8.3% quarter on quarter. So operating expenses impacted the operating profits in this quarter. Operating profits were up just 5.7% YOY, but they were down by 2.7% on a sequential basis. Now, provisions were at just rupees 60 crores, down about 92% YOY and 98.5% on a sequential basis. So overall, profits after tax for HFCs were up 21% YOY and about 373% sequentially. Now, asset quality continued to improve for them. So gross NPA value-wise was down about 15% on a sequential basis, while net NPA was down more than 1% on a sequential basis. So gross NPA ratio as a resultant declined to 1.75% versus 2.1% in the previous quarter. Net NPA ratio also declined by 3 basis points on a sequential basis. So for NBFCs, X of HFCs, the AUM growth was healthy at about 16.5% YOY and about 3% sequentially. The net interest income growth for them was healthy as well. NII was up 17.7% YOY and 4% quarter on quarter. So calculation shows that the net interest margin actually expanded to 6.6%, up 7 basis points on a year-on-year basis and 6 basis points on a sequential basis. Now, operating expenses were high due to employee expenses, which increased sharply. So employee expenses were up 15.1% on a sequential basis and nearly about 26% on a year-on-year basis. So operating profits that grew by 14.7% year on year, but they declined by more than 1% on a sequential basis. Now, provisions were at about 8,700 crores, which was up nearly 72% YOY and a decline of 2% quarter on quarter. Overall, profit after tax for NBFCs were up nearly 29% YOY and about 7.35% sequentially. Asset quality improved, but ratio-wise, gross NPA in absolute value was up 0.6% quarter on quarter. Net NPA value-wise was up nearly 3.5% quarter on quarter. As a ratio, gross NPA ratio has declined to 9.77% versus 10% in the previous quarter, while net NPA ratio is at 4.14% versus 4.12% in the previous quarter. Going ahead, loan growth is expected to moderate as per analyst estimate in many segments of NBFCs except gold loans. There are signs of asset quality stress that is emerging in other segments like pockets of vehicle finance, micro loans against property and affordable housing are witnessing pain in asset quality. Pain in the microfinance sector will continue for the lenders. Net interest margin outlook post the rate cut from RBI will be divergent. So rate cut is beneficial for fixed rate NBFCs like MMFSL, Shriram Finance as well as Cholamandalam, while rate cut is negative for floating rate based NBFCs like HFCs, housing finance companies. Valuations are around the long-term averages for superior earnings growth of 15-20% like MMFSL, Shriram, Bajaj Finance as well as Cholamandalam as per analyst.
Thank you very much for that. We will get into a break. On the other side, we'll come back with more on the market. Stay tuned.
Bring in. User development fee is charged by an airport operator to passengers to bridge the revenue shortfall. This fee varies across airports and the amount is approved by the Airports Economic Regulatory Authority or AERA. Now, GMR Airports operates Delhi Airport, Hyderabad Airport, Goa Airport, Nagpur and Bidar Airports. It is also developing the Visakhapatnam International Airport. Now, when it comes to UDF, Delhi Airport stands among the lowest at a flat fee of 129 rupees for domestic and international passengers as compared to Bengaluru, Hyderabad, Chennai, Kolkata and Ahmedabad. Now, GMR took over Delhi Airport in 2006 and the tariff proposal that it has submitted now is the fourth control period from April 2024 to March 2029. Here, DIAL has proposed UDF for departing as well as arriving passengers on peak hour and non-peak hour basis. So, for domestic passengers, the proposed fee is at 405 rupees during off-peak hours and 610 rupees during peak hours. For international passengers, departing economy class will pay 810 rupees and business class will pay 1620 rupees. Now, please note that these rates are in proposal stage and the final tariff will only be determined by AERA. Now, DIAL has justified the demand citing insufficient cash flows and consecutive losses totaling 1795 crores from FY21 to FY24. They are projecting a 1794 crore loss in FY25 as well. With a debt of 14,786 crores and a declining credit rating, the airport told AERA that raising funds for future projects has become difficult. It claims to have invested 12,500 crore rupees from 2019 to 2024 in new development projects like Terminal 1 development, 4th runway and Eastern Cross taxiway. The airport said that there is a significant need for capital expenditure for further developing the airport's infrastructure and which is why the need for higher user development fee.
What next for Donald Trump and Ukraine's President Zelensky after the massive showdown that the entire world witnessed at the Oval Office? Before this, America and Ukraine were planning to sign a minerals deal. But then we all saw what happened. Now, in the latest statement, Zelensky says Ukraine is ready to sign that deal.
If we agreed that a minerals deal with the US will be signed, from our side, we are ready to sign. I honestly think the United States will be ready as well.
So what is this deal all about? And before that, why does Trump want Ukraine's minerals? Trump claims that US military and economic aid to Ukraine is almost about $500 billion, and he wants the US to have access to Ukrainian minerals equivalent to that amount. However, Ukraine disputes this figure. Even the German think tank, the Kiel Institute, estimates that the US has sent $119 billion in aid to Ukraine. Trump has argued that such a deal would help US taxpayers get their money back for the aid provided throughout the war. Additionally, America is keen on securing Ukraine's mineral resources to reduce.
Welcome back. Will the benchmark indices try and get back into the green? Some stocks are attempting an up move now. IT. So Tech Mahindra is now back in the green. Infosys has managed to trim its losses. Trend is seeing some buying over the last 2-3 days. Yesterday, stock was up 2.5%. It's followed it up with another 2% up move. So these are some stocks in the frontline pack. In the mid-cap end of trade, it's many of these pharma names. So Vijaya Diagnostics is up close to about 12.5%. Wockhardt has moved up nearly 4.5%. IOL Chemicals, pretty decent volumes. IOL Chemicals is up nearly about 5%. And RateGain, which got battered, the stock has slipped 40% plus from its 52-week high. Of that, 30% has come from the beginning of 2025. And RateGain, too, has now moved to the day's high. But let's get to the latest from the insurance sector, because sector regulator IRDAI has warned that health and general insurers against rising commission payouts. Yash is here with the details.
Well, that's correct, Reema. So it's some tough talking which has come from the insurance regulator to the general insurance companies as well as the health insurance companies. What has been the point of concern for the regulator? The regulator clearly seems to be concerned about the fact that insurance companies haven't done, put in their efforts when it comes to reducing or containing the commission payouts which they make to various distributors to sell their policies. And eventually what that has led to is that the cost of insurance products, that is the premium which policyholders pay, haven't really come down because of that particular aspect, that is the insurance companies not reducing or containing the commission payouts. Do remember that about 2 years ago, that was in April 2023, the insurance regulator, what it had done is that it had given some relaxation to insurance companies on commission payouts. It had said that we are removing the limit on the commission that insurance companies can pay to the distributors. Instead, we are putting a limit on expenses of management. Expenses of management has two things, commission payout as well as the operating expenses. According to the regulator, what has panned out in the last 2 years is that the insurance companies have significantly increased the commission payouts, and to balance the limit, to adhere to the limit on expenses of management, they've reduced the operational expenses. So though they are under the limit when it comes to the expenses of management, but the commissions under that, they've increased significantly, and that has led to the cost of insurance products, that is the premium, not coming down and only increasing for policyholders. Now, what is the tough talking which the regulator has done? The insurance regulator IRDAI has told general and health insurance companies that if corrective measures are not taken by them to reduce commissions and also pass on the benefits to policyholders, then in the review which happens in April 2026, of the expenses of management guidelines, it could very well consider the fact of removing the limits on expenses of management and putting that limit back on the commission payouts in individual business segments. What were those limits earlier? About 19.5% for motor insurance, 19.5% of gross premium for health insurance. So, of course, that's the warning which is coming from the regulator, that, contain the commissions, focus on reducing commissions, focus on passing on the benefits to policyholders. Otherwise, we could look at putting the limits back on commissions yet again and removing the limits from expenses of management.
Okay, Yash, thank you so much for that. Just quickly marking Poonawalla FinCorp once, that's also something that we're keeping an eye on. Maharashtra State Tax Officer has initiated inspection of the records at its registered office. The inspection is initiated after the search proceedings issued by the Deputy Commissioner of State Tax. So keep an eye on this one. Right now, Poonawalla FinCorp, 0.6% of what, again, is what it's holding on to. But time for a short break. And after the break, on the other side, we bring you the highlights from our conversation with top pharma players from BioAsia Summit.
Trying to get over it is where today we have a lot of those mental issues that have taken a hold of sport. So many people with mental health issues and so on from sport, because it is the highest risk startup ever that I've ever seen.
I also want to talk about film with you,
Yes.
and the James Bond experience.
Yes, the Broccolis were watching me play, and they had tested over a several hundred people for the role. They didn't feel they came up with the right person. They asked if I would do a screen test. And I said to myself, you know what? Who can say they worked at Pinewood Studios in the morning and played at Wimbledon in the afternoon? Everyone has an inbuilt resilience in them and a determination, a dedication, a discipline, a desire that is burning in there, and we just have to find it. Male, female, young or old, doesn't matter, and you can find it at any time. Muhammad Ali and I were appointed by Kofi Annan when we worked together as messenger of peace for the UN. He said, the service you do for others on earth is the rent you pay for a room in heaven. The commitment from the athlete needs to be total. Forget about your friends, forget about your education, forget about your family, forget about everything that you like in life. And when you're 17 years old, boy or girl, you can't have another girlfriend or boyfriend.
On China, which controls 75% of the world's rare earth deposits. This is according to the Geological Investment Group. Now let's return to the deal itself. Both Ukraine and the United States had agreed to give the US access to Ukraine's rich mineral reserves, with revenues diverted to a joint US-Ukrainian fund. Ukraine holds approximately 5% of the world's mineral resources, which Trump seeks to secure. However, not all of these resources are currently exploited or easily exploitable, and some lie in territory which is occupied by Russia. Ukraine is known to be the producer of several critical minerals. It ranks as the world's 8th largest producer of manganese, which is according to the World Mining Data, the 11th largest producer of titanium, and the 14th largest producer of graphite, which is essential for electric batteries. Ukraine also possesses 20% of the world's estimated graphite resources, according to France's Bureau of Geological and Mining Research. Additionally, it claims to have one of the largest lithium deposits in Europe. However, there's another interested player in this game, Russian President Vladimir Putin. He has suggested that he's open to cooperating with the US on rare earth minerals and has expressed support for US investment in Russian-occupied regions. While Zelensky has expressed confidence that relations with Trump can be salvaged and that the Trump administration won't cut off assistance to Kiev, the world is closely watching Trump's next move.
Welcome back. Thanks for staying tuned to Trading Hour on CNBC-TV18. Nifty has recovered from the day's lowest point, but is holding on to the 22,060 levels as of now. Not much of an up move or a down move from that level. Mid and small cap outperformance on that front, as well as the Nifty Bank also is holding on to the green. 48,180 levels around that mark is what the Nifty Bank is holding on to. But yes, on that note, let's move on. And India's emergence as a hub for a global capability center signifies a pivotal shift in the international business landscape, driven by country's technological advancements as well as digital transformation. And life science as well as healthcare is no exception to this growing prominence of GCCs as a part of MNC's strategic growth agenda. I caught up with the top management of pharma sector and players coming in from the pharma industry at BioAsia 2025 Summit. And as we wrap up Trading Hour, listen in to the excerpt of that conversation.
If you just take the last 18 to 20 months, we're now around 2,000 plus employees based out of Hyderabad, trying to get medicines to our patients faster. And if you really go back, fundamentally where we started was very simple. We had a very clear vision and we had a set of core guiding principles. And those core guiding principles were built on how do we build an innovative workforce, how do we collaborate more cross-functionally, how do we get a sense of urgency and a purpose for our employees who can deliver for our patients. And I think that DNA really helped us very well. And if you really think of it, we were also very clear what we didn't want to do, because a lot of the GCCs come in to say they want to do everything. And we held on to that part of what does not fit well as a strategic value for Bristol Myers Squibb Hyderabad. And the other piece I'll add is a lot of people, confuse this to I call it the value versus volume, right? I think we always have to come in for value and deliver to what are the main goals for the company, right? And then value is a broad spectrum. Because in some cases, value can start off with automating and eliminating some simple manual activities. And the other side of the spectrum can be some breakthrough innovation that you can get, right? And we wanted to play to that spectrum, and that was a very clear guiding principle for us. 2-3 things that worked very well for us is we were very open to look at a very diverse workforce coming from different industries. You cannot be innovative by limiting yourself to certain areas or niche skills. So we were open to trying out build a workforce from different backgrounds, different industries, different experiences. And I think it's important to harness that in the first 6 to 12 months, because at some point that kind of fades away. And we were intentional to harness that. And the dream for any leader or any company is if you can do innovation at scale. So we were able to figure that out, mantra for us, that helped us. That led to more people joining us, and that's how we could grow so quickly. So it has to be one integrated culture. It has to be unified so that it's just not innovation happening in pockets only in one place, in one country or in one city. So I think we were very intentional that it would be one BMS culture. We got a lot of empowerment. There's a lot of trust that came in very quickly, and the teams could build that. That is kudos to the teamwork that happened on the ground. I think those 3-4 ingredients really helped us move very fast and deliver value for our capability center in Hyderabad. And just happy that we can sit here and talk about it, and behind it is a lot of teamwork and collaboration and many people and partners coming together.
John, you've been here for a while, but last 4 years, that's something that changed for you all, right? I know. What was it that changed? What was it in the environment and the ecosystem that changed for you all?
Yeah, thank you very much for the opportunity. Yes, you're right. So Novo Nordisk has existed as a GCC here in India for 17 years. But it originally started as a transactional shared service center. And then we kind of scaled slowly. But over the last 4 years, we've grown by just more than 2,000 employees. So today we are 4,500 employees in India, covering pretty much the whole pharmaceutical value chain as a GCC. Everything from research and early development through to all the R&D activities, through to IT, finance, commercial, supply chain, etc. And I think the things that have really impacted this growth, first of all, is our ability to build and maintain trust with our headquarters. So first thing, of course, is to be able to deliver what you promise and not over-promise and under-deliver. So deliver on our promises, deliver quality, deliver efficiency, deliver speed. Second thing is to really maintain trust with our stakeholders. You know, as a broad organization, we have many stakeholders in headquarters, and them understanding what we do and trusting us to put more activities in our case in Bangalore is super important.
Absolutely. You know, Puneet, coming to you, I'm going to pick up from what Mohit as well as John have been mentioning. Value, trust, I think these are the key words, as well as culture. You know, your thoughts on these three as well. How have you built it at Takeda? How has that driven your force going forward for the GCC?
Yeah, it's a great question. And firstly, thank you very much for this opportunity. Value, the entire value ecosystem, right, is so central to Takeda, right? We any initiative, any thought process that we start, starts with keeping patient at the center, right? So we have a value system that talks about patients, trust, reputation, and then business, right? So we believe that if we take care of our patients, we can build trust, we have the right, things that can lead to reputation build-up, business will come automatically. That has been a fantastic approach by Takeda over, 243 years. It's a 243-year-old Japanese multinational, which has been focusing very, very strongly on these PTRB principles and our core values, which is keeping integrity at the center and, talking about honesty, fairness, and perseverance. I think these value and the ecosystem have really helped us, look at India as a strategic location, and we call it as the heart of digital innovation for Takeda, right? So, we went about looking at, obviously a lot of other countries where, we can get talent, right? And John was talking about it. We also ran about, getting talent from other European countries, right? So we looked at what are those strategic locations where, we can find talent and not transactional, resources who can just work on, in silos and things like that. That's why our GCC, we are calling it as innovation capability centers, right? And they are all around the world. So starting from, we have from Mexico, Bratislava, India, and now we are going to have ICCs in Japan and so on and so forth. So from a strategy standpoint, our resources, our people are core to us, right? And we want them to get embedded into the business rather than, at one place or the another. It doesn't matter to us. What matters is that our people are imbibing our culture. They are loved and loved stands for living our values every day, right? So they are loved. They love and they are loved, living our values every day, and they get integrated into the business, driving value for the business.
Absolutely, that's interesting. Funny coming to you. You're born and brought up company in India, right? 40 years is what you were saying. Yeah. So I want to understand from your thought process, right? GCC, ICC, different names. But for Dr. Reddy's, what has the focus been? And how has that moved for them?
Yeah, so I think you're right. We are born in India for the world in that sense and been around for 40 years now. So for us, GCC has not been like a new idea that came in. It's about how we have structured ourselves to deliver value globally. So beyond the cost arbitrage, it has always been that value arbitrage that obviously started, because cost was not really the concern to start with in the first place, right? So when we looked at the global capabilities, as I would call it, it basically fell into three different buckets. One is, how does it deliver efficiency at scale? So as you're expanding into markets outside India, you're expanding globally into different therapy areas and spaces. How do you create efficiency at scale? So that was one of the key levers as we started looking at global capabilities. The second one is primarily on differentiated capabilities, because as John was mentioning it, some of us were talking about it. It's the only place where you can actually build these differentiated capabilities at scale. And I was talking about how we could build very quickly a lot of omni-channel marketing capabilities right out of India once COVID, hit us, and when we started thinking about some of these things. How do you deliver, digital patient support, patient engagement platforms, build them from here, for instance. And even if you get closer into the core of R&D, deep science research and things like that. There are opportunities which we could actually leverage to, India for and kind of build those right out of Hyderabad in many of these places. So while we take a look at the work globally, like for example, a lot of our peptide work happens out of Cambridge, but a lot of, the further elements of the value chain get done out of India. So in a sense that, a bit of efficiency, differentiated capabilities, and increasingly as we see when we go into these differentiated business models, as we go into consumer healthcare, specialty products, biosimilars, a lot of these capabilities again, need to be thought more globally. So, for instance, the recent acquisition of an RT brand from Helion, for instance, the business is spread in 30 countries. But then, how do you kind of create the operational capabilities and the model that gets built for the globe, but from India, right?
Was just a generic tweet about the fitness of a sports person. It is not body shaming, it's about the fitness of a sports person. I always believe a sports person has to be fit. So I felt he's a bit overweight and I just tweeted on that. And I've been attacked for no reason, And when I compared him to the other captains, previous captains like Dhoni, or for that matter, Ganguly, Dravid, Tendulkar, Kapil Dev. So I put in and Virat. I put in a statement because I found him, I have the right, it's a democracy, what is wrong in saying it? So that is what you have to understand. So I just spoke in a generic manner and I fail to understand a democracy, we don't have the right to speak in such a manner.
Mid-cap stage a bounce, turning the market breadth positive for the session. Industrials and power are the big gainers, while FMCG, pharma and IT are the big drags.
Bajaj Auto's ED Rakesh Sharma says weak market sentiment may have hit sales in February, even as the year should end with an expected 6 to 8% growth. He expects strong sales in the upcoming wedding season starting in March.
Experts warn of risks to inflation and growth from the imposition of tariffs by the US, even as it is unclear as to how long the tariffs on Canada and Mexico, along with China, will remain in place and what retaliatory actions could follow. Likely reciprocal tariffs from the 2nd of April is another big imponderable.
Bitcoin and other cryptos tank over fears on the economic impact of US tariffs, offsetting the positive sentiment infused by creation of a US strategic crypto reserve. You're watching us here on Halftime Report. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormas Fatakia. For the markets, we're in a process. We're in a process of bottom formation. Yes, the Nifty is off the lows. It's off the highs as well, sitting with a cut of 60-odd points. There is a tug-of-war at the mid-cap end of things as well. The index was doing a lot better, some moments ago. Right now, seeing some bit of profit-taking from the highs of that day. That index just below the flat line. The Nifty Bank is holding up in the green, though that one too is off the high. So the sum and substance of the last two trading sessions for our markets have been that we're in a bit of a tug-of-war position. It's no slam dunk decline that we had seen earlier in the previous few weeks, but at lower levels there is some purchase that we're seeing in a lot of stocks, and that's what the advanced decline charts tell you. You have nearly two stocks advancing for every one stock which is declining. So even as the frontline indices are subdued, your portfolios might be feeling a little better than what they were all of last week. Hi, Hormas.
Hi, Mangalam. Resilience is the word of the day, if you can call it that, considering the sell-off that you saw on Wall Street overnight. The GIFT Nifty also suggesting a 170-point gap down. We did open with a gap, but that gap has been bought into, at least for now. We're still holding above that mark of 22,000. Made a new intraday low today, below the mark of 22,000, but we are holding above that as of now. So it'll be interesting to see whether that sustains as we go into for the trading session and for the rest of the week as well. There are plenty of positives in the broader markets. As you saw, the advance decline as of now, fairly in favor of the advances, and stocks like Jyoti CNC, Vijaya Diagnostics, India Cements trading with gains of 10 to 12% in today's session. Usually it was on the opposite side of things, but today most of these stocks are trading fairly in the green. Vijaya Diagnostics at the highest point of the day, as is Jyoti CNC and India Cements too, trading with healthy gains. But what started off this slight bit of recovery though was a brokerage note that came in on India's largest lender, that is State Bank of India, and that is also doing well for itself, and that is on the back of a note from Citi. Abhishek is joining in with more details on that. Abhishek.
Well, Omas, Citi has double upgraded SBI to buy from sell. They have increased the target price by more than 15% to 830 per share from 720 that they had earlier. Three key points: a sharper net interest margin focus from the lender, sustained growth, asset quality outlook that they see, as well as valuation being inexpensive is the key highlight in their report. So the key takeaways from the management meet was that management outlined multiple liability cost optimization initiatives as well as yield levers that they have. So with respect to a relatively lower EBLR, that is external benchmark linked rate book, or at just 28%, and the MCLR hike repricing should actually protect their net interest margin downside. So management has guided for a net interest margin of more than 3% in the coming fiscals. However, Citi believes that the net interest margin could remain between 2.9 to 3%. Growth visibility is backed by express credit, robust corporate pipeline, as well as accelerated housing loans that they are rolling out. So unsecured retail slippages are being curtailed at 0.5%. SMA2 pool, which is dues between 60 days to 90 days, that is also being reined in. Credit cost is expected to remain around 0.5% or less. So the restoration of risk weight asset on NBFC loans should actually boost the CET1 ratio between 25 to 30 basis points as per Citi estimates, and weak market sentiments ally near-term equity raise overhang that they have. So they are factoring in a 13 to 14% growth and curtail credit costs, which makes them revise their earnings outlook over the next few fiscals by 1% to 2%. So stock has corrected by 18%, 16% and 10% in last 3 months, 6 months and 12 months respectively, and has underperformed Bank Nifty by 10 to 12%. So valuations are inexpensive, 0.85x with respect to price to book value, given 1% ROA and 15% ROE. Back to you.
All right, we take that point, Abhishek. Thank you so much for that. So that's about SBI, up around 2.6%. The EMS companies, they're in focus on the back of an Investec note that has come in as well. So just pull up some of these manufacturing names. We have Dixon, Amber, all of them up and about in today's trading session, though Keynes Tech is mildly off the highs. What is that report saying? Upasna joins in with that. Upasna.
Well, Investec has written a positive note on EMS companies. It has upgraded the ratings of Keynes Tech and Syrma SGS to hold from a sell rating following the sharp correction, with valuations now looking reasonable. Now, the brokerage says that the growth opportunity in EMS space looks good, but has highlighted few concerns such as high barrier to entry, high working capital intensity and weak cash flow generation for these PCBA companies. Now, it has said that it likes Dixon and Amber Enterprises. When it comes to Dixon, the company's capital efficiency, cost competitiveness and opportunistic approach followed by the management is what stands out as compared to the other peers. When it comes to Amber Enterprises, it says that the consumer durable business of the company is facing competitive pressures, but electronic and railway business yields impressive ROIC, leading to a compelling growth driver going forward. Hence, all these companies remain in focus today, and we can clearly see Dixon and Amber surging in trade today on the back of this.
There was a time when there was no stopping these companies making new highs every single day. Upasna, thanks a lot for that. But if there was a law of gravity, it has applied to these companies for sure, down anywhere between 35 to 40% from their peaks. We're moving on then from breaking barriers to rewriting the rules. Our exclusive Future Female Forward Mega Summit brings together the voices that matter. Now, don't miss this power-packed conversation on enabling success, driving parity, and shaping a more inclusive future. Tune in live to CNBC-TV18 on the 10th of March, starting 5:30 p.m. Take a short break. Back on the other side. Welcome back, and we are speaking about a lot of these railway stocks having corrected significantly from their highs in yesterday's trading session. They too are seeing a bit of a rebound today. IRFC is up almost 2.5%. That is now down 50% from its peak of around 229. RVNL too seeing some bit of gains in today's trading session. But speaking of railway and railway linked names, in our special segment Insight Edge, we put the spotlight on Jupiter Wagons, which is doing well in today's trading session. Vinny joins in with more details on that. Vinny, tell us more.
Absolutely. So, even Jupiter Wagons, when you look at it, in the last 6 months itself, it's fallen almost 45 to 50% in trade. And today we're seeing a bit of a run-up coming in for the stock. Why? One, the company's mobility arm had launched its new factory for LCVs. So the electric LCVs is what they're focusing on. And we spoke to the management today, and they spoke about how they are focusing on this segment as well. Currently, their capacity for this is around 8,000 per annum in terms of vehicles that they can make. They spoke about the wheel set business, which is the key focus area for the company, and they will be focusing on this. They're talking about making investments of around 2,500 crores on this specific side of the business and segment of the business. And they are also obviously opening up the plant in Odisha that will open up in FY26 will be the axles business which will open up, and other than that we'll have the whole plant which will operationalize by in FY27. So in terms of revenue potential from this business is also quite high, because from this business itself they're expecting around 2,500 to 3,000 crores revenue coming in for this business. FY27, once the whole plant is operationalized, we could see this revenues coming in. And do not forget, in terms of valuation also, it's quite significantly below its peak valuation of 55 times. Current PE is at around 23.6 times. So it'll be interesting to see where Jupiter Wagons moves from here on. Let's also listen into what more the management had to say in terms of their wheel set business.
The key focus for us is our wheel business, where we are undergoing a massive capacity expansion. We will be investing close to about 2,500 crores in the next 2 years. This year we are going to grow by close to, in FY24 we did a number of about 100 crores in this business, which in this year we will take it up to 300 crores. Right now the only limitation for us is the capacity. So in Aurangabad, from now 13,000 wheel sets, we are ramping it up to about 20,000 wheel sets. In the next 4 to 5 months, that capacity will be online. So that will, the 600 crore revenue target, basically that will help catapult us to that target. Once the Odisha capacity comes in, you're looking at numbers of close to anything between 2,500 crores to 3,000 crores of revenue just from the wheel business itself. It'll 26 end is when the axle line is going to start, and 27 is when it'll be completely commercialized.
Right, that was our Insight Edge segment where we spoke about Jupiter Wagons on account of them having launched their first commercial electric vehicles. But quick commerce companies, they are on our radar right now, Swiggy and Zomato. Why is that? Because one, they've already seen a big decline from the top, and this morning we had a note that came in from ICICI Securities as well. What does that note say? 3 things. Most importantly, they believe that as per their channel checks, discounting has been past the peak levels that they saw in November 24 to Jan 25 itself. And this is product level discounting that they're talking about. So what's the second thing? That there are discounts, but they are at a cart level and not product level. So what it means is that if you go onto any of your quick commerce apps, you want to buy a soap, you won't get a 40-50% discount on that soap itself. But if your overall cart value is about 100 rupees, the app will prod you into saying that if you buy 49 rupees worth more, then maybe you get a 20-30 rupee off. What this does is this incentivizes higher order values, which basically is contribution margin positive for all these companies. The third thing that they're talking about is that, there has been a noticeable pullback in performance marketing spends as well. What all of this does is, while it increases user activation, user engagement, it does it in a more rational manner, which is not as, denting on the contribution margins as the previous product level discounts are itself. Remember, these stocks have already seen a big correction. At the same time, we've, seen valuation, which as per ICICI is compelling for investors with an horizon of more than 1 year, and that explains why these stocks are buzzing around. They reiterate their buy calls on both Swiggy as well as Zomato. A higher upside seen on Swiggy as against Zomato. target price that they have on Zomato is 310 rupees. That for Swiggy is over 740 rupees, which is much above everyone else on the street itself. So we'll keep an eye out on that. In fact, on that note itself, we spoke with Ramdev Agarwal of Motilal Oswal Financial Services yesterday about his views on the quick commerce industry, and he was fairly insightful on saying that these companies have begun to make a bit of a bottom and they will only add value going forward.
That is one sector which is holding out very well. If you see, because see what is happening is, while price is where it is, I mean it might have fallen 20-30% from the top, they are increasing value at very rapid pace. Price is here, okay, it has come down from here, but value is increasing very rapidly. So it is quite possible if it stays here for 3-4 months. See, if you are talking about investing, it's not about picking the absolute bottom prices. It's about buying at fair prices. Okay, are you buying a company which is growing at 50-60% at a fair valuation? My sense is that is one sector where there is a momentum, and momentum will pick up further, and it will become very interesting. There are not some 10-20 players, there are only 2-3 players, and others will find it difficult to enter. Of course, others will try as the pie becomes big. I think it's fair value. It is stabilized in the sense that, see, nobody can say that 5% can move down from here. It can, but we are closer to the bottom, I'm saying.
Closer to the bottom, the words from Ramdev Agrawal and the quick commerce space as well. And one of the highest price targets for Swiggy on the street. In fact, the stock is still trading below its IPO price of 390 rupees. Moving on then, Prime Minister Narendra Modi inaugurated and visited the Wildlife Rescue, Rehabilitation and Conservation Centre Vantara in Gujarat. Vantara is home to more than 2,000 species and over 1.5 lakh rescued, endangered and threatened animals. The Prime Minister explored various facilities at the centre and also closely interacted with various species of animals which have been rehabilitated there. The Prime Minister visited the Wildlife Hospital at Vantara and saw veterinary facilities which are equipped with MRI, CT scans, ICUs, among others. The Prime Minister also interacted with doctors, supporting staff and workers who are managing various facilities at the centre.
Through my discussions over recent days, we've agreed that the UK, France and others will work with Ukraine on a plan to stop the fighting. Then we'll discuss that plan with the United States and take it forward together. The purpose of today's meeting was to unite our partners around this effort, to strengthen Ukraine and to support a just and enduring peace for the good of all of us. Yesterday evening, the UK signed a £2.2 billion loan to provide more military aid to Ukraine, backed not by the British taxpayer, but by the profits from frozen Russian assets. And today I'm announcing a new deal, which allows Ukraine to use £1.6 billion of UK export finance to buy more than 5,000 air defence missiles, which will be made in Belfast, creating jobs in our brilliant defence sector.
I think most important thing is now, don't wait for the, because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Okay. I have seen best of the chartists and all telling me, they're all eating their own stuff. So what I'm saying is, now this is a time, stocks are making bottoms.
Welcome back. There is recovery from the lows. That's what we're seeing in the markets, but a good time to get you the setup in the F&O as far as things are concerned right now. We're seeing some traction in a lot of these mid caps. If you look at the frontline indices, there has been recovery from the lows. The Nifty Bank is the one which is outperforming today. We have a couple of stocks which are doing a lot better as well. The broader markets is where we are seeing better recovery, even as the mid cap index at an index level is slightly subdued. The advanced decline chart tells you that we have 1,600 stocks advancing for just about 1,000 stocks which are declining. The key outperforming indices today are the ones that suggest that there is risk on in the market. What are those outperforming indices? You have, the PSU Bank Index, the PSE or the Public Sector Enterprises, and you have the Metals Index. The ones which are underperforming, again, are the ones which are looked at typically as defensive. So you have the IT stocks, the pharma stocks, the FMCG stocks. So are we trying to look at, the markets moving more in a risk-on mode or not, is the question that we'll get an answer to. Over the last couple of trading sessions, we've recovered from lows. Today's low on the Nifty is 21,965. Yesterday's low on the Nifty is 22,005 itself. So those are a couple of levels that we'll keep an eye out on. And because we bounced back from these levels, put writers at 22,000 have been fairly active. 1.3 crore shares in open interest out there, premium of 63 rupees, telling you there would be some support around 21,950 thereabouts. In fact, closer to 22,000 itself, because the 22,100 put writers are fairly active as well. And remember, these are puts which are currently in the money. On the way up, however, there is some sort of congestion that is expected around 22,350 to 22,400. Were we to cross that mark, then maybe there could be a case for short covering. But until that happens, 22,000 at the lower level to about 22,300 at the upper level is the broad range that the option writers are working with. Just keeping an eye out on a couple of data points as well. The put call ratio has moved to 0.85 versus 0.77. Again, telling you that there is some confidence that put writers are getting. This can go all the way up to 1.2 before it begins to look like overbought, but we're far away from that. In fact, we bounced yesterday from oversold levels. A couple of stocks on our radar. I'm looking at some sort of long building in Titagarh Rail Systems. This stock had taken a big knock, down almost 40-45% from its highs. Now we have seen a huge open interest build up on that counter. Bajaj Auto on the other side is seeing some short positions being added. So that's Bajaj Auto, some fresh shots on that counter.
Well, it did reverse from 21,960 in today's session. So that important 50-point range acting as a cushion for the index as of now. But is this the start of a base formation? Well, Saumil Mehta of Mirae Asset Sharekhan is joining us to answer just that. Saumil, good afternoon. Thank you for joining in. What's your call on the index now that we have managed to defend 22,000 for 2 days in a row now? Is this the start of a base formation for the index? And couple that up with your stock recommendations as well.
Good afternoon. Thank you for having me on the show. Very close. We are very close. I think, but before taking our call, I think we should wait for a reversal pattern to happen. Short-term and medium-term trend remains negative. We're forming low tops, low bottom. However, there are stocks which are looking good at this point of time. On Nifty, I think we are still, if the trend is negative, the next levels to watch out is 21,800 and 21,500 on the downside. In the very short term, probably for a week, we probably see a small consolidation towards 22,300 levels. 22,300 would be a very, very, a strong resistance on the upside. If we close above that, then the momentum on the upside continues. However, short term, medium term trend negative.
All right. And what about individual stocks?
I'm betting on mid caps. Mid caps have very good momentum at the moment, and if we are planning to bounce a little bit, then I would want to go with Trend. Good momentum. Stop loss would be 49.80, and target would be around 51.50. The second stock would be Polycab. Stop loss would be 48.50, and the target would be around 5050.
Interesting names there, Trent and Polycab. Saumil, thank you for joining in and sharing with us your views on the index and on specific stocks as well. We take a short break here on Halftime Report, but before we do that, here's some good news for our viewers. India's business news leader is now just a click away. We're introducing CNBC-TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app right away from the App Store and the Google Play Store. Take a short break. Be right back.
All the stocks will not make bottoms on the same day. Okay. So if you like certain stock and that stock is available at your dreamy price and it has gone below that, don't hesitate, start moving into the market. This time, the market has moved from 500 rupees EPS to 1000 rupees EPS for Nifty, and market extended from say 8,000 at the bottom to 24, 25,000. So it went 3x, earnings went double. So obviously market got re-rated big time. Now we are correcting that re-rating because earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown, every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. And despite that, we are doing 6.5%. Don't forget that. It is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. Excesses in the market was very clearly visible. And regulator, government, worldwide investors, everybody was uncomfortable. So this is a very healthy correction. And now next year, earnings will pick up from 1,050 to maybe 1,150 or 1,200, whatever. And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. You know, government expenditure is picking up. So I think all the things are falling in place, and correction has also happened.
Welcome back. 22,070 is where the Nifty is, still 50 points lower, continuing to remain in that 50-point range between 22,000 and 22,050, 22,100 is where the index lies, but a significant recovery from the early morning lows. And moving on to our special segment, Fin Street, where Abhishek is telling us today about how the third quarter panned out for housing finance companies and NBFCs. Listen in.
Well, it has been a good quarter for the non-bank lenders with respect to the loan growth and net profit growth. Now, net interest income surprised positively, which actually helped sustain the net interest margin. OPEX cost was very high for both HFCs and NBFCs. Now, earnings have relatively been driven by the lower provisions that you saw this time around. Improvement in asset quality continued for them. Outlook remains healthy. Some pockets are witnessing asset quality issues. So for housing finance companies, the loan growth in Q3 FY25 was about 14.5% YOY and about 3.2% sequentially. X of LIC Housing Finance and Samman Capital, the AUM growth was much healthier at about 27.3% YOY and about 5.5% sequentially. The NII growth was healthy as well. NII growth was around 20.5% on a YOY basis and close to 3% on a sequential sequential basis. So calculation shows that the net interest margin expanded YOY to 4.45%, up about 22 basis point YOY and down by 1 basis point sequentially. Operating expenses were high. They were up more than 32% YOY and about 8.3% quarter on quarter. So operating expenses impacted the operating profits in this quarter. Operating profits were up just 5.7% YOY, but they were down by 2.7% on a sequential basis. Now provisions were at just rupees 60 crores, down about 92% YOY and 98.5% on a sequential basis. So overall, profits after tax for HFCs were up 21% YOY and about 373% sequentially. Now asset quality continued to improve for them. So gross NPA value-wise was down about 15% on a sequential basis, while net NPA was down more than 1% on a sequential basis. So gross NPA ratio as a resultant declined to 1.75% versus 2.1% in the previous quarter. Net NPA ratio also declined by 3 basis points on a sequential basis. So for NBFCs, X of HFCs, the AUM growth was healthy at about 16.5% YOY and about 3% sequentially. The net interest income growth for them was healthy as well. NII was up 17.7% YOY and 4% quarter on quarter. So calculation shows that the net interest margin actually expanded to 6.6%, up 7 basis points on a year-on-year basis and 6 basis points on a sequential basis. Now operating expenses were high due to employee expenses, which increased sharply. So employee expenses were up 15.1% on a sequential basis and nearly about 26% on a year-on-year basis. So operating profits that grew by 14.7% year on year, but they declined by more than 1% on a sequential basis. Now provisions were at about 8,700 crores, which was up nearly 72% YOY and a decline of 2% quarter on quarter. Overall, profit after tax for NBFCs were up nearly 29% YOY and about 7.35% sequentially. Asset quality improved, but ratio-wise, gross NPA in absolute value was up 0.6% quarter on quarter. Net NPA value-wise was up nearly 3.5% quarter on quarter. As a ratio, gross NPA ratio has declined to 9.77% versus 10% in the previous quarter, while net NPA ratio is at 4.14% versus 4.12% in the previous quarter. Going ahead, loan growth is expected to moderate as per analyst estimate in many segments of NBFCs except gold loans. There are signs of asset quality stress that is emerging in other segments like pockets of vehicle finance, micro loans against property and affordable housing are witnessing pain in asset quality. Pain in the microfinance sector will continue for the lenders. Net interest margin outlook post the rate cut from RBI will be divergent. So rate cut is beneficial for fixed rate NBFCs like MMFSL, Shriram Finance as well as Cholamandalam, while rate cut is negative for floating rate based NBFCs like HFCs, housing finance companies. Valuations are around the long-term averages for superior earnings growth of 15-20% like MMFSL, Shriram, Bajaj Finance as well as Cholamandalam as per analyst.
All right, we take that point, Abhishek. Thanks a lot for that. Just before we slip into that short break, just pull up a couple of these financials which are now picking up pace. Abhishek was speaking about some of the financials on FinStreet. Look at Shriram Finance. That's moved to the high point of trade. We're seeing some traction in, HDFC Bank as well, which held on in yesterday's trading session. Now currently moved to the high point of trade for that stock as well. And then we are seeing some traction in LIC Housing Finance as well, which has seen a near 3.5% recovery from the lows, currently at the higher end of today's trading range. We take a short break, come back, get you more on the markets. A lot of stock-specific action. Stay with us.
So the first thing is about the values inside the family. And for us, the work was never looked at the balancing part of life. It was always something which was the biggest part of our life. Growing up, we saw our parents, both my father and mother, not only try to balance family and work, but make them both the biggest priorities of our life. And that's something that I've continued to embody as we have now been working in Reliance for the last 10 years. So the question of balance really does not come of balancing family or work. Both are the biggest priorities of my life. And there's one simple funda that I think we all need to embody, which is, your priorities of your life. And, as you grow older, your priorities change, but you want to make sure that your priorities are something that are very meaningful to make your life what you imagine it to be. And from our point of view, my family and my work are the two biggest priorities of my life, not only for this phase, but going.
Welcome back. Just before we move on, quickly highlighting a couple of names. Gensol Engineering is one of them, down in a 20% circuit now, and that's after Care Ratings has downgraded the company to a D from a BB+, and it's a big downgrade that has come in for Gensol, and as a result of which the stock is down in a 20% circuit as of now. It's down almost 65% now from its peak of over 1100 rupees. And some of the defense names, though, on the flip side, are doing very well for themselves, be it Cochin Shipyard, Garden Reach, Mazgaon Dock, all of them are doing well, and that is of course on the back of the European defense names doing very well overnight on the Rearm Europe plans that will be unveiled anytime during the course of the day. But moving on then, Ramdev Agrawal of Motilal Oswal Financial Services says that the promoters may start buying their stocks from the market in the next 2 to 3 months. Listen to what he said.
In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know their value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price or multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected.
In fact, Nigel is here with a list of those companies where promoter buying was seen in the last few quarters. Nigel.
Well, that's right. The last few months there's been plenty of talk about promoter selling, and that seems to have done a bit of a role reversal now, because there are select promoters that are coming in. They're showing the faith. And as we normally say, promoters, they're the best analysts of their own company. And select companies have seen some kind of promoter chipping in. Case in point being TD Power Systems. Just yesterday, they reported on the exchange that in February, the promoter entity went ahead and they bought close to around 15,000 shares. However, the street likes that, because the promoter coming in there and supporting the stock. And in February, we had a lot of companies actually where you had the promoter entity came in there, backed up the stock and bought some stake. One of the top, buys that we saw in value terms as well as in percentage terms is the promoter of JSPL. Now, the promoter entity, that's Jindal Power, they have come ahead and they have bought close to around 0.96% stake, which amounted to close to around 650 to around 700 crores approximately. And that's why the stake has gone up to above 62% post this particular buy. Not just them, we had the management of Maharashtra Seamless as well joining in. And remember, the promoter over the last few years has gradually been increasing their stake from around 65%. Last reported number was around 68% as of December 2024. And in February, they've gone ahead and bought close to around 0.5%. That's not it. If you look at Quest Corp as well, the promoter entity, just a few quarters ago, that was in December 2022, they went ahead and in fact, they increased their stake in March 2023 quarter by close to around 5%, very, very roughly. And now in the last month or so, last couple of months, they've gone ahead and they've increased their stake yet again to around 57.06%. So there is some creeping acquisition that we have seen from the promoter entities. And that's been the trend actually for the last few quarters as well, because select stocks have fallen off the cliff. But we have seen that promoters have come in there and they have been buying. If you look at Snowman Logistics as well, the promoter entity, which is Gateway Distriparks, they have come on the channel and they've said we're looking at making it a subsidiary. And that's precisely what's happened, because the promoter holding now has gone above 50% from around 40%. Fairchem Organics as well, we don't normally track this counter too often, but between September as well as December quarter, the promoter entity went in there, increased stake by around 2.5%. And finally, Mangalam Cement. The street is waiting by for some kind of corporate action. I've been hearing that buzz for the last many quarters. But for the time being, the promoter entity itself has gone in there and increased stake by close to around 1%. So as Mr. Agarwal said, we need to keep an eye out on this. Select promoters, they'll come in there, they'll be like, let's back up my own stock, because a lot of these stocks have corrected a good deal from the top. And I'm encouraging to see some promoters coming there, putting in their own money and increasing their stake. So the quantity is varying across counters. Back to you.
Take that point, Nigel. Thanks a lot for that. For a moment, when you said Mangalam Cement, I was happy that you, suffixed that with cement, because I thought you were suddenly calling out to me. And here's a disclosure: I have nothing to do with that company or that promoter.
No, you're not even on the block.
Not even.
You're done and dusted. Please be clear about that.
Done totally. What we'll do is we'll take a short break on the other side. While Nigel, me, and Hormaz keep talking on the other side, you have Manisha Gupta joining in with the agri expert Sumit Gupta to talk about all things commodities.
Also,
yeah, that's a great answer. Shlok, thumbs up. All right, you got the thumbs up from the wife. Talking about your dad, MDA, obviously, Mukesh Ambani for all of us is the inspiration for our whole country. Everyone looks up to him. You have a mom who actually runs larger companies than 99% of our business people in India. So you have this super achieving family. How do you step into these shoes? These shoes are very large shoes to fill. And how do you manage, and what is your biggest inspiration?
Harsh, biggest inspiration goes without doubt is the family that we've grown up with. We've all lived under one roof for now 32 years of our lives. And the inspiration is not too far to find in both my parents. I deeply value the human beings that they are and the work that they do. But the inspiration really does not come from, large items. Of course, the vision, the boldness, the ability to be very, very inspiring. It comes from the small things, like for example, till date, my father clears each and every email that is sent to him, and he does it till 2 a.m. at night, and he's working for the 4th decade of his working life, and that's where the inspiration really comes from. My mom, very, very similarly, we'll be staring at the same thing. We share a joint passion for cricket, and we're watching the same TV, but the small little details that she notices is something that you can draw inspiration out of. And I think out of and above everything is their dedication is the biggest inspiration for everyone around us who are who have grown up around them. And that's really why we can say that the biggest inspirations, because we can tell all of the small nuanced things that make the difference.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back, and it all starts to take another level, a notch up when you talk about agriculture products, which also seem to be now getting a part of trade wars there. I want to take the quote on as the US President Trump posted on Truth Social. He said to the great farmers of the United States, and get ready to start making a lot of agriculture products to be sold inside of the United States. The tariffs will go on external products on 2nd of April. Have fun, and unquote. I mean, that is what the US president has now spoken about. While we have been talking about, tariffs going on various commodities and countries as well, and some of the metals also. But now we are talking about agriculture commodities here. So what the US president has talked about is new tariffs on imported agricultural products will take effect from 2nd of April. So what we have as of now is, of course, a date, and we've seen those dates being changed and various commodities getting changed as well. But there is a conversation now that has been initiated on agriculture products as of now. The US president has urged American farmers to increase domestic production. He also has emphasized on need for agriculture products to be sold within US itself. What we also are looking at in the meanwhile is China talking about retaliatory tariffs. Now, what China has talked about, and here China is talking about specific commodities also. 15% on US goods, including chicken and cotton, and soybeans will face a 10% tariff, is what China has said. So more important to note here is that even as US is talking about farm products now, but the US agriculture tariffs as of now lacks details on what products this would be put on. The second point is that the proposed tariffs will raise the cost of imported goods within US here. The tariffs of agri imports is in that sense seen beneficial for the US farmers, because then you are protecting the US farmers here. More production will be used in-house itself. The second thing to watch out for is that the tariffs on products like soybean and grain is what really could have a major impact, not just for US and China, but various other geographies as well. Now, when you talk about the Indian markets itself, we do understand, and this all is via sources, that India as of now seems to be resisting pressure to lower tariffs on many of these agriculture products. India seems to be putting that front up because lower tariffs would mean more cheaper imports, more dumping of agriculture products within India, and that could really impact the farmers within Indian markets itself. So there is some conversations that we do understand, because the trade minister right now is in US exactly talking on the same things. Let's take the discussion forward and let's get in Sumit Gupta to do the same. Sumit, hi. First of all, on the Indian markets itself, we do understand that when it comes to soybean, wheat, grains, there are conversations that we understand, and all of this is coming via sources. India is resisting all of these tariffs being taken off. What is your stand? What is the kind of trade that India does with US right now, and what commodities really are we looking at?
Hi, Manisha ji. This is the topic of the hour right now. And Truth and X, they are driving the global trade these days. As you have captured the analysis on how Trump is thinking about trade, tariffs, and especially on the agricultural side, because everybody is actually catering to their vote bank, the people who have voted for them. If you look at the US politics, Republicans dominantly are strong in the agricultural, in the Bible Belt, and that's where majority of the farmers live, and they have to cater to their segment. And as far as when we come to India, India has largely tariff are in line of agreement on agriculture basis year 2000. So India is in no compulsion to reduce this agri tariff because it comes under the category of a developing country. And within that, I personally believe there'll be a lot of high temperature discussion that will take place. But US grows product to export. India grows product to sustain itself. Personally, I don't believe with 100 million farmer, 800 million people living in rural India, 600 million people directly dependent on agriculture, India can bow down on the agricultural tariffs in any way. So this will be a topic of negotiation, discussion. There'll be more concessions that will be given on the other side, but agriculture, personally, I believe will be not impacted.
Sumit, also when we look at the US and China trade itself and the kind of retaliatory tariffs that China is talking about, especially in soybeans and cotton, how will that impact the global trade, and how does that impact India?
That is a very interesting question, because what happens whenever you put a tariff, you actually don't change the supply and demand of the commodity. You just change the trade flow. Right now, for example, soybeans which are going from US to China, now the trade flow will emerge. Those soybeans will start going from Brazil and US. US will start processing more. They have the processing capacity. US will start exporting more meal. Europe will start importing more beans from US Chicago CME prices may go down, South American bases may go up. As more soybeans will go from South America to China, it may impact vegetable oil prices. Vegetable oil prices in India may go up because South American farmer will have more incentive to ship out soybeans to China, because there'll be a 10% tariff on China on the US goods. So for sure, this realignment of trade flows is going to impact India. But we are too early in this journey. It's very difficult to take a call at this moment. It is more of an understanding that we have to develop.
Oh, well, absolutely. Sumit, that was my next question, because as of now, when you look at these agriculture commodity prices, you look at a CME or you look at the Chinese markets, in some sense, you look at Asian markets as well, whether it is about Malaysia, Indonesia, etc. Do you see all of that changing? Because we've seen various other commodities either trade in discount or premium, depending on what geography you're looking at.
For sure. Actually, Chicago represents the price of commodities in Chicago, and world over we trade premiums, defining okay, what is a discount and premium of goods against the prices on Chicago. And once there will be a tariff on US goods export, especially the goods they export, that means US Chicago has to go down to accommodate for those tariffs. And South America and other countries will start trading in a much significant premium over Chicago because they will not have tariffs. But largely, personally, I believe there will be a much larger realignment of the trade flows. China will move towards South America. US will move towards Korea, Japan, Central America, Asia, Vietnam. So there'll be a big realignment of the trade flows. And as far as agriculture is concerned, the beauty of that product is it is not a factory that you have a fixed capacity. It changes every year. And every country needs to keep their food inflation low. And US is an exporter of last resort.
Sumit, do you think India could be forced to buy from US without tariffs? Do you see that kind of a situation emerging even for a short moment? And do you see India in a strong, negotiating position for that?
Personally, I believe if you look at the budget of this year, Finance Minister started with first statement that we want to increase realization of Indian farmer. So if we believe that budget is a statement that gives an outlook on what government of India thinks, and number one. Number two, looking at the farm economy, looking at the reduction in the consumption power in rural India at the moment, personally, I don't believe that government of India is going to tweak with agriculture at any point in time. So there'll be much more negotiation which will happen, concessions on the other side, but agricultural is something which is like a holy cow for India.
Oh, well, yes. And if the Indian markets are forced or Indian ministers are forced to buy with lower tariff, that doesn't really augur well with the kind of policy that India has, and of course does not work with millions of farmers that India has as well. Sumit, thank you so much for joining in. Still early days, as you said, and we will wait for the details on what negotiations are brought to the table and what really India gives into that. But with that, it's wrap on Halftime Report. Business Lunch will take all the action forward.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Very importantly, tomorrow tariffs 25% on Canada and 25% on Mexico, and that'll start. No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow.
Midcaps stage a bounce, turning the market breadth positive for the season. In a session, I beg your pardon, industrials as well as powers are the big gainers, but FMCG, pharma and IT drag. Bajaj Auto's ED Rakesh Sharma says a weak market sentiment may have hit the sales in February, even as the year should end with the expected 6 to 8% growth. He expects strong sales in upcoming wedding season starting end of March. Experts warn of a risk to inflation and growth from imposition of tariffs by the US, even as it is unclear of how long the tariffs on Canada, Mexico and China will remain in place and what retaliatory actions could follow. Likely reciprocal tariffs from April 1st is the other big imponderable. Bitcoin and other cryptos tank on fears of economic impact of US tariff, offsetting the positive sentiment infused by creation of US strategic crypto reserve. Hello, good afternoon. You've tuned into Business Lunch, coming in live from CNBC TV18 Motilal Oswal Studios. I'm Vinny Motiwala, and thank you as always for tuning into Business Lunch. A quick look at what the market is doing today. It did stage some bit of a recovery from the day's lowest point. As of now is what we're seeing for the Nifty 50 as well. So Nifty 50 managing to hold on to the 22,050 and around that mark, 22,050, 22,080 is what it's moving on in today's trading session. After that recovery it's made, 0.3% of decline is what Nifty is seeing as of now. Sensex similarly down 0.2 to 0.3% in today's trading session as well. Let's pull up the small cap because that's looking interesting because it's trading in the green today. So Nifty small cap is holding on to gains of 0.3% in today's trading session. Opened up in the red and then look at the recovery that's made. Let's pull up the mid cap. That's down almost 0.4 or 0.5% in today's trading session as of now. That too has seen that recovery coming in. It did go to the green but again has come back to the red side. So we'll be keeping an eye out on the Nifty mid and small cap, the broader end of the market that's seeing a bit of a better performance as well. Nifty Bank, that's another one that's holding on to gains of almost 0.2% in today's trading session. 48,200 is what the Nifty Bank is holding on to as of now. PSU banks obviously are among the names that are coming in terms of the good move that they're seeing in today's trading session. Other than that, let's pull up Nifty Media as well because that's managing to hold on to very strong gains of 2%. What we're seeing in terms of not doing well and where, sharp fall is coming in is Autopack, IT as well as FMCG are the top sectoral drags in today's trading session. So yes, that's how the market setup is looking like. We've seen that recovery coming in from the day's lowest point, but will that sustain in the next couple of hours of trading session is something that we'll keep an eye out on and keep you all updated with. But on that note, let's kick off business lunch with the top news of the day. And markets worldwide took a dive as investors brace for impact from US President Donald Trump's order to impose tariffs on Mexico, Canada and China. In his address to the media, he said that reciprocal tariffs will begin on 2nd of April, while tariffs on Mexico and Canada will go into effect and will be effect later today. Let's, in fact, listen in to those comments coming in.
Tariffs, as you know, will start a week earlier than the reciprocal, which is going to be on a couple of weeks earlier. Reciprocal tariffs start on April 2nd. And I wanted to make it April 1st, but I didn't want to go April Fool's Day because that costs a lot of money, but that one day. But so we're going April 2nd. Tariffs 25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariff. So what they have to do is build their car plants, frankly, and other things in the United States, in which case they have no tariffs. No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect.
And meanwhile, Canada has imposed retaliatory tariffs on the US hours after Donald Trump's 25% tariff came into effect. Canada will impose 25% tariff on $107 billion worth of US goods from Tuesday. Initially, 25% tariff will be imposed on $20 billion worth of US goods. Tariffs on the remaining products will come into effect in 21 days. So that's the latest update that we have coming in on the tariff front. Now, the tariffs that are going to be imposed could also have a negative impact on US itself. Ben Powell, chief middle strategist of BlackRock Investments, spoke to us earlier today, and he told us that these tariffs would be inflationary for America itself. He also added that the tariff uncertainty has weighed on markets worldwide. Listen in.
This is now a stagflation shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. Negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So yes, it's kind of a double negative, unfortunately, of a stagflationary shock. For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute. I think unusually we can have a clear moment where we move from one paradigm to a different global economic paradigm, and that's today. So the tariffs, as you say, go from theoretical to real, so they are here. To your critical question as to whether they're going to persist, but the honest and real answer is we don't know. It's an extremely uncertain situation. So are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that uncertainty is a kind of permanent change, which we're all going to have to kind of get used to as investors in the months and even years ahead.
We had also spoken to Robert Sorkin, global economist at Citi, and he expects US GDP could fall over the next few quarters if tariffs persist. Listen into an excerpt of that conversation.
The models that we've run have shown that of these tariffs, the economic damage is probably largest for Canada and Mexico, given the significant ties to the US economy. But the US is not immune from the negative effects of these tariffs. I think even if these tariffs go into effect, my assumption would be that they would not stay on for a durable period because of those negative economic effects that I mentioned and the negative effects to equity markets you're likely to see. that the stagflationary effects on the US are kind of amplified, and you get a large negative hit, probably over a several quarter period, over 1% off of US real GDP, and you get a sizable boost in inflation. You're looking at US real GDP that falls over a several quarter period by over 1 percentage point. And I would expect the spikes in US inflation in the short term to be half a percentage point or higher.
Continuing with the tariff chatter, China has vowed to hit back at the US with retaliatory tariffs ranging from 10 to 15%. CNBC Sri Jaggaraj is joining in with us from Beijing to give us more updates on this.
There were countermeasures coming down the pike from Beijing, because today is the day when those US tariffs, the additional 10% tariffs on Chinese imports, is effective, coinciding, perhaps not a coincidence, with the beginning of the 2 sessions, the annual parliamentary gathering here in Beijing, that really sets the tone and sets the policy agenda politically and importantly for us, for the macro markets economically in China for 2025. It really feels like the entire MPC agenda has been overshadowed or usurped by the tariff conversation. And let me just remind you and summarize, if I can, what we have learned from the Commerce Ministry and MOFCOM, the Ministry of Finance. China will impose 10% tariffs on US sorghum, soybeans, pork, beef, seafood, fruits, vegetables, dairy. China will impose 15% tariffs on US chicken, wheat, corn, cotton products, and MOFCOM will add 10 US companies to the unreliable entity list, and also 15 US entities to the export control risk list. So it's very clear here, as far as the external risks are concerned, that China is not taking this lying down. They're not being passive, they're not acquiescing, and they are hitting back with countermeasures of their own, which seems somewhat at odds with what we heard from the MPC and the spokesman earlier on today, which was still keeping the door open to some sort of compromise, to some sort of dialogue or negotiation. So perhaps there still is some sort of diplomatic off-road to all this tariff unpleasantness, but let's see what washes out and transpires. But very clearly, Dan, this puts the onus of responsibility on the policymakers to really give a hard look at the policy and the stimulus response ahead. And if we do go down a tariff rabbit hole, that's not good news for China's export growth, and the authorities may have to work harder in terms of bringing more stimulus to the table.
On that note, we're going to slip into a very short break. You viewers, don't go anywhere. We'll be back with more news and updates after this break.
This is now a stagflation shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. Growth, negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So yes, it's kind of a double negative, unfortunately, of a stagflationary shock. For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute.
Welcome back. Thanks for staying tuned into Business Lunch on CNBC-TV18. Let's move on. India's Chief Economic Advisor, V. Anantha Nageshwaran, has reiterated, that India's regulation needs to reforms to make it simpler and investor-friendly. He also said that India is revising its bilateral investment treaty norms in the line with global standards. Listen in to what he had to say.
We need to ensure that regulations are efficient, cost-effective, and responsive to stakeholders. It is vital to have regulations which are simple, easy to understand, and easy to comply with, without imposing hardship and uncertainties on regulated entities or creating unintended distortions. Therefore, it is important to have a well-defined, well-designed ex-ante and ex-post cost-benefit analysis framework for regulations to ensure that to evaluate their net impact on financial sector and the economy. Many countries, including India, have realized the importance of balancing investor protection with state sovereignty. The goal is to safeguard national interests while encouraging foreign investment. As with everything, it is a balancing act, and we are prepared to iterate our approach. Countries are revising their BIT frameworks to reflect modern challenges. Given that almost 10 years have passed since the last review of India's model BIT, and since then the global investment ecosystem, international jurisprudence have evolved significantly as well. Investors now seek stronger protection for their investments, especially in emerging economies. And therefore, these developments have led to the decision to revise and update India's model BIT to align with international norms while ensuring the country remains an attractive investment destination, especially for medium enterprises.
And also some news from the insurance space. Now, the sector regulator, IRDAI, has warned health and general insurer against rising the commission payout. Yash is joining in with us to give us more details on this one. Yash?
Well, there's some tough talking which has come from the insurance regulator, IRDAI, towards general insurance companies as well as health insurance companies. What has been the point of concern for the insurance regulator? It has been the high commission payouts by general as well as health insurance companies for distribution or sale of the insurance policies. What has suddenly led to this particular point? April 2023 is when the regulator gave relaxation to the industry by removing limits on individual business commissions, motor commission, health commission, accident commission, and putting a limit straight away on the total expenses made by any insurance company. This gave insurance companies freedom to sort of maneuver the commission that they wanted to pay, but at the same time stay under the limit when it comes to the total expenses which they were making.
According to the regulator, there has been some misuse of this relaxation which was given to the insurance companies, where the insurance companies, as per the regulator, have significantly increased the commission payouts in the last couple of years. And against that, they've reduced the operational expenses to stay under the limit of the total expenses. What this has led to, or this has done, is that the cost of the product, insurance product, that is the premiums, haven't come down because the commissions have increased significantly. The regulator is concerned about this particular aspect. In fact, the tough message from the regulator is that if commissions are not reduced by insurance companies and the benefits are not passed on to the policyholders in terms of lowering of premiums, then it may also think about putting those limits back to individual commissions, and that may happen as soon as the next review, which happens in 2026.
Okay, Yash, thank you so much for the latest update coming in there. Let's move on. The Bombay High Court has granted a stay on a lower court's order to file an FIR against the former SEBI chairperson Madhvi Puri Buch and 5 other officials. Ashmit is getting us more details on this one. Ashmit?
Well, Bombay High Court coming to the aid of former SEBI chief as well as SEBI officials as well as the BSE chairman. What's important is that the Bombay High Court has stayed the operation of the lower court order, the ACB court order. So effectively what that means is that no FIR will be filed against any one of these officials. As far as what the fate awaits, as far as this entire complaint is concerned, that is an issue that the Bombay High Court said it will take up in 4 weeks' time. Now, what's important is that there were a whole host of lawyers that appeared for various officials who made a number of key arguments. Number one, they argued that this violation that is being alleged of is with respect to a 1992 SEBI circular. It's been more than 30 years. Also going on to say that the listing of the company in question, Cal's Refinery, took place back in 1994, that none of the officials who've now been named as accused were anywhere near in the picture as far as the 1994 listing is concerned, that the complainant appears to be a habitual complainant, a habitual litigant who's been reprimanded on various occasions, who's been called out to be an extortionist by the High Court itself. In fact, the various councils went on to go ahead and argue that even under the Prevention of Corruption Act, there's a government sanction required to prosecute, to take any prosecutive action against government officials. On all these counts, the Bombay High Court, at least prima facie, at this interim stage, appears to have held that the ACB court order directing an FIR was mechanical in nature. There were not enough attention paid as far as details were concerned, and that this is an order that needs to be stayed, at least as of right now. So no action to be taken against the former SEBI chief or the SEBI officials, and importantly, the hearing in this case will resume in 4 weeks' time. Back to you.
Okay, Ashmit, thank you so much for that. But on that note, we're going to step into a very short break, viewers. Don't go anywhere. We'll be back with more news and updates on the other side.
And the deal can be made very fast. It should not be that hard a deal to make. It can be made very fast. Now, maybe somebody doesn't want to make a deal. And if somebody doesn't want to make a deal, I think that person won't be around very long. That person will not be listened to very long because I believe that Russia wants to make a deal. Well, I just think he should be more appreciative because this country has stuck with them through thick and thin. We've given them much more than Europe, and Europe should have given more than us because, as you know, that's right there.
Welcome back. Thanks for staying tuned into Business Lunch on CNBC-TV18. Some of the pharma names that I want to point out today. We have Occam's drug that's in focus and it's buzzing in trade. We have AstraZeneca Pharma as well as Alembic Pharma. All of these are managing to hold on to very strong gains in today's trading session. Look at it. 6%, 5-6% gains of all these companies managing to hold on. So keep an eye out on these pharma companies. But yes, these are some of the pharma stocks that have been buzzing in trade. On that note, we're going to wrap up this edition of Business Lunch on CNBC-TV18. Thank you so much for tuning in. But here's something that we have for you all. PM Narendra Modi inaugurated and visited the Wildlife Rescue, Rehabilitation as well as Conservation Center in Vantara in Gujarat. Now, Vantara is home to more than 2,000 species, over 1.5 lakh rescued, endangered and threatened animals. The Prime Minister explored various facilities at the center and also closely interacted with various species of animals which have been rehabilitated there. The Prime Minister visited the Wildlife Hospital at Vantara and saw veterinary facilities which are equipped with MRI, CT scans, ICUs, among others. PM Modi also interacted with the doctors, supporting staff as well as workers who are managing various facilities at the center.
Let's talk about SIFs, the new investment option in town. If you have been investing for a while, you have probably heard about mutual funds, the go-to option for most retail investors, and maybe even about PMS, the portfolio management services, where high net worth individuals invest 50 lakh rupees or more for a custom-built portfolio. But now there's something new and interesting in between these two categories, and that's specialized investment funds or SIFs. This is a brand new category that SEBI has just approved, and it's designed for investors who want more flexibility and sharper investment strategies, but without needing to lock up 50 lakh rupees like PMS. To invest in this specialized investment fund, you'd need a minimum of 10 lakh rupees, so it's definitely not for first timers, but it's far more accessible than PMS. Now let's talk about how this fits into your investment toolkit. Mutual funds are obviously your starter pack. You can start with as little as 500 rupees. The strategies are basic, mostly long-term buy and hold, and they're designed to be simple and transparent. PMS on the other side is your high-end tailor-made option. You need at least 50 lakh rupees. The portfolio is customized for you, and the fund manager has a lot of flexibility to choose what to buy, sell and when. Now SIF sits right in the middle of these two, 10 lakh rupees minimum, advanced strategies like long-short trades and derivatives, but still regulated closely by SEBI, so there's proper oversight. Now what makes SIFs different from regular mutual fund? For one, the strategies. Regular mutual funds mostly follow long-only strategies. They buy assets they expect to go up over time, but SIFs on the other hand can go both long and short, meaning they can bet on stocks and bonds and even on sectors that they think will rise or even fall. They can also use derivatives up to 25% of the portfolio, which lets them hedge risks.
It's Midcap Radar time. Mangalam and I are coming to you from the CNBC-TV18 Motilal Oswal studios. And Mangalam, it's not a significant difference from where we left off half an hour ago. The Nifty still holding on to that 22,050 mark, but the broader markets are the ones that are in focus this afternoon.
That's the only fly in the ointment, that the recovery that we saw in the mid-cap end of things is now seeing a bit of profit booking, and the lines that we were talking about, yes, the green line is still above the red line, but they've only come a little closer. The Nifty Bank's still holding up in the green. What we'll do is take note of all the top stories that we're tracking this afternoon and then get cracking on a lot of these individual names that we're talking about. The markets, which trade in a range but under pressure, mid-caps also give up gains, while banks are the only bright spot. IT, auto and real estate stocks drag.
Quick commerce stocks, Swiggy and Zomato are trading with gains after ICICI Securities reiterated their buy recommendation on them. The brokerages say that the valuations are now compelling for investors with a 1 year and higher time horizon.
Varun Beverages climbs over 3% after CLSA upgrades the stock to a high conviction outperform, citing the company's risk reward being very compelling despite assuming competition impact.
EMS companies like Keynes Technologies and Sirma SGS are in focus at the back of an Investec upgrade. The brokerage said that valuations are now looking reasonable after the correction, and they are convinced about the growth opportunity, albeit with some concerns.
Gensol hits lower circuit after Care Ratings downgrades the stock default from Care BB Plus with a stable outlook, citing ongoing delays in the servicing of term loan obligation as per feedback from its lenders as the reason for this downgrade.
And it is Gensol Engineering that is been the stock of the last few minutes, a 20% lower circuit after that downgrade, and some interesting names that come up as its lenders as well, the ones that have exposure to it, be it IREDA, Power Finance Corporation, Bandhan Bank, with smaller amounts of course, but IREDA and Power Finance Corporation are the big names that have exposure to Gensol Engineering. IREDA too has come off the highs of the day, but Power Finance Corporation still about there, around about 0.25% lower. But there are plenty of movers in the broader markets other than Gensol Engineering. Which are those? Vamakshi is here to take us through those. Vamakshi, good afternoon.
Well, good afternoon, Hormaz. It's a tug of war between the bulls and the bears as far as the mid-cap index is concerned today. It started off at the day's lowest point. It has since recovered and still holding on to that level. But let's first look at some of the top gainers. Vijaya Diagnostics is one such name. That stock is up nearly 10%. Concord Biotech also trading close to the day's highest point, up nearly 9%. India Cements is another counter. It is seeing the biggest intraday advance since June of last year. Deepak Fertilizers as well. That stock is flying away in trade, up nearly 5.5%. Defense as a theme itself is a buzz today. We have several names flying high. Bharat Dynamics is one such counter, up nearly 5%. Look at Mishra Dhatu Nigam, DCX Systems, as well as Cochin Shipyard. All of these counters are trading anywhere about 2%. Industrial counters, on the other hand, are also some names that are a buzz in trade today. Jyoti CNC is up nearly 11%. Earlier during the day, the stock was up as much as 15%, which is the biggest intraday advance since Feb of last year. GE Vernova, TNT, Schneider Electric, as well as Hitachi Energy are some other counters that are flying away in trade today. On the flip side, let's also look at some of the counters that are declining in trade today. Astral is down nearly 4%. Supreme Industries, Paytm, as well as Welspun Living are some other counters that are down over 4%. Lastly, let's take a look at stocks that are moving on the back of very strong volumes. Alok Industries is one such counter, up nearly 6.5%. So is AstraZeneca. We also have Alembic Pharma as well as Acom Drugs. Both of these counters are anywhere up between 5 to 6%.
Take that point, Vamashi. Thank you so much for that. In fact, if you add some other names to that as well, Ramakrishna Forgings, for instance, is up around 6% as we speak. Jana SFB too has moved to the high point of trade. And we are seeing some traction in names like HOEC, which has recovered about 3% from the lows. Good time to welcome Shrikant Chauhan from Kotak Securities for a quick technical check on the market. Shrikant, seems like by now the consensus is that we're closer to the bottom than, what we had earlier feared. Between 21,800 to 22,000 is where the market is likely to take some support. Would you concur with that view? Are the charts suggesting that as well? And if yes, then would it make sense for one to try a long position or maybe wait for a reversal and buy higher only on confirmation?
Good afternoon, Mangalam and Horvas. Well, for Nifty, yes, we are very close to the important support levels. Although today's recovery is not that encouraging, because if we see the advanced decline ratio, then it is not that encouraging. Even if we consider the mid-cap stocks, then they are finding some selling pressure at higher levels. But broadly, I am of the view that we are very close to these levels where the market is having excellent support in terms of extensions, in terms of averages. So close to these levels, we need to see some like a very sharp recovery after hitting the lows, and today that is missing. So in case we may see some such type of activity in next few days, then there will be an opportunity for short-term traders to create some position. But if there is a medium-term view, if there is a positional view of at least next few days, then certainly we should look for taking some contra bets at current levels, little bit more on dips on index with a stop loss at 21,700. Again, the market can rebound to the levels of 22,300 and maybe 22,800 sort of levels. Also, if we consider, Mangalam, the trend of last 15-20 days, then the market has fallen nearly 2,000 points from its high, and the pullback is completely missing. So whenever in the past we saw sell-off of around 2,000 points, we saw recovery of at least 800, 900 points. So this time also I am of the view that in case if we see the market is, let's say, dropping 100, 150 points more, then there we should look for taking some contra bets.
So what are those contra bets, Shrikant, when it comes to specific stocks? Because most of them too have seen a very steep correction from the top.
Yeah, absolutely. And almost like whenever there is such type of activity in the market where there is like, I'm going to say the broader market is under pressure, we need to focus on those companies where there is specific news flow. And in that, we like NBFCs, Sundaram Finance, which is currently trading around some 4,600 levels. There, if we see the technical pattern, then it is consolidating within the range of 5,000 and 4,000 on the downside. On the dismissal of 5,000, I'm expecting stock to move towards at least 5,500. And at this level also, it is a very, I can say, confident buy because it is reversing after hitting the lower levels. So it's a buy at current levels with a target of 5,500. And the other stock which we like is SBI Cards. And if we see the technical pattern of last, let's say, a few months, at least 12 to 14 months, then you can see that the stock is forming some rounding bottom sort of formation, and now it is forming some continuation formation on daily and short-term charts. So at this level, it's a quite attractive buy around 825, 830 with a target of 900, 950, and eventually we may even see the levels of 1100. So that's the view on SBI Card.
Interesting. Shrikant, thank you so much for sparing time and joining us today this afternoon with your views on the index and on specific stocks as well. We take a short break, but before we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app where you get instant access to breaking news, in-depth articles and financial world updates right at your fingertips. So you can download the app right away from the Apple Store or the Google Play Store, or just scan the QR code that just comes up on your screen. Take a short break. Back with the management of Sudarshan Chemicals on the other side. Stay tuned.
Bets. Flexibility you don't get with traditional mutual funds. And SIFs themselves can be either open-ended, meaning you can enter and exit anytime, or close-ended, meaning there's a fixed tenure. But even for closed-ended SIFs, SEBI says that they must be listed on stock exchanges so investors have a chance to exit early if needed. Now, SEBI hasn't just opened the gates and said launch what you want. There has been a clear rule set for AMCs who want to offer these funds. Only AMCs with at least 5 years of track record are eligible to launch SIFs, plus they need to manage at least 5,000 crore rupees in existing mutual fund assets to even qualify. This ensures that only experienced players with rock-solid management systems get to handle these advanced funds, because these aren't plain vanilla products meant for casual investors. So who should even look at SIFs? If you're already comfortable with the markets, maybe you've been investing for a few years now, you understand terms like hedging, short selling and global macro strategies, and you want to go beyond mutual funds but without committing 50 lakh rupees to a PMS, this could be worth exploring. But remember, flexibility comes with higher risk. These are not simple set and forget products like mutual funds. They're designed for investors who actively want to participate in more complex strategies and who understand the risk involved. This is a new space, so keep an eye out for which fund houses launch the first SIF and what kind of themes and strategies they bring in. And
user development fee is charged by an airport operator to passengers to bridge the revenue shortfall. This fee varies across airports and the amount is approved by the Airports Economic Regulatory Authority, or AERA. Now, GMR Airports operates Delhi Airport, Hyderabad Airport, Goa Airport, Nagpur and Bidar airports. It is also developing the Visakhapatnam International Airport. Now, when it comes to UDF, Delhi Airport stands among the lowest at a flat fee of 129 rupees for domestic and international passengers as compared to Bengaluru, Hyderabad, Chennai, Kolkata and Ahmedabad. Now, GMR took over Delhi Airport in 2006 and the tariff proposal that it has submitted now is the fourth control period from April 2024 to March 2029. Here, DIAL has proposed UDF for departing as well as arriving passengers on peak hour and non-peak hour basis. So, for domestic passengers, the proposed fee is at 405 rupees during off-peak hours and 610 rupees during peak hours. For international passengers, departing economy class will pay 810 rupees and business class will pay 1620 rupees. Now, please note that these rates are in proposal stage and the final tariff will only be determined by AERA. Now, DIAL has justified the demand citing insufficient cash flows and consecutive losses totaling 1795 crores from FY21 to FY24. They are projecting a 1794 crore loss in FY25 as well. With a debt of 14,786 crores and a declining
Welcome back. Let's get chatting with the management of Sudarshan Chemicals, which has informed the exchanges that they've successfully completed the acquisition of Germany-based Huback Group through its wholly owned subsidiary, Sudarshan Europe BV. This acquisition will enhance their product portfolio, give access to diversified asset footprint across 19 international sites. What does this mean in terms of a turnaround and addition opportunity for them in terms of revenue and operating performance? We have with us Rajesh Rathi, who is the managing director of the company. Thanks a lot, Mr. Rathi, for joining in. And that really is the first question, because I'm looking at your acquisition note. You have paid about 1160 odd crores in terms of cash and another 268 crores on account of adjustments for inventory, working capital and VAT. So a net outflow of close to around 1350 to 1400 crores for a company that does almost 800 million euros in terms of revenue. So the obvious question is, what is the profitability of this company and what's your scalability plan out here? What kind of synergies do you think you can realize?
First of all, thank you CNBC-18 for having Sudarshan on your channel. To talk about the big picture on our acquisition, Sudarshan had an ambitious growth strategy. We aim to become a world leader and the most value-adding pigment player globally and a preferred partner for our customers. As you mentioned, this acquisition provides us a great opportunity to kind of visualize our, to achieve our vision and become a value-adding player globally. 19 manufacturing sites in 11 countries across 4 continents. Plus, it gives us a very deep access into Europe and America's market, which are the largest markets. It also provides us the state-of-art technical expertise, and which our second technical expertise is, the technical center is going to be in Frankfurt, which gives us a great opportunity to grow. In terms of profitability, due to antitrust, not able to delve into the numbers, but we are very confident year one itself we would be able to achieve good positive numbers.
What are those positive numbers, sir? We're just trying to understand that. And secondly, how does this impact the listed Indian company, Huback Colorants?
So I think, as I mentioned, due to antitrust, not able to delve into numbers yet. We are just getting into the numbers. The second, the Huback Colorant comes as part of this deal and will be part of our business.
Merge the two at some point?
Sorry, come again?
Will you merge the two?
I think we're looking at all the legal aspects of what we can do, but I think we would want, but it'll be a very important part of our portfolio going forward.
Mr. Rathi, good afternoon. Thank you for joining in. So you're mentioning that a merger is on the cards, but you're still exploring legal options for the same. But you had also mentioned the last time you spoke to us that there might be some capital infusion that you may have to make in terms of working capital. How is that progressing? If you could quantify that number for us, sir.
So there are various aspects which cash infusion would be required. One is a small amount for the working capital. We have to make an open offer for Huback Colorants, and we may also require some cash infusion for some structuring. And our estimate was that this the cash infusion will be another 11 to 1200 crores.
With this acquisition, what is the kind of debt that comes onto your financial books? How much debt do you assume because of this acquisition?
So I think what we've done is this acquisition plus cash infusion is a combination. How we've raised funds is a combination of equity plus debt. And so that's where, that's how we are financing this whole acquisition.
No, that is about how you are financing this. So if you could give us a split on how much is the cash that you are using, how much is the debt you're raising. And secondly, by acquiring this company, which also had its own financial troubles, high interest costs, etc., I'm sure there was some debt on the books of this company already, which will come as a part of this acquisition as well. So we just want to understand that too.
Absolutely. So this acquisition is a debt-free acquisition. So no debt comes onto our books from Huback. And, as I mentioned, I would say the total infusion is about, let's say about, including the acquisition price is about 2,500, and about half of it will come through debt and half of through the QIP process.
So what does that take the total overall debt number to for your Indian entity, Mr. Rathi?
So as I mentioned, we, on our books, we have a very small debt amount. The new Huback business is a debt-free acquisition. So the only debt would be, which I already mentioned to you.
We still don't get how much would be the incremental revenue that would be added, because, you know, I'm looking at your own performance. Your export business is close to around 315 crores per quarter. I'm looking at your quarterly run rate in terms of revenue is close to around 650, 666, if you look at the last quarter as well. This business that you've acquired has revenues of almost €1 billion. So how does that reflect in your overall consolidated entity? And, you know, what are the margins that this business operates at?
So the overall business would be 1 billion plus. As I mentioned, due to antitrust regulations, we've not been able to deep dive into numbers. We're getting into the numbers. But directionally, I think, you know, the business would be in the teens of EBITDA margins. That's what we aspire to.
And by when does this start showing up on your accounts, Mr. Rathi?
I think it's too early to say that. We are getting into the numbers. We've just concluded the transaction and we'll be looking at the numbers in more details.
Right. And, you know, currently, what is your revenue that comes in from the particular product that Heubach makes? And we're just trying to understand upselling or cross-selling synergies here, over and above what the company does already.
There are great cross-selling synergies. Directionally, if you look at Europe and US are strong markets for Heubach, and the paints and digitaling markets are strong versus for Sudarshan, plastic market was strong. So there are great synergies going forward.
So currently, what proportion of your revenue comes in from Europe and US, and how does this acquisition add to that?
So as I mentioned, we're not able to delve into detailed numbers, but going for, you know, we would have a great market share in these two as a combined entity now.
By when would you have clarity, sir, on you know, on the numbers? By when can you tell all the viewers, the shareholders, these numbers in detail?
So there is a formal process where you know, we will declare numbers as per the statutory requirements, and we would share numbers from that perspective.
Now, at X of that acquisition, Mr. Rathi, what is your current exposure to US and Europe? If you could quantify that for us. You may not want to tell us the acquisition plus acquisition numbers, but X of that?
So I think from a perspective, as our guidance to the market, we've not been giving breakups due to competitive intelligence of the breakup of numbers. But I think Heubach's presence in Europe and Americas is much larger than ours. And as a combined entity, I think we will bring in customer centricity and be the preferred choice for our customers in these markets too.
All right. X of this combined entity, which you can't speak of, or the standalone business, I mean, the business which is currently there, what kind of prognosis can you make in terms of FY25 and FY26 revenue growth and margins?
So directionally, like I mentioned, there are great opportunities which we've identified to win back business. Heubach had lost some business, and we see that we will be able to win back this business. And again, won't be able to delve into particular numbers.
No, we're talking about Sudarshan Chemicals, not Heubach right now. For Sudarshan Chemicals, what's the guidance that you have?
From a Sudarshan perspective, our guidance has been very clear. I think we did a large investment to transform our product portfolio into a specialty product portfolio, and that's been paying dividends. And as you can see, we've already recorded on YTD 18% growth, and that trend should continue.
All right, Mr. Rathi, thank you so much for sparing time and joining us today. We hope you join us once you are at liberty to discuss more numbers once the entire acquisition starts reflecting on your accounts as well. The management there of Sudarshan Chemicals. Take a short break. More on the markets on the other side. Stay tuned.
untold era that raising funds for future projects has become difficult. It claims to have invested 12,500 crore rupees from 2019 to 2024 in new development projects like Terminal 1 development, 4th runway and Eastern Cross Taxiway. The airport said that there is a significant need for capital expenditure for further developing the airport's infrastructure, and which is why the need for higher user development fee.
What next for Donald Trump and Ukraine's President Zelensky after the massive showdown that the entire world witnessed at the Oval Office? Before this, America and Ukraine were planning to sign a minerals deal. But then we all saw what happened. Now, in the latest statement, Zelensky says Ukraine is ready to sign that deal.
If we agreed that a minerals deal with the US will be signed, from our side, we are ready to sign. I honestly think the United States will be ready as well.
So what is this deal all about? And before that, why does Trump want Ukraine's minerals? Trump claims that US military and economic aid to Ukraine is almost about $500 billion, and he wants the US to have access to Ukrainian minerals equivalent to that amount. However, Ukraine disputes this figure. Even the German think tank, the Kiel Institute, estimates that the US has sent $119 billion in aid to Ukraine. Trump has argued that such a deal would help US taxpayers get their money back for the aid provided throughout the war. Additionally, America is keen on securing Ukraine's mineral resources to reduce its dependency on China, which controls 75% of the world's rare earth deposits. This is according to the Geological Investment Group. Now let's return to the deal itself. Both Ukraine and the United States had agreed to give the US access to Ukraine's rich mineral reserves, with revenues diverted to a joint US-Ukrainian fund. Ukraine holds approximately 5% of the world's mineral resources, which Trump seeks to secure. However, not all of these resources are currently exploited or easily exploitable, and some lie in territory which is occupied by Russia. Ukraine is known to be the producer of several critical minerals. It ranks as the world's 8th largest producer of manganese, which is according to the World Mining Data, the 11th largest producer of titanium, and the 14th largest producer of graphite, which is essential for electric batteries. Ukraine also possesses 20% of the world's estimated graphite resources, according to France's Bureau of Geological and Mining Research.
Welcome back. The Nifty still holding on to 22,050, but a couple of stocks that are coming up on the radar. Paytm is one of them, 4.5% lower now at the lowest point of the day, now below levels of 700 as we speak. And the other one is Supreme Industries. That is continuing to see selling pressure right now after a downgrade that has come in from Prabhudas Leeladhar as well in today's trading session. So 4.5% lower there on Supreme Industries as well. But we call time on this edition of Midcap Radar. From Manglam, me and the team that put this show together, thank you so much for watching. MF Corner on the other side.
It claims to have one of the largest lithium deposits in Europe. However, there's another interested player in this game, Russian President Vladimir Putin. He has suggested that he's open to cooperating with the US on rare earth minerals and has expressed support for US investment in Russian-occupied regions. While Zelensky has expressed confidence that relations with Trump can be salvaged and that the Trump administration won't cut off assistance to Kiev, the world is closely watching Trump's next move.
Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC-TV18 and I'm Vinny Motiwala. Let's talk about something very interesting that has happened over the last week. Now, the SEBI has released a framework for the new category of investment products that is called the Specialized Investment Fund. According to the SEBI, the category aims to bridge the gap between mutual funds and portfolio management services. Now, this new framework is set to come into effect from 1st of April. But what does it mean for you as investors? Who should be actually going for this option as well? And which one should you be choosing? There are categories coming in. To discuss more on this as well, we are joined by Kirtan Shah, founder of Credence Wealth, joining in with us. Kirtan, good afternoon. Thank you so much for joining in with us, as always, on CNBC TV18. Kirtan, let's start just by the basics first. What is SIF or Specialized Investments Fund?
Vinny, thank you so much for having me on the show. So a couple of things. I think you should actually look at SIF as a traditional mutual fund only, which is allowed to do 25% derivatives. So in a traditional mutual fund, what typically happens is you are allowed to do derivatives, but that's typically used to hedge your investments. But in SIFs, you are actually allowed to take 25% unhedged derivative positions. Now, this typically may help the SIF to, kind of leverage or even make monies by shorting stocks or sectors or indices. So if you look at it in that sense, let's say, to give you an example, in a traditional mutual fund, let's say there is a flexi cap mutual fund, right? Then in an SIF, the same flexi cap mutual fund, when is allowed to do 25% derivatives unhedged, then you will call that strategy to be equity long short SIF, right? So like you rightly said, it's actually a product between PMSs and mutual funds. And I'm assuming that SEBI typically, kind of gave an okay for such a product because a lot of retailers were kind of delving into F&O, and this product probably may be a substitute if at all they want to do derivative investing, and they can use this route. So look at SIFs as traditional mutual funds plus 25% derivative options, but the minimum ticket size here is 10 lakhs of investment.
Okay, so minimum ticket size is 10 lakh. The difference is that there is a 25% derivative option in this one. So fund managers will be able to do F&O trading in this one as well, in this sort of a mutual fund, that is the SIF funds, right?
Yeah, absolutely.
And how is it different from PMS then? What is the difference between SIF and PMS?
See, there are a lot of differences between SIF and PMS also. Like say, for example, SIF is 10 lakhs, PMS minimum ticket size is 50 lakhs. Typically, even in a PMS, while some bit of derivative is allowed, it's typically not the unhedged part like in the SIFs. And the main difference, in my opinion, is going to be on the taxation front, Vinny, because in SIF, it is expected that in spite of the derivative play and whatever we've discussed, the tax part is still going to be capital gains, like exactly in the way in MFs, where when the fund is buying and selling within the fund, right, you are not expected to pay a separate capital gains tax. Unlike in a PMS, where every time buying and selling happens, you are expected to pay a tax. So I think that's a very large difference between the SIF and the PMS.
And Kirtan, what are the strategies that SIF can offer right now?
There are 7 strategies that are currently allowed. There are 3 in equity, 2 in debt, and 2 in the hybrid category. If I have to break that down, if you look at the equity category, Vinny, right, the first fund is something called as equity long short. Now, like I said in the last answer, it's actually the traditional flexi cap fund with 25% derivatives, right? Now, the second one is something called as equity X top 100 long short. This fund has to be looked at as a mid cap, small cap kind of a fund, where 65% of the money has to be invested in the X top 100, which I'm assuming is going to be mid and small. And the third is sector rotation long short, in which you have to look at it as a sector fund. 80% of your money has to get invested in 4 sectors. Now, in all of these 3 categories, you probably might see daily redemptions like currently is happening on the MF side. But on the fixed income side, on the debt side and the hybrid side, there are some interesting developments. So if you look at fixed income, on fixed income, there are 2 SIFs. The first is called the debt long short. Now look at this as a dynamic bond fund, where the fund is allowed to invest across duration but they are allowed to take some derivative position. And sectorial debt long short. This is a new category where minimum 2 sectors are in which most of the investments will happen, but one sector cannot have more than 75% weight. So you will have more than 2 sectors, but minimum there needs to be 2 sectors. Now the change here is that in the debt category, Winnie, it is possible that the redemption is allowed only once a week kind. Right, and in hybrid also there are two opportunities. The first is called the active asset allocator fund. Look at this as a multi-asset fund on the traditional MF side, and then there is something called as hybrid long short. Now again, look at this as a balance advantage fund on the traditional side, which is allowed to do derivatives. Right, so again in the hybrid category, redemptions probably maybe twice a week types. So again, like I said, it's actually a combination of traditional fund where some layer of derivative is allowed.
Okay. All of them have that mix of traditional fund with the derivative funds, obviously in different categories, debt or hybrid. They have their own uniqueness as well, but a mix of all of that combined. Kirtan, you mentioned 10 lakh rupees is the minimum investment in this one, right? So then how does it work? Is it going to be always lump sum, or is there SIP route as well? And how does that 10 lakh come into this picture then?
So Winnie, whatever we've learnt and heard so far, the minimum investment is 10 lakh per PAN, which means if there are 7 categories, you can divide this 10 lakh rupees amongst either one or all the 7. But in total, on one PAN, you will have to invest a minimum of 10 lakhs to start with. Now, let's say if you invested 10 lakh rupees and then the market goes down, right, and it becomes 9 lakh, then it's okay because you initially invested 10 lakhs and then it fell, right? But down from 10 lakhs to 9 lakhs, then you cannot say that I want to do 1 lakh of redemption, right? Then if you want to do redemption, you will have to do the entire 9 lakhs. So if once you've invested 10 lakhs and the market takes the value down, it's okay. But you cannot redeem and bring the value down below 10 lakhs. That's one. And second, once you are able to maintain the 10 lakh of threshold, Winnie, you are allowed to do an SIP, an SWP or an SW or an STP over and above the minimum threshold of 10 lakhs.
Okay, so I have to first, the 10 lakh investment is necessary, whether it's across those different categories what you do, but on that PAN, one PAN has to have 10. So I'm investing 10 lakh rupees. Over and above that, then I can start a monthly one of 1,000 rupees SIP. That is also okay as well.
Yeah, once you are able to maintain the 10 lakhs of minimum requirement, then you can do most of these layerings.
Okay, so that is just the layering on top of it is what you're highlighting. It's not the first one, you have to have that 10 lakh investment. Typically, who should opt for this now? Who does it make sense to, put in? Because it's some sort of a way, it is lump sum, and then you can go on with, an SIP route or other methods as well and layering it up. So who should opt for this? And are there typical financial goals that one should have? Who's looking for it, like maybe a retirement or a child education? Who does it make sense for them?
I think, Winnie, for me, very honestly, I don't think this is meant for retail investors. Because look, the way I really look at investing from a retail standpoint, I am also of an opinion that even sector funds are not really meant for retail, right? So in that context, this is way too far. So I'm of an opinion that this is actually not meant for retail. This is more of a sophisticated product meant for HNIs who've, kind of got 50 lakhs or a crore kind of investments. And then, they are looking at doing a 10% or a 20% of their investments in this on the tactical or the satellite side of the portfolio, then it is okay. But I don't really think just because it's a new product, retail investors who are, trying to build their investments using SIP, they have a very small portfolio, or they don't really understand investments as well, like any other sophisticated investor would, should actually jump onto this just because this looks something fresh, something new. This is actually not meant for retail, at least in my opinion. I would rather only look at probably HNIs or sophisticated investors wanting to do this product.
Okay, not too friendly for retail investors. Not many may look for it. HNI, for them, it's a better option, obviously, given that you're putting in also that much 10 lakh amount at the start itself. So, I'm going to wind it out, Kirtan. Just tell me if I'm going wrong anywhere. But SIF is mainly a fund which is a mix between traditional funds, where you get an option for 25% derivatives as well, where the fund manager can do, and that is what the difference comes in between normal mutual funds. And 10 lakh is the minimum amount. Then you can layer it up with an SIP, SWP, what comes in into later points, and mainly it's for retails, right? Non-retailers, HNIs.
Absolutely. There are two more points that probably I am assuming that the audience will find it useful. Redemption on the traditional side of the MF can typically happen regularly, like it does every day. But like I highlighted on the SIF side, it is not necessary that redemptions may happen daily. It may be weekly or fortnightly. One very interesting point also to highlight here is there can be a notice period for redemption in SIF. So you may redeem it as of today and the NAV may be today, but you may receive your money, let's say, over 15 days of notice period. And also the portfolio disclosure on the SIF side typically happens or will happen once in 2 months, unlike in equity MS where it happens once in a month kind.
Okay, Kirtan, thank you so much for explaining us SIF in details and what an investor should look out for, who it's suitable for as well. On that note, viewers, we're actually going to slip into a very short break. We're going to continue our discussion with Kirtan, but we have more topics to discuss, so we'll be talking about all of that on ELS schemes after this break.
Was just a generic tweet about the fitness of a sports person. It is not body shaming, it's about the fitness of a sports person. I have always believed a sports person has to be fit. So I felt he's a bit overweight and I just tweeted on that. And I've been attacked for no reason, And when I compared him to the other captains, previous captains like Dhoni, or for that matter, Ganguly, Dravid, Tendulkar, Kapil Dev. So I put in and Virat. I put in a statement because I found him, I have the right, it's a democracy, what is wrong in saying it? So that is what you have to understand. So I just spoke in a generic manner and I failed to understand a democracy, we don't have the right to speak in such a manner.
Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC-TV18. Now let's move on and talk about equity-linked savings schemes. What are they? Do they provide high returns? Who has, is it just a tax benefit kind of a move that you should be making by investing in these funds? Lot more on that. How are the historic returns, the pros and cons of this? We're going to continue this discussion with Kirtan Shah of Credence Wealth, who's here with us. Kirtan, ELSS, just for our viewers who may not know, what are ELSS funds? And is it only a good option for tax benefits or even otherwise?
So when ELSS are typically equity funds. By definition, you need a minimum of 80% in equity. But look at it as a pure equity fund where 95% of the money generally will be invested in equity with 3 to 5% in cash for redemptions in general at an industry level. These are very similar to flexi cap funds because in an ELSS fund, you don't typically have any market cap benchmarking, right? So you are free as a fund manager in the ELSS category to invest across large, mid, small, depending on where you think there is more opportunity available. Like you rightly said, that when you invest in these funds, you get up to 1,50,000 of advantage under ATC if you are in the old tax regime. But what investors also have to understand is that there is a 3-year lock-in in this. Now, of course, the tax advantage is a big reason why a lot of people invest in ELSS. But I would rather probably go a step forward and say that the 3-year lock-in actually makes a lot of difference in terms of the fund performance and the investor behavior. Because as soon as this is a fund with a 3-year lock-in and you can't redeem before 3 years, the investor experience automatically becomes much better. So if you really have to look at it from a flexi cap versus an ELSS standpoint, not only on the basis of return, but risk-adjusted basis also, these schemes have done decently better over flexi cap. So it's not just the tax advantage. I would rather believe that these funds in itself, without the tax advantage, have a lot of merit, and the discipline with a 3-year lock-in actually is the reason why the investor experience is much better in these categories.
Okay, it does make sense on that front. But, what are the things that one should consider as an investor while investing in an ELSS funds? You said there is a lock-in period also that comes in. What are the other factors that one should keep an eye out on?
Winnie, actually, honestly, I don't really believe that ELSS as a fund is any different from any other fund that you typically want to onboard to make a part of your portfolio. So I think the most important thing is for you to be able to figure out what do you want to keep the portfolio construct as, right? Like say, for example, I sincerely believe that if there is an aggressive investor with 8-10 years of investment horizon, the best way to move forward is an equal weight portfolio across large, mid, small. Right now, if you look at the ELSS history, typically you will see that ELSS are typically funds on an average on a category basis, slightly more tilted towards large cap. So if I have to build a portfolio for myself, I will use ELSS in the large cap category and then do mid cap and small cap separately. So the first thing is don't look at ELSS as any separate fund from any other category that you're typically looking at. It is as good as a flexi cap in that context. But if you want to deep dive and understand how to pick from the multiple ELSS fund, I think you can look at the rolling returns of the funds to try and understand the consistency of the fund. You can look at the information ratio, which will soon be issued on the fact sheet to understand the risk-adjusted performance of the fund. And if you can compare it with the category average and the index, I think you will be able to pick a decent fund.
Okay, and Kirtan, I just want to understand a couple of points. One is in terms of overall, when you're looking at it for, is there a specific way to invest in ELSS fund or similar to mutual funds? And ELSS versus PPF versus NSC and other tax saving instruments, is there a major difference between all of that?
I think, like I said, while you are investing in your ELSS, there is absolutely no difference between any other fund category versus an ELSS. You exactly invest the same way that you've been investing in any other categories in the mutual fund. It is just that probably there is a lock-in here that you need to be aware of, which most of these other categories don't have. While we talk about from a tax saving perspective of ELSS versus any of these other products like a PPF, I think what the investor community needs to understand is that you can't really compare an ELSS and a PPF because the asset class is completely different. ELSS is an equity fund, PPF is a fixed income fund, right? But let's say, keeping that aside, what are the different contours that you can typically look at? So the advantage that ELSS has is it has a 3-year lock-in versus, let's say, a PPF, which has a 15-year typical lock-in. And because it's an equity scheme, you, along with volatility, definitely are expecting slightly better returns than what a PPF will give you. And because interest rates will keep falling in a growing economy like India over a period of time, PPF rates may go down. But very honestly, ELSS versus all of these other categories are not really an apple to apple, because like I said, ELSS is equity and everything else mostly in this space is fixed income. So in that sense, we may not be able to compare them, but definitely ELSS has a very short lock-in period. And because it is equity, the expected returns are definitely probably better than most of these other.
Absolutely, Kirtan, does make sense. And, who should invest in ELSS? You said, it's a normal fund as well. They give good returns as well. You spoke that in your first answer. You highlighted, in terms of an average return after the lock-in period as well. So, who should look at investing in it? And what portion of your, mutual fund portfolio that you have could be ELSS funds?
So, I think I can just think of 2-3 set of investors who probably may fit exactly well in the ELSS category. First is, of course, people who opted for the older tax regime. They need to make sure that 1.5 lakhs on the ATC side of deduction is taken care of. That category is definitely the lowest hanging fruit to invest in an ELSS. Second, I would rather believe that, investors who probably want to do flexi cap, large cap kind of investing, but they are not able to figure out the right kind of fund in that category, are also the kind of people who can look at ELSS, because in my opinion, ELSS ends up doing the same job that probably a flexi cap or a large cap to a larger extent will end up doing. Right. And this is slightly contra as an opinion, the third one, but you will come across a lot of investors who are not very, very disciplined inherently as cells in nature. I think the 3-year lock-in will bring in that discipline. So if you think you're not very disciplined, look at this investment and it'll get you locked in for 3 years.
Okay, and Kirtan, right now, what are the options that are available for an ELSS fund that one could go for? Does each of them have a different return type of, performance-wise?
See, actually, historical returns may not be the right way of really looking at it, because all of us know what happened in the past may not repeat in the future. But if you ask us as an institution, we typically prefer doing ELSS in 2 funds. First is the PPFAS ELSS Tax Saver, and another is SBI Long-Term Equity. I think these are 2 interesting funds from a track record and consistency and objectivity standpoint. And I think if there is somebody who's looking to do investments in ELSS at this point in time, probably can split the amount of money that they want to do in ELSS in both of these funds equally.
Okay, Kirtan, thank you so much for that. And thank you so much for joining with us on the show today. It's always a pleasure having you and chatting with you on CNBC TV18. But with that, viewers, we are absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Closing bell up next to take you to the last hour of trade.
Through my discussions over recent days, we've agreed that the UK, France and others will work with Ukraine on a plan to stop the fighting. Then we'll discuss that plan with the United States and take it forward together. The purpose of today's meeting was to unite our partners around this effort, to strengthen Ukraine and to support a just and enduring peace for the good of all of us. Yesterday evening, the UK signed a £2.2 billion loan to provide more military aid to Ukraine, backed not by the British taxpayer, but by the profits from frozen Russian assets. And today I'm announcing a new deal, which allows Ukraine to use £1.6 billion of UK export finance to buy more than 5,000 air defence missiles, which will be made in Belfast, creating jobs in our brilliant defence sector.
Market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Japanese index, the Nikkei, is down 2.5%. The Kospi trading just below the flat line.
Mexico or for Canada. No, the tariffs, they're all set. They go into effect.
Down about 1.7 on the S&P. Nasdaq down about 2.6, 2.7%.
But the Nifty has got into that zone where it could see some kind of buying and some kind of bottoming out.
Potentially, right at the beginning of this kind of tit-for-tat escalation.
0.5% on the Nifty. So 22,000, around 22,000 right now.
This is a fair value market. The excesses of the past has been corrected.
Financiers who have been prudent from the beginning are continuing with the same policy.
Markets, there has been a remarkable recovery.
Loan growth is expected to moderate as per analyst estimate in many segments of NBFCs except gold loans.
Prime Minister explored various facilities at the centre and also closely interacted with various species of animals which have been rehabilitated there.
It's all engineering that is been the stock of the last few minutes, a 20% lower circuit after that downgrade.
Good morning. That was the day so far. Good afternoon.
Yeah, not morning anymore, Rima.
Good afternoon and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me is Nigel and Surbi. And that intraday recovery that we had in the first 30-40 minutes of trade is we're holding on to it so far. So the Nifty is above 22,000. Still mildly lower on the benchmark indices, but the mid-cap index, small-cap index in the green, and we've got a positive advanced decline ratio. Hi, guys.
Hi, absolutely. And I think Nigel and I were discussing this in the morning, and it's played as per script because that's exactly what you were pointing out. That given that this market is already so beaten down, what could have been otherwise a very brutal day with the kind of headlines we woke up to has actually turned out to be okay. And who knows, by the time this closes, maybe we're in the green.
Well, the factors were in place, right? We are bouncing from oversold levels. That's not yet changed the structure because the structure continues to remain weak. But a much needed relief rally is what we're seeing. The Nifty is down only around 30 points and the broader markets, the breadth of the market is good. And I think Surbi, that red top trade did the trick as well. I told you, whatever you wear, the market will do the ulta. And for now, we have a higher amount of green on the screen.
Yeah. I can wear red every day if that helps.
Hello. Yeah, just make sure. but it's a far better looking screen. And actually, a couple of factors are playing in for India out here, because when you woke up this morning, whether you looked at your WhatsApp groups, you look at Twitter, you look at everything, everyone was talking about much lower levels. People are throwing in the towel, which actually was a sign that actually things are bottoming out. And also Brent crude prices, the last I checked, it is sub $71 per barrel. That's a macro tailwind, and we like that very, very much. And in addition to that, the Nifty is already down 15%. So while the globe was celebrating, we didn't really take part in that. And for the time, we just take a look at that. Brent now sub $71 per barrel. That's a kicker for India.
And Europe, by the way, is down and sharply lower it opens. So the CAC...
After rallying a lot in the last few days.
Yeah, yesterday it was sharply higher. And today there is that unwind taking place as investors are bracing for the impact
of Trump tariffs, which go live on Canada, Mexico and China, and the fear of retaliatory tariffs. China has already announced a 15% import duty on certain U.S. goods, and they've also added 15 U.S. firms to the export control list. So investors are bracing for the impact. In Europe right now, frontline indices are down more than about 1%. Asia has largely closed in the red. Nikkei is down 1.2%, Hang Seng down close to about 1/3 of a percentage point, but they too managed to recover quite a bit from the day's low. Shanghai actually is in the green now in terms of closing. But what should you do right now? Is it time to stay on the sidelines? Is this a buying opportunity? Last hour trades with Mitesh now up for you. So Mitesh, good afternoon. All the action took place in the first, 45 minutes. Then things turned quiet. Markets moving in a tight band. And once again, you're seeing some buying interest. So what's the approach? On the index, are you getting more confident to go out there and buy?
Good afternoon. I'm still waiting for, some kind of a reversal to be triggered. We've not fallen today is a good thing, but I was hoping that the Bank Nifty at some point in time will clear 48,400. It didn't happen. It attempted first around 10 o'clock and then again around 2:15. We got a high of 48,355 and 375 respectively. But I think, once you get the price to, start getting and capturing some supply pivots, I think that will show strength and just not suggest that this is, just a bounce back from oversold level. So that trigger is still pending for me. But a lot of stocks, I think, are showing good traction. So we'll take some long positions over there or suggest them. ABB for me is a buy with a stop at about levels of 51.30 for targets of 53.80. And the other one which I like is Chola Finance. That's one stock which is not corrected. It's been making fresh highs. So buy here with a stop at 14.34 for targets of 14.80.
Okay, all right, Mitesh, got that. Thanks very much. We'll come back to you for some more trades. By the way, Mitesh, before I let you go for now, just a word on the two-wheeler majors, the biggies. There's a big slide that's underway on Bajaj Auto and Hero Moto. The numbers were weak for February, we know that. But just technically, how do these two look?
It's extremely oversold, but they've broken all the weekly and the monthly averages as well. Bajaj Auto, if you look at it, peaked out in September at 12,775, and since then it's nearly down about 40% plus, and there's still no sign of reversal. Though the only good thing is that it's so oversold that it could give a good bounce back. But my sense is that it will just be a bounce back. So the broader trend is very, very negative over here. Similarly for Hero Motors, also if you look at the charts, the stock peaked out way back in September end and at a price of in excess of 6,000, and now we are down to about 3,500 with a very similar chart setup. So I would avoid them. I think if somebody's stuck, use any 5 to 7% kind of a pullback, bounce back to sell and exit.
Okay, all right, Mitesh. Thanks very much. We'll come back to you in a bit for some more ideas. Right now, markets holding fairly steady. Now, what are the signs that a market could be turning around? Ramdev Agrawal of Motilal Oswal Financial Services says that promoters could start buying their own stock from the market over the next 2-3 months, and that could be a significant indication that maybe we're past the worst. Take a look.
In 2-3 months' time, when promoters will actually come to buy, because they're the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected.
All right, so when promoters start buying their own stock, maybe that's a big indication that the worst is over. Now, Nigel's been looking at some of the companies in the metal space, right, where there's some evidence of this already happening?
All the spaces, actually. So just last week itself, since the mood was very, very somber, I said, let's go in and look at where the promoter is buying into their own stock. I'll tell you what, there are a lot of buy and sell side analysts. But the best analyst on their company is the promoter himself. He knows the worth of his company. And if he really wants to back it up, he'll go in there and buy some shares, particularly since most of these shares have fallen 10, 20, 30% from the top. And last week itself, I pulled out some data. Now, before we get to what happened in February, just yesterday, post-market hours, TD Power, that's one of the promoter entities, they went ahead and they disclosed they bought only 15,000 shares from the open market. The market likes that. They saw that filing yesterday, and this buying was done in February, but the filing was given yesterday. So that's why that stock, in fact, it's taking some heart from it. It's up close to around 5%. But there have been some larger promoter buys that we saw in February. Case in point being JSPL. I recall their numbers that they gave, had caused a bit of a scare because of the capex that was up. The promoter came in there, bought close to 100% from the open market in the month of February. And now the promoter holding has gone up to around 62% from around 61% or thereabouts. That's close to around 600 crores or thereabouts at current market price. So big money being put in. JSPL is one stock. The next one is Maharashtra Seamless. We had the management join us on the show as well, and I've seen it in the last few quarters itself. Every time the stock is a little bit weak, the promoter comes in there and they chip in. So from around that early 60%, now it's moved to close to around 68.5% or thereabouts. So that's the other stock. The other one is Quest Corp. I recall, close to around 6-7 quarters ago, the promoters were buying from the open market. To be precise, in the March 2023 quarter, they went ahead and they bought more than 4% from the open market. And off late as well, they marginally increased their holding by around 0.4%. The street likes that. The stock has seen some support from those levels. Well, the other couple of names that we have seen in the last few quarters where there has been promoter buying, Gateway Distriparks, that's the promoter entity of Snowman Logistics. And the management has been telling us that they want to increase their stake. They want to make the company from an associate company into a subsidiary. Precisely what's happened. 40 to 50% is what the promoter entity holds now in the company. Faircam Organics as well. We don't talk too much about the smaller company. But the promoter entity, I'm just looking at the filing from December in comparison to September. They bought 2.5% from the open market. And Mangalam Cement, over the last few years, I've heard a lot of rumor about whether or not there is some corporate action on the cards. We'll wait by in case that's true. But for the time being, the promoter entity has shown the faith, gone ahead, increased stake by more than 1.1%. So as Ramdevji said, that this could be one of the indicators out there. He expects more of the same in the coming months as well. Just thought we'll elaborate and put down a few of those stocks. Deepak Shenoy joins us on the show. Hi Deepak, good afternoon and good to see you. When Indian market's not doing too bad today, so that's pretty good news, and hopefully India knocks off the Australians later on in the day. For the time being, the Australians are bowling in, so I guess in the evening we'll get to see Rohit, Kohli and company, all of them, take to the pitch and in fact score some runs. But what about the markets and this promoter buying? The street seems to be liking it quite a bit, and I think in times of trouble, you want the promoter to go ahead and back your company. Your take, any of these stocks on your radar?
In fact, I think we've been monitoring a few other things here, including system-driven disclosures, where if a promoter buys, they don't have to disclose it themselves. The system discloses it automatically on the exchanges. We're seeing some early stages of promoter buying, and promoter buying in general is a better indication of direction than promoter selling. Promoters usually sell for very different reasons. Most times it's not valuations. But when they buy, it's typically that they find value in the stock and they want to increase their position and so on. So I think promoter buying is actually a good thing, but it's very, very early right now. I think we've probably seen the first signs of something. In general, I expect to see a lot more happen in March, because most companies don't allow promoters to buy until the results are announced. So there'll be a window after April 1st till when they announce results, when they will not be allowed to buy their stake. So they will be able to only buy now. So this will be a month where I think we'll track the activity a little more. We don't have any positions in the stocks you mentioned, but we're looking at a lot of the companies where we're interested, where we're seeing, we're looking for whether promoters start to buy in that space. That gives us some more of an idea, maybe not, some confidence more than anything else. But by and large, I think the numbers are not significant right now.
All right. Deepak, I wanted to ask you about the two-wheeler majors. Clearly the street is quite cautious on them. Bajaj Auto, Hero MotoCorp, in a market that's actually recovering, both those two are seeing aggressive selling pressure. And the fear is that the economy itself is slowing down, which could be a factor on a temporary basis. But how would you approach these names? Bajaj Auto is now at a 52-week low. We had the management, Mr. Sharma, earlier today, and he was actually saying that he'll treat this as a one-off, and he's actually optimistic about the path ahead from here on. Your take?
So, I mean, they've had a very disappointing February as well. I think, Nigel, we've seen the numbers. Hero was not good at all. The rest were okay. I think at some level, there is not yet a meaningful recovery in auto two-wheeler sales since 2018 or so. I think if you look at the numbers, At one point, I think there was 7 lakh two-wheelers sold per month. And since then, we've really not been able to come close to that figure. More than 8 years or nearly 8 years now. Or 7 years now since those numbers have come, and we've had a very prolonged slowdown. I think in some way the market's kind of tired of this, and kind of when is this recovery really going to come? But I feel like there's nothing wrong fundamentally here. It may be that the love has been spread across more two-wheeler manufacturers, including the electric vehicles. And there has been no meaningful innovation in the two-wheeler space in the last few years. So at some level, if you've got good vehicles that are running, there's not so much additional demand coming to two-wheelers. Possibly more is coming towards four-wheelers, which is probably a good thing, for the economy in general. So at least at this point, I think it's the lack of innovation in the space that has probably hurt some of the two-wheeler manufacturers. TVS, on the other hand, has been doing okay. I think recently they have not done so well, but in general, they have been the more innovative of the pack. Bajaj Auto probably the second, and Hero probably the last in that regard.
Yeah, actually, we asked him exactly that. I mean, what is the real issue? And he clarified, just to put it on the table, Deepak, that he said that it's not because there's any issue with financing, lack of financing, nothing of that sort. He just said it's mood and sentiment, which seems to be a little downbeat. But he seems to be confident that by end of this month or early April, things will change because the tax cuts flow in, the respite from some of the GST reductions, comb, etc. A lot of those factors perhaps will stir up demand. We'll see. But yeah, weak numbers, no doubt, for February, for Bajaj as well as for Hero.
And he also said that the consumer buying behavior has also changed, influenced by the mega trends in e-commerce. So, like you have those Black Friday sales on e-commerce, many of the consumers are timing their purchase in order to get the best deals. So he's not too worried about the dip seen in the month of February. Consumer buying psyche for discretionary spending has also changed. But let's get on to the news from the insurance space, because sector regulator IRDAI has warned health and general insurers against rising commission payouts. Yash is here with the details.
Well, that's correct, Rima. There's been some tough talk coming from the insurance regulator IRDAI to the general as well as health insurance companies. What is the primary concern of the regulator? It is simple, that the general and the health insurance companies are spending excessively when it comes to commission payouts to their various distributors for selling health and general insurance, other general insurance policies. Now, if you remember, about 2 years ago, April 2023 is when the regulator had given the industry the relaxation on removing limits on which existed on commissions and shifting those limits to a headline expenses of management limit. Now, what does expenses of management include? It includes commission as well as other operating expenses. So the regulator gave them, the insurers, a free hand to decide how much they want to spend in terms of commission. But at the same time, on the headline with respect to expenses of management, it should remain under a certain limit. Now, what the regulators observed in the last 2 years, as per our sources, is that the insurance companies are spending excessively when it comes to the commission that they pay out. Compensating for that excessive commission payout, they are reducing the operating expenses and hence staying under the headline limit of expenses of management. What that has done, according to the regulator, is that it has restricted the premium pricing or the premiums that policyholders pay towards various insurance products. It has restricted those prices from coming down. Hence, the benefits haven't really been passed on to policyholders. The regulator has done some tough talking, saying that reduce the commissions, contain the commissions that you're paying. Otherwise, it would be forced to bring back those limits on commission level itself, moving away from that relaxation of fixing the limit on the expenses of management side. The review for the expenses of management regulation happens next year. That is at an interval of 3 years from 3 years ago when it was implemented, 2023. And hence, this could come under the review where the regulator could decide on changing those limits and putting it back on the commission level itself.
Yash, I just want one clarification. If you could just demystify this. Now, even though the commissions have gone up, what you're saying is that the insurers are still they're still within the headline cap,
Correct.
which is total expenses. So how is that impacting premium pricing?
So it is very simple. Just to demystify the concept of total expenses, it includes two things: commission as well as operating expenses. Now, commission is something which directly impacts the price of the insurance product. So if a product is selling for 100 rupees of premium, 8 rupees is, let's say, assuming the commission which is paid to a policy holder, it is 108 rupees, right? If the commission becomes 11 rupees, then the cost of the product for a policy holder becomes 111 rupees. At the same time, if the commission is reduced to 6 rupees, the cost reduces overall cost to the policyholder to about 106 rupees. And that is where the regulator is saying that the commission is not coming down, and hence the cost of the product, which is the premium to a policyholder, is not really coming down.
Okay, got it. So basically, pricing is far more directly linked to the commissions than to overall headline expenses. Got it, Yash, and that's why the regulators sort of not too happy with the way this is going. Thanks for that story. Deepak, insurance. Let's talk general and health first, if you have any interest over here. Never a dull day when it's insurance, right? Either regulation or taxation or something or the other is always happening. Your views, general insurers?
So I haven't seen anything major in general. We don't have any exposure in general. Is there something that has happened recently? I've not paid too much attention.
No, Deepak, this was just a story that our colleague Yash had just put out, where he was explaining how the regulator is watching the high commissions very, very carefully. Yeah, okay. And maybe, it comes down with some sort of definitions, because those commission levels are high, which is why premium prices are quite high. You don't have any exposure to general insurers, life insurers, or a platform like PB Fintech. Any thoughts there?
Yeah, no. So I think we have exposure to life insurance companies, but then in general, I think the commission structures has gone through a very different sort of a route. If you remember 2 or 3 years ago, there was this issue where a lot of these companies got GST notices because they were somehow getting paid by the insurers as something that was not commission, but was marketing expenses, and marketing expenses were capped to a certain level, and therefore, a lot of these rules were requested to be changed. Eventually, what the insurer IRDA said was, take the total marketing expenses and put it under a cap, and in general, don't try to put sub-level caps for everything. And now it appears that the commissions that are paid to intermediaries is the problem. So they have kind of warned about it. So typically regulators do initially warn. There are a lot of times when commissions are introduced at a very high level in certain products. ULIPs at one point used to have 100% commissions on the first year or first 2 years of premium. So your money would only get allocated to something that's invested about 3 years after you start paying your premiums. Then IRDA came down harshly, and things have improved since then. So I think now what they're doing is just warning people that, if you introduce high commission products, you'll have trouble. Companies that are either wealth managers or people like PB Fintech perhaps will see the impact of it either directly or indirectly over a period, especially if regulation comes in that limits these numbers.
Well put. Thank you, Deepak, for explaining that. And thank you for joining us today. We'll slip into a very short break. Before that, here is a message from us. Parity isn't just a goal. It's the key to unlocking new possibilities. HSBC presents CNBC-TV18 Future Female Forward, the mega summit co-presented by Cognizant, where we will discuss what it takes to close the gender gap and create lasting impact. Tune in for this game-changing dialogue live on CNBC-TV18, 10th March, 5:30 p.m. onwards.
I think most important thing is now, don't wait for the, because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Okay. I have seen best of the chartists and all telling me, they're all eating their own stuff. So what I'm saying is, now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay. So if you like certain stock, and that stock is available at your dreamy price, and it has gone below that, don't hesitate, start moving into the market. This time, the market has moved from 500 rupees EPS to 1,000 rupees EPS for Nifty, and market extended from say 8,000 at the bottom to 24, 25,000. So it went 3x, earnings went double. So obviously market got re-rated big time. Now we are correcting that re-rating because earnings profile is slowed down, but it is not broken. I mean, last year, the current year.
Welcome back. Well, the market's still sitting with a cut-off closure around 20 points or thereabouts. I guess, won't be surprised if by the end of today, actually, we move into the green. That's the kind of market that we have today. We had a pullback and we're sustaining out there. Just one more point, these OMCs, they're rejoicing this fall in crude oil prices. If you look at BPCL, HPCL and IOC, I recall, at around 950, 920 as well, we had pointed it out that these could be the stocks to track. All of them are at the high point of the day. Even I think Interglobe has moved up. Temporary had a bit of a pullback. But I think that one, because this means that the ETF prices as well will be well behaved going ahead. So that one's up close to 3%. And we know that traffic has been very, very good. Aditya Sood, fund manager at Incred Asset Management, joins us on the show. Hi, Aditya. Good afternoon. Good to see you win. A far better day to join in, Aditya. The markets have been bruised and battered actually in the last few trading sessions. The mood has been very, very somber. Tell us, how are you all approaching markets? Are you all buying, sitting on cash? Do you think the time has come now?
I think so. It is a bit of combination of both. One is that, since March of 2023, when markets went relentlessly up for 16 to 18 months every month, who would have thought that we can have, 5 months of Nifty going down, every month on month. Normally in a bull market, you have an element of markets rallying, once, you have seen bit of oversold territory, but this time around, obviously, the fall has been relentless. Obviously, the framework that we have been using is that, every bull market has a element of correction that comes through. Bull market corrections are very, very sharp, treacherous. I think so. It is about time wherein investors start to think more about return and less about risk. Possibly, risk has already played out in the portfolio in the sense that, many stocks are down, 30-40%. Another thing that we are very anchored towards today in this environment is that, you had 4 years of 25% plus earnings growth getting delivered in the market. And obviously you had certain sectors which delivered, earnings growth in excess of, 30-40% also. That obviously created excesses in the market. And we are in an earnings reset environment now. So I do believe that coming 2-3 years are going to be very, very different than what we have seen, post COVID, in terms of earnings growth environment. We are watching out for companies in this environment wherein multiples and earnings both have been cut, and whether promoters and insiders start to buy. I think so. This is a very, very interesting combination to look out for, and obviously that would mean that you could have asymmetric return opportunities as we move forward. Over next 6 to 12 months.
Aditya, you said it's going to be very different next 2 to 3 years. It's going to be very difficult or different?
I think so. Different and difficult both, in the sense that once you have this environment. So if you look at the earnings growth trajectory broadly, last 10 years, we have compounded at 12% CAGR, which is nothing but the nominal GDP growth rate in the country. And you had 4 years wherein, earnings compounded at, in excess of 20%. Obviously, that led to, sort of excesses coming through. But I think so we would like to be in areas wherein earnings are fairly protected or insulated. So that is point number one. Point number two is that, obviously the valuations are much more reasonable, not necessarily in the new stocks, in the set of stocks that we already own, than what they were, 6 or 9 months back. And these companies, as long as they continue to deliver on earnings growth rate, I think so, we would be better off in comparison to the market.
So Aditya, in terms of fresh allocation, are you buying more of the same? Because we've spoken about stocks like Newland, Thyrocare, Federal Bank, Tejas. These have been some of your bets in the past, which we've discussed. So are you buying these, topping up these, or are there any new ideas, any fresh purchases, the first time investing in any stocks? And tell us about them.
Yeah, so essentially it is a two-pronged approach. One is that we are looking at areas wherein there have been, combination of earnings getting brutally cut. Obviously, MFI is a sector, wherein earnings and multiples both have been cut. And, now they are, most of the, sort of MFI companies are trading at closer to the low that they made during the COVID time. So that is one example, we find value there, not necessarily that we would, go down the ladder, essentially we would buy the MFIs which have managed or who have a consistent track record over the last 4 or 5 cycles of managing asset quality well. So, that is clear-cut example. The second example also is, areas wherein we see a very good dividend yield. And in a market like today, that dividend yield is going to, be a combination of having support in terms of stock price. Secondly, we are closely looking at insider buying data. So if you could get promoters who are backing their companies essentially and buying more of the stock that they already own, it is a very, very good combination. So if you look at, some of the PSU names today, essentially I can find stocks which are trading at a low double-digit PE valuation and having 3.5%, 4%, 5% dividend yield potential. Obviously, OMC is being, one of the areas which is looking very interesting from a dividend yield perspective. A large cap like Vedanta, offers considerable value purely if you look at, dividend yield today. So essentially, I think so. These are areas wherein you can do some value buying. And this market is meaningfully different because in the past, 6 months back, had you imagined that, you can find a dividend yield play with a low price to earnings multiple. Today, possibly, whatever way you want to position yourself as an investor, it is possible to construct a portfolio. Be it a dividend yield investor, be it a growth at a reasonable price investor. You can position yourself beautifully in this market.
Okay, so at least it's got some excitement going for real stock pickers. That's what you're saying, Aditya. Got that point. So dividend, you've given some examples. Vedanta, you're saying could be an example where the dividend yield play can work really well. Also, of course, the company's going through its own, corporate restructuring, and then the division has to happen in 5 different entities. But on the other piece, growth at reasonable price, because that almost never was happening in this market for the last 2-3 years, right? Give us some examples of that, where there's growth, there's some valuation comfort, and things are looking not too bad.
Sure. So essentially, if you look at our top holdings like Indraprastha Medical, Tejas Network, or, Newland Labs, I think so all the 3 stocks fit into that category. So if you look at, Newland as a case in point, last year they made a profit of 300 odd crores. Our forecast is that, possibly we are looking towards, doubling the profit trajectory over next, 2 to 3 years. If I compare Syngene, Newland and DVs, in terms of the ROC profile of these companies, because each of these companies are very similar in terms of, bucketized into the CDMO play category. If I look at the PE ratio, both on forward and trailing basis, I think so Newland is the cheapest of the lot, possibly the highest return on invested capital. And if I look at the EBITDA margin profile also, possibly, it is very, very attractive. Similarly, if I look at essentially Indraprastha Medical and compare it to the hospital universe, the multiple is half of the universe. The ROC is double of what the universe is generating. And I think so the earnings growth profile is going to be materially different over the next 4 or 5 years once they get into the capex mode. They have not done any capex for practically last 25 years, and now they are getting into a free cash flow yield zone of 8% plus, and now they are getting into a capex mode as well. So I think so these are very, very interesting opportunities, because what it essentially also means is that you are buying into a combination of earnings growth which is superior than the market earnings growth. So the second thing is that, superior quality in terms of, return on invested capital. And the third point is that whether there is scope for P multiple to re-rate in the next cycle. That is, I think so that is very, very important. So in a market like today, that is the kind of opportunity that you are witnessing. Multiple can now also expand over a 3 or 5 year period.
There are three interesting examples: Tejas, Newland, and Indraprastha Medical. And quickly, just 10 seconds on this. Are you willing to venture into any of the erstwhile highly sort of valued stocks, which were promising growth? There was a narrative, but the valuations were a problem. Whether it's EMS, names like Dixon, etc., whether it's defense, or even your capital good majors like ABB Siemens. Are you buying anything there where you think now valuations look better, or would you skip?
I would say that I would, skip, because, this is a market wherein you can buy a combination of low multiple and earnings bottoming out. So why would you go and buy a company, which is like trading at 50, 60 times earnings multiple, and, you see limited scope of P multiple expansion. So one of the areas wherein you need to be extremely careful is wherein multiple can cut further. So let's say you end up buying a stock at 40 PE, and suddenly you realize 2 years down the line that market has derated the stock at 20 PE. So why would you buy that kind of a combination? So all the popular themes which are fads in the previous cycle, be it, solar, EMS, we will strictly stay away from.
Avoiding. Okay, not going with the earlier fads, looking at value elsewhere. Got it. Aditya, thank you very much. Helpful conversation. Good to have you on the show today. With that, let's quickly head to Nimesh, figure out what the chatter is like on the street. Nimesh, so at least it's not that bad, right? In the morning, it looked like it would be a horrible down day, but relatively not too bad?
Oh, absolutely, Surbina. In fact, I would say it's a very matured reaction from the Indian markets today. Given the kind of global cues, we are pretty much in the green. And the heartening part is that the mid-cap index is bouncing back very strongly. The mid-cap index has recovered almost 2% from the intraday lows. A lot of individual names are buzzing in trade. And I would say, this recovery in the broader markets is backed by some bit of institutional buying as well. So while the overall flows are quite mixed yet, there is a bit of selling in large caps, but it's a small cap where there's a small nibbling happening from domestic funds as well as some large HNI investors as well. Remember, even yesterday there was a feedback that you will see a large DI number, and that turned out to be, and the feedback was that a couple of domestic funds did basket buying as well in yesterday's trade. I'm not too sure about today's large number, but at least there is small nibbling happening, is what I understand, in the broader market names from domestic as well as HNI investors. So that's the overall feedback. Technically, now 21,800 will act as a very strong support on the downside. That's a very important level to watch out for. And now 22,800 will act as a very strong resistance as well on the upside. In terms of sectors, today two specific sectors stands out in terms of institutional interest. One is banks. Select banks are well built, and some bit of interest seems to be back in the PSU names as well. So again, very selectively in both those sectors, but there is institutional interest in both those sectors, especially banks and PSU stocks.
Indeed, Nimesh. And what about stocks? What have you picked up?
So the first stock on my list is Kaynes Technologies. Well, the stock is under pressure today, despite the fact that there is an upgrade from a sell-side analyst. There are reports about an overseas acquisition as well. I understand largely the under pressure could be because of the fact that there is a buzz of a very large block coming in Kaynes very soon. So there could be a supply overhang, at least in the near term, on Kaynes Technologies. So that's the first stock. The second stock is GMR Airports. Again, that stock has recovered sharply from the very recent lows. Stock is sharply seen a very sharp correction of late. And now at these levels, some bit of HNI seems to be back. I understand a very large influential investor has started buying or nibbling into GMR Airports at current levels. So that's the second stock. Third, Jyoti CNC and India Cements. Both these names stood out for me because there are very small buy flows, but look at the reaction in both the names today. Jyoti CNC, last I checked, was up 16%, and so was India Cement up 12-13%. So even though there are very small buy flows, but at least the institutional interest is back in some of those mid-cap and small-cap cash stock names. So that stands out for me. And the last is Biocon. Within the pharma names, again, it's an extremely beaten down stock now, and now at these levels, some bit of HNI interest is back in Biocon. So that's the reason why even Biocon is buzzing in trade today.
All right, Nimesh, I'm waiting for to hear what I heard a month or so ago when you said, Nigel, today I'm sticking my neck out and the FIs will be buyers. It's been a while, Nimesh. Let's hope in the coming weeks we hear that again from you.
Well, Nigel,
it's been a long while.
The day I have a feedback, Nigel, I will tell you. I mean, again, this is all the feedback that I pick up from institutional dealers and sources. So the day it has to happen. See, yesterday I was quite confident that the DI number will be strong, and it turned out to be.
Bang on, Nimesh. Thanks a lot for that. Well, time to slip into a short break. Up next, Prashant has two very special guests waiting by to discuss the big global reset. Slip into that break, come back. Prashant's waiting for us on the other side.
About 5-6%, and there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened, and now there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy, and despite that we are doing 6.5%. Don't forget that. It is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. Excesses in the market was very clearly visible. And regulator, government, worldwide investors, everybody was uncomfortable. So this is a very healthy correction. And now next year, earnings will pick up from 1,050 to maybe 1,150 or 1,200, whatever. And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. Government expenditure is picking up. So I think all the things are falling in place, and correction has also happened.
Hello and welcome to this special program. We are calling this the Global Reset under Trump 2.0. I'm Prashant Nair. The new U.S. administration under President Trump seems determined to upend the world order as we know it. From tariffs to security alliances, everything seems to be up for negotiation. How does one navigate this changing environment? That's the big question. I have with me someone who tracks all this very, very closely. Louis Gave is the founding partner and chief executive officer at Gavekil Research. Gavekil is a financial services company. They do research in global markets, global economics, based out of Hong Kong. Gavekil is widely followed for their institutional research, commentary on daily global macro events, and of course some of the bigger trends as well. I also have with me Manish Bhandari, who's director at Valum Capital, a fund management business based right here in Mumbai. Gentlemen, great to have both of you here. Thank you very much, Louis and Manish.
Thank you. Thank you for hosting us.
Thank you so much for having me. Having us.
This is an extremely interesting time. A lot of things, everything seems to be changing.
It sure is. Definitely keeping busy. Lots to think of, lots to write about, lots to stay in business for.
So let's start with what is most current, most recent, right? Tariffs, Louis. How real are these tariffs in terms of their durability?
Yep.
Because the Canada-Mexico tariffs and, of course, the 10% extra tariffs on China, they seem to be motivated by sort of essentially stopping the flow of illegal drugs into the US, right? It's not to raise revenues, at least that's not the stated objective. So is this going to off-ramp at some point, or you think this is here to stay? These tariffs particularly?
I think you put your finger on it. The big question is, are the tariffs a tool towards achieving something, or are they the end goal? I think so far, there's still a lot of signs that Trump is looking at tariffs like a tool to achieve something else. Now, fundamentally, what does Trump really want to achieve? I think the first goal right now, what seems pretty obvious, at least to me, is that contrary to Trump 1.0, who kept tweeting about, the stock market making new highs, and what they're really worried most about is three things. They want to get the bond yield down, they want to get the US dollar down, and they want to get the oil price down. And pretty much every one of these policies that they've implemented. Now, there's other things. Yes, they want to stop the drug flow, et cetera, but everything they're implementing is really driven by these three goals, and including the tariffs. For me, and I could be wrong on this because it's very hard to predict what Trump is going to do next, but for me, the tariffs remain a tool, and it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy U.S. treasuries and unless you raise the value of your currency. I think the next few months, we get a lot of this until basically Xi Jinping and Trump meet in May, and then we'll have a better outlook on whether tariffs are here to stay, or whether some kind of Mar-a-Lago Accord, to use Scott Bessent's term, whether some kind of Mar-a-Lago Accord gets achieved.
Are the three things you mentioned consistent with a higher stock market?
I don't think it's as much of a priority, to be honest.
That's an interesting, important point, because, I mean, the general assumption is that he's very focused on the Dow being at a new high. It's like a point of pride. But you're saying actually the target this time is not higher stock markets, it's lower cost of borrowing.
I think so. You'll notice this time he hasn't tweeted once on the level of the stock market.
Okay.
You've had tweets from Elon Musk, you've had talks from J.D. Vance, from Scott Bessent, from Trump himself on the 10-year yield. And I think the reason for that is actually the setup today in the U.S. is completely different.
Yeah.
The big problem is in the second half of this year, you have a massive amount of debt to roll over. Because remember, in the second half of 2020, interest rates were at record lows. Every single U.S. corporate went out and issued debt. You know, when interest rates were below 2%, you're a CFO of a company, it'd be criminal not to issue debt. They all did it, and most of corporate debt in the U.S. is 5 years. So now, these guys all have to roll over the debt in the second half of 2025. If they roll over at much higher rates, that means that CapEx is going to get cuts. That means that employment is going to get cut to pay for the debt. They have to get the cost of debt down. Without that, you're facing a really bad 26. And guess what happens in 26? Midterm elections. So take the pain up front, get the lower interest rates so that the economy can be rebounding by 26 on the back of lower energy and lower interest rate costs.
Okay, let's just complete the tariff point.
Sure.
So I think average tariffs into the US are 2.5%, 3%, somewhere there.
Yep.
By the end of the year, where do you see those?
That's a really tough question because I think a lot is going to depend on those negotiations with China.
Okay.
And here...
But they're going to be higher. We don't know.
I think they're going to be higher because part of, I think, Trump's view of the world is foreigners should pay more. Now, I'm not quite sure how he came to that conclusion, but essentially, one of his hardcore beliefs is foreigners have been taking advantage of the United States and they need to pay more. And a lot of these policies, like the golden visa thing, where foreigners are going to pay $5 million to move here, even though you already have an EB-5 visa that costs $800,000 and only 2,000 people take a year. Somehow millions are going to take the $5 million option. There is this perception of foreigners have to pay. So yes, there will be higher tariffs. The big question is, will it be marginally higher? So you say 2.5%. Will it be 10? Will it be 12? If that's the case, that can sort of come out in the wash. Like if you got a 10% across the board, that's not going to throw the global or the U.S. economy off the rails. If you move to 25, 30, then all of a sudden, that's much more problematic for global growth.
Okay, let's talk about what is important for emerging markets as well, which is the US dollar. You're saying he wants the dollar lower, and so far it seems to be working.
Yes.
Right? Yields are down, I think, about 50, 60 basis points in the 10-year over the last 1.5 months. Dollar is lower as well, the broader dollar. What's your sense, Louis, here?
Well, look, I think when you look at Treasury Scott Bessent, Treasury Secretary Bessent, his very first thing when he got into his new office was first thing he did was to pick up the phone to call his Japanese counterpart and to essentially tell him, look, the yen is too low. Which it is. The yen is ridiculously low. If you spend any time in Japan, it used to be that if you went out for dinner in Japan, you'd have to check your bank balance to make sure you could afford dinner. And now, you go there and, things are really, really cheap. So bottom line is, the U.S. does want a revaluation of Japan, does want a revaluation of the won, the Korean won, does want a revaluation of the renminbi. That's going to be, obviously on the table with the discussion with Xi Jinping in May. I think there's a good chance that gets achieved because all these currencies are today massively, massively undervalued. The U.S. dollar is very expensive. You go travel in the U.S. today. For most of my life, traveling to the U.S. Was a decent value experience. Today, it's completely out of whack relative to everywhere else in the world. Yes, the U.S. dollar has to come down. It's too high.
But Louis, isn't it quite conflicting that you are you're doing the fiscal consolidation? And there is a possibility of a dollar going down. You're just talking your way through, or you really want to implement. You can really push this through.
Yeah, that's a great point. You're absolutely right to highlight that usually fiscal consolidation, you tend to have a bit of a stronger currency. Now, having said that, in the past 2 years, you had massively pro-cyclical fiscal policy in the United States. And the dollar still went up because, at any one time, I think you have many factors can impact a currency. Yeah. And in recent years, the biggest factor impacting currency has been interest rate differentials because the U.S. yields were going up, U.S. dollar was going up. If they're going to be successful in bringing yields down, then partly through Doge, partly through cuts in government spending, maybe a little less issuance of treasuries than the market had expected, maybe arm twisting China, Japan to buy more bonds, a little bit of this, a little bit of that, get yields a bit lower. I think the U.S. dollar does roll over from the current level of overvaluation. I think it's happening, actually. It's already starting.
And I think it'll be good news for capital flows into emerging markets if that would happen as well. Of course, the other stuff will play out as well. The other thing is the market here in India has been weak. I think the market here in India and the US have been very, very tightly correlated. Two best performing large markets in the world last few years. But here we've started to pull back. US, the S&P is just under 5% away from its all-time highs. Do you think we're starting a correction in the US as well, especially large cap tech, which actually is the only space which has mattered, which has driven the US outperformance, is a top in there. Your thoughts?
Yes. No, I think we've just had a massively important event with DeepSeek. DeepSeek changes the world we live in. It changes it on many different fronts. First, until DeepSeek came around, the perception was that the US could contain China technologically. The fact that China all of a sudden shows that it's at the same level on artificial intelligence as the US shattered this illusion. The second reason it mattered is that up until 10 minutes ago, the widespread belief was that all these huge Mag 7, these big cap tech stocks, could in essence build monopolies for themselves through unprecedented capital spending. That if you wanted to play at the AI table, you needed to put 50 billion a quarter on the table as your ante. DeepSeek has also shattered this belief. And so all of a sudden, the idea that you can spend your way into building a monopoly for yourself, into building ever bigger moats, has been completely undermined. And I think with that, you have started to see a rotation in the market where, indeed, investors start to say, well, hold on. If Microsoft, Google, Amazon, if they're not going to be the massive monopolies I thought they were, do I still want to pay 35 times earnings, 40 times earnings? Especially if at the same time, you're starting to get other stories around the world. Now, you pointed out, in recent years, there's been only a handful of stories. There were really three. It was gold, US tech, Indian equities. That was it. Like anything else you did was kind of lame. But now what you've seen is while the US starts to fiscally tighten with Doge, China is fiscally easing and starting to do a lot of pro-consumption measures. Europe is fiscally easing. And so as the fiscal easing shifts from the US to China and Europe, lo and behold, China and Europe start to outperform. All of a sudden, there's other things to do in the market. Maybe I don't need to just own Microsoft at 35 times earnings. There's other exciting things to do.
There's some very interesting graphics, as you were talking as well, from your research, which you're putting out for our viewers. We will continue this conversation, Louis, and I want to sort of connect that with flows as well, right? I mean, there's always this debate whether when money goes into China, we get our money through EM funds.
Yes.
So if China gets money, we get money, or is it, I mean, one at the expense of the other? We'll sort of ask you that. Let's just take a quick commercial break here. We're going to come back, continue this very interesting chat with Louis.
So the first thing is about the values inside the family. And for us, the work was never looked at the balancing part of life. It was always something which was the biggest part of our life. Growing up, we saw our parents, both my father and mother, not only try to balance family and work, but make them both the biggest priorities of our life. And that's something that I've continued to embody as we have now been working in Reliance for the last 10 years. So the question of balance really does not come of balancing family or work. Both are the biggest priorities of my life. And there's one simple funda that I think we all need to embody, which is, your priorities of your life. And, as you grow older, your priorities change, but you want to make sure that your priorities are something that are very meaningful to make your life what you imagine it to be. And from our point of view, my family and my work are the two biggest priorities of my life.
Careful.
Welcome back. We're in the final leg of closing bell, and the market for the time being is, trying to hold on to a little bit of green, though there's some volatility. Nifty is now about 40 points lower. So let's see what the final close turns out to be. Jay Bala is with us. Bala, always a pleasure having you on, and you've been right all along in calling this fall. But now let's talk levels. We were speaking to someone yesterday who was also looking at some technicals, and that one view was that we will actually go past the election day lows as well, and then only find some support around 19,500. But I don't know. I mean, you tell us how close or how far away from the bottom are we?
Hi, so good to be here, and I know you guys have been quite graceful in acknowledging that I called it correct. And when I called this markets to decline, Nifty to decline to 21,280 on the 1st of October, the Tuesday 1st of October, I had three options in front of me. One was this 26,277 was a long-term top, very long-term top, and the second one was a deeper correction than I had projected. And the third one was the one correction I projected to 21,280. The reason I'm bringing this is about the market has come to where it is now with a very strong momentum. The momentum is intact. So usually momentum wanes when the market's trying to bottom, but that sign is not there yet. So the next character of the bounce the market does is going to be extremely crucial. And if it were to be corrective, I mean, it's a technical term, and that evaluation will be done by technicians, and we can conclude after that. But if it were to be corrective, there's a good possibility that this correction is likely to drop to something like 17,800 on the Nifty. Another reason is the global markets. The tech semiconductor index had topped in July 2024 and has not crossed the all-time high. And I can conclude from the monthly charts of the semiconductor index and the NASDAQ 100 index, there's a very good possibility that the recent highs of July in the stocks and in December in the NASDAQ 100 is a long-term top. So if that were to materialize, there's a greater probability that the Nifty's drop to 17.8 would increase. But currently, the September to November decline and the January to present day decline is equal. What we call in technical parlance as A equal to C. Usually, markets tend to give some kind of relief rally or bottom. So we'll be very closely evaluating what the market does over the next couple of weeks.
Okay, all right. So Jay, but you believe that we'll have a relief rally from here? It's a possibility from if 21,800 holds out, then we see a 1,000-point rally, and then we go to 17,800.
Yeah, there's a good possibility. It's going to be support is coming in at 21,800 to 21,300. That's a support for Nifty. The relief potential is something like 22,650 to 725, which was the February 18th low. That former low becomes a resistance now. So that is one projection. Or it gets a little bit higher to something like 23,100. But more likely it could be 22,650 to 22,725. Yes, there is a potential for a short-term pullback. And the banking index is holding relatively well. And my candidates for a counter-trend bounce should be coming from the capital goods, realty, metals, and Nifty PSE. And all of them are counter-trend bounces. There have been long-term damages done on the Nifty Auto, Nifty FMCG, and even Nifty IT is at the precipice of a very important trend line from 1996.
Very quickly, Jay, talk to us about the global indicators and what the setup is for U.S. markets, the key indices, Bitcoin, gold, the 10-year bond yield, because this entire U.S. exceptionalism is getting challenged now.
That's right. That's right. See, Bitcoin, I had mentioned 3 times in December that it's coming to a very important long-term top, and it had potential to halve from the all-time highs. If Bitcoin doesn't hold 72K to 75K, it's very likely that it's going to at least 49K, if not 18K. So that's a bit, confusing even for me, given that Trump has just announced a sovereign holding of selective cryptos. But the technicals is that's what it's saying. But let's watch 75,000 to 72K on Bitcoin. That will be a signal of animal spirits going off. And when it comes to the US Treasuries, I might have to revise the short-term outlook that it's rising higher. If it breaks 400 bips, probably it's going to somewhere close to 300 bips. That is probably telling you, again, flight to safety, moving into the bond markets, probably. And when it comes to the precious metals, gold has probably got one more record highs to come through. It's not completely clear whether it comes first to 24,000 and then goes to 3,200, or straight away goes to 3,200. And whereas silver is unlikely to clock fresh 52-week highs. And dollar index, it's crossroads. Yeah, either the dollar index has already bottomed or it's going to break down very soon. It depends on what the USD JPY does.
Okay.
And if the USD JPY strengthens, we have a reverse carry trade. Again, negatives coming in for the equity markets.
Okay, the bell has gone, Jay. Just hold that thought. Quickly wrap up the day. And the day is going on a very flat note, 38 points lower on the Nifty. The mid-cap index is ending absolutely flat, but the story lies in the intraday recovery. Massive intraday recovery for the mid-cap market from a 2% decline in the morning, and the advanced decline ratio is still positive. Over 1,500 stocks advancing, about 1,100 declining. Just very quickly, some trends. PSU stocks have done really well today in the recovery. So the likes of SBI, BPCL, BEL, Coal India, ONGC, Power Grid, long list of winning PSUs. The auto majors, and especially two-wheeler makers, they have received a bit of a drubbing. Bajaj Auto is ending 5% lower, Hero is about 3.5% lower, Eicher is down, Maruti is also down. So these have been the weak hands. And then, of course, some of the big boys that have been sulking today, Lever, Reliance, ITC, Infosys. These are some of the weak names on the Nifty. But, of course, a very good day for the mid-cap market.
Well, that brings us to a close and closing bell. Thank you very much for watching. But don't go anywhere, because on the other side is Markets Forward.
This phase, but going forward also.
Yeah, that's a great answer. Shlok, thumbs up. All right, you got the thumbs up from the wife. You know, talking about your dad, MDA, obviously, Mukesh Ambani for all of us is the inspiration for our whole country. Everyone looks up to him. You have a mom who actually runs larger companies than 99% of our business people in India. So you have this like super achieving family. How do you step into these shoes? These shoes are like very large shoes to fill. And how do you manage, and what is your biggest inspiration?
You know, Harsh, biggest inspiration goes without doubt is the family that we've grown up with. We've all lived under one roof for now 32 years of our lives. And the inspiration is not too far to find in both my parents. I deeply value the human beings that they are and the work that they do. But the inspiration really does not come from, you know, large items. Of course, the vision, the boldness, the ability to be very, very inspiring. It comes from the small things, you know, like for example, till date, my father clears each and every email that is sent to him, and he does it till 2 a.m. at night, and he's working for the 4th decade of his working life. And that's where the inspiration really comes from. My mom, very, very similarly, like we'll be staring at the same thing. We share a joint passion for cricket, and we're watching the same TV, but the small little details that she notices is something that you can draw inspiration out of. And I think out of and above everything is their dedication is the biggest inspiration for everyone around us who are who have grown up around them. And that's really why we can say that the biggest inspirations, because we can tell all of the small nuanced things that make the difference.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe.
Tariff war continues to rattle markets during the trading session. However, broader market stages a recovery in the last hour of trade. The mid and the small cap indices end in the green in a weak market.
Experts warn of a risk to inflation and growth following the imposition of tariffs by the United States. Canada and Mexico, as well as China, swiftly announced retaliatory measures targeting Trump's tariff war.
Insurance regulator IRDAI warns health and general insurers of rising commission payouts. Sources say the regulator may introduce a cap on commission payouts if the insurers fail to take corrective steps. That's a CNBC-TV18 exclusive. Hello and welcome to a fresh new edition of Markets Forward, your go-to show where we aim to get you all the key data points to prep you up for the next trading day. I'm Reema and with me is Vinny. Hi.
Hi, Reema. Interesting day, right? Coming in, we are recovering from Monday blues. So did the market recover from those reds and day's lowest point today as well?
Indeed, it was a resilient session for our markets. At the day's low in the morning, given the weak global cues and the handover from Wall Street, the Nifty went down to levels of 21,965, and after that, we staged quite a bit of a recovery with the Nifty defending that 22,000 mark yet again. It's an important support, and we managed to hold on to it. The mid-cap staged a recovery of more than 1,000 points, and the index finally closing marginally in the green, but the small-cap index had a much better session, and the advanced decline ratio turned in favor of the gaining side. When we started trade, it was about a 1:4 advanced decline ratio, and by the close of trade, it was about 3 stocks advancing for 2 in the red. Sectorally, it was PSU. So whether they're oil and gas PSUs like oil marketing companies, ONGC, defense names like BEL, State Bank of India was a big mover with a 3.5% gain. So PSU banks, on the front foot today. These were the gainers on the way down. Two-wheelers took a big beating. So Bajaj Auto, Hero MotoCorp under pressure. Eicher Motors down nearly 2. IT, FMCG, the traditional defensive names also closing in the red.
Absolutely an interesting day coming in there, but let's get started with the show and we'll tell you what we've got lined up for you all in the next 20 minutes with all the big news and the key developments on D Street, top corporate voices and events to track ahead. Let's kickstart the day today with the market action that has happened, and we'll go across and talk to Hormaz as well in terms of what is happening in today's trading session, what were the top movers and shakers, what was on the radar of SBI, and all of that in the show. So Hormaz, let me take it to you as well first. What were the top movers and shakers in today's trading session?
It was a resilient trading session, as you guys just mentioned, right? The mid-cap index recovering from the lows ending and the small caps having a better day. But the one sector that stood out right from the onset and regardless of the market move was the defense names. And that is also taking forward from the overnight rally seen in the European defense stocks. Bharat Dynamics, Garden Reach, Bharat Dynamics actually ended at the highest point of the day. Most of the others cooled off, but still ended up with gains of anywhere between 3 to 5% in today's trading session. The newsmakers were plentiful today. Gensol Engineering, with that announcement that came in later in the afternoon, a 20% lower circuit. The stock is now down almost 65% from its peak. HPCL and BPCL, of course, the oil marketing companies did well today because of the fall in crude oil prices. Zomato and Swiggy, of course, having a good day because of the positive brokerage note. It was a good day for PSU banks, as you just mentioned. They were among the top losers in yesterday's trade, but they saw a bit of a rebound today. SBI on the back of the double upgrade that came in from Citi, and it rubbed off on most of the other state-run lenders as well. Stocks that did well on the back of strong volumes. And some of the underperformers featured in this list today. India Cements was up 15% in today's session. Jyoti CNC, Concord Biotech, Vijaya Diagnostics, all seeing very healthy gains and on very strong volumes as well. And lastly, stocks that ended at a 52-week low in today's trading session included the likes of Bajaj Auto, Hero MotoCorp not doing well after their sales figures, both ending at the lows of the day. Sona BLW, IIFL Finance and Astral 2 ending at the day's low. Back to you guys.
Thank you very much for that, Hormaz. Jay Bala from cashthechaos.com is still with us on the show. Jay, thank you for joining in. Just in the near term, we've spoken about the big picture, but in the near term, say for the next 2 days, what is the trade on the Nifty Bank, which has shown a little more resilience?
Yeah, the trade is to do nothing if you're going to be focused on the next 2 days, because the markets are have come very close to an important support at 21,800. So if we are just evaluating if the markets are going to hold, we've got a flat close today. So the markets aren't giving a definitive signal for the very short term. The banking index, although broke the January low by 3 points, it currently seems to be holding up well, but everything comes down to HDFC Bank. If HDFC Bank were to break below 1620, that will be having a very negative impact on the banking sector as well as the overall market due to its weightage. So do nothing for the next few days. Wait for the next couple of days. Wait for a signature reversal to come through. If that happens, we can see something like 3 to 4% rally on the mainline indices, maybe slightly larger on the mid caps and small caps.
Okay, mid caps and small caps, and anything in terms of specific sectors, Jay, that you would be looking at as well. You know, in the last 6 months, we've seen pharma see a good fall. We've seen real estate also see a fall in the last few months. So anything on that front that looks interesting?
Yeah, the market's momentum to the downside is waning for capital goods, realty, metals, and Nifty PSC. But the damage over the long-term charts on the Nifty PSC has been done. So you might want to not look at them as investment candidates, rather than you must be looking at them as trading candidates. So if you're going to keep your eyes open for the counter-trend rally, look at these 4 sectors: cap goods, realty, metals, and Nifty PSC.
Thank you. Let's get to State Bank of India. That was the big winner after Citi double upgraded the stock to a buy, raised the target price to. Abhishek is now joining in with the details. And what makes Citi so bullish on State Bank of India?
Well, Rima, to begin with, Citi actually met the management of SBI, after which, they have double upgraded the recommendation on the stock to buy from sell, increased the target price by more than 15% to 830 per share. The key takeaways from the management meet was the management outlined multiple levers with respect to, cost optimization as well as yield levers that they have. And they also have relatively lower EBLR, that is external benchmark, lending rate. Loans, they are about 28% of their overall portfolio. NCLR hike pricing should actually help them maintain the net interest margin. So the management continues to guide for net interest margin of more than 3% over the next couple of fiscals. However, Citi is confident that they will be able to maintain the net interest margin anywhere between 2.9% to 3% over the next couple of fiscals. So unsecured retail slippages have been curtailed to 0.5%. The SMA2 pool, which is overdue between 60 days to 90 days, that's also been reined in. So they expect the credit cost to be less than 50 basis points for the lender. Now, restoration of risk-weight asset to NBFCs should free up CET1 by anywhere between 25 to 30 basis points, and weak market sentiments allay near-term equity raising for the entity. So they are factoring in 13 to 14% growth and curtail credit costs, thereby making them raise their estimates by 1 to 2% over the next few fiscals. The stock has corrected 18%, 16% and 10% in the last 3 months, 6 months as well as 1 year, and has underperformed Bank Nifty by 10 to 12%. So they say that the valuations with respect to price to book value of just 0.85x is inexpensive for return ratios, that is ROA of 1% and ROE of 15% that SBI stands to deliver. Back to you.
Okay, Abhishek, thank you so much for the update coming in on SBI double upgrade today. We've seen the stock buzzing in trade as well. Jay, coming to you for SBI, what are your thoughts coming in? Citi clearly is quite positive on this one. Raise the target price, double upgrade coming in. And in the last couple of sessions, we've seen the stock see a good move as well. Yesterday also it was in the green. Today also it's strongly and comfortably closing in the green. So your thoughts?
Yeah, SBI had a great potential to drop to 550, but given that it's finding support at the minor support level of 680, we need to see what this stock is doing over the next couple of sessions. If it's just a counter-trend bounce, I don't think this rally is going to exceed something like 750 to 760. And probably go down after that. But right now, it's looking positive in the short term. Maybe, if it is bullish, the stock needs to cross 780 to 785.
Let's get to the other important story today is that lately many promoters have been buying stock considering the weakness that we've seen in the market. And even veteran investor Motilal Oswal's Ramdev Agrawal highlighted this during his conversation with us, saying that it's one of the important metrics to track to know whether the market is turning around, whether promoters have confidence in their own share price. Nigel is here with a list of promoters who have indulged in such purchases recently.
Well, that's right. There is a buy side and there is a sell side, and then there's the promoter who's the most supreme analyst because he knows his company the best. Just went through a few details, and off late there have been some promoters that have been chipping in there, as Mr. Agarwal had pointed out as well. Case in point being TD Power Systems. Well, the stock was up close to around 6% in today's trading session. Yesterday, they disclosed on the exchanges that the promoter entity had bought close to around 15,000 shares. So that's why the street like that. But if you look at it in the month of February itself, stocks like JSPL, their quarter 3 numbers were a howler because the capex spend had gone up. But the promoter has shown the fade. After the kind of correction that we see in the stock price, they have come in there and they have bought close to around 1% stake, which is around 6 to around. In the month of February, they bought 0.5% from the open market, and now the stake goes up to around 68.5% or thereabouts. A couple of other names as well come up for you on the screen, and there have been some promoters that have been buying consistently. Quest Corp, I recall the stock had seen a correction. And towards the end of 2022, at the start of 2023, the promoter entity went ahead and bought some stake. And in the last couple of quarters, they've increased their stake by close to around 0.5%. But, if you just rewind a little bit behind, you'll see that select promoters, they've said they're going to be doing this, and they've gone ahead and done it. You have Gateway Distriparks, which is the promoter entity of Snowman Logistics. Over the last few quarters, their stake has gone up from around 40 to around 50% approximately. Fairchem Organics, we don't talk about the stock too often, but everyone's been talking about selling in the past quarter. Well, in the past quarter, that's the quarter ended December, they in fact went ahead and bought close to around 2.5% from the open market. And finally, Mangalam Cement, that's the other stock in there, where the promoter entity in the last quarter or so has bought increased stake by close to 100%. So the best analyst of a company is the promoter, and when they buy some stake, it sends out a positive signal. Back to you guys.
Okay, Nigel, thank you so much for the latest update coming in on this front. Jay Mangalam has, I beg your pardon, Nigel has mentioned a lot of stocks right now as well. Your thoughts on any of these names? Are you looking at it, any of them closely? TD Power, JSPL, Maharashtra Seamless, anything?
See, cement stocks, some of them seem to be completing their corrective decline. So Mangalam Cements that you spoke about, that might be a good candidate for a short-term bounce. If Mangalam Cements were to take out SAN 51 on a closing basis, there's good potential to rally in a meaningful way, something like 15-20% from there on. So of the names that have been mentioned, I like Mangalam Cements and Fairchem. Although I don't know exactly which sector it's in, but as a related field, I'm looking at SRF Limited in the specialty chemical space. That's looking very interesting for me. I don't know if Fairchem Organics is in the same space. But I think if it is, it's a far weaker candidate compared to SRF.
Okay, let's get to the other story that we've been tracking. Insurance regulator has asked general and health insurance companies to take corrective action against rising commission payouts. As per sources, the regulator has threatened to limit the commission payout if the insurers fail to take corrective action. Yash is here with the details.
Well, certainly some tough talk coming from the insurance regulator, IRDAI, to the general as well as standalone health insurance companies. What has been the primary concern for the regulator? It is that general and health insurance companies are spending excessively when it comes to their commission payouts to the distributors to sell the various general as well as health insurance policies. If you remember, about 2 years ago, that was in April 2023, the regulator had given some relaxation to the industry in terms of commission payouts, saying that we will put a limit on the headline total expenses which any insurer makes. But under that total expenses, which has 2 elements, commission as well as operating expenses, we will let you decide, that is the insurers decide how much they want to pay as commission and how much they want to pay as operating expenses. Now, what the regulator, according to our sources, has observed in the last 2 years is that companies are paying excessively, and the growth in the commission payout has been very abnormal in the last couple of years. Now, as far as that high commission payout is concerned, that is being compensated by lowering of operating expenses to stay under the headline limit on the total expenses of any insurance company. What this does is that it restricts the insurance premium or the cost of insurance products to come down for the eventual policyholders, which was in the first place the intention of the regulator by putting a limit itself. This has been the large concern for the regulator. What we've been given to understand is that the regulator has told these insurance companies that when the expenses of management guidelines come up for a review next year, that is 2026, the regulator, if these insurance companies do not take corrective measures, which is reduce commissions and pass on the benefits to policyholders, will also consider putting a limit again on individual commission itself, which will be a big negative because that will restrict the kind of expenses which these companies can make towards selling those policies itself.
Okay, Yash, thank you so much for that. Surely we'll be keeping an eye out, going forward also on the general as well as health insurance companies. Jay, your thoughts on any of these stocks that you have, the ICICI Lombard General Insurance or in terms of Star Health, any thoughts on that one, on the general insurance space?
General Insurance of India, General Insurance Corporation, that's trying to find a strong support at about 347, and that's probably the strongest in the candidate, the insurance space. LIC India is an avoid, and when it comes to ICICI Lombard, that was probably it's also a very strong downtrend. So I would generally avoid stocks within the space with the exception of GIC India.
Jay, thank you very much for joining in and sharing your thoughts on the market. But as we slip into a short break, we leave you with market commentary that we got during the day.
The models that we've run have shown that of these tariffs, the economic damage is probably largest for Canada and Mexico, given the significant ties to the U.S. economy. But the U.S. is not immune from the negative effects of these tariffs. I think even if these tariffs go into effect, my assumption would be that they would not stay on for a durable period because of those negative economic effects that I mentioned and the negative effects to equity markets you're likely to see. That the stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit, probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation. You're looking at U.S. real GDP that falls over a several quarter period by over 1 percentage point. And I would expect the spikes in U.S. inflation in the short term to be 0.5 percentage point or higher.
As of today, it looks like FPIs are aggressively selling. On Friday, net of passive funds buying of about 8,000 crore. The gross sell number was about 20,000 crore. Never stand in front of a running train. If they are selling aggressively, undoubtedly buyers will continue to buy at lower and lower prices. And as long as their selling continues, we think market's unlikely to settle. Buyers will continue to buy at a lower and lower prices. In terms of valuation, now Nifty is trading little below its historical average valuation. This is a fair value market. The excesses of the past has been corrected. And now this is probably time for long-term investors to start accumulating.
A success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda.
Welcome back. Now let's take a quick look at the key corporate voices. So first up, Bajaj Auto's management is quite optimistic despite the turbulence in February's auto sales. He expects the industry to grow by 6 to 8% in FY25. Further, the fundamental drivers for the industry remain intact and the company expects a recovery in domestic sales by the end of the month or early next month.
And next up, we also had Jupiter Wagons that was buzzing in trade today after its electric vehicle arm, Jupiter Electric Mobility, launched its first light commercial vehicle EV, TEZ, and the vehicle will start rolling out to dealers in March itself. Now, to the wheels business, the management says it is a key focus area for the company with around 2,500 crore rupees investment planned for this expansion. It expects revenue to be around 300 crore rupees in FY25 and doubling to 600 crore rupees in FY26.
And before we wrap, let's get you the key market events to watch out for tomorrow. Vamakshi standing by.
Well, absolutely, Reema. Lots to watch out in the trading session tomorrow. Let's first look at some of the economic cues that will be in focus. China's Caixin Services PMI data will be out tomorrow. India's S&P Global Services PMI, as well as the same from the US, will also be out tomorrow. So we'll be keeping an eye out on that. US crude oil inventories will be another important factor that we'll be keeping an eye out for. As far as corporate action is concerned, keep an eye out on Anand Rathi because the stock will go ex-dividend. The bonus is in the ratio 1:1. As far as stocks to watch are concerned, we'll be keeping an eye out on PSU banks, and that is because the FinMin performance review meeting is scheduled tomorrow with the heads of all these PSU banks. All of these counters will be in focus tomorrow. Bharat Electronics will be another counter we will be watching out for, and that is because a board meeting is scheduled tomorrow in order to discuss the interim dividend for FY25. Apart from that, several other important events to watch out for. That includes National People's Congress, which opens in China. Apart from that, lastly, we'll be watching out for the commentary that comes through from the US President Donald Trump. He will be addressing a joint session of the Congress. So those are some of the key events that you need to keep an eye out for.
Okay, well, Vamakshi, thank you so much for that. But with that, it's getting down on this edition of Markets Forward on CNBC TV18. Thank you so much for tuning in. More news and updates on the other side, so don't go anywhere.
India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Very importantly, tomorrow tariffs 25% on Canada and 25% on Mexico, and that'll start. No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow.
This is now a stagflation
shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. Growth, negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So yes, it's kind of a double negative, unfortunately, of a stagflationary.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Trump's tariff levies against China, Canada and Mexico come into effect. Beijing retaliates, says it would impose 10 to 15% additional tariffs on US imports and impose export curbs on 15 American companies. Canada decides to impose 25% tariffs on $107 billion worth of US imports. Trump trains his guns on agri exports, announces plans to impose new tariffs on imported agriculture products from the 2nd of April, but doesn't provide further details. China's retaliatory tariffs target US farm products, including beef, soybean and corn. Trump's new tariffs rattle stock markets across Asia and Europe, but Sensex and Nifty managed to recover in late trade to end with marginal losses. Both indices have now declined for 10 straight days, the longest losing streak on record. US pauses all military assistance to Ukraine just days after the public clash between President Trump and President Zelensky. White House says aid is being halted to determine if Ukraine is making a good faith effort to achieve a peace deal with Russia.
विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे.
Prime Minister Modi asked India's manufacturing sector to step up to the opportunities on offer from the global supply chain disruption. Says India Inc. cannot view this as mere spectator and calls for big steps. IRDAI warns health and general insurers against rising commission payouts, says will impose a cap unless they take corrective action. Sources say that the regulator feels that insurers have misused the expenses of management limits by curbing their operating expenses to compensate for commissions. Cryptocurrencies crash after a sharp rally. Yesterday, nearly all gains from Trump's announcement to creating a strategic reserve have been wiped out. Ola's Bhavish Agrawal takes a leaf out of the Elon Musk playbook. Once again, asks employees to submit weekly reports outlining their accomplishments. The move comes amidst major layoffs at Ola, where the company is expected to cut over 1,000 jobs. Also on the show, we get you exclusive visuals from Prime Minister Modi's day out at Reliance's Wildlife Rescue Centre Vantara, situated in Gujarat's Jamnagar. Reliance's Vantara has been billed as the world's largest rescue, rehabilitation and conservation centre. Right, on to the big global story. The first shot in Donald Trump's much-wanted trade war has been fired. New tariff levies on imports from China, Mexico and Canada come into effect today. Most imports from Mexico and Canada will attract 25% tariffs. Canadian energy imports, including crude oil and natural gas, will attract a levy of 10%. The Trump administration has justified that the tariff hikes are aimed at stopping fentanyl smuggling across U.S. borders. The duties are expected to affect over $918 billion worth of U.S. imports from Canada and Mexico, two of America's biggest trading partners. Similarly, the U.S. government has also levied 20% tariffs against China, doubling the initial levy from last month. Both China and Canada have announced retaliatory measures against U.S. tariffs. China will impose additional tariffs of up to 15% on some U.S. goods from March 10th. The additional tariffs will entail an extra 15% levy on U.S. chicken, wheat, corn and cotton products, and an additional 10% levy on soybeans, pork, fruits and other dairy products.
China has gone a step further and added 15 American companies to an export control list. This will prohibit Chinese exports of dual-use goods to these companies. Further, China has also included 10 American companies to its unreliable entities list. These firms will now be prohibited from exporting or importing in China or from making new investments in the country. Canada will also impose 25% tariffs on U.S. imports of alcohol, clothing, and household appliances. The ensued tariff battle between America, Canada, and Mexico will mark the end of a 3-decade-long tariff-free equation among the countries.
We are willing to resolve international concerns through dialogue and consultation with the U.S. on the basis of mutual respect, equality, and reciprocity. However, we will never accept pressure or threats and will firmly safeguard our national sovereignty, security, and development interests. We hope the U.S. will work together with China to implement the important consensus reached by the two heads of state and return to the path of resolving issues through dialogue and consultation.
Are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that uncertainty is a kind of permanent change.
The stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit, probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation.
Donald Trump, with his self-confessed love for tariffs, is planning to train his guns on the agriculture sector next. He has promised tariffs on U.S. imports from the 2nd of April. Manisha Gupta joins us now. Manisha, Trump's latest move to upend the global agricultural trade system. What's on the cards?
Well, thank you for that. Yes, after steel, aluminum, cars, drugs and semiconductors, the U.S. President Donald Trump is readying on tariffs on agricultural products in a fresh salvo. Trump wrote on social media, and I quote, "To the great farmers of the United States, get ready to start making a lot of agricultural products to be sold inside the United States. Tariffs will go on external products on April of 2nd, end of quote. Well, Trump's announcement, however, lacked clarity on the details of the agri-products that will be affected. The proposed tariffs are expected to raise the cost of imported agricultural goods within the U.S., but this will benefit the U.S. farmers. Meanwhile, China has retaliated into the Trump's orders to double the tariffs on Chinese goods to 20%. China will impose tariffs as high as 15% on American agricultural goods, including chicken, corn, and cotton. Soybeans from the U.S. will face a 10% tariff. Over the years, China has also reduced its dependence on agriculture goods from the country. The share of soybean imports from U.S. has declined to 21% in 2024 from 40% in 2016. Its imports of American corn also fell to less than $600 million last year from $2.6 billion in 2023. However, cotton imports have surged marginally in the year. Now, where does India stand when it comes to this agri-tariff war triggered by Trump? Well, sources tell us that the country is resisting the pressure to reduce its tariffs on many products, as it would impact millions of farmers within India.
All right. Thank you, Manisha, for that update. So that's the big headline that we are tracking as far as Trump's tariffs are concerned. Now, Trump's new tariffs rattled the global markets. Stocks tumbled across Asia and Europe. Automobile stocks are selling off across Europe as most companies use Canada and Mexico as their manufacturing base. The Mexican peso is also weakening rapidly against the US dollar. Back in India, Sensex and Nifty declined for the 10th straight day. This is the longest losing streak for the Nifty on record. However, the losses were limited as mid-caps and bank stocks managed to buck the downtrend in trade today. Amidst a clamour by foreign institutional investors for a reduction in capital gains tax, Nilesh Shah of Kotak AMC wants all investors to be treated equally. Speaking with CNBC-TV18, he said, just reducing taxes does not guarantee returns.
Just reducing taxes does not guarantee return. What if tomorrow FPIs demand guaranteed return? Will we succumb to it? I don't think so. We should be focused on creating earnings growth and governance. We have delivered better return than all the emerging markets put together. We have delivered better return than China, Brazil, Russia, South Africa. But my recommendation will be treat all investors alike, whether it's foreigner or whether it's local.
Shares of state-run oil companies like HPCL, BPCL and IOC surged in trade today as crude oil prices continued to ease to a 3-month low. This on the back of US President Donald Trump's decision to pause military aid to Ukraine and the imposition of tariffs on Canada, Mexico and China. OPEC Plus countries also decided to proceed with a planned April oil output increase. Cryptocurrencies took a major hit today with prices falling sharply. Prices of Bitcoin slipped nearly by 10% and other cryptos like Solana fell by 20%. This comes just a day after cryptocurrencies saw a price rally on the back of Trump's announcement of a US strategic crypto reserve fund. Prime Minister Narendra Modi has urged India's manufacturing sector to step up to the opportunities on offer from the global supply chain disruptions. Speaking at the Finance Ministry's post-budget webinar, PM Modi also said that India Inc. cannot view supply chain disruptions as a mere spectator and has called for big steps.
आज दुनिया राजनीतिक अनिश्चितता के दौर से गुजर रही है। पूरी दुनिया भारत को एक ग्रोथ सेंटर के तौर पर देख रही है। दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान है। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी। अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा।
The Petroleum Ministry has issued a demand of $2.81 billion to Reliance and its consortium partners, BP Exploration and Nico Limited. In a statement, Reliance said that this was pertaining to a long-standing dispute concerning gas migration from ONGC's blocks to the consortium's block. The government has raised the demand after the Delhi High Court Division Bench's order. Remember, the government had claimed a $1.55 billion on the consortium for alleged gas migration from ONGC blocks. However, Reliance won the arbitral award issued by the International Arbitration Panel in 2018 against government's claim. A single-judge bench of the Delhi High Court had initially upheld this arbitration order, but a division bench set the order aside last month. Shares of RBL Bank slipped 2% in early trade. This comes after the Maharashtra State GST Department conducted search operations at 3 of its offices in the state. In a statement, the bank said that the proceedings are ongoing and that it's fully cooperating with authorities. The Maharashtra State Tax Officer has initiated inspection of records at Poonawalla FinCorp's registered office. In a statement, the company said that the probe was initiated after search proceedings were issued by Deputy Commissioner of State Tax. The Bombay High Court has granted a 4-week stay on a lower court's order to file an FIR against former SEBI chairperson Madhvi Puri Buch and 5 other officials. The High Court has said that the Special Court directed the Anti-Corruption Bureau to register the FIR mechanically without going into the details of an alleged fraud in 1994. Right on to a CNBC-TV18 exclusive. The insurance regulator has issued a warning to health and general insurers to enforce limits on commissions and pass on the benefits to policy holders. Remember, insurance companies get the flexibility to decide their commission structure. However, the regulator has found that all benefits went to the agents and not to the policy holders. Yash Jain is here with all the details. Yash, take us through what you're picking up.
Well, certainly some tough talk coming from the insurance regulator IRDAI to the general as well as standalone health insurance companies. What has been the primary concern for the regulator? It is that general and health insurance companies are spending excessively when it comes to their commission payouts to the distributors to sell the various general as well as health insurance policies. If you remember, about 2 years ago, that was in April 2023, the regulator had given some relaxation to the industry in terms of commission payouts, saying that we will put a limit on the headline total expenses which any insurer makes, but under that total expenses, which has two elements, commission as well as operating expenses, we will let you decide, that is the insurers decide how much they want to pay as commission and how much they want to pay as operating expenses. Now what the regulator, according to our sources, has observed in the last 2 years is that companies are paying excessively, and the growth in the commission payout has been very abnormal in the last couple of years. Now, as far as that high commission payout is concerned, that is being compensated by lowering of operating expenses to stay under the headline limit on the total expenses of any insurance company. What this does is that it restricts the insurance premium or the cost of insurance products to come down for the eventual policyholders, which was in the first place the intention of the regulator by putting a limit itself. This has been the large concern for the regulator. What we've been given to understand is that the regulator has told these insurance companies that when the expenses of management guidelines come up for a review next year, that is 2026, the regulator, if these insurance companies do not take corrective measures, which is reduce commissions and pass on the benefits to policyholders, will also consider putting a limit again on individual commission itself, which will be a big negative because that will restrict the kind of expenses which these companies can make towards selling those policies itself.
Right, thank you Yash for that. It's time for a short break, but coming up next, Ola's Bhavish Agarwal takes a leaf out of Elon Musk's playbook once again, asks employees to submit weekly reports outlining their accomplishments. More on that when we return.
For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute.
Welcome back. US President Donald Trump has paused all military aid to Ukraine after his heated argument with President Zelensky at the White House last week. In a statement, the White House said that the aid is being halted to determine Ukraine is making a good faith effort to achieve a peace deal with Russia. Reports have said that this is not a permanent move and that the president has been clear that he is focused on peace. Ola CEO Bhavish Agarwal has pulled out a page out of Elon Musk's playbook. In an initiative that he has called Kya Chal Raha Hai, Agarwal has directed all employees across his companies to submit weekly reports highlighting their weekly accomplishments. Ritu Singh joins us now with the details. Ritu, take us through Bhavish Agarwal's plan.
Well, Bhavish Agarwal has taken a page straight out of Elon Musk's playbook, requiring all Ola employees to submit weekly reports detailing their accomplishments. Now, he has rolled out a new initiative which is called Kya Chal Raha Hai, which roughly translates to what's going on, mandating all Ola employees to email 3 to 5 bullet points of their achievements to him, to their managers, and also to a company-wide email address. Now, if this whole employee output report with bullet points sounds familiar to you, that's because it is. Elon Musk, in his role at the US Department of Government Efficiency, or DOGE, recently implemented a similar policy for US federal employees. He'd previously done this at Twitter as well. Now, Bhavish Agarwal in the past has drawn comparisons between himself and Elon Musk, even positioning himself as India's answer to Tesla. He's been vocal about his ambitions in the EV space, often repeating the phrase Tesla for the West and Ola for the rest. Now, Bhavish Agarwal has also previously enforced strict workplace policies, including cracking down on poor attendance, where in December in a letter, he had told employees to have, and I quote, the basic self-respect to not fleece the company by not even turning up for work, end of quote. He's backed Narayan Murthy's 70-hour work week debate. He's dismissed weekends off as a Western concept as well. So this latest message is not really a surprise, but the timing of this initiative does raise questions, because Ola Electric is currently undergoing major restructurings and layoffs, with more than 1,000 job cuts expected across departments. So while this may be framed as a move for accountability, employees may see it as added pressure amid growing job insecurity.
Right, thank you, Ritu, for that. Moving on, Maharashtra Minister Dhananjay Munde has resigned from his post after State Chief Minister Devendra Fadnavis asked him to. This comes after Munde's close aide was being named as an accused in the murder of a sarpanch in Maharashtra's Bid district. Now, Uddhav Thackeray-led Shiv Sena has strongly criticized the state government, stating that a resignation from a ministerial post is not the solution for the ongoing crisis. Dhananjay Munde is a leader of the Ajit Pawar-led NCP. For Pune, 2025 began with a health scare. Hospitals saw a sudden influx of patients suffering from GBS. Since then, multiple cases have emerged from Delhi, West Bengal, Andhra Pradesh and Karnataka. CNBC-TV18 Santya Gora and Shilpa Ranipeta report that GBS has claimed 25 lives so far.
Last year, 64-year-old Delhi-based realtor Rohit Gurtu felt a tingling sensation in his limbs. The pain spread to upper limbs and back. He ignored the pain for a couple of days before consulting his doctor.
I went and saw a doctor. Now this doctor made me do some tests like sodium test, potassium test, a brain scan and a spine scan, which turned out to be all clear. It's then that I went to a neuro and I told him my symptoms. He spoke to my doctor and he immediately told me I had GBS.
The Guillain-Barré syndrome, GBS, is an autoimmune disorder where the body's immune system attacks the peripheral nervous system. It causes weakness, tingling and numbness in limbs, and in some cases, it leads to paralysis.
It usually typically starts with a weakness. Weakness usually starts from lower limb going up to the upper limbs, but there are variants where it actually can start from the upper limbs and go down to the lower limbs. And there are some other variants where the cranial nerves, which are the nerves involved, which actually originate from our brain, they get involved as well.
The first GBS outbreak of 2025 was reported on the 9th of January in Pune. Since then, hospitals have seen a surge in GBS cases, prompting authorities to test water samples.
GBS is typically waterborne or foodborne. However, the health department has ruled out a foodborne outbreak as patients had no common food history. Authorities now attribute the outbreak to contaminated water. So far, over 7,000 water samples have been collected in Pune, with 138 testing positive.
GBS is non-communicable. Doctors suggest that if someone is experiencing weakness in limbs, double vision and is unable to cough, they should immediately seek medical attention.
The treatment essentially depends on two aspects. One is to try and stop this autoimmune process in the body by stopping the destruction of the nerves. And the second would be supportive of whatever damage has already been caused.
Since the outbreak in Pune, cases have also been reported in Delhi, West Bengal, Andhra Pradesh and Kerala. GBS has claimed 25 lives so far, 21 from Maharashtra and 25 from the rest of the country. Doctors say immediate medical attention is the best way to deal with GBS, and a delay of even a day or two can worsen a patient's condition.
The central government has extended support to Maharashtra's health department in combating GBS. The Union Health Ministry has issued a set of guidelines to affected municipal bodies, urging the hospitals to monitor early warning signs and prepare a rehabilitation plan for patients. WHO teams are also on the ground assisting health authorities. In Mumbai with Shilpa Rani Peta and camera person Deepak, this is Santya for CNBC-TV18.
And before we wrap up this edition of Business 360, we leave you with visuals from Prime Minister Modi's day out at Vantara, situated in Gujarat's Jamnagar. Reliance's Vantara has been billed as the world's largest wildlife rescue, rehabilitation and conservation centre.
and the deal can be made very fast. It should not be that hard a deal to make. It can be made very fast. Now, maybe somebody doesn't want to make a deal, and if somebody doesn't want to make a deal, I think that person won't be around very long. That person will not be listened to very long, because I believe that Russia wants to make a deal. Well, I just think you should be more appreciative, because this country has stuck with them through thick and thin. We've given them much more than Europe, and Europe should have given more than us, because, as you know, that's right there.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, after steel, aluminum, cars, drugs and semiconductors, the US President Donald Trump is readying tariffs on agricultural products in a fresh salvo. Trump wrote on social media, and I quote, "To the great farmers of the United States, get ready to start making a lot of agricultural products to be sold inside of the United States. Tariffs will go on external products on April 2nd, end of quote. Well, Trump's announcement, however, lacked clarity on the details of the agri products that will be affected. The proposed tariffs are expected to raise the cost of imported agricultural goods, benefiting the US farmers. Meanwhile, China is retaliating to Trump's orders to double the tariffs on Chinese goods to 20% from earlier 10%. China will impose tariffs as high as 15% on American agricultural goods, including chicken, corn and cotton. Soybeans from the US will face a 10% tariff. Over the years, China has also reduced its dependency on agri-goods from the country. The share of soybean imports from US fell to 21% in 2024 from 40% in 2016. Its imports of American corn also fell to less than $600 million. Last year was $2.6 billion. However, cotton imports surged marginally in the year. Now, where does India stand when it comes to this agri-tariff war triggered by Trump? Sources tell us that the country is resisting as of now the pressure to reduce its tariffs on many of the products, as it would impact millions of farmers within the country. Well, that really brings us to the conversation on what really will be the impact on all of these assignments. And joining us for that is Himanshu Agarwal, Managing Director, Satyam Balaji Group. Thank you so much, Himanshu, for joining in. And when you look at the overall numbers, we do understand that India is at number 10. When you look at the goods trades with the US within the countries, the contribution, of course, is just about 2.4% within that number, while you have 15% coming in from Mexico and Canada, 11% perhaps from China. But within this number as well, Himanshu, rice clearly is a very big number when you look at exports, whether it's basmati rice or non-basmati for that matter. So with all of this happening, with the currency moves as well, what has been your immediate sense on how the trade really seems to be getting impacted? And if there are tariffs, then how as a sector in sense of rice are you looking at it?
So Manisha ji, in terms of rice, US is already sort of self-sufficient. They do about 11.5 million tons of rice production, wherein their import is about 1.5 million tons, out of which what India does is close to about 250,000 tons. So mainly the rice exports to US happening from India is to the Indian diaspora living over there, the non-basmati and mainly the basmati trade. So the basmati trade would be affected to a certain extent if there's a tariff to be coming in place, because that accounts to about 8 to 9% of total basmati exports from India. But then again, not many options to go for in terms of basmati import from US. I mean, US either has to buy from China or from India. So the Indian diaspora will continue to flourish out there, and thus will the import from India should not be affected as much. But yes, the other soft commodities, as you've spoken, would take a bigger hit. Countries like Mexico and all, there it is to be seen that how exactly they take these tariffs, because of course there would be retaliatory tariffs from their side as well. So I don't know what US wants to achieve by this. I mean, I'm sure there's a huge trade deficit between India and US in terms of total commodities, if you see technology, oil and gas and everything. But yeah, in terms of export of rice, if we talk about, I don't see a lot happening, even if there is a tariff imposition happening, because non-basmati is just about 50,000 tons, which is to Indian diaspora. They would continue to buy even if there is a tariff.
Himanshu, also, as you spoke about, I mean, it is getting really broadened when you look at all of these tariffs and agriculture. Now, the next layer that the US president is talking about. But even before, as he spoke about agriculture, and that perhaps would happen on 2nd of April, what China has pushed out is as early as the second week of March. Are we looking at a bigger and a longer tariff trade war, as it were?
I most certainly would feel so. I mean, if they are not to come on a common table, there would definitely be a trade war happening. And India being in the center of agri supplies across the world. I mean, today India is literally feeding the world in terms of, whether it is sugar, whether it is rice, whether it is wheat, whether it is maize. So yes, India happens to be in the epicenter. I'm sure the Indian government would have a dialogue with these countries and will try to sense logic over here. But yes, it certainly is a time wherein India would have a more commanding position, because we are on the better state of supply chain. We are very well sufficient in terms of agri, at least we are talking about. So there could be a trade war, but I happen to believe that we are very aptly placed, and Indian government can take their calls accordingly how they want to go about it. Because India government was never too happy with Indian rice going to China. So I'm sure now with these trade wars, they might find a way of restricting that and, make sure that we are not doing rice as well as a water export, which Indian government is so keen on restricting.
Himanshu, the other thing really is about, on how China found other markets when it comes to soybean and corn, perhaps. They started importing more from Brazil. We've seen that happen in numbers on where US and China trade was in 2015 or 2016, even until 2020 and 21. But the last few years, or the last 2 to 3 years, have seen on how Brazil is becoming a major force within the markets as well. So when it comes to India, are we looking at the numbers? Are we looking at the geographies changing here? Because COMEX for the longest time, or CME for the CBOT for the longest time, has been a price reference, and the rest of the world really looks at premiums or discounts from that. Do you see that changing with what's happening?
I certainly would feel so that Indian products are going to be the benchmark products down the line, because the acceptability is increasing, the reliability is increasing, and more to do so, the quality wise and whole infrastructure that India has developed around export, it has become much more reliable. So I certainly feel that, our products is going to be benchmarking different criteria and different agricultural products. So I would feel that finding an alternative to India is going to be difficult, because then again, it's not so easy to change the food habits of certain countries that we are seeing now. Like in rice, if I would say that Thai rice export used to enjoy a good 15 to 20% premium on Indian rice in African markets, which is not the case anymore. There are certain times where India is selling at a premium over Thai, which was historically considered to be a much premium product. So I mean, with stability in exports and continuous supply to certain markets, I really feel that we can establish that sort of an authority internationally.
And Himanshu, we do understand that India is talking to US right now. We do understand that our trade minister, commerce minister is in US right now, having various conversations with the kind of trade deficit that we have with US. Various sectors that I have been speaking to seem to be preparing themselves. I've been speaking to a lot of international guys as well, and they tell us that China was preparing because they have imported and stocked a lot of corn and soybean from US already ahead of these tariffs, and they've been buying from Brazil also. Is India, as of now, watching, waiting on sidelines, or do you think we have various sectors really activated into ensuring that there are enough stocks and then that we are prepared for anything that comes in?
So exactly, the thing is that India has never been dependent on US in terms of agri imports, because agriculture, as we have been self-sufficient and we have been net exporter, unlike China. So there's not much of a preparation that was needed to be done at India's level. We were self-sufficient for the longest of period, and I don't think there is any buzz or any panic in the sense that if the tariff would come, it would hurt any of the business drastically. There may be some adjustment period, but I think India is going to find its way, and I don't see any challenges in terms of accepting these tariffs, even if they were to come.
And you don't think that's going to happen, especially for things like soybean or corn or wheat? Or do you think those are the sectors that perhaps need to be more bothered about than rice?
I think the only thing India is bothered right now is how to liquidate FCI stocks, because that's the only challenge we are sitting on right now. So yeah, I mean, Indian stocks, I mean, whether it's maize, whether it's wheat, whether it's rice, I think we are very suitably placed, and all these tariffs have, very little or negligible impact on Indian trade.
All right, that's good to know, and that you perhaps are another assuring voice that has been saying that. Himanshu, thank you so much for joining in and making sense of what really agriculture tariffs mean for the world and how India perhaps is better aligned and has better stocks. And of course, there's more credibility and acceptability when it comes to Indian goods as well. So we perhaps may not be so hit when it comes to agriculture as a sector. Well, on that note, it's time for a short break, but don't go anywhere. We will bring you a CNBC TV18 exclusive from Merce's vehicle naming ceremony in Mumbai.
Let's talk about SIFs, the new investment option in town. If you have been investing for a while, you have probably heard about mutual funds, the go-to option for most retail investors, and maybe even about PMS, the portfolio management services, where high net worth individuals invest 50 lakh rupees or more for a custom-built portfolio. But now there's something new and interesting in between these two categories, and that's specialized investment funds or SIFs. This is a brand new category that SEBI has just approved, and it's designed for investors who want more flexibility and sharper investment strategies, but without needing to lock up 50 lakh rupees like PMS. To invest in this specialized investment fund, you'd need a minimum of 10 lakh rupees, so it's definitely not for first timers, but it's far more accessible than PMS. Now let's talk about how this fits into your investment toolkit. Mutual funds are obviously your starter pack. You can start with as little as 500 rupees. The strategies are basic, mostly long-term buy and hold, and they're designed to be simple and transparent. PMS, on the other side, is your high-end tailor-made option. You need at least 50 lakh rupees. The portfolio is customized for you, and the fund manager has a lot of flexibility to choose what to buy, sell, and when. Now, SIF sits right in the middle of these two, 10 lakh rupees minimum, advanced strategies like long-short trades and derivatives, but still regulated closely by SEBI, so there's proper oversight. Now, what makes SIFs different from regular mutual fund? For one, the strategies. Regular mutual funds mostly follow long-only strategies. They buy assets, they expect to go up over time. But SIFs, on the other hand, can go both long and short, meaning they can bet on stocks and bonds and even on sectors that they think will rise or even fall. They can also use derivatives up to 25% of the portfolio, which lets them hedge risks or make more tactical bets. Flexibility you don't get with traditional mutual funds. And SIFs themselves can be either open-ended, meaning you can enter and exit anytime, or close-ended, meaning there's a fixed tenure. But even for close-ended SIFs, SEBI says that they must be listed on stock exchanges, so investors have a chance to exit early if needed. Now, SEBI hasn't just opened the gates and said launch what you want. There has been a clear rule set for AMCs who want to offer these funds. Only AMCs with at least
Hello and welcome to this very special show aboard the Albert, which is the latest ship that has been launched by Maersk. Well, we are at GNPT and the naming ceremony has just gotten done. Well, naming ceremony is very customary, goes back way back to thousands of years perhaps, and is done differently in various cultures there. Well, the important thing about this ship is that one, it's the 11th coming in from Maersk. We are at GNPT right now. This is the second largest ship in the fleet of Maersk. We are told that this is 350 meters long. That is 3 football grounds here. This also can take around 16,000 plus containers on board, and it is expected to go via Middle East to Europe. And the most important thing about this ship is that this runs on green fuel. Joining now to take this discussion forward is Vincent Clerk. He's Global CEO at Maersk. Vincent, hi, thank you so much for joining us here at CNBC India. Congratulations on Albert to begin with. And how do you look at India in the overall map of things, and how important is a naming ceremony for your vessel here in India?
Well, I think in general, if you look at the world economy in general, there's a lot of uncertainties. There is a lot of also areas that are slowing down compared to what we have seen over the past few decades. And you have a bright spot. And this bright spot is India. That has really hit a stride, and where we're seeing an acceleration of the growth, an acceleration of the development. And of course, for a company like Maersk, it is important to signify in a very symbolic but very powerful way our commitment to playing our part in bringing that transformation about.
Since we are talking about India, Vincent, you also pledged $5 billion in coming few years. How do you look at this investment, in what areas, and how much time frame?
So I think what is really important for us is to look at how we can support the development of India, and what does India need where we have capabilities that are differentiating. We know how to develop ports and operate ports. We know how to develop and operate warehouses, inland infrastructure. We know how to develop also. We have a large technology base here that we're going to continue to increase. But if you look at the $5 billion, the lion's share of it is going to go to terminal infrastructure and inland logistics infrastructure to support the growth that there is in this country.
Vincent, you also, the company that is also has met the Indian Prime Minister, and there has been a talk about alliance, Green Fuel Alliance, that is. What does it really mean, and what is the time frame and roadmap here?
Well, I think there is a great alignment between our goal for decarbonizing our operation and the vision that there is for India becoming a powerhouse in the new world of green energies. And I think that for us, making these two agendas meet in a powerful way, and again, playing our part in bringing this about while also serving what we want to do for the world, what we want to do for our customers, makes a lot of sense.
Talk about this ship now, Albert. This has been named, and naming ceremonies are usually, when it comes to maritime and shipping companies, big deal, and I saw that one today. How important is this ship? This is one of its kind. This is going to be running on complete green fuel. Tell us more about this one.
Well, I think always the name giving within the maritime sector, within our industry, is really big. This is the time where you actually come and hope with the Godmother really give it a blessing and wish it, safe sailings and prosperity and so on. So it's a really, really important symbolic event. It is especially symbolic because it is the first time that it happens in India. Ever. We've been here for over 100 years and have never had such an event. So from that perspective, it's very important. But it is important also because it is a different design. It is a different technology. It is a real beacon of hope and a symbol of that it's not just words, but the future is actually coming, and this is how it looks.
This is one of the green fuel ships that you have. So what is the number right now, and what really is the plan going forward?
So this is the 9th ship that we have joining, and they will continue to come. In the same series, we have 26 ships on order, so there will be more of those coming during the rest of this year and next year. And we have other series that are following that in the coming years. So this is part of our fleet renewal program to make sure that the network that we have remains the most competitive network out there, but also a network that enables us to reach the decarbonization goal that we've put forward.
Vincent, it also is going to be about availability of green fuel. As of now, we do understand that China is your major source for that. But is India giving you those kind of numbers? What are the kind of conversations that you have in India for this?
Yeah, so the markets for green fuels, and especially the supply of green fuel, is still emerging markets. And it is true that so far A few Chinese projects have gone faster than what we have seen elsewhere in the world, and that's why so far the contracts that we have signed are mostly in China. But we're actively looking for diversification of sourcing, because a lot of our ships do not call China. A lot of our ships, like Albert Maersk, will be sailing between India and Europe, and so it is important for us to find sources of energy, either in India or on the way between India and Europe. And there is a lot of really promising projects here. But we need to really, I think, encourage the development. It takes some risks to be the first ones to have a big project come online. We need a lot of that green fuel to power this ship and its sisters. So there is a scale element in that. But again, this is a dialogue that we're having with different projects here in India, and we're looking forward to hopefully seeing one of them come into a real business and signing a contract and having the first step in this diversification.
Vincent, also, when you talk about the recent budget that went by for the Indian markets here, there was this reference of maritime and shipping and how India wants to play a bigger role in that. There were time frames set as well. How do you see being part of that?
I think this is a really opportune moment for India to actually reflect on the role that they play in the maritime industry. 1 employee in 5 in Maersk is an Indian passport holder. So it's the largest nationality in our company by far. And it will continue to grow. I mean, we have interest. 40% of our seafarers are Indian. Most of our technology is sitting in our technology center here in Bangalore. We have big resource centers. So the footprint and the role that India is playing into the global supply chain, into the shipping and the maritime sector is outsized. And it is great to see that this is becoming in focus now, and we're going to get even more energy behind developing capabilities here.
Vincent, talking slightly bigger here, and when you look at the global trade at this point in time, do you see, and how much would you see India's growth numbers leading to that? When you look at various geographies in sense of global trade, where is India standing?
I think if you look at India today, where India really stands out is in the growth that it delivers. Between 8 and 10% growth in the market, likely to continue in the coming years. This is, given the size of the market, actually quite unique nowadays. And certainly the role and the place that India is going to play in the global supply chain is going to continue to increase in the coming years. So it is important. A ship like this would not have been economically viable to serve India just a few years ago. Okay. But this growth is actually allowing us to upgrade and to continue to invest in the infrastructure to support this, lower the cost of logistics, bring the world markets closer to India in a way by taking away these frictions and these costs.
Talk to us also about on what's really happening in the global markets right now, and with the US president talking about tariffs, some of them implemented, some of them still being talked about. Has it had an impact, and how are you looking at the impact if actual tariffs are implemented?
So I think the reality on the ground so far is that you cannot see neither pull forward nor any type of consequences of the tariff activities that there has been so far. And for a reason that is fairly simple. What determines the demand for transport is the consumption. If consumption doesn't slow down, then demand remains strong and people have to source. And at that sourcing, capacity is not widely available. So sourcing is actually sticky, and it takes time for things to shift in terms of sourcing. So our expectation is still that tariffs or no tariffs, in the very short run, it is hard to see that this can have a massive impact. Okay. Unless inflation was to really ignite again at a very, very high level. That would certainly, then we would certainly move into a different type of scenarios. But if demand stays as robust as it is, tariff or no tariff, containers will continue to move largely from the same origins, largely in the same regions. But you will see a gradual shift. We just talked about the growth in India a few minutes ago. The market share of India in global trade is going to grow in the coming year. That's certain. And that means that more of that capacity is being added in India than anywhere else.
How are you looking at, as you said, you're looking to come into India in a big way. We've been working together for 100 years now, and you're looking at very huge investments as well. So going forward, though, what are the challenges that you see in India? And I'm sure you're having conversations with various counterparts here, but what is it that really sticks out?
Well, It is actually, growth can be painful when it comes as fast on such a big base. India is a huge country, 1.4 billion people spread over a huge geography that needs to be connected. Everything needs to be stood up at the same time for it to continue. So it's a huge challenge. It's a challenge for companies like ours to do our part. It's a challenge for the government to orchestrate all of this and to do the part that they have to do. So far, I think that the fact that this growth is sustaining itself for a few years already is a sign that things are going well. Okay. But the more we grow, the more 10% of a bigger number becomes a very big number. And then you have to continue to accelerate and accelerate, because what you did last year is not going to support 10% next year. You're going to need a bit more. So sustaining this, I think, is going to be key.
It's going to be a challenge.
Yeah.
Okay, Vincent. Also, you're into 130 countries, and you have a huge fleet. What are Maersk's plans going forward from here? Are you looking at more businesses? Are you looking at increasing capacity, increasing fleet? What really are the numbers you're working with?
So our strategy for now is actually that the world is adding ship capacity faster than it is adding inland infrastructure, whether it is ports, warehouses. It is not deploying technology fast enough to support the supply chain, and therefore our key focus has been for the past few years to really concentrate on where we see bottlenecks appear in order to reduce the cost of logistics. And we're doing that by increasing our focus on port operations, on warehousing operations, on road transports operation, e-commerce and technology. That's what we have done. For the fleet, it's mostly about renewal and keeping the tool of production, which are our ships, extremely competitive. But since, in general, this is not where the bottleneck is, we prefer to focus on some of the other part. We think we can make a bigger impact.
My final question clearly is on Red Sea, because that clearly has been a concern for the last couple of years. Has the world gotten used to it, and have the freight rates now kind of settled down?
I think it has gotten used to it, at least temporarily. It's been more than a year, and it's certainly going to be quite a few months before, this changes. But I wouldn't say that this is normal. It's normalized for now, but I think the expectations for everybody is that this is not the most optimal route to take, and we're going to need to find a solution in order to reopen the route that is the intuitive route to sail, and that will come hopefully in the near future. But there are a lot of conditions that need to be met, and so far there is so much volatility. Actually, changing back and forth is not really an option. It's extremely costly and disruptive. So for us, prudence is really important. There is a lot of safety for our crew members, for our assets, for our customers' cargoes that we need to take care of. But we're, of course, monitoring that situation very closely and look forward to being able to reopen that route.
One very final question, and this is about the commodity prices. Very, very huge volatility there as well. Does that impact you in any sense, and how are you looking at overall markets?
So we are fortunate that most of what we transport is actually not commodities, but semi-finished goods or finished goods. So from that perspective, we are less impacted than maybe other shipping sectors. It is, of course, something that has an impact because it has an impact on the economy and how much growth there is in the economies that we serve, back to the consumption point. But for now, it's really all about consumption for us to determine what is going to shape our markets.
So if in one word or one sentence you had to describe 2025 outlook, what would that be?
You have to plan in scenarios. A lot of volatility and uncertainty. You have to be ready for a lot.
Energy transition, does that come to your mind? I mean, is that going to be an important year for that?
In 25 and in 26, it's a long haul transformation. It's going to take a couple of decades, and we got to take this one step at a time.
One taken, Vincent. Thank you so much, and congratulations yet again. Thank you for making time for us today.
Thank you.
Thank you.
Thank you.
Record are eligible to launch SIFs, plus they need to manage at least 5,000 crore rupees in existing mutual fund assets to even qualify. This ensures that only experienced players with rock-solid management systems get to handle these advanced funds, because these aren't plain vanilla products meant for casual investors. So who should even look at SIFs? If you're already comfortable with the markets, maybe you've been investing for a few years now, you understand terms like hedging, short selling and global macro strategies, and you want to go beyond mutual funds but without committing 50 lakh rupees to a PMS, this could be worth exploring. But remember, flexibility comes with higher risk. These are not simple set and forget products like mutual funds. They're designed for investors who actively want to participate in more complex strategies and who understand the risk involved. This is a new space, so keep an eye out for which fund houses launch the first SIF and what kind of themes and strategies they bring in. And
user development fee is charged by an airport operator to passengers to bridge the revenue shortfall. This fees varies across airports and the amount is approved by the Airports Economic Regulatory Authority or AERA. Now, GMR Airports operates Delhi Airport, Hyderabad Airport, Goa Airport, Nagpur and Bidar airports. It is also developing the Visakhapatnam International Airport. Now, when it comes to UDF, Delhi Airport stands among the lowest at a flat fee of 129 rupees for domestic and international passengers as compared to Bengaluru, Hyderabad, Chennai, Kolkata and Ahmedabad. Now, GMR took over Delhi Airport in 2006 and the tariff proposal that it has submitted now is the fourth control period from April 2024 to March 2029. Here, DIAL has proposed UDF for departing as well as arriving passengers on peak hour and non-peak hour basis. So, for domestic passengers, the proposed fee is at 405 rupees during off-peak hours and 610 rupees during peak hours. For international passengers, departing economy class will pay 810 rupees and business class will pay 1620 rupees.
Hello and welcome to News Center with me, Parikshit Luthra. Donald Trump's trade wars have begun with the US president confirming 25% tariffs on Canada and Mexico and doubling tariffs on China to 20%. Canadian Prime Minister Justin Trudeau has announced 25% retaliatory tariffs on $20.7 billion worth of US goods, followed by another 25% tariffs on $107 billion worth of US products after a 21-day consultation period. Mexico is following a wait-and-watch policy. China has also announced 15% additional tariffs on US chicken, wheat, corn, cotton and an additional 10% levy on US soybean, pork, beef, aquatic products, fruits, vegetables and dairy from March 10. Speaking on Truth Social, Trump has also promised to impose tariffs on all agricultural imports into the US from the 2nd of April. The US has already announced that reciprocal tariffs will be imposed on all nations from the 2nd of April this year. India and US are currently in the process of negotiating a trade deal, and Commerce Minister Piyush Goyal is in US for talks with his counterpart Howard Lutnick. How will these tariffs impact India? Joining us right now are Jayant Dasgupta, former Indian ambassador to WTO, and Amitendu Palit, senior research fellow on trade and economics at the National University of Singapore. Ambassador Dasgupta, if I can begin with you, speaking about agricultural imports into the US, how do you think tariffs on agricultural imports in the US is going to impact exports from India specifically?
Well, the US is one of the largest exporters of agricultural products. In 2024, it imported about $204 billion worth of products. And if the US were to impose 100% tariffs, the burden will have to be borne by the US consumers. The second point that I wanted to say is that as far as India is concerned, India exports coffee, tea, and mate and other things, beverages, worth about $390 million worth. That is one of the largest. Shrimps and other fish, which is strictly speaking not considered as a part of the agricultural universe. It is part of the non-agricultural market access NAMA product, industrial product. Now, that is the largest export product. If you take it as part of agriculture, it is about $2 billion worth. And then comes other things like, honey and essential oils, etc. So India, the agricultural products that India exports is not very high, and it is focused or concentrated only in a few chapters of the harmonized code. So I don't think it is really going to be affected very much. But of course, if the US imposes 100% tariffs across the board on all agricultural imports into the US, irrespective of the country, then it's going to be quite problematic.
Mr. Palit, I'd like to ask you, do you think Donald Trump will follow through on this threat of tariffs on agricultural imports?
I think he will, Parikshit. There is a reason for that. I think the reason is pretty much clear that now with tariffs being imposed on United States exports to various other countries, there is a serious prospect of prices that the United States consumers will face in their internal market is going to go up. And if you would have noticed, most of the retaliatory tariffs that have come on the U.S. exports till now, principally from China, that have already come in through, and also from Canada, as they have suggested, are on United States agricultural exports to these countries. So I think there is a side of the tariff play that is coming into prominence now. There is a cost to the tariffs that have been brought into play by Trump 2.0. In fact, he has admitted to it as well, that probably there is going to be a cost in the short run. But what that cost is also now going to generate is a twofold effect. First, in a lot of cases, American consumers are going to face much higher prices for their products. Number two, several American exporters, and principally agricultural exporters, which comprise significant segments of the Republican constituencies, are going to get hit hard on their market access exports. So this is now a reverse policy that is being brought in. While the initial round of tariffs were being imposed by the Trump 2.0 for improving the market access of American products in other countries, now this is the other side of the story coming into play, that American consumers will now be encouraged to buy more from the domestic producers to ensure that these producers don't suffer the kind of economic losses they are going to face as a result of retaliatory tariffs. And one quick point here, I think I'd just like to mention that very soon Donald Trump is going to deliver his first State of the Union address to the Congress after getting elected, which is going to address his domestic political constituencies. And I think that is where he has to send a message across to all constituencies about the success and long-term fruitfulness of the measures that he's adopting.
One quick question. When it comes to agricultural exports from India to the US, which product lines do you expect to be hardest hit by Trump's tariffs?
I would expect some impact to come on pulses, some impacts to come on essential oils maybe, or oils as such, but I'm not too worried about a broader range of impacts for Indian agricultural exports generically, for the very simple reason that I think India also has an opportunity. The opportunity is that India and the United States have begun negotiating a bilateral trade agreement. Now, in the backdrop of that, these generic tariffs on agricultural exports have come up. So in a sense, that gives India a baseline to look at and explore the kind of market access it would like to have for its own products into the American market. Because if you see a situation where a lot of other competitor agricultural exports into the American market are facing high tariffs, but Indian exports somehow get a concession on those in the space of the first tranche of the PTA that is going to be worked out, then actually that might give India an opportunity.
Right. Ambassador Dasgupta, coming back to you, Donald Trump has also followed through on his threat of tariffs on Canada and Mexico. He's confirmed that 25% tariffs on Canadian products being exported to US and Mexican products being exported to US, those tariffs will come into effect. He's also doubled tariffs on China to about 20%. Retaliatory tariffs have also come into effect from both Canada and China. How do you think this is going to impact global supply chains and India?
I think there is going to be a lot of upheaval and disruption of supply lines and trade flows. The Canadians are the largest agricultural export destination for the US. And the Chinese also figure amongst the top 5. Sometimes it is the Chinese which are the largest buyers of American agricultural products. Sometimes it is the Canadians, followed by the Colombians, the Japanese, the Koreans. Now, if there is going to be 100% tariffs on the imports. The Chinese also export some agricultural products to the US, but there would be cross-sectoral retaliation. And that I think the Chinese have already started doing it by saying that they will impose 15% tariffs on American products, additional tariffs. So it is going to be, quite chaotic. And retaliatory tariffs will be there, crisscrossing the oceans. So it is very difficult to predict as to when there will be a cessation and good sense will prevail, because this is not the way that international trade can grow and can benefit all countries which participate in trade.
Right. And Amitendra Palit, final question to you. How do you see these tariff wars, which have now truly started impacting India? US and China imposing tariffs on each other, Canada and US imposing tariffs. Is there an opportunity for India, or in the short run, we are going to be impacted on certain products?
Parikshit, that's a very interesting question because it can go both ways. As I mentioned earlier, there could be an opportunity for India because India knows what to expect when it is into the negotiations. There are generic tariffs that have come on both sides, on agricultural products, on steel, aluminium, copper, and there are a number of countries on which tariffs have come. There are going to be dismantling of existing trade arrangements. Like after these trade agreements, you obviously won't really have the US-Mexico-Canada agreement existing the way it used to have earlier. So that means a whole new range of opportunities for India. But there are various complications going ahead that I can foresee. The first is that because of these back and forth tariffs, there's going to be an escalation in the embedded costs that producers face. There is going to be a tendency to divert production for avoiding the tariffs. Some countries would scramble to catch up production. Some countries would attempt to catch up production but may not be successful. Now, in all these, how prospects pan out for a country like India is actually not too certain at this point in time. And there is a second point that comes in here. We need to wait for the reciprocal tariffs. Now, the problem over here is that reciprocal tariffs, as the United States has said, it's not just going to be a one-on-one response to tariffs on one line vis-a-vis tariffs on another line. There are a range of other issues that are going to come into the calculation of those tariffs, like non-tariff market access barriers, other investment and market access issues, positions taken on currencies, and so on and so forth. I think where India stands right now is at an interesting posture because India is probably, apart from Japan, only country which in the Trump 2.0 has been shown the inclination by the US administration to be entered into and engaged with a straightforward, no-nonsense bilateral trade agreement. And the United States has shown a clear interest in that. It is important for India to capitalize on that interest and ensure that it comes back with a balanced outcome.
Let's not forget, Trump has also threatened to impose tariffs on agricultural imports into the US as well. On that note, we take a short break, but don't go anywhere. When we return, we'll get you an interview with the global CEO of Tenneco, a global automotive component manufacturing firm, which is a big supplier to OEMs and the aftermarket around the world and has a big presence in India as well.
That these rates are in proposal stage and the final tariff will only be determined by AERA. Now, DIAL has justified the demand citing insufficient cash flows and consecutive losses totaling 1795 crores from FY21 to FY24. They are projecting a 1794 crore loss in FY25 as well. With a debt of 14,786 crores and a declining credit rating, the airport told AERA that raising funds for future projects has become difficult. It claims to have invested 12,500 crore rupees from 2019 to 2024 in new development projects like Terminal 1 development, 4th runway, and Eastern Cross taxiway. The airport said that there is a significant need for capital expenditure for further developing the airport's infrastructure, and which is why the need for higher user development fee.
What next for Donald Trump and Ukraine's President Zelensky after the massive showdown that the entire world witnessed at the Oval Office? Before this, America and Ukraine were planning to sign a minerals deal. But then we all saw what happened. Now, in the latest statement, Zelensky says Ukraine is ready to sign that deal.
If we agreed that a minerals deal with the US will be signed, from our side, we are ready to sign. I honestly think the United States will be ready as well.
So what is this deal all about? And before that, why does Trump want Ukraine's minerals? Trump claims that US military and economic aid to Ukraine is almost about $500 billion, and he wants the US to have access to Ukrainian minerals equivalent to that amount. However, Ukraine disputes this figure. Even the German think tank, the Kiel Institute, estimates that the US has sent $119 billion in aid to Ukraine. Trump has argued that such a deal would help US taxpayers get their money.
Our focus today is on the global automobile industry and a company that is a leading automotive designer, manufacturer and supplier to OEMs and aftermarket customers all across the world. The US-based company has operations across more than 35 nations, including India, and has reported over $20 billion in revenue. Joining us right now to talk about the company's India strategy and the global sentiment for the auto industry at a time when there are tariff wars and a lot of uncertainty is Jim Voss, the global CEO of Tenneco. Jim, thank you very much for joining us here on the program. Let me begin by asking you what brings you to India and how bullish are you on India's prospects at this juncture?
Very good, very good. Parikshit, thank you so much for having me. And listen, I'm here in India in very exciting times. As you mentioned, there's many things going on in the auto industry. But for us, India is a key part of our past success, our current success, and certainly our future. So what brings me here to support Team Tenneco on the ground in India and to look at the tremendous opportunity we have here. At Tenneco, we have a very simple but straightforward purpose statement, and that's to be the world's most trusted partner to our OEM partners and customers, and most importantly, to be the best manufacturer and supplier, distributor of auto parts in the world, not just in India, but around the globe. And we're very, very excited about that. We've been doing business, Tenneco has been doing business in India since the 60s. We have 19 manufacturing facilities, 6, as you mentioned, aftermarket drive distribution centers, 3 engineering centers, technology centers, and over 12,000 employees. So India has been a huge part of our success, but even more importantly, I think a critical part as we move forward. So I'm just here to support the team and to continue to drive our strategic imperatives here in India, but also intentions to support the globe from India.
Is there a plan to expand your India business, invest more so that it can contribute not just more to domestic customers, but globally as well, export more from India?
Yes, it is. You know, when I think of just a macro strategy for India, I think of India for India and India for the rest of the world outside of India. India for India, of course, we've been here and we continue to invest, move more technologies that are needed for the very specific needs of India. So I think, you know, before we look at India for the rest of the world, we have to make sure, and we do have the right technologies to support the Indian growth, which is different than other parts of the world in some respects. But the second prong is, you know, we very much support the manufacturing growth for the world from an Indian perspective. And again, we are continuing to invest in our technology, our engineering, our manufacturing footprint. You know, as the world looks at having a reliable supply chain, a lot of the products coming from China, now some of our OEM partners are rethinking their strategy, as we are as well. And I think India is incredibly well positioned because of the cost basis, because of the world-class employees here, world-class technology. I think there's a lot of promise going forward for India.
You know, the China Plus One strategy, and also the strategy to move away from China, that really began during Donald Trump's first term. Could you give us a sense as to how much in the last 10 years, how much of your business from China have you shifted to India in terms of manufacturing?
You know, I'm not going to give out specific numbers, but I think China continues to be a very strong producer of components for auto parts, no question. It's the world's largest car park and aftermarket. But as our OEM partners are rethinking their strategy and they're rethinking some of their supply chain issues, we are continuing to look at opportunities to invest in countries like India that have the growing infrastructure, great cost position as we move forward. So when we think about our longer range plan over the 5-10 years and longer, I think India is incredibly well positioned to grow maybe more than its fair share with the auto industry and the component makers.
All right. I would also like to ask you about the tariffs that the US President Donald Trump has imposed on Canada and Mexico. And Canada has imposed retaliatory tariffs. China has also come out with some retaliatory tariffs. How do you think these tariff wars are going to impact the auto industry? Are you already seeing impact on your bottom line?
You know, really, we're not seeing any impact at the moment, but they're just being implemented now. As a matter of fact, this week, I think there's tariffs being imposed from Mexico and Canada from the United States. And of course, as you mentioned, not just worried about and keeping our eye on the tariffs, but the retaliatory tariffs. So there's no doubt, listen, we'll just have to see how this plays out and how long they last will determine the effect. There's no doubt longer term, the price of the vehicles will go up for the consumer if the tariffs stay in place. However, I remain cautiously optimistic. But I will tell you, from a technical perspective, we're very, very well positioned, irrespective of tariffs. We have almost 200 plants around the globe, as you mentioned earlier, in 35 countries. We produce in region. We have manufacturing, technology centers in every region. So we're poised for success, irrespective of the tariffs.
Right. How do you see the demand in the auto industry globally? I'm talking about from OEMs, from component makers. How would you describe the demand overall, the sentiment?
Listen, there was slower demand last year, and as we go into this year, that's no secret to anyone, and we see slower demand in China as well. However, from our perspective, you know, we think there's really two prongs in terms of growth. Even as the electrification takes place for the light vehicle, and it's slower in some areas than others, where we still need advanced components for the internal combustion engine. As emission standards get more strict, we want more efficient vehicles. We still have to have technology in the internal combustion that's going to be around for a very, very long time. Also, as we see the growth in the electrification, we're going to have, you know, powertrain agnostic pieces that play a key role, like suspension, ride control, and the like. So again, the strength of Tenneco is we have a very, very complete and dynamic portfolio, not just for EV, not just for internal combustion, but agnostic to the powertrain. So while the volumes have been lighter the last couple of years, I see it going forward. It's going to be strengthening possibly as we go into next year. Either way, however, because of our portfolio, we're poised for success.
All right. You have a diverse portfolio and presence across the world in manufacturing as well. So you're able to diversify the risk to a great extent. But coming back to the issue of tariffs, as Donald Trump continues to impose tariffs on different countries, he has threatened to impose tariffs on India as well, on the auto industry as well. Do you expect this to have a negative impact on US auto sector, including companies like yours?
I think that's very, very difficult to say because it's very difficult to see how this plays out. Again, certainly tariffs could possibly increase the price of the automobile to the consumer. However, from a competitive perspective, you know, if there's tariffs that are assigned to different countries and different places, it's going to be equal to all of us in terms of making components and to our OEMs. So then you're going to have to look at the strength of the portfolio and the diversity around the globe, and I think that's where we have a significant advantage. Because we're in so many areas, because we produce locally for local consumptions for our OEM. I believe the tariffs are going to affect us less than our competition, and I think we're poised for success that way.
Right now, US and India are negotiating a trade deal. How do you think this could impact the auto industry, companies like yours who have significant business in both US and India?
Again, these tariff arrangements and negotiations are very complex. I don't necessarily have an opinion of how this is going to go because it completely depends on the magnitude of the tariff and the length of time of the tariff. All we can do is stay focused on what we do, be the world's best manufacturer, and again, focus on the fact that a large part of our business, especially in India, we have over 19 manufacturing facilities in India, technology centers in India. So we're well positioned here, and we're well positioned to be able to weather the storm that may or may not come from the tariffs.
Right. What, according to you, needs to be done to give companies, global auto companies, more market access in India?
I think you have to be willing to invest and lean in. You know, the Indian market is incredibly complex and robust. And I think because of some of the geopolitical concerns around the globe, I think it's actually poised to be a real hub for India outside of India. You know, manufacturing, taking the manufacturing excellence of India and using it kind of as a hub for growth. So I think you have to be willing to lean in. And we are at Tenneco. We continue to invest in manufacturing. We continue to bring in world-class technology, again, to meet the very specific needs of India, but also the specific needs of the globe, and take advantage of the world-class talent from the folks in the plants operating 24/7 all week long to the very skilled engineers and leaders. There's a tremendous amount of capability in India, and we're very excited about that going forward.
All right, Jim, thank you so much for joining us, giving your view on some very contentious and complicated issues around tariffs as well. The whole world, the Indian auto industry is watching very closely, and we want to see how much of the US auto industry will come and invest in manufacturing in India over the next 5 years as well. Thank you once again for being with us here on News Center.
Very good. Thank you so much. Thank you.
With that, we come to the end of this special broadcast. Thank you for watching. Goodbye.
Provided throughout the war. Additionally, America is keen on securing Ukraine's mineral resources to reduce its dependency on China, which controls 75% of the world's rare earth deposits. This is according to the Geological Investment Group. Now let's return to the deal itself. Both Ukraine and the United States had agreed to give the US access to Ukraine's rich mineral reserves, with revenues diverted to a joint US-Ukrainian fund. Ukraine holds approximately 5% of the world's mineral resources, which Trump seeks to secure. However, not all of these resources are currently exploited or easily exploitable, and some lie in territory which is occupied by Russia. Ukraine is known to be the producer of several critical minerals. It ranks as the world's 8th largest producer of manganese, which is according to the World Mining Data, the 11th largest graphite, which is essential for electric batteries. Ukraine also possesses 20% of the world's estimated graphite resources, according to France's Bureau of Geological and Mining Research. Additionally, it claims to have one of the largest lithium deposits in Europe. However, there's another interested player in this game, Russian President Vladimir Putin. He has suggested that he's open to cooperating with the US on rare earth minerals and has expressed support for US investment in Russian-occupied regions. While Zelensky has expressed confidence that relations with Trump can be salvaged and that the Trump administration won't cut off assistance to Kiev, the world is closely watching Trump's next move.
Hello and welcome to the CNBC-TV18 special from the CNBC-TV18 Motilal Oswal studios. As markets continue to remain under pressure, the question most asked nowadays is, are we there yet? Are we at the bottom or close to this sell-off ending? And the sell-off has been quite painful. While the Nifty has lost about 16% in value from all-time highs, the small cap and the mid cap indices have lost 25% and 21% respectively. While the market peaked in late September last year, the real vicious turn in sentiment firmly to the downside is only about 45 to 60 days old. Is it just a plain vanilla correction after a few years of absolutely go-go fantastic markets, or is there some deeper underlying malaise at play here?
And to help us with answers, we have with us in the studio Ramdev Agrawal, who will be our guest editor for the hour. The other area, with Trump hinting at tariffs on pharma, how is the sector placed? We will be joined by Lupin's Ramesh Swaminathan to discuss all this.
Well, let's get the ball rolling then. Ramdevji, welcome to the show. Thank you very much. And always good to see you. Reassuring, and I think to our viewers as well, right? Who always see you as someone who has seen lots of markets, lots of cycles, and I mean, they learn from you. मुझे याद है हम 2 हफ्ते पहले हमारी बात हुई थी, आप बोल रहे थे जब पार्टी चलती है तो चलती रहती है, जब बंद हो जाती है, then it is to restart it, it becomes very difficult. टाइम लगता है. So अभी कब कितनी देर बंद रहेगी पार्टी और पेन कितना है यहाँ पे?
या प्रशांत, ये थोड़ा अनयूजुअल टाइम है. हर समय every time it is a new story. That's the beauty of the market. Like 92 was the first shocker we had. First there was a upward move of 7x in 19 months, and then collapse, vertical collapse from 4200 to 2500, and the market started moving from 700 to 4200, unprecedented in 19 months. So stories are always different. It was not backed up by earnings. It was just some kind of liquidity flow. 2000 Y2K boom. It was sectoral move, big time. Again it crashed by 50-60%. 2008 was again GFC crisis. The same 2003, 2008 build up and then crash. And every time the earnings are broken. This time the market has moved from 500 rupees EPS to 1000 rupees EPS for Nifty. And market extended from, say, 8,000 at the bottom to 25,000. So it went 3x. Earnings went double. So obviously market got re-rated big time. Now we are correcting that re-rating because earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. And despite that, we are doing 6.5%. Don't forget that. And now we are exiting probably March quarter with closer to maybe 7.5%, 8%. Let's see what comes. So I think we have set the mood. One, correction is done. The P multiple, which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So nothing stops at the average. It overshoots a little bit. So that is what is on now. If market corrects further from here, it is overshooting downside. Okay. So that's what we are in right now. How long it is? See, as you said, the all-time high was in September. It is not even 6 months that market is correcting. So after 4 years of relentless rally, if we are there for 6 months out here, last year we made 50% in the market, broad market I'm saying, and we have lost say 20-25%. So I think it is painful, I understand, it is painful to me also, but it is very, very logical. I mean, it's a proper healthy correction. If indices in small and mid had gone up by say 70-80%, they have fallen by 25-30%. And whose portfolio has done 70-80%, they have also fallen by 35-40%. So excesses in the market was very clearly visible. And regulator, government, worldwide investors, everybody was uncomfortable. So this is a very healthy correction. And now next year, earnings will pick up from 1,050 to maybe 1,150 or 1,200, whatever. And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. Government expenditure is picking up. So I think all the things are falling in place and correction has also happened.
So just to complete that point, Nifty, anything more now is overshooting on the downside.
That is my
Valuation
feel.
wise.
I mean, I'm just looking at the averages.
What about?
I don't look at the forward, nobody knows. We look at the last 10 years.
10 years.
Last 10 years, average about 20, 21, 20, half P multiple. Now it is sub 20. So yes, can it go another percent, another
Absolutely.
one? It can. Overshooting can happen, yeah.
What about mid and small caps? Because there, Gautam Dugar from your team was with us, I think the previous Monday, and he was telling us mid caps trade at a certain discount to Nifty, small cap index discount to Nifty, and I mean there the gaps. These are numbers as of last Friday, last Monday.
Yes.
Yeah.
So if you see today, in your money control, you can go and see 5-year, index performance. So index performance for Nifty is about 95-96% up on a 5-year basis. On same 5-year basis, mid cap is up 177-180%. So the gap is too much. If it was at about 100, 110, that I understand. So that excess gain, either large cap has to catch up to match mid cap, or mid cap has to keep correcting, time wise or actual downfall. So I think the divergence between mid and small is too high. Let's see how the market does. Maybe mid will keep correcting and large will make a move, or large will make a move but mid will stay there, and then it will catch up. So market does its own stuff. I think most important thing is now, don't wait for because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Okay. I have seen best of the chartists and all telling me, they're all eating their own stuff. So what I'm saying is, now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay. So if you like certain stock, and that stock is available at your dreamy price, and it has gone below that, don't hesitate, start moving into the market. That would be my suggestion.
Was just a generic tweet about the fitness of a sports person. It is not body shaming, it's about the fitness of a sports person. I always believe a sports person has to be fit. So I felt he's a bit overweight and I just tweeted on that. And I've been attacked for no reason, And when I compared him to the other captains, previous captains like Dhoni, or for that matter, Ganguly, Dravid, Tendulkar, Kapil Dev. So I put in and Virat. I put in a statement because I found him, I have the right, it's a democracy, what is wrong in saying it? So that is what you have to understand. So I just spoke in a generic manner and I fail to understand a democracy, we don't have the right to speak in such a manner.
we'll bring in Mr. Ramesh Swaminathan, Executive Director, Global CFO and Head of Corporate Affairs at Lupin. So pharma is another one of those spaces where Ramdevji has had lots of interest over the years, and it's a very interesting space as well. Go on.
Yeah.
Ramesh is with us.
Yeah. Ramesh, hi.
How are you doing?
Yeah. So, you know, one of the things which is your sector is has come back, and you guys are doing very well in terms of margins, exports and everything. And then suddenly this bolt from the blue is coming, where at least the authorities they're talking about tariffs of 25% or whatever. I don't know what numbers are going to go through, but what I heard is about 25% kind of a import duty for whatever is being exported called pharmaceutical to US. So how do you react to this thing, and does it have any legs? I mean, is it going to be renegotiated to lower levels, or will it create actually confusion to start with?
Let me begin with, in fact, the economics of the situation. 50% of, in fact, the generics for America go from India, and they actually import 70% of their generics, so to speak. The value of this is about $13 billion. And the economic value of this is close to about $408 billion. It's all about access to medicine, and this makes medicine accessible to the poorer sections of the American society, so to speak. The actual imports of medicines from America is supposed to be about $800 million. About $400 million is without tariffs, so to speak. When this is all about access to medicines, would he be in a position to actually jeopardize his own situation? Because if you raise tariffs, obviously it is going to mean that it's going to be more expensive to a large section of his population itself. I could actually look at 5 scenarios. There's a lot of talk, but nothing really happens, which could be scenario A. There could be a second scenario in terms of equalization. So as I just said, about 50% of the imports from America, which is about 800 millions, is really without tariffs, whilst the balance carries a 10% tariff. And it's quite possible that India could bring it down. And to that extent, even if there is an equalization levy, it doesn't actually mean anything at all because it comes down to zero. The third situation where he actually, talks about incentives to manufacture in America itself, and this potentially could be a long-term story, but as regimes last 4 years, so I don't know whether people would potentially look at actually setting up shop out there. And even if they do, one would like to be reminded that the cost of manufacturing in America is not going to be cheap. I know as a matter of experience that what costs about $6, $5 per 1,000 tablets could potentially cost about $35 to $40 out there, 8x in terms of manufacturing cost, conversion cost. And that's something which has to be, it's not easy for them to kind of digest something like that. And lastly, if you talk about import tariffs, from my perspective, I would say that this would actually be passed on to the consumer. And lastly, if it is not passed on, it really is going to be specific to individual molecules. Then potentially there would be a situation where some part of it has to be absorbed, some part has to be passed on. But there are far too many moving parts, as you can very well imagine. I would also add that this industry, it caters to the rest of the world as well. And America is not necessarily the El Dorado that it was some time ago. So a lot of companies are kind of diversified also. So from a sector perspective, whilst it is, of course, disturbing news, it's something that we need to contend with.
Yeah. But Ramesh, does it mean because of all this confusion and uncertainty as a capitalist, would you stop your growth investment for these markets? I mean, earlier everybody was trying to get US FDA and set up the bigger and better and the at faster speed the plants. Would that take a break?
There are two parts to this. America still remains the biggest market from a pharmaceuticals perspective. And certainly, it's a nuanced strategy that we follow. So we have, over time come down in terms of, and the industry, I'm talking about the industry itself, not necessarily Lupin, come down our exposure on more commoditized generics and so on, and focusing on the value-added ones. That will certainly continue because it's certainly very lucrative from our perspective and from the industry perspective itself. These temporary blips will certainly continue. But I see a long-term future which is pretty pretty rosy and pretty interesting, alluring from a pharma perspective.
Mm-hmm.
So you are saying that the business remains as usual and growth prospects. See, because when you buy stocks at 30, 40 P multiple, I mean, your sector is one of the most coveted sectors, which has created fantastic value, including Lupin itself in the last 15, 20 years. So they have been very highly valued at about 30, 40 P multiple. So do you think, I mean, and that is linked to the, very clear, unobstructed growth possibility for the companies. Now, is it becoming cloudy in the sense that you may, I don't know in what form the restrictions will come, whether you have to share part of the restrictions, the tariffs, because they are talking about reciprocal tariffs. Now, reciprocal tariff, apart from the pharma and auto, they are talking about reciprocal tariff at a country-to-country level.
Yep.
So I don't know where exactly it settles and when it settles. And after settling this round, whether it will another round, like so long as this Trump, this regime is thinking like this, it never ends. So as a businessman, I would be scared to put up $1 billion out there for the new, whatever capacity is there, that's fine. But the future commitments of $1 billion or something in India or someplace to cater to US market, you'll say, take a walk here, let's go to some other market and don't bother about it. Is it likely to happen like that?
As I said, I think we are, it's not as though we are dependent only on America. So essentially from our perspective and from the industry perspective, India is still a wonderful market, and there are exports to other parts of the globe as well. Though, of course, America remains the most important market, and any tariff change will certainly in some ways impact it. But I think I would say, as I said, I painted out 5 scenarios, and all of these are moving parts. It's difficult to conjecture what really would potentially transpire. It's from that perspective, I would rather wait and watch. But I would say it's not going to be all gloom and doom because it is really going to be specific to individual molecules. A lot of molecules have, a lot of companies in the recent past have also shed, in fact, certain molecules because they're not so remunerative. As you would know, the number of drug shortages in America, the number of drugs that are in short supply, have hit an all-time high. It's close to about 395, 400, only because the fact that a lot of companies have actually, in recent times, shed their portfolio for America. So if indeed it comes to a situation, and if they find it unviable, they will, of course, not export. But they would, of course, kind of work on more complex ones where there is going to be less potential of competition from America or any other part of the globe and so on. And that's reworking on their own strategies for more complex stuff and moving on to specialty and the like. But clearly, I think the investment mode is certainly going to be on. And the long term certainly does look pretty alluring.
Mm-hmm. Are you likely to shift the portion which is the generics which are made in US for US? Right now, I don't know what percentage of the total generics sale of Lupin in US is manufactured in US and how much of it is manufactured in India?
As I was just telling you, we do have manufacturing facilities in America, and of course, a larger chunk of it actually comes from India. The paradigm always has been low-cost manufacturing in India, low-cost R&D in India, and of course, exporting from out here. But we do have factories out there as well. But out of experience, I'm also telling you that the cost of manufacture in America is multifold in terms of cost vis-a-vis an Indian scenario. And from that perspective, manufacturing in America for the long term does not really make sense. But again, it has to be a nuanced strategy where, for example, we still have a facility in America for, in fact, the respiratory portfolio and the like. So it has to be really nuanced to, in fact, the therapy that you're speaking about, the product that you're speaking about, and the like.
Okay. Would you have the number, Ramesh? What percent, or as Ramdeep asked, what percentage of what you sell in the US is made in the US?
Oh, as from our perspective, about I would say, we export close to $1 billion from India, and what we actually manufacture in America is perhaps about about 8 to 9% of that.
Do you think, Ramesh, because Ramdeep, they've invoked with pharmaceutical products, drugs, etc., they've invoked the national security angle as well. It's not just about tariffs. It's not about raising revenue. They're saying, well, these are critical things. We want them made in America. But as Ramesh said, this is 4 years. What happens after 4 years? If the policy changes, you invest all of that.
Yeah, so that brings that's what I said. See, economics are clearly in favor of being made in developing countries like India or some other place. But the issue is that currently the confusion which comes in the minds of the larger companies or investment cycle. So that slows down. And that slows down the earnings profile of the companies whenever you slow down the investment cycle. So that was my question. Otherwise, the economics of these businesses are fantastic.
What, Ramesh, the other thing is, while we're talking about tariffs and Make in America, etc., with pharma, the administration seems to be looking at everything at a very base fundamental level in terms of how things are done, what can we change. What about licensing of drugs going off patent, those kind of things which have been working pretty well, right? Authorized generics. You think we've got the health secretary in the US who's also considered a pretty, he wants to do a lot of things which will, if he's allowed to, it will disrupt things. Do you think those will come under scrutiny at all? I've not heard or read anything of that sort yet. Any thoughts?
Absolutely. From my perspective, neither have I heard about, in fact, other elements of, in fact, their overall strategy. They do talk about, in fact, incentives for manufacturing in America. That's a nationalistic fervor seems to be running across several countries also. So that possibly is picking up momentum out there in some ways. But it's, of course, to be nuanced with, in fact, the complexities of that market itself, where 70% of it is actually being imported today. And the cost of manufacture is going to be pretty high. So far too many moving parts to comment. So we'll have to wait and see how it actually emerges.
Ramesh, just a quick question. In one of the scenarios, in the case of tariffs being imposed, you said the company will have to bear part of it and part of it will be passed on. What could be the extent that Lupin will have to bear?
No, I don't think it can't be specific to, as I said, it's really going to be dependent on a particular molecule, okay? And if we find that a particular molecule is not remunerative enough, we've actually not, we've never stymied away from, we've never been stymied from actually dropping that particular product from our portfolio. So that portfolio adjustment will certainly take place. And as you can see, there are close to about 395 molecules in short supply in America because a lot of companies have professed exactly that.
Amdiji, from a stock perspective now, just to wrap this up,
So,
just as Ramesh said, you can't make investment decisions based on 4-year administrations, right? You'll have to take a longer-term view in that sense. Similarly, you can't make investment decisions based on at least long-term investment decisions. So I've heard some say, well, look at India-focused companies now. US generic companies, perhaps they'll go through
this sector is, this one and tech.
Yeah.
Both are extremely, kind of export focused. These are two backbone of the Indian exports.
Correct.
So you cannot, the prospects of these companies are heavily dependent on what happens to the US exports or even non-US exports. So non-US exports are still fine, but US is the core where profitability is also very high. And Lupin has been particularly very successful in exporting to US with the complex generics and a whole lot of things they do. So, I think finally the logic will prevail. But right now, the confusion I see, my sense is the boardrooms will definitely behave differently. They will slow down till the clarity comes. Maybe the clarity will come in a month or 2 months' time.
Slow down investments and
Yeah, if you're pushing for a next expansion of your injectables or something by 200, 300%, seeing the market,
I think that you will kind of
that's
go slow. And
I don't know. I've not sat in any of these boards.
Yeah.
From outside, I would think that boards will develop a cold feet,
Well, it's a wrap from Rima, me, everyone on the team who put this show together. Thank you very much for watching, but regular programming resumes in just a bit after this quick commercial break.
Through my discussions over recent days, we've agreed that the UK, France and others will work with Ukraine on a plan to stop the fighting. Then we'll discuss that plan with the United States and take it forward together. The purpose of today's meeting was to unite our partners around this effort, to strengthen Ukraine and to support a just and enduring peace for the good of all of us. Yesterday evening, the UK signed a £2.2 billion loan to provide more military aid to Ukraine, backed not by the British taxpayer, but by the profits from frozen Russian assets. And today I'm announcing a new deal, which allows Ukraine to use £1.6 billion of UK export finance to buy more than 5,000 air defence missiles, which will be made in Belfast, creating jobs in our brilliant defence sector.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Trump's tariff levies against China, Canada and Mexico come into effect. Beijing retaliates, says it would impose 10 to 15% additional tariffs on US imports and impose export curbs on 15 American companies. Canada decides to impose 25% tariffs on $107 billion worth of US imports. Trump trains his guns on agri exports, announces plans to impose new tariffs on imported agriculture products from the 2nd of April, but doesn't provide further details. China's retaliatory tariffs target US farm products, including beef, soybean and corn. Trump's new tariffs rattle stock markets across Asia and Europe, but Sensex and Nifty managed to recover in late trade to end with marginal losses. Both indices have now declined for 10 straight days, the longest losing streak on record. US pauses all military assistance to Ukraine just days after the public clash between President Trump and President Zelensky. White House says aid is being halted to determine if Ukraine is making a good faith effort to achieve a peace deal with Russia.
विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे.
Prime Minister Modi asked India's manufacturing sector to step up to the opportunities on offer from the global supply chain disruption. Says India Inc. cannot view this as mere spectator and calls for big steps. IRDAI warns health and general insurers against rising commission payouts, says will impose a cap unless they take corrective action. Sources say that the regulator feels that insurers have misused the expenses of management limits by curbing their operating expenses to compensate for commissions. Cryptocurrencies crash after a sharp rally. Yesterday, nearly all gains from Trump's announcement to creating a strategic reserve have been wiped out. Ola's Bhavish Agrawal takes a leaf out of the Elon Musk playbook. Once again, asks employees to submit weekly reports outlining their accomplishments. The move comes amidst major layoffs at Ola, where the company is expected to cut over 1,000 jobs. Also on the show, we get you exclusive visuals from Prime Minister Modi's day out at Reliance's Wildlife Rescue Centre Vantara, situated in Gujarat's Jamnagar. Reliance's Vantara has been billed as the world's largest rescue, rehabilitation and conservation centre. Right, on to the big global story. The first shot in Donald Trump's much-wanted trade war has been fired. New tariff levies on imports from China, Mexico and Canada come into effect today. Most imports from Mexico and Canada will attract 25% tariffs. Canadian energy imports, including crude oil and natural gas, will attract a levy of 10%. The Trump administration has justified that the tariff hikes are aimed at stopping fentanyl smuggling across U.S. borders. The duties are expected to affect over $918 billion worth of U.S. imports from Canada and Mexico, two of America's biggest trading partners. Similarly, the U.S. government has also levied 20% tariffs against China, doubling the initial levy from last month. Both China and Canada have announced retaliatory measures against U.S. tariffs. China will impose additional tariffs of up to 15% on some U.S. goods from March 10th. The additional tariffs will entail an extra 15% levy on U.S. chicken, wheat, corn and cotton products, and an additional 10% levy on soybeans, pork, fruits and other dairy products. China has gone a step further and added 15 American companies to an export control list. This will prohibit Chinese exports of dual-use goods to these companies. Further, China has also included 10 American companies to its unreliable entities list. These firms will now be prohibited from exporting or importing in China or from making new investments in the country. Canada will also impose 25% tariffs on U.S. imports of alcohol, clothing and household appliances. The ensued tariff battle between America, Canada and Mexico will mark the end of a 3-decade-long tariff-free equation among the countries.
We are willing to resolve international concerns through dialogue and consultation with the U.S. on the basis of mutual respect, equality and reciprocity. However, we will never accept pressure or threats and will firmly safeguard our national sovereignty, security, and development interests. We hope the U.S. will work together with China to implement the important consensus reached by the two heads of state and return to the path of resolving issues through dialogue and consultation.
Are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that uncertainty is a kind of permanent change.
The stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation.
Donald Trump, with his self-confessed love for tariffs, is planning to train his guns on the agriculture sector next. He has promised tariffs on U.S. imports from the 2nd of April. Manisha Gupta joins us now. Manisha, Trump's latest move to upend the global agricultural trade system, what's on the cards?
Well, thank you for that. Yes, after steel, aluminum, cars, drugs and semiconductors, the U.S. President Donald Trump is readying on tariffs on agricultural products in a fresh salvo. Trump wrote on social media, and I quote, "To the great farmers of the United States, get ready to start making a lot of agricultural products to be sold inside the United States. Tariffs will go on external products on April 2nd, end of quote. Well, Trump's announcement, however, lacked clarity on the details of the agri-products that will be affected. The proposed tariffs are expected to raise the cost of imported agricultural goods within the U.S., but this will benefit the U.S. farmers. Meanwhile, China has retaliated into the Trump's orders to double the tariffs on Chinese goods to 20%. China will impose tariffs as high as 15% on American agricultural goods, including chicken, corn and cotton. Soybeans from the U.S. will face a 10% tariff. Over the years, China has also reduced its dependence on agriculture goods from the country. The share of soybean imports from U.S. has declined to 21% in 2024 from 40% in 2016. Its imports of American corn also fell to less than $600 million last year from $2.6 billion in 2023. However, cotton imports have surged marginally in the year. Now, where does India stand when it comes to this agri-tariff war triggered by Trump? Well, sources tell us that the country is resisting the pressure to reduce its tariffs on many products, as it would impact millions of farmers within India.
All right, thank you, Manisha, for that update. So that's the big headline that we are tracking as far as Trump's tariffs are concerned. Now, Trump's new tariffs rattled the global markets. Stocks tumbled across Asia and Europe. Automobile stocks are selling off across Europe as most companies use Canada and Mexico as their manufacturing base. The Mexican peso is also weakening rapidly against the US dollar. Back in India, Sensex and Nifty declined for the 10th straight day. This is the longest losing streak for the Nifty on record. However, the losses were limited as mid-caps and bank stocks managed to buck the downtrend in trade today. Amidst a clamour by foreign institutional investors for a reduction in capital gains tax, Nilesh Shah of Kotak AMC wants all investors to be treated equally. Speaking with CNBC-TV18, he said, just reducing taxes does not guarantee returns.
Just reducing taxes does not guarantee return. What if tomorrow FPI's demand guaranteed return? Will we succumb to it? I don't think so. We should be focused on creating earnings growth and governance. We have delivered better return than all the emerging markets put together. We have delivered better return than China, Brazil, Russia, South Africa. But my recommendation will be treat all investors alike, whether it's foreigner or whether it's local.
Shares of state-run oil companies like HPCL, BPCL and IOC surged in trade today as crude oil prices continued to ease to a 3-month low. This on the back of US President Donald Trump's decision to pause military aid to Ukraine and the imposition of tariffs on Canada, Mexico and China. OPEC Plus countries also decided to proceed with a planned April oil output increase. Cryptocurrencies took a major hit today with prices falling sharply. Prices of Bitcoin slipped nearly by 10% and other cryptos like Solana fell by 20%. This comes just a day after cryptocurrencies saw a price rally on the back of Trump's announcement of a US strategic crypto reserve fund. Prime Minister Narendra Modi has urged India's manufacturing sector to step up to the opportunities on offer from the global supply chain disruptions. Speaking at the Finance Ministry's post-budget webinar, PM Modi also said that India Inc. cannot view supply chain disruptions as a mere spectator and has called for big steps.
आज दुनिया राजनीतिक अनिश्चितता के दौर से गुजर रही है। पूरी दुनिया भारत को एक ग्रोथ सेंटर के तौर पर देख रही है। दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान है। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी, अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा।
The Petroleum Ministry has issued a demand of $2.81 billion to Reliance and its consortium partners, BP Exploration and Nico Limited. In a statement, Reliance said that this was pertaining to a long-standing dispute concerning gas migration from ONGC's blocks to the consortium's block. The government has raised the demand after the Delhi High Court Division Bench's order. Remember, the government had claimed a $1.55 billion on the consortium for alleged gas migration from ONGC blocks. However, Reliance won the arbitral award issued by the International Arbitration Panel in 2018 against government's claim. A single-judge bench of the Delhi High Court had initially upheld this arbitration order, but a division bench set the order aside last month. Shares of RBL Bank slipped 2% in early trade. This comes after the Maharashtra State GST Department conducted search operations at 3 of its offices in the state. In a statement, the bank said that the proceedings are ongoing and that it's fully cooperating with authorities. The Maharashtra State Tax Officer has initiated inspection of records at Poonawalla FinCorp's registered office. In a statement, the company said that the probe was initiated after search proceedings were issued by Deputy Commissioner of State Tax. The Bombay High Court has granted a 4-week stay on a lower court's order to file an FIR against former SEBI chairperson Madhvi Puri Buch and 5 other officials. The High Court has said that the Special Court directed the Anti-Corruption Bureau to register the FIR mechanically without going into the details of an alleged fraud in 1994. Right on to a CNBC-TV18 exclusive. The insurance regulator has issued a warning to health and general insurers to enforce limits on commissions and pass on the benefits to policy holders. Remember, insurance companies get the flexibility to decide their commission structure. However, the regulator has found that all benefits went to the agents and not to the policy holders. Yash Jain is here with all the details. Yash, take us through what you're picking up.
Well, certainly some tough talk coming from the insurance regulator IRDAI to the general as well as standalone health insurance companies. What has been the primary concern for the regulator? It is that general and health insurance companies are spending excessively when it comes to their commission payouts to the distributors to sell the various general as well as health insurance policies. If you remember, about 2 years ago, that was in April 2023, the regulator had given some relaxation to the industry in terms of commission payouts, saying that we will put a limit on the headline total expenses which any insurer makes, but under that total expenses, which has 2 elements, commission as well as operating expenses, we will let you decide, that is the insurers decide how much they want to pay as commission and how much they want to pay as operating expenses. Now, what the regulator, according to our sources, has observed in the last 2 years is that companies are paying excessively, and the growth in the commission payout has been very abnormal in the last couple of years. Now, as far as that high commission payout is concerned, that is being compensated by lowering of operating expenses to stay under the headline limit on the total expenses of any insurance company. What this does is that it restricts the insurance premium or the cost of insurance products to come down for the eventual policyholders, which was in the first place the intention of the regulator by putting a limit itself. This has been the large concern for the regulator. What we've been given to understand is that the regulator has told these insurance companies that when the expenses of management guidelines come up for a review next year, that is 2026, the regulator, if these insurance companies do not take corrective measures, which is reduce commissions and pass on the benefits to policyholders, will also consider putting a limit again on individual commission itself, which will be a big negative because that will restrict the kind of expenses which these companies can make towards selling those policies itself.
Right, thank you Yash for that. It's time for a short break, but coming up next, Ola's Bhavish Agarwal takes a leaf out of Elon Musk playbook. Once again, asks employees to submit weekly reports outlining their accomplishments. More on that when we return.
I think most important thing is now, don't wait for the, because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Okay, I have seen best of the chartists and all telling me they're all eating their own stuff. So what I'm saying is, now this is a time stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay, so if you like certain stock and that stock is available at your
Welcome back. US President Donald Trump has paused all military aid to Ukraine after his heated argument with President Zelensky at the White House last week. In a statement, the White House said that the aid is being halted to determine Ukraine is making a good faith effort to achieve a peace deal with Russia. Reports have said that this is not a permanent move and that the president has been clear that he is focused on peace. Ola CEO Bhavish Agarwal has pulled out a page out of Elon Musk's playbook. In an initiative that he has called Kya Chal Raha Hai, Agarwal has directed all employees across his companies to submit weekly reports highlighting their weekly accomplishments. Ritu Singh joins us now with the details. Ritu, take us through Bhavish Agarwal's plan.
Well, Bhavish Agarwal has taken a page straight out of Elon Musk's playbook, requiring all Ola employees to submit weekly reports detailing their accomplishments. Now, he has rolled out a new initiative which is called Kya Chal Raha Hai, which roughly translates to what's going on, mandating all Ola employees to email 3 to 5 bullet points of their achievements to him, to their managers, and also to a company-wide email address. Now, if this whole employee output report with bullet points sounds familiar to you, that's because it is. Elon Musk, in his role at the US Department of Government Efficiency, or DOGE, recently implemented a similar policy for US federal employees. He'd previously done this at Twitter as well. Now, Bhavish Agarwal in the past has drawn comparisons between himself and Elon Musk, even positioning himself as India's answer to Tesla. He's been vocal about his ambitions in the EV space, often repeating the phrase Tesla for the West and Ola for the rest. Now, Bhavish Agarwal has also previously enforced strict workplace policies, including cracking down on poor attendance, where in December in a letter, he had told employees to have, and I quote, the basic self-respect to not fleece the company by not even turning up for work, end of quote. He's backed Narayan Murthy's 70-hour work week debate. He's dismissed weekends off as a Western concept as well. So this latest message is not really a surprise, but the timing of this initiative does raise questions because Ola Electric is currently undergoing major restructurings and layoffs with more than 1,000 job cuts expected across departments. So while this may be framed as a move for accountability, employees may see it as added pressure amid growing job insecurity.
Right, thank you, Ritu, for that. Moving on, Maharashtra Minister Dhananjay Munde has resigned from his post after State Chief Minister Devendra Fadnavis asked him to. This comes after Munde's close aide was being named as an accused in the murder of a sarpanch in Maharashtra's Bid district. Now, Uddhav Thackeray-led Shiv Sena has strongly criticized the state government, stating that a resignation from a ministerial post is not the solution for the ongoing crisis. Dhananjay Munde is a leader of the Ajit Pawar-led NCP. For Pune, 2025 began with a health scare. Hospitals saw a sudden influx of patients suffering from GBS. Since then, multiple cases have emerged from Delhi, West Bengal, Andhra Pradesh and Karnataka. CNBC-TV18 Santya Gora and Shilpa Ranipeta report that GBS has claimed 25 lives so far.
Last year, 64-year-old Delhi-based realtor Rohit Gurtu felt a tingling sensation in his limbs. The pain spread to upper limbs and back. He ignored the pain for a couple of days before consulting his doctor.
I went and saw a doctor. Now this doctor made me do some tests like sodium test, potassium test, a brain scan and a spine scan, which turned out to be all clear. It's then that I went to a neuro and I told him my symptoms. He spoke to my doctor and he immediately told me I had GBS.
The Guillain-Barré syndrome, GBS, is an autoimmune disorder where the body's immune system attacks the peripheral nervous system. It causes weakness, tingling and numbness in limbs, and in some cases, it leads to paralysis.
It usually typically starts with a weakness. Weakness usually starts from lower limb going up to the upper limbs, but there are variants where it actually can start from the upper limbs and go down to the lower limbs. And there are some other variants where the cranial nerves, which are the nerves involved, which actually originate from our brain, they get involved as well.
The first GBS outbreak of 2025 was reported on the 9th of January in Pune. Since then, hospitals have seen a surge in GBS cases, prompting authorities to test water samples.
GBS is typically waterborne or foodborne. However, the health department has ruled out a foodborne outbreak as patients had no common food history. Authorities now attribute the outbreak to contaminated water. So far, over 7,000 water samples have been collected in Pune, with 138 testing positive.
GBS is non-communicable. Doctors suggest that if someone is experiencing weakness in limbs, double vision, and is unable to cough, they should immediately seek medical attention.
The treatment essentially depends on two aspects. One is to try and stop this autoimmune process in the body by stopping the destruction of the nerves. And the second would be supportive of whatever damage has already been caused.
Since the outbreak in Pune, cases have also been reported in Delhi, West Bengal, Andhra Pradesh and Kerala. GBS has claimed 25 lives so far, 21 from Maharashtra and 25 from the rest of the country. Doctors say immediate medical attention is the best way to deal with GBS, and a delay of even a day or two can worsen a patient's condition.
The central government has extended support to Maharashtra's health department in combating GBS. The Union Health Ministry has issued a set of guidelines to affected municipal bodies, urging the hospitals to monitor early warning signs and prepare a rehabilitation plan for patients. WHO teams are also on the ground assisting health authorities. In Mumbai with Shilpa Rani Peta and camera person Deepak, this is Santya for CNBC-TV18.
And before we wrap up this edition of Business 360, we leave you with visuals from Prime Minister Modi's day out at Vantara, situated in Gujarat's Jamnagar. Reliance's Vantara has been billed as the world's largest wildlife rescue, rehabilitation and conservation centre.
and it has gone below that, don't hesitate, start moving into the market. This time, the market has moved from 500 rupees EPS to 1000 rupees EPS for Nifty, and market extended from say 8,000 at the bottom to 24, 25,000. So it went 3x, earnings went double. So obviously market got re-rated big time. Now we are correcting that re-rating because earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown, every aspect of tightening by the regulators have happened. And now, and there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. And despite that, we are doing 6.5%. Don't forget that. It is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. Excesses in the market was very clearly visible. And regulator, government, worldwide investors, everybody was uncomfortable. So this is a very healthy correction. And now next year, earnings will pick up from 1,050 to maybe 1,150 or 1,200, whatever. And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. You know, government expenditure is picking up. So I think all the things are falling in place, and correction has also happened.
Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup space. Merchant SaaS platform Mintoke buys DigiLedge, marking the first acquisition in the central bank digital currency space. The deal will enable Mintoke's partner banks to offer more comprehensive CBDC-related payment solutions. Insurance Deco lands $70 million of investment. The funding will help Car Deco Group-backed Insurance Deco to expand its distribution network and strengthen its AI-driven solutions. FluxGen Sustainable, a climate tech company, received 28 crore rupees in a pre-Series A funding round. The funds will be used to scale FluxGen's AI and IoT-powered water management solutions, expand into new industrial markets, and strengthen customer acquisition. Ola's Bhavish Agarwal takes a leaf out of the Elon Musk playbook once again, asks employees to submit weekly reports outlining their accomplishments. The move comes amidst major layoffs at Ola, where the company is expected to cut over 1,000 jobs. Bitcoin declines over rising trade tensions and uncertainty around U.S. cryptocurrency reserve fund. Ether, the second largest digital asset, also felt the heat. Other cryptocurrencies, XRP, Cardano, and Solana, were also under pressure. Those were the headlines that we're tracking for you this evening. But on What's Brewing today, fintech firm Cred has forayed into secured credit offerings with Cred Cash Plus, allowing its users to borrow against mutual funds in partnership with financial institutions, with interest rates starting at 8.99%. Cred recently launched a suite of credit management tools aimed at helping its members improve credit scores, manage multiple cards, and access secured credit without liquidating investments. My colleague Ritu Singh caught up with Cred's founder Kunal Shah on the sidelines of that launch event for more. Take a look.
Kunal, thank you very much again for speaking to CNBC-TV18. Finally, you've forayed into secured loans. This is something you spoke about the last time we had a conversation. Tell me what prompted the move and what prompted it now?
Yeah, I think it was something that was always there in our roadmap, but we wanted to create a user experience that feels magical, right? So let's just understand the product first of all. Cred Cash Plus is basically allowing our members to borrow against their mutual funds in the most frictionless manner without any documents and without having to deal with a human call or any of that stuff almost in minutes and get very attractive interest rate, almost 8.99%. And the idea is that it's something that we thought it was always an ultra HNI product where you always saw that this big businessmen kind of borrowed against their mutual fund or their stocks and enjoyed the low interest rates. But we saw very peculiar behavior where members were kind of breaking their mutual funds or FDs to kind of, let's say, have a temporary vacation or, let's say, get a wedding in the family addressed. It doesn't make sense from a compounding perspective, right?
Sure.
Mutual funds work when you keep compounding them versus break them for, let's say, doing a temporary transaction. You've lost that momentum completely, right? But let's say you may need money only for 2 years, right? Or 1 year or 6 months. I think this product works well for them. We believe that it was a use case only for business folks before, but I think it makes sense for every consumer now. And the same consumer now, instead of getting 15-16% interest rate on personal loans, could get a very attractive rate over here. There's no foreclosure, and with secured credit score goes up, right? Which actually works really well for the members. And our model has been very clear: always encourage good financial behavior, always make the interest rates work for you and never against you.
You know, while I understand the philosophy behind this, you want to provide a seamless experience to customers. Interestingly, this is also coming at a time when the unsecured segment is slowing down. I know you've said before, the segment you cater to is not impacted, but the fact of the matter is banks and NBFCs you partner with to give these loans are slowing down on the segment. So did that play a role?
I think it just coincidentally got timed around the same thing. We've been building this product for quite a long time. Most products at Credit are usually cooked and baked for many, many months, probably quarters before we actually launch it.
Well, this started in November 2023, if you ask.
We started building much before that, so it's been a while before we started launching it. The reason it works out well in terms of timing, because you're right, the partners are quite ready to kind of do secured, but to get that experience working well for you to work across your demat accounts, all your mutual fund portfolios, valued correctly, given to you in a seamless manner, limits given to you in the most positive interest, like positively good interest rates for you, I think just doing that integration is a little bit of an effort because none of them have built these frictionless experiences before, right? And our goal was that if the ecosystem is demanding that and the consumer behavior is already shifting to that direction, be the one who's kind of being at the forefront of that. Also, our consumer segment actually has quite a few, most of them have a large amount of AUM on their mutual funds as well, right? And we noticed that less than 1% of AUM was leveraged, right? If you go to more matured markets, it's very easy to imagine 20-30% of mutual funds being leveraged, right? And why should this not be the case over here? It works out really well from credit score perspective. It works out well for banks, balance between unsecured and secured. So the idea is to just kind of keep building on that momentum. But more importantly, is this the right thing for our members? The answer is absolutely yes, and therefore build it.
Will there be some kind of FLDG involved with your partners, or how would you be offering these loans?
When you think about secured, first of all, we do not participate in FLDG in most of the businesses we do. The reason is that we focus on high affluent customers, low interest rates. So FLDG is not a business that you will see in low interest rate businesses, right? Secured, on the other hand, actually does not have risk because it's secured business, right? So FLDG is not a very prominent thing or pronounced thing you'll see in any secured businesses anywhere in the world. So what happens is that we actually facilitate for the banks and NBFCs to make it easy for offering these things on our platform. We make our small fees on top of that for facilitating this thing or as a cross-sell ability on our platform. But there will be no FLDG in this particular category because of the nature of the product it is.
I know you don't really focus on revenues and certainly not profits, but with these additional product lines, could you give us a sense when you're offering 8% kind of starting interest rates, what kind of additional revenue do you hope this will unlock? And will we see more unsecured or rather secured products from you in future?
First of all, I think it's not true that we are not focused on revenue and profit, but I think we are more long-term about our business versus trying to make that quarter win, right? We're trying to build a business that will outlast every single member that exists at Cred. And therefore, the choices we make are much more long-term in nature, right? If something is right for the consumer and makes you less money, but eventually you will be able to enjoy the trust of them for 2, 3, 4 decades, the amount of money we'll make will be actually much more than anybody else over there, right? So always focus on being long-term. Always focus on long-term revenues. Long-term partnership goes with our lenders as well. All of our partners we would be probably the largest partner for all of them because largely we focus on how the long-term partnership works, right? And if we are it's unsexy to build boring long-term businesses, but I think when it comes to financial services, that's the only way one should be building businesses.
Okay, with a long-term view, not really focused on short-term profits yet, but quickly a word on your loan book, which has crossed about 19,000 crores as of December. How fast is it growing, and what do you hope will be the contribution from the secured segment as you expand in this space?
Just a quick clarification, it's not our loan book, it's a loan book that
through your, yes, you do not lend from your platform, you do it with a distribution model.
Exactly. Yes. I think the growth rate is quite healthy. It's kind of keeping up to the market growth rates only. At least when it comes to prime customer, the growth rate is not slowed down as much as for the other segments. The growth rate is slowed down for high interest rate loans, short-term loans, and low credit score loans. When it comes to, you see the lenders are actually switching more towards more prime and super prime customers, right? Because they have demonstrated to be having much more resilience in these times, right? So we are actually seeing a decent amount of growth. Hopefully we'll announce numbers in the next financial results, but we are quite confident to continue the momentum. But we have been very proactive in ensuring that our promise to our lending partners is the best quality book out there, right? I think what we are able to prove in this time is that we are actually the best partnership that we can imagine, because even in these turbulent times, we've kind of been the absolute pristine book that they want to go after.
Well, some of the other products you announced today, for instance, customers being able to see their CIBIL scores on the app. What kind of monetization opportunities do you see from there?
Yeah, I think CIBIL score or building card management, these products are not necessarily designed from revenue backwards, but creating a good, responsible credit behavior. We want to create an ecosystem where A, we attract people who like being responsible with credit, B, attract the partners who like to lend to people who have these needs of solving for that, and every product that appeals to the people who are wanting to do responsible credit behavior is what we are building, right? So it's a self-selection of those customers, right? For example, people who are trying to take high interest rates, do misbehavior with the thing, may not appeal to this. Like, we are this over-alerting, over-protecting platform where we say, boss, protect your long-term reputation. So it's a self-selection, right? We want to aggregate the best quality customers that eventually everybody will care about.
On that note, it is time for us to head into a short break. But coming up on the other side is special coverage from Web Summit Qatar 2025. Stay tuned. Welcome back. You're still with us on Startup Street. With increasing pressures in the labor markets, humanoid robots are becoming more commonplace. According to a report by Goldman Sachs, the market for these robots is projected to reach $38 billion by 2035. Agility Robotics is one of the leading companies developing and deploying humanoid robots. In a conversation with me on the sidelines of the Web Summit in Qatar, Daniel Diaz, the firm's chief strategy officer, outlined the firm's growth story. Take a look.
So Agility's been around for over 10 years. It was born out of the University of Oregon. And they were creating robots really designed and focused on locomotion, bipedal locomotion. So 2 legs and moving around. I think in the last few years, the company's really focused on materials handling in the industrial space because there's such a huge need for labor. Right now, in the U.S. alone, I think there are over 1 million unfilled positions in materials handling, moving items from one area to another that they simply can't fill the jobs. These are repetitive, injury-prone jobs, lots of absenteeism, lots of turnover, and so humanoid robots with 2 legs and 2 arms are a great fill for that massive labor gap that just keeps on growing.
And, you know, your robot is called Digit, right?
That's right.
And could you sort of tell us how Digit is different from any other robot that's out there in the market?
Well, I think Digit is the only commercially available robot right now.
Right.
It's the only one actually doing work. So we've got great customers, companies like GXO, the big logistics player, Schaeffler, huge automotive parts manufacturer. Digit is at work in those facilities, moving materials around and helping lower the cost of labor. And that is a big part of what we're trying to accomplish here. Fill that labor gap and do it at a rate that's competitive to what a fully burdened human would actually cost. And what the great thing about it is with human labor in these areas being so scarce, companies can now choose where they want people to play a role and where they want to automate through humanoid technology.
Right, absolutely. And, you know, you just mentioned that you're with players like, you know, Schaeffler. You're also with Amazon, right?
Also with Amazon.
Yeah, so if you could sort of tell us, you know, how are you building efficiency for these companies and how does the business model work?
Right now, I think what was really most popular is this RAS model, robot as a service. And so the way we price that is that, you know, we examine the actual labor cost of the task we're taking on, and then we price our robot based on a discount of that fully burdened human labor rate.
Right.
We get up and running within a facility within a couple of days. So really what the customer is seeing is almost instantaneous ROI because of the pricing model. It works really well for Agility as far as the margins are concerned, and it's immediately valuable to the customer.
Absolutely. So, you know, you're looking at this RAS model, as you said, but where do you see the future of this? Where do you see these humanoid robots being able to make a difference, even going forward in other sectors? Because right now it's back-end, logistics, you know, all of that. So where do you see this growing? What's the future looking like?
Sure. I think logistics is an area where there's clearly interest and need. Manufacturing is another one. We are getting a huge amount of interest in the automotive space. So Schaeffler's a good example, but the automotive manufacturers in Germany, the US, and Japan also becoming large customers for Agility. The pharmaceutical industry, retail, starting with back end, but then also moving onto the floor. Safety for humanoid robots, not just Digit, but all humanoid robots, is a very critical barrier to scale. Agility will be the first company to actually create a robot at the end of 2025 that can safely work in close proximity with people, which means these safety cages that they work in right now disappear for us. And then the ability to deploy at scale is almost infinite for us.
Yeah, so what is this new robot looking like? What are you going to call him?
So it'll be the 5th generation. It'll be Digit. It'll be the 5th generation of Digit, but it'll have this cooperative safety capabilities and a battery life like nobody else. So we'll have a 10-to-1 charge ratio on that battery, which means 10 minutes of charging, 100 minutes of work. So that robot's capable of working 20 hours a day, and it's capable of working in close proximity with people. So for us, that's the last big barriers to scaling this technology.
So, you know, when we talk about robots working with humans, what does this new workforce look like, right, going forward? Because, you know, we're going to have the robots, we're going to have the humans. How do you see it impacting jobs? Are we taking away jobs with this robotics? Are we just creating efficiency? How do you see the new age, you know, office space look like?
Sure. Well, right now we're focused on the industrial space, and I don't see robots doing office work anytime soon. And what's great about the areas that we're targeting is there's a huge need because of that labor gap.
Yeah.
So I don't see robots taking away jobs. I see them fulfilling tasks that companies are having a hard time finding people for. Eventually, the robots will get more and more capable and more dexterous and safer. And then we'll have to think about what we're doing and where we're deploying people for the jobs that people are really great at. Jobs that require creative, critical thinking, digital jobs, managing these fleets of robots, maintaining these fleets of robots. That opens up a whole new set of possibilities for human workers that just don't exist right now.
So how many of your robots have been deployed right now? How many of your robots are out there, digits?
I think with the various generations of Digit, there are over 100 robots that are out there, whether they're in academic research facilities or in companies. With the U.S. Navy, we have robots that are all over doing great tasks. The biggest opportunity for us, though, will be this next generation of Digit that's coming out, which will really open up the possibilities.
Absolutely. And what's 2025 looking at in terms of how many robots you're going to deploy out there in other companies?
Sure, I think we'll have, by the end of this year, probably close to another 100 robots that have been deployed doing, advanced proof of concepts and pilot programs, and then actually fully being deployed. And then 2026, that number seems to just grow and grow. We've got a factory in Oregon where we build these robots that has a capacity to build over 10,000 robots a year. And so we're ready. We're ready for this big scaling moment.
You're ready for this big scaling moment. So then talk to us about the global expansion plan. Where will we see Digit robots out there, apart from the U.S.?
Sure. So, of course, the U.S. was our primary market. I think Europe is next for us. The demand there across the manufacturing sector is huge. Schaeffler's a great example of a strong foothold now in the European Union. Asia, Korea, and Japan specifically, there's huge interest there, and we'll continue to grow from there. But those are the markets that we're going to primarily target.
So, if we talk about the Asian market, is India part of the picture? Where do you see India in this robotics game?
I think that's obviously a huge possibility for our opportunity for us in India. I think we have to think about the labor rates and what the prevailing labor rates are and whether the economics of humanoids at their current cost structure makes sense. But I absolutely see that as a market, as the Indian market, labor market continues to evolve and grow and change. Humanoid robotics and automation will become a bigger part of that economy.
We get you more from the Web Summit in Qatar. On the sidelines of the summit, I also spoke to Jim Bankoff, the CEO of Vox Media. He believes sky is the limit when it comes to AI. That's not all. He also spoke about the company's global aspirations and his desire to enter the Indian market. Here's a slice of that conversation.
There's a lot of different places where AI is going to be important. Some are predictable and most are not. So I will say for our business, first of all, we put human creativity still at the center. So we ask ourselves, how can AI help elevate and enable human creativity like never before? We have a few applications that we've launched in our own portfolio. One of our media brands is called Eater, and Eater helps people discover great places to eat and food. There's so much content that our reporters are coming up with every day. We've used AI to make that content more accessible, so value. So we're exploring all of it, and really, the sky is the limit in terms of opportunity.
So you said that, you try to keep it human-centric and you use AI to sort of boost that. But also the other bigger issue right now is while we have professionals who do this work, we've also got the advent of social media. We've got so many, social media creators who now also are partaking in journalism. So how does this pose a challenge or a threat to, let's say, traditional media outlets?
Right. Well, first of all, I think it's wonderful that media is so accessible to people, creators. We work with a variety of creators. We help them grow their audiences. We help them monetize as well. We have a whole part of our business. Frankly, the fastest growing part of our business is called the Vox Media Podcast Network. And it's podcasts on YouTube, it's podcasts on TikTok, etc. And so we go out and we find great creators.
Deep fakes and, misinformation has become such a big problem in a social media era, right? So how do you sort of circumvent this? How do you use AI or technology to sort of, stop this?
Yeah, well, first of all, I think part of the value, you asked me, there's so much change, and media is always defined by change, technology, change of taste, change of the economy. And so we always have to stay on top of it. But one of the things that I find is that the consumer has a place for trust, and trust is really paramount, and we're smart people and we can sift through over time. Maybe you can fool us once, but over time you can sift through what is trustworthy and what is not trustworthy. So we, like CNBC, like other great media outlets, have to find ways to provide that trust. And I think technology can, if channeled the right way, can play a role in helping to identify what is trustworthy and what is real. And I think ultimately over time, there's going to be demand for that. And if we can do our jobs well, I think the consumers will trust us and the consumers will value us. And the algorithms that support the discovery will also surface us in the way that they should, because it's in their best interest to do so.
Right. And speaking of that, how do we ethically use AI? What sort of guardrails need to be put in place? And does the industry do that, or is that something the government needs to do, or do both need to come together? So what kind of guardrails are needed to protect people from AI, their privacy and data?
Well, there's so many moving parts to answer that question successfully. I think ultimately it starts with empowering consumers, giving them the tools and the algorithms to have the choice and the say in how they consume this media. And then, of course, there's a role of educating people to understand where there's disinformation, understand how they can kind of take control and get the information from the places that they trust and they value. That will be each individual's choice, and they have to be given that choice. And I think technology can assist that. I think government can play a role, but I think it's also incumbent on the free enterprise to make sure that they are acting responsibly, because ultimately it's in their best interest to do so. And I think there are plenty of good actors. There's a lot of things that need to be figured out. There's a lot of opportunity for exploitation. There's a lot of bad things, just like in any other industry, that can happen, and we have to be on alert for them. We have to allow innovation to foster, so we can't overdo it, but we have to be smart, and we have to continue to iterate through that.
Yeah, so you have to use it responsibly and not have too many guardrails in place as well to sort of dampen innovation at this point.
That's right. Learn, test. Some guardrails make sense, of course, but we have to be careful because things evolve, and what might be a good prescription in one area can change very quickly based on how technology changes too. And so, I think often it's the responsibility of the companies that are producing these technologies to make sure that they're on top of it. And again, in the long term, I would hope it's in their best interest to do so as well.
I just wanted to ask you, what's the Vox Media expansion plan? Are you eyeing other markets? Are you looking at India at all? Are you planning on entering the India market?
I would love to enter the India market, but we need to be very humble as we enter the market. It's an enormous, thriving market. Yeah. I don't have to tell you that.
Yes.
But we are an American culture, and so we have to go about it in the right way, whether that's via a partnership or whether that's via working with people on the ground who are experts, not only experts in the culture and the taste of the journalism, but expert in the advertising markets, expert in the business markets as well. So we are very careful, that we're a very ambitious company. We have global aspirations, but we're very careful and we don't want to take an arrogant approach just because something works so well for us in North America and in the countries that we operate. I will say we already have large audiences in India who already go to The Verge or go to Vox or go to SB Nation, who listen to our podcasts. We reach large swaths of the English-speaking world as it is. Having said that, we do aspire to not only be American-centric, but to be global as well.
Absolutely. And what about the 5-year growth target for Vox Media?
We want to continue to serve large audiences, and we want to meet audiences where they are. We want to have a dynamic business model with revenue diversification. We see a lot of opportunity right now. All of the landscape of media, because it is being disrupted so quickly, that creates opportunities for companies like ours that are traditionally disruptors as opposed to ones that are less nimble. We have built a successful business model, but we are not tied to an old way of distribution. We are not tied to a printing press or a broadcast network or anything like that. And so we have opportunity to continue to innovate and continue to grow. And I expect and I know we will hold ourselves accountable for growing dramatically.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
So the first thing is about the values inside the family. And for us, the work was never looked at the balancing part of life. It was always something which was the biggest part of our life. Growing up, we saw our parents, both my father and mother, not only try to balance family and work, but make them both the biggest priorities of our life. And that's something that I've continued to embody as we have now been working in Reliance for the last 10 years. So the question of balance really does not come of balancing family or work. Both are the biggest priorities of my life. And there's one simple funda that I think we all need to embody, which is, your priorities of your life. And, as you grow older, your priorities change, but you want to make sure that your priorities are something that are very meaningful to make your life what you imagine it to be. And from our point of view, my family and my work are the two biggest priorities of my life, not only for this phase, but going forward also.
Yeah, that's a great answer.
Welcome to Indianomics. No surprise, the topic is President Trump's tariffs. He's not backing off the tariffs and in fact is indeed set to persist with imposing tariffs on Mexico and Canada. He has also levied additional 10% tariffs on Chinese goods. Chances are the affected countries are going to retaliate in some fashion. Now, how will these tariffs affect the US economy itself, considering that the most recent Atlanta Fed GDP nowcast data and the ISM manufacturing data for February are already pointing to a possible contraction of the US economy? Also, what are the takeaways for the global economy and for emerging economies like India? I have with me an economist par excellence who excels in several areas, Barry Eichengreen, Professor of Economics and Political Science at the University of California at Berkeley. Professor Eichengreen, thank you very much, sir, for sparing time for us. Well, first, can you start by telling us what may be the impact of these recent tariffs on the US economy itself?
Tariffs on Canada and Mexico, which will elicit retaliation from the two countries, are a disaster in general and for the United States in particular. The three members of what we used to call the North America Free Trade Area are intimately connected, intertwined with one another. The famous figure is that parts and components of motor vehicles assembled in North America go across these internal borders 6 and more times before they're completed. So interfering with that is going to raise costs, reduce efficiency, and be bad for economic growth here, and by implication for economic growth in the world.
Okay, well, sir, the Atlanta Fed GDP data and the February ISM manufacturing data are already pointing to a contraction of the US economy. Do you fear the US can actually go into a contraction for even longer, maybe a couple of quarters?
So the Atlanta Fed indicator is very noisy, very volatile, and not a precise pinpoint indicator. But I think it's getting the trend right, that consumer confidence has been declining. Consumers are unhappy over inflation still, and it becomes harder to blame that on the Biden administration. They're uncertain about the costs of maple syrup from Canada and avocados from Mexico. So consumer spending is softening, and consumer spending is 2/3 of the US economy. The other third is investment, and firms don't know what the investment environment is going to look like in a few weeks or a few months. So we're seeing inflation showing signs of accelerating because tariffs and tax cuts both are inflationary, and we're seeing signs of the economy weakening. The next thing that's going to happen, of course, is that Trump will take out against the Fed, because the Fed should be doing something about this inflation problem and this weakening economy. And if Trump attacks the Fed, that will only undermine investor confidence yet further. So I'm not hopeful.
Well, yes, I'm coming to the Fed, but so you're also a professor of political science. Now, if stagflation indeed becomes a reality and the markets start reacting, won't the president move away from these attacking tariff policies?
There has been quite a debate over the last months about whether Trump's tariff rhetoric is simply a negotiating device, or he really believes that tariffs are good for the U.S. economy. The higher, the better. We've learned that he really believes, and he's not going to go back to freer trade because he learns that they're not an effective negotiating tool. They only elicit retaliation. Similarly, he's a true believer in tax cuts. And I think having to choose between cutting taxes further and blowing up the deficit, he will opt for blowing up the deficit.
Okay, so inflation is still nowhere near the Fed's target of 2%. It's a good 60 basis points higher, actually. What's your overall assessment of the US economy, both growth and inflation?
Well, Latha, your words were looking very serious. And that's about the most positive or optimistic assessment I've heard recently. I think the economy does not do well in the face of chaos, and Trump is a chaos machine. So the odds of recession are rising by the day. I would expect, if the current stance of policy and Trump's current intransigence continue, that the US will be in recession by the end of the year, and the rest of the world doesn't grow with the US lapsing into recession.
Okay. What's your take on the implications of tariffs on India? Will the reciprocal tariffs actually take place? Or do you think even that could get diluted?
I think they will actually happen. I think there are a few national leaders who've done a good job at getting on Trump's right side. Keith Starmer of the UK and your Prime Minister Modi, partly because Trump so dislikes China, and India is a valuable counterweight in Asia to China. So I think there is a scenario where India avoids significant US tariffs, but it cannot avoid a significant US recession. So I think there are still very grave dangers for the Indian economy going forward.
Okay, time permitting, I'll come to that, sir. But what do you think will be the impact of the tariffs on China itself? Do you think China may react by devaluing their currency? How else may they react? How will the economy pan out?
As I understand it, today's measure is an additional 10% tariff on China, above and beyond what is already there. Because there were earlier tariffs on China, Chinese policymakers have been able to plan and adjust, invest abroad in Asia, do assembly of Chinese products in other Asian economies, begin to sell more to non-US markets. In all those ways, they can limit the fallout, limit the damage to the Chinese economy. In addition, they can retaliate strategically by banning exports of rare earths to the United States and other things that will encourage Trump to limit his tariff increases to 10% or whatever. I do not think that they will significantly devalue their currency, because that would damage financial stability at home in China, and because that would elicit more tariffs from Mr. Trump. So they're going to have to do the best they can with current exchange rates and current financial conditions.
Oh, that's useful, sir. In fact, we have seen some stability in the yuan between 7.2 and 7.3. But now the bigger question, how will the Fed respond? Inflation is persisting well over 2%, and the economy may start contracting, if not this quarter, the next. And on top of this, there is this Elon Musk threat that the Fed is overstaffed. So how will the Fed respond?
This is the worst imaginable situation for a central bank because resurgence of inflation points to the need for higher interest rates. A weakening economy points to the need for lower interest rates. That's a very hard circle to square. The inflation is clearly coming now, and the recession, if it comes, will come later. So I would be betting on rate increases rather than further rate reductions, but it's not a happy situation. And I do worry that President Trump has issued executive orders challenging the status of independent agencies in the United States, asserting his authority to dismiss the head of those independent agencies. The Fed is a little different because it's run by a committee and not by a single head. But the Supreme Court has said it's fine to dismiss a single head. It can say next, it's fine to dismiss the head of a committee. Financial markets will respond very negatively to any such measure undermining the independence of the Fed. And we will find out whether Trump still cares about the reaction of financial markets. He didn't care that they slumped in the US today because of his tariff announcement, and he stopped talking about them as well. So the widespread belief that financial markets will deter Trump from his worst instincts, that may no longer be true. So if the financial markets don't, and the courts don't, and the Congress doesn't, who is left?
Well, that's a real scary situation, Professor Eichengreen. I'm not done with questions. Professor Eichengreen is also an expert on India. He's also an expert on global currencies, international currencies. So questions on India and cryptocurrencies after we return, after a short break.
Thumbs up? All right, you got the thumbs up from the wife. Talking about your dad, MDA, obviously, Mukesh Ambani for all of us is the inspiration for our whole country. Everyone looks up to him. You have a mom who actually runs larger companies than 99% of our business people in India. So you have this like super achieving family. How do you step into these shoes? These shoes are like very large shoes to fill. And how do you manage, and what is your biggest inspiration?
You know, Harsh, biggest inspiration goes without doubt is the family that we've grown up with. We've all lived under one roof for now 32 years of our lives. And the inspiration is not too far to find in both my parents. I deeply value the human beings that they are and the work that they do. But the inspiration really does not come from, large items. Of course, the vision, the boldness, the ability to be very, very inspiring. It comes from the small things, like for example, till date, my father clears each and every email that is sent to him. And he does it till 2 a.m. at night, and he's working for the 4th decade of his working life. And that's where the inspiration really comes from. My mom, very, very similarly, like we'll be staring at the same thing. We share a joint passion for cricket, and we're watching the same TV, but the small little details that she notices is something that you can draw inspiration out of. And I think out of and above everything is their dedication is the biggest inspiration for everyone around us who are who have grown up around them. And that's really why we can say that the biggest inspirations, because we can tell all of the small nuanced things that make the difference.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the
Welcome back to a very special Indianomics. With me today, Professor Barry Eichengreen, Professor of Economics and Political Science at the University of California at Berkeley. He is both an India expert as well as a US and global international currencies expert. So, Professor Barry Eichengreen, thank you very much for your patience, for staying on. Let me come to India. You just wrote an excellent paper with Poonam Gupta of NCAER on Indian federal finance. Our third quarter GDP has shown a decent recovery. How may 2025 pan out for India amid the global headwinds?
India still depends heavily on the global economy. It's not as open to trade as China or Europe, but its fate still turns on the health of the global economy. And we have new reasons, both in the United States and now in Europe, because of the mess around Ukraine, to worry about growth in the advanced economies. And if the advanced economies stop growing, that will be a negative, no doubt, for India.
Okay. Well, sir, time permitting, I'll come back to India. But how does the new global political economy order look like to you? America was, for the last 75 years, the global policeman, seemingly supporting democracies. But now America and Russia are on one side and democratic Europe is on the other side. So how does the global economic order look to you?
Well, in terms of Ukraine first, and possibly the Middle East second, Europe is going to have to step up because the US is either disengaged or no longer a constructive force. Militarily, Europe has the problem that it still relies on US intelligence, air cover, military parts, and the like. So it will need some US cooperation. And there are questions even there about what will happen. Trump's latest announcement is that he is pausing all aid to Ukraine.
Yes.
By implication, he will not be providing to the European countries the support they need to aid Ukraine. So I think this is very worrisome. In the longer run, there is that famous phrase uttered by Jean Monnet, the father of the European Union: Europe is forged in crises. Whenever a crisis happens, Europe steps up and deepens its collective will and resolve, we will see whether that will happen now. It can't happen in a few months, but it certainly can happen in a few years.
Well, fair point, sir. You know, these are dynamic situations and dynamic reactions from countries. But nevertheless, I would like your view on what kind of a new international order are we staring at? It will definitely be different from the post-World War order that we are used to, first bipolar, then unipolar. But just tell us, how will the global economy and global political economy look like?
I think we are entering a new world order for the next 46 months, at least. That's the length of time before we have another president in the US.
Okay, I like that, next 48 months. Well, so the financial markets have been seeing the US as an exceptional country, US exceptionalism as we call it, and funds were fleeing from emerging markets like India and going to the US. This also meant a strengthening of the dollar. Now, do you think has US exceptionalism ended?
If you had asked me 6 weeks ago on Mr. Trump's inauguration day, I would have said U.S. exceptionalism is intact and the dollar's safe haven status is intact. John Maynard Keynes famously said, "When the facts change, I change my mind." What do you do, young man? And the facts have changed. I think this is the first real threat to the dollar's status as a safe haven that investors and central bank reserve managers are reassessing meaningfully for the first time in my lifetime, so that what has been a strong dollar will not necessarily remain a strong dollar.
Well, I'm glad you brought the conversation to international currencies and the dollar, because Trump's other announcement is a strategic reserve of cryptocurrencies. Now, how do you expect this reserve of cryptocurrencies to impact financial markets and indeed the dollar?
Well, Mr. Trump understands one thing about cryptocurrencies, which is that crypto companies and entrepreneurs have contributed a lot to his campaign and to his pocketbook, to him personally. But he doesn't understand, so far as can be told, the economic and financial potential, the upsides or the downsides of cryptocurrencies. So all this talk about a crypto reserve and the crypto summit in the White House this coming Friday, it's just talk, what Mr. Trump would call good television. I do not think that cryptocurrencies are valuable as a means of payment, as a financial vehicle, except for tax evaders, money launderers, people engaged in terrorist finance and other nefarious activities. Plain vanilla cryptos like Bitcoin or Melania coin are too volatile to be a store of value or to be useful as a means of payment. Stable coins are not stable because they're not fully collateralized more often than not. Central bank digital currencies are not going to happen in the United States because the crypto industry sees a Fed coin as competition, and they're going to be lobbying furiously and effectively the White House not to permit the Fed to go down that road. So I don't think crypto will support the dollar. Only a central bank digital currency issued by the Fed has that potential. And given the politics, it's not going to happen.
Yeah, but they may nevertheless disrupt the financial system. But separately, do you think the dollar will start weakening now, given the problems of the US economy?
I think the dollar will weaken. The now part, you said, will now begin to weaken. That's a little bit above my pay grade and a little bit above everybody's pay grade. We can only guess at these turning points. But I think more inflation, weaker economic growth, all this chaos around crypto and the possibility that financial deregulation in the US will cause more financial problems in the US all of those factors combined will make for a weaker dollar over time.
Oh, yes, chaos ahead. Well, to sum up, how would you have us understand how the US and the global economy will pan out in 2025? Just what should we be prepared for?
It's hard for Americans to be optimistic about the economy or anything else under current circumstances. So I do think that 2025 will be a year of accelerating inflation and declining economic growth in the United States, a dilemma for the Fed and difficult times for the people. If Europe begins to spend more on defense and relax its very strict fiscal rules, that may be something of an offset. But, you know, the old statement about if the US sneezes, the world catches cold, that's true economically, and it's still true. So could be a tough year for the world economy as well.
Oh, yes, indeed. The impact is transferred to us through real economy channels, financial channels, confidence channels. Okay, last two questions, sir. How will India pan out, you think? While it's true that we are connected, it has a large domestic-facing component. Will we be able to get away with fewer bruises to our growth?
India will be lucky with growth between 6 and 7%. I think that is achievable or conceivable unless the US really goes into the tank economically. Services are less likely to be hit by trade restrictions than merchandise. So India has some factors working in its favor.
Okay. Well, finally, sir, we have to worry about China as well, because financial markets have now started investing in China. There is a buy China trend. Do you think China has bottomed out?
I think China has probably bottomed out, but it will continue to bounce along the bottom. In other words, there will be no sharp pickup in growth until China deals with its financial systems problems in the banking system, in the real estate sector, in the corporate sector. China can grow at 4%, which is my best guess of how fast it really grew in 2024, but it will be hard for it to do better.
Well, Professor Green, out of time. Thank you very much indeed for giving us a 360-degree perspective of the global economy, of the US economy in particular, and India as well. We like your 6 to 7% hope about the Indian economy. I think we should be able to deliver, but clearly very severe global headwinds ahead. Thank you very much for joining us.
Entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Very importantly, tomorrow tariffs 25% on Canada and 25% on Mexico, and that'll start. No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow.
This is now a stagflation shock.
Hello and welcome to this special program. We are calling this the Global Reset under Trump 2.0. I'm Prashant Nair. The new U.S. administration under President Trump seems determined to upend the world order as we know it. From tariffs to security alliances, everything seems to be up for negotiation. How does one navigate this change?